build up the, we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Norwegian trade balance 58.7 billion, 58.7 billion.
Good morning. This is Bloomberg Markets Today. I'm Guy Johnson alongside Kriti Gupta and Tom McKenzie. Anna is off today. About an hour away from equity market trading. So what do you need to know this Monday morning? French political risk very much dominating the agenda. Campaigning officially gets underway today. EU leaders gather tonight in Brussels to discuss the next Commission president. Mario Draghi makes his case in a speech pushing for an aggressive European industrial policy. And in the UK, the leader of the Liberal Democrats, Ed Davey, tells this programme that the UK needs to get much closer to the EU if it's to lift its economy out of stagnation, Tom.
Let's check in on these markets then. European futures pointing higher so far, around 0.5%. But of course, the context is the sell-off that we saw last week, down around 2% by the end of the close on Friday, and diverging from the picture in the US, where the S&P ended up with gains of around 1.4%. We continue, of course, to monitor the political risk out of France. The FTSE 100 looking to gains of around 30 points, despite a bit of pressure coming through across the commodity space. 423 on your US benchmark 10-year yields, pointing high by around 2 basis points after the gains for Treasuries last week. 108, or 106 and 94, I should say, squinting at the screen, is the single currency, of course, after the pressure that the euro came under last week. Markets today starting right now.
Good Monday morning. Welcome to the show. There's a lot to digest. Look, we're talking about the markets. We're talking about kind of the fallout of what we saw last week in terms of the ECB, in terms of the Fed as well. But now this week, of course, in terms of monetary policy, we're going to be talking a lot about the BOE, plenty of economic data and geopolitical speak as well that's going to be dominating the agenda. But I think everyone is in consensus when we can say geopolitics also driving the market narrative, specifically coming out of France.
Politics going to be the entire agenda this week. The BOE is not going to be a big event this week, I don't think, but French politics is. The UK politics is starting to warm up as well, and I think becoming interesting as well. But the French political narrative really starting to churn these markets. We saw it last week. I've just been speaking to Michael Masika. He's going to be joining us a little bit later. And he was saying, you ain't seen nothing yet. If the left starts to gain traction, the impact on the French economy, the European economy, global markets, we are just at the beginning of this narrative. So maybe it's actually less of Le Pen and more of Mélenchon, though it won't be Mélenchon. It probably won't be Le Pen either, depending on who wins. But that's where the narrative is right now. French politics is having a big effect on global markets.
You mentioned politics, Guy.
I probably might have done, yeah. I think politics is going to be important this week.
Politics might be a thing.
Did I mention that before?
Yeah, is it politics?
I think it may be.
OK, it's remarkable. When you look at the poll, just a reminder, Macron's party is now polling third. To your point, around the fact that the left and elements of the extreme left have combined. And we'll see if that holds, of course, up to the first vote and then the second round. Does that start to break down? How sustainable is that? The socialists were part of the establishment. Now they're in bed with Mélenchon, with all the concerns about not just his economic agenda, but his political agenda as well, of course. We'll see if that holds. But for the moment, that is proving a significant threat.
Absolutely. It's interesting. Citi out with a note this morning. Beata Manthi out with a note this morning from Citi. We downgrade continental Europe from overweight to neutral in our global equity market strategy and upgrade the more growth-orientated United States. 3 reasons for the downgrade. 1, heightened political risk. Did I mention that? 2, narrowing market leadership. And 3, potential for a continued positioning unwind. Citi downgrading on politics this morning.
It's interesting that the narrative over the weekend is quite similar because, yes, there is always the debt sustainability issue, which I've been talking about for weeks now. This is kind of the nerdy take on what spending within the UK or within France may actually look like, which is going to potentially create some sort of third quarter 2023 market-esque move in the bond market. At least that's the fear for a lot of folks. But then there's that tariff policy that we're talking about. A lot of people are saying, look, this is really dependent on the U.S. election. Mario Draghi throwing that out of the water this morning, talking over the weekend a little bit about what Europe's approach to China should be, saying that actually we should be taking a more protectionist approach. The quote on your screen right now saying, quote, "We do not want to become protectionist in Europe, but we cannot be passive if the actions of others are threatening our prosperity," saying Europe is more vulnerable both to inaction on trade and to retaliation. So some strong words coming out of Draghi that could affect that industrial policy.
He wants a much more robust industrial policy. I just wonder whether he also wants Ursula von der Leyen's job. You've got European leaders gathering in Brussels tonight. Macron is going to be there. French politics, I suspect, will be dominant in terms of kind of setting the agenda. But who is next? Is it going to be von der Leyen? Is a weakened Macron going to change the narrative? How does Meloni play on the Draghi front? There's a lot going on here. But he is talking about a much more robust industrial policy. We're seeing it in China. We're seeing it in the United States. Could we see it in Europe? Is he potentially going to take that seat? The horse trading starts tonight, I think, in earnest.
And look, you've hit this before, Guy. How do you fund that industrial policy? If that more aggressive industrial policy, when Critty highlighting the constraints around the French budget that it is about, how do you fund that, and what does it mean as well for longer term inflation?
So listening to Draghi speaking in Spain over the weekend, he seemed to be signalling that he doesn't think that actually Europe will be able to fund its way forward in terms of this joint approach that it took during the pandemic, the next generation funds. He doesn't think that's going to be viable. But to your point, Tom, that is the most obvious route for figuring out how that industrial policy, investing in the green industrial transition, though voters don't seem so keen on that right now, and defence and all the other kind of things that we're talking about right now, he's less convinced, it sounds, that you could do that jointly.
I also find it fascinating, again, we're bringing it back to the market narrative here, right? There's so many cross currents, as Guy points out. And then how do you price it in these markets? And the reaction seems to simply be sell off, don't buy. You had Beata Manthi talking about it in the equity market. This week, I believe, we've got a bond auction coming out of France as well.
Thursday.
I want to say on Thursday,
yep.
Yeah. And I'm curious what that means in terms of just fund flows, right? Does that then create a bid into the UK equity market, the UK bond market, for example, ahead of the BOE? You're seeing some real strength coming out of cable, for example, on the back of it. Same story into the States. Do you start to see this kind of fund flow story simply as a function of not wanting to be invested in Europe right now?
So that's on the economics, and of course, the focus on the finance. But there's also a question mark, particularly around Marine Le Pen's party and Mélenchon's party, frankly, around their support or not of Ukraine, where they land on the question of Russia. And geopolitics was back in focus for us as well over the weekend with that peace summit over in Switzerland.
Absolutely. And European politics is really putting this in flux, to your point. It's going to be really interesting to see what does the next UK government do? Maybe less on Ukraine, but potentially on Israel. What does the next French government do? Potentially on Ukraine and potentially on Israel. There's lots of different things that could be changing over the very near future, and it's going to be interesting to see how that geopolitical story folds in. China, I think, is also interesting as well. The data that we've seen out overnight, what do you make of that? It seems that actually there's a little bit of a pickup in the retail, but overall the housing market remains really weak, and the industrial data remains really weak. And China, bringing it back to the Draghi stuff, feels like it's been increasingly hemmed in by the industrial policy, the tariff policy of the United States, and increasingly of Europe.
Yeah, absolutely. Where does China turn? It has this overcapacity. We talk about the EV structure. Can it continue to ship into Latin America and make up that Southeast Asia if the markets around Europe close or at least become more challenging? We know the tariffs are now in place, even as Germany, and Olaf Scholz pushes back. I think we're talking like the wider market impact now. You saying that the Bank of England is likely to be less important in terms of versus politics this week.
It feels like it's August or September for the Bank of England. It doesn't feel like it's this meeting, and they're also in purdah better in as much as they don't want to talk because of the politics. So it feels like you can park that one maybe for this week.
Temporarily, and then,
I agree.
and then come Friday, it feels like there's going to be some sort of reckoning, at least in the FX market. Euro sterling seems to be a little out of whack because of what you've seen in terms of French politics. We're going to dive into the market dynamics later into the show in terms of that. But you mentioned the South in terms of China and in terms of reaching out to Latin America, et cetera. This is a similar approach that Giorgia Meloni is using as well. Take a look at what she said in the G7. Not to bring it back to the politics here, but she was really talking about collaboration with Modi, collaboration with Milei in Argentina. This is significant, especially when we talk about where those inflationary pressures in the long term are going to come from. You see this kind of re-globalization, deglobalization, fragmentation, if you will, pick your word, when it comes to reassessing how these new kind of narratives are taking place, especially with tariffs looming over everyone.
Tariffs are inflationary. Inflation continues to be the big challenge right now. You saw it in the University of Michigan data Friday. Joanna Shu's numbers really highlighting once again this concern around the consumer, driven largely by this re-emergence, this re-acceleration, it seems, in the consumer's head to what is happening on the inflation front.
Consumer sentiment falling in terms of. So, at what point does a weaker consumer? The consumer is not. I mean, there's a political story to this as well.
Yeah.
But the consumer in the US is not feeling bullish. They're not feeling happy. We've seen the softness in the labour market. Yes, 4% unemployment. It's a marked number, of course. In the context of what we're seeing in Europe, still a relatively benign picture. But when does that start to have an effect and start to edge down and start to really weigh on the inflation story that, Guy, you were highlighting?
Well, it's interesting that we're talking about that because what are the odds that in just the last, we had pretty strong, better than expected CPI data on Wednesday. We had some interesting kind of commentary on Wednesday as well from Chair Powell. 2 days later, we see the consumer sentiment data that's completely indicating the opposite, and the market's reacting pretty heavily on the back of that. Maybe we'll get a little bit more color this week as well when we tend to get plenty of central bank speak coming out, not only today, but throughout the rest of the week as well. Whereas on Thursday, we get the BOE. They are in a blackout period. There's plenty of Fed speak, plenty of ECB speak in the meantime. Some of that coming out today as well. Harker and Lane, of course, due to hit the tape. On Tuesday, though, it's also lots of data as well. You got retail sales, you got Euro area CPI, and we mentioned the BOE on Thursday, but don't forget we had the RBA on Tuesday as well. We're talking about inflationary impulses. We're talking about the commodity story. The RBA can be a little bit of a canary in the coal mine when we watch that story. Plus, of course, the Norges Bank, the S&B, plenty going on there as well. And, of course, the Japanese CPI is one that we're watching quite a bit. I believe on Friday we talked about the BOJ quite aggressively in terms of what they're talking about. CPI numbers coming out of Japan. Very important.
Can I just pick up on one point? Because you talked about the flows from France into the UK. A headline dropping just in the last 5 minutes or so on the Bloomberg. The UK overtaking France as Europe's biggest stock market. There we go.
As of Friday's close, I imagine.
As of Friday's close.
Yeah.
And by the way, we won against Serbia. I don't know if there's a linkage there.
I only just, though.
Thank
talking
you.
about only
Thank you,
just.
Jude. Yeah.
Bellingham kind of. The rest of the team looking quite nervous. He didn't. He was the only player that didn't look. I've watched the highlights this morning. I went to bed early last night. I also didn't get to. I thought McIlroy might have it at one point. I genuinely thought at one point this might be the US Open, but no. I woke up this morning. Check my headlines. England won 1-0 just, and McIlroy didn't win the Open.
It's the volatility of Guy Johnson's sporting reaction to the results when he wakes up first thing.
I didn't check the markets this morning. The first thing I checked was what exactly was the outcome in the two key sporting events that I went to bed last night trying to watch two different screens.
Did you watch Germany-Scotland on Friday?
I watched a bit of that. Yep. To be honest. That was
my only
addition
value
you have a take on Germany versus Scotland.
I was Germany all the way. I said that, I think, on the air on Friday. And I think Scotland did
Where's my kilt? I need to dust off the Mackenzie kilt at this point.
I'm sorry.
Or maybe not. Sorry. Let's move on quickly. Guy Johnson. You've been talking to... McIlroy, back to the golf. You don't want to talk about politics.
I could talk about Ed Davey as well. Liberal Democrats on Friday. Funnily enough, at a football club. A soccer club, a football club, Isha Football Club, that's where I met him, in the rain and the wind and actually the lightning. But I had to say Ed Davey quite stoic in terms of his approach to the weather. Pointing basically to the idea that the UK is, if you want to reignite this economy, if you want to give, I asked him kind of, is this a business-friendly agenda? Because he's talking about raising taxes on business on a number of different fronts. He said, basically what we want to do is create an economy that has the staff and the people that it needs to be able to build the economy. But we also think that a closer relationship with the EU is the way to go in terms of revitalising this economy. We are the only party that's talking about that. So he certainly... It's interesting, given the turbulence we're seeing in Europe, how that kind of relationship with the EU could evolve, given the new kind of political narrative that could be evolving in Europe.
They've been a little bit more circumspect in terms of their views on rejoining the EU, haven't they? So he's talking about the time frame, wanting to give it time to join the single market. But a full embrace of the EU is not yet on the agenda.
No, he said, I asked him, why is it on page 100? He said, because that's where our international section is. But yeah, it's going to be interesting to see whether or not it would be more front and centre were he to win more seats. The leader of the Liberal Democrat Party talking to me over the weekend. We'll get more on that a little bit later. We'll bring you that interview with Ed Davey in the wind and the rain at Isha Football Club. Plus, we're going to talk about what is happening tonight. EU leaders gathering for summit talks with France's decision to call a snap parliamentary election, certainly looming over discussions. We're going to look at what we can expect. Mario Draghi, I suspect, is high on the agenda. If you want to join the debate this morning, there is lots to talk about this morning, isn't there? IB Plus, BBTV Go is the function on your Bloomberg. No wind and rain this morning. Look at that. Blue sky over London. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is a pattern of populist leaders being feared by markets and then getting elected and actually not doing that much.
From a market perspective, that maybe was the US in 2016, was it? Yeah.
Correct. And even in France, the potential for a cohabitation, for a parliament that is in the far right and a Macron president at the same time is not that bad.
Alberto Gallo, Andromeda Capital Management CIO, basically saying you don't need to fear the populist leaders, at least when it comes to this market sell-off, saying that it is actually indeed overdone. A little bit of a contrarian approach at the moment, given the sell-off you're seeing across the bond market, the equity market. Will add another view to that story. Michael Metcalf, head of macro strategy over at State Street Global Markets, joins us this morning. Pleasure to have you on the program. Is he wrong? What do you do?
Well, it's an interesting point, though, isn't it? Because I think we've been through a similar scenario with Italy, where markets weren't quite sure what to make of Meloni, and actually, since she's been in, markets have been fairly calm, and some of the more extreme policies haven't arrived. So, I think there is a precedent there, as in a past example, not a president Le Pen, obviously. But I think right now there's no doubt that the market is trading the narrative, and I think it just shows that markets were priced for perfection. We've been saying that for a while, and they're not really getting it.
But this feels kind of like a panic and sell and more of a fund flow story. What entices investors back into not just the French market, but the European market?
So I think you're right. So going into this, investors were neutrally positioned on Eurozone equities as a whole. Now, interestingly, they were already quite underweight the euro. So what I would look for actually is for the euro to stabilize first. So I think that's where investors were ready for some bad European news, and then maybe the equity market will follow. But I think it was just because investors were just coming back into Europe, and then they've just been hit with this surprise, because we didn't really factor in political risk in Europe this year.
Nobody saw the French risk coming, and we've spent a week and a bit digesting the fact that that is now a risk that we need to manage. Have we got to the point yet where we really understand, what if the left wins? People are talking about Le Pen. What if the left wins? The economic agenda that they're proposing is so out of kilter with what's happening in the rest of Europe. Do you think how far through this journey do you think we are? How quickly do you think markets are able to get their arms around understanding the scale of the risk? Not just the fact that there is a risk, the scale of the risk that potentially a left-wing win in France could pose. Wow, that's hard to say.
Yeah. Well, look, I think right now, and obviously I think you probably have to wait to the first round and the first round results and the polling going into it. But you can definitely, as you say, there are some quite extreme policies potentially on the table. Yep. But if they're just potentially, what probability does the market need to assign to it? So I think it's going to be dependent on polling and then the first round results, and then we see where we go from there. But I think right now we've gone from pricing in obviously no political risk to, quite a bit. There has been a movement, and as I said, I think particularly in the currency, I think investors were, they'd been reluctant to buy the euro all year and have been proved right.
How do you think markets would react if we get a more positive signal coming out of the next government in the UK towards the EU? Looking at a headline, front page of the FT on the website right now, Rachel Reeves to seek improved UK-EU trade terms if Labour wins the election. I spoke to Ed Davey of the Liberal Democrats over the weekend, very much pushing the idea that we need to have closer relationships with Europe, and that would be the way that you relaunch the UK economy. If you were to get that political narrative starting to develop and it was reciprocated out of the EU, how big a positive would that be for UK assets?
It's interesting. So while you were doing your sports reports on the way in, I was reading that article actually. Yeah. And it is.
You got to watch the game, so
I also got to watch the game. That's true. But look, I think this is a positive, potentially a positive story. The only thing I would just hesitate with is, and look, and we saw this in Mexico a couple of weeks ago, is that when you get a very kind of affirmative vote in one direction, the market seems to get concerned that there's no kind of check from the opposition. So I think that's just one thing to consider in the UK. But look, as the article highlights quite nicely, Labour in economic terms, it's almost continuation. So there's continuation of a lot of the economic policies, but then potentially closer ties to the EU. So that is all a positive. And the one thing that we note, which I think is interesting this year, is that while investors have been very reluctant to buy the euro, they have squared their underweight in sterling. And they've continued to square that underweight, even though you've had the earlier election announcement.
What is behind that? Is that BOE higher for longer? Is it the data looking a little bit more resilient in the UK? What is feeding into that?
I would
view
say
on the pound?
I'd say it's a bit of both. I mean, I think in general, sterling demand has correlated quite well with relative rate expectations. So I think it's a little bit of that. I think the flip side of it actually was that investors were becoming more doubtful on their overweight dollar position, but they decided to go into sterling, not the euro, which I think is interesting.
What do you do with the US at this point?
Yeah, so look, I think the US we're in a little bit of a holding pattern now because I think we're getting clearer signs now that the economy is softening, just at the point where the Fed has backed away from the immediate rate cut promise. So I think if it wasn't for the European election news, it would be very clearly a dollar unwind story. Because rate cuts can become to be priced back in as the economy softens. But I think we're hesitating now because we've got this European political risk.
I'm having a little bit of deja vu when we're talking about the U.S. and election risk and political risk and potentially tariffs over as well. Mario Draghi making some strong comments over the weekend talking about kind of that protectionist policy that Europe may have to embrace even further than it already has. In terms of the market narrative, 8 years ago in 2016, basically, when you're talking about this tariffs, it was a pretty easy equation to do. You look at the terms of trade, the country that's more affected by the tariffs, that's the one you sell off. Is it that simple this time around?
Well, I mean, the tariff narrative itself, if you go all the way back to 16, has changed completely. In that, when Trump was talking about tariffs in 16, it was, overwhelmingly seen as a negative thing, and it was only the U.S. And whereas now, we've got global industrial policy, so everyone is trying to kind of protect their own countries, and so I think it's a much maturer narrative now. But that said, obviously, look, I mean, we've just seen an incredible amount of volatility in the Mexican peso as an example, and so I do think that the tariff narrative is worth tracking because it is going to be a factor for markets, no doubt.
Is it too simplistic to say you buy protectionism or you buy defense investments? What is the green flag in terms of investing?
Well, look, I mean, I think, look, clearly because of international conflict, there's a very positive story towards defensive stocks and for the defense industry. So probably both, actually, you could say. But in terms of on the international side, you're going to look for the governments that have got the more proactive policy, ironically. So it's almost the reverse of where we were in 16, right?
The challenge many people have at the moment when they look at their portfolios is that tech continues to outperform. That is where you are. If you want outperformance, that is the place you've got to go. If you want a diversified portfolio, you have just got to accept that you are going to underperform that particular narrative. Given the political risk that we now face, we're building up to November. It feels like kind of Europe is the starting of this process. Then we're building up to November. Do you have to accept underperformance right now in order to protect your portfolio? Do you have to have that diversified portfolio and forsake the gains that tech are delivering just to protect yourself as you work your way through this year?
Yeah, look, I think that's right. And look, everyone is wrestling with the concentration in tech, and you look at the kind of the signals from small caps in particular, which are telling you there's a cyclical concern.
Yep.
Right. So that is real. So markets were priced for this perfect cycle, and it just isn't coming. That's the reality. But I think to your point on diversification, if we're thinking about political risk by definition is country risk. Yep. And so you have to be diversified internationally. And actually, I think in particular, I mean, interestingly, so I get no surprises for telling you, no prizes for telling you that biggest overweight is in the US and in tech.
Yep.
Flip side of it is in emerging markets. Now, we've just gotten through our emerging market risk, so that's where the underweight is.
Okay, Michael Metcalf, thank you very much indeed. Head of macro strategy at State Street Global Markets on the political risk in these markets and how to position. Coming up, French turmoil, talking of which, looms, of course, over the EU summit, which kicks off later. Stay with us. This is Bloomberg.
politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back to Markets Today. We're about 30 minutes from the start of today's trade. When you look at the futures picture, a little bit of green on the screen. Eurostoxx 50 futures higher by 0.6%. When you look at the bond market as well, you're seeing a similar story. Some of this just feels like even though the geopolitical risk kind of looms over everyone, perhaps a little bit of a technical paring back of last week's market reaction. 106.95, by the way, on euro-dollar. So you continue to see that weakness in the FX and the bond space. Well, let's get into why that is, specifically in France, where far-right leader Marine Le Pen says she won't try to push out President Emmanuel Macron if she wins the country's snap parliamentary election. Let's get a little bit more on these comments. In the context there, Bloomberg Stephen Carroll joins us right here on set. Walk us through the thinking behind these comments. Why is it so significant?
Look, this is clearly a pitch from Marine Le Pen to the centrist voters, to those voters that she hasn't so far managed to attract. She was asked in an interview with Le Figaro whether or not she would call for Emmanuel Macron to resign if her party comes first in the parliamentary elections, the first round of which is happening on the 30th of June. And she said she will respect the institutions and she will not call for institutional chaos. In her words, there will be simply cohabitation. This is the system where you have the president from one party and the prime minister from another. So essentially what she's trying to say is that she won't try to dislodge Emmanuel Macron from his job and perhaps cause more problems for the markets on one side, but also the governing of France on the other. This is interesting because we are looking at that party leading in the polls as well. The National Rally coming out 35% in the poll over the weekend too. It's a question also of how much the program, the economic program in particular, is going to be in focus for the National Rally as well. We don't have full details of it. Some of the measures they have announced, like cutting the rate of VAT on certain food products and also on energy, that's something that the French Finance Ministry has costed at around 20 billion euros. A concern when France's public finances are already in focus, and a worry for markets too. That's part of what we see in the reaction. On that point, Marine Le Pen says the financial markets will understand the economic program when they get it, and they will find it reasonable.
And Macron and his party, the Renaissance Party, being squeezed by not just the right, but the left as well, and the combination that's come together, that coalition, even as fragile as may be. What is the response then? What is Macron's party doing to fend off these dual threats?
Well, at the moment, they're essentially saying that both of these options will lead to chaos. The Finance Minister, Bruno Le Maire, from Macron's party, was out over the weekend talking about this, and he said that both the choice of the left alliance, which brings together the far left and the moderate left parties, and the far right, will make French people poorer. That was his message. He says that it's still possible for his party to win this election. Looking at the polls, as you say, they're in third behind the left alliance and the far right as well. we're into the heat of the election campaign now. Nominations for candidates closed last night, which means that people now know who they can vote for. The two-round electoral system means that you could end up in a situation, if you look at those poll numbers, where when it comes to the second round, people will have a choice of the left-wing alliance or the far right. Macron's party might not even be in the running. We saw protests over the weekend in France, tens of thousands of people out talking, opposing Marine Le Pen's policies on things, you know, part of her central policy platforms as well. That's part of the dynamic as well. It's also worth considering that this left alliance is quite fragile. That may not provide certainty either to markets, and some of those economic policies also a concern.
Everybody seems to be focusing on the threat from the right, economically. But if you look at kind of what the left is saying, potentially that has a much greater effect, to your point, on the French economy, on the European economy, on France's place in Europe, than the right does. Are we underestimating, is the rest of the world, is the rest of Europe kind of focusing too much on Le Pen as the threat and potentially underplaying the threat that the left poses? Certainly the markets are still trying to grapple with the right. It feels like they've barely even started to price in the left.
It depends on what you consider a threat. If we're looking at it from the market's point of view, we don't have the full economic programme for the National Rally. They say that they will aim for stability. But the issue with the left is this programme, this alliance, was thrown together in a hurry because it was a snap election. A lot of the policies that we see in the economic front are policies that come from the France Unbowed Party, the party of the far left. Things like blocking the prices of essential goods, you know, price controls, which we know don't usually have economically very good results. That's something that is very concerning for markets. The question would be is how many of those policies would make it into a final programme if the left party were to come out on top. And also this question of where Macron's party fits into this after the election as well. How many seats do they have? Will they be looking for coalition partners, or will they be frozen out altogether?
All right, Bloomberg's Stephen Carroll bringing us that crucial context on the various shades of the turmoil in France. We thank you so much. It's also something that's going to be looming over the EU Leaders Summit, which kicks off later today in Brussels. All over that story, Bloomberg's Oliver Crook joins us out of Berlin. Ollie, walk us through the dynamics at play in Brussels right now.
Yeah, so basically this is the first sort of actual EU leaders meeting since the actual election and the outcome, and this is where they basically come together and hash out all of these sort of top jobs. Of course, as you can imagine, they were all at the G7 meeting over the weekend. This is surely something that came up during those discussions, but this is the first time that these EU leaders sit down together in Brussels and start talking about the jobs. So listen, if we want to look at the actual jobs themselves, a lot was made about Ursula von der Leyen, what her position would be, how strong would she be as a possible candidate again in the European Commission, just given where the votes fell. Since the EPP did really so well, that seems to really have solidified her at the sort of top of the EU Commission. We also understand that Antonio Costa, the former Prime Minister of Portugal, will likely be the European Council President. That is a post currently occupied by Charles Michel. And then very interesting here, the Estonian Prime Minister, Kaja Kallas, the High Representative, to probably replace Joseph Borrell. She has been, of course, one of the most concerned, one of the most hawkish about Russia and Ukraine. That'll be a very interesting dynamic coming into this commission, particularly when there's been all these other discussions about potentially starting a whole other new commission within the EU on defense, which currently does not exist.
Ollie, what is the conversation around Macron likely to be within this meeting? To what extent is that going to overshadow these conversations?
Well, I think there's no way around it that this is going to just basically detract from his power and his ability to influence things. I mean, remember, part of the reason there was some questions about Ursula von der Leyen having another crack at the presidency of the Commission was that Macron apparently in sort of closed-door conversations in the back rooms was talking about maybe putting forward Mario Draghi. Obviously, he does not have the sort of wind in his sail to pull those kinds of stunts anymore, and he's really solely focused on what's going on in France. And even at the G7 meeting, we were there, went to one of the sort of scrums, the press, when Macron went out in front of journalists, no one was interested in his position on, these lofty subjects of global trade, Ukraine. It was all about the chaos that's going on in France, and that is just an absolutely huge distraction right now, not only for him, but also just detracting from his influence.
In terms of, therefore, who has influence, the Germans are also distracted at the moment. There's a lot going on there. Who has influence over this decision right now, and how different is that versus where we were even a few weeks ago?
So I think that what's really interesting is that, a few weeks ago going into this election, there were a lot of questions, again, around Ursula von der Leyen. She has sort of appeared as to being completely buttressed by this whole thing. I mean, she has a slightly bit of an abstract role as European Commission President. It doesn't sort of come with the same powers and sort of gravitas necessarily as a national leader, but she has definitely been reinforced. And of course, Guy, Giorgia Meloni, right? This sort of G7 was a kind of coronation of Giorgia Meloni and the sort of new far right. And this is really kind of the playbook that Marine Le Pen Pen, as we've been seeing and you were discussing with Stephen, is trying to sort of to play from, basically saying, we have historically been the far right, but actually we're actually quite reasonable on this, that, and the other, and you shouldn't be so afraid. And that is exactly what she has done. And she's basically the most effective and the most sort of powerful leader within the European Union as far as their sort of personal mandate goes right now.
Maybe we do discount Draghi. Maybe Macron's backing doesn't exist in the way that it once did. But Draghi is pushing forward this agenda that is much more protectionist, that feels much more akin to what we're seeing coming out of the United States, out of China to a certain extent as well. How is what he is saying, and others are saying as well, shaping what industrial policy is going to look like? How strong, how different will industrial policy look in this new commission, given the fact that this idea of this sort of passive industrial policy that we've had in the past here in Europe no longer makes the cut?
I think you're sort of disentangling this is really interesting. So first of all, Draghi has been tasked with coming up with this huge competition report, right? Some 400 pages. And what's interesting is we get these sort of speeches every couple of months where he sort of drip feeds kind of teasers about what he's going to be sort of talking about. This one was really based on productivity. But as you say, Guy, what's sort of interesting here was it was one of the most sort of aggressive and just sort of completely blatant advocating for the use of tariffs and the use of subsidies, not as a sort of to try to take an economic advantage, but to level the playing field. And that coming from Mario Draghi, sort of old school institutionalist of the EU, is, I think, significant. And I think also with the sort of EU that's tacked a bit more further to the right, this question of defense and industrial policy, this is going to be front and center. And maybe there is consensus there. Maybe there is a way to sort of move things forward. But again, the interesting thing with Mario Draghi, and again, this is probably my own bias, having spent so many years listening to every word he speaks of, there's so much in this speech sort of between the lines talking about, the Europe does not function like the United States. They're not willing to sort of do joint debt yet, right? Teasing to that. But then also the fact that they have a huge disadvantage because they don't have a federal budget, right? Is that another tease? Is that a conversation that needs to begin to happen in Europe? I think all of these things are on the table at this stage.
Okay, Oliver Crook, thank you very much indeed with the context around this EU summit. Ollie, we appreciate it. Coming up, we're going to take a look at your stocks to watch, including ING.
Bonds Germany 10-year spread jumps to 80 basis points as an all-time benchmark.
Profitability as it seeks to grow fee income. That's coming up. This is Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
This is Bloomberg.
Monday the 17th, 43 minutes past the hour. Welcome back. This is what you're looking at in terms of the picture around markets this morning. Equity markets feeling a little bit more positive, but keep an eye on the bond market. That is once again where the action is this morning. Take a look at the OAT Bund spread, France versus Germany, 80 bips. We're at 80 bips, folks. People were talking about 60 being kind of a point in time that we need to focus on. Then it was 70. Now we're at 80. How much further could we go? If you continue to see the left or the right gaining traction, is this something that goes significantly wider from here? Big auction coming up on Thursday. Let's get a take from Bloomberg's Markets Live, Ven Ram, to get a take on what is happening here. Ven, let's talk a little bit about what is going on. 80 bips. We're at 80 bips, OAT Bunds. How much wider do you think that could go?
That's going to go another 20-25 basis points further guy. Why do I say that? Because if you look at French bonds, the 10-year yield is offering around 3.22. If you look at the Italian yield, it's at 3.92. Now, Italian debt is rated much lower than France, of course, so the two are not comparable. But S&P already lowered the rating on France's credit rating to AA-. So the market's fears are what happens if the National Rally comes to power, or if the left coalition comes to power, or some combination of it. So the markets have to price that risk, and where that will take us is somewhere at an intermediate point between France and Italy. So that will mean about another 20-25 basis points on the French 10-year yield guy.
Is 100 bips between France and Germany sustainable? What happens at that point?
Well, it all depends on what happens after July 7th. If we get to know the results are more investor-friendly, then obviously French bonds will rally. If, on the other hand, the National Rally comes out and says, we're not as much to be feared as the markets are fearing us, our policies are going to be more market-friendly, i.e. the fiscal deficit isn't going to blow out, we are going to contain fiscal deficit, then that will send a message of reassurance to investors. That is when you want to pile back into French bonds. So over the long term, if everything goes well, if there is no Frexit, then 100 basis points or thereabouts would be a level to buy back into French government bonds. But that is not the point we are at yet.
But is there a new, in 10 seconds, is there a new fair value that is higher than it was but lower than potentially we're going to? In 10 seconds.
Yeah. That's about another 20-25 basis points in yield because the bonds are already trading at a discount. There's more to go.
All right, Ben, that's the bond markets. Don't go anywhere because I want to get your take on the FX market as well. There is a chart that caught my eye when we're talking about this dynamic that we're seeing in continental Europe. Of course, pressuring the euro. A lot of this has been French-driven. But take a look at what it's doing between euro sterling. It's this chart. It's a very simple one. We're just looking at the intraday moves year to date for euro sterling right now. And you can kind of see that between January to, I want to say, mid-April, before that red line really hits, it's kind of largely been trading in a little bit of a range. The idea here simply being that it's really all driven by monetary policy, really all driven by the inflation narrative until, of course, we've seen some real weakness in the euro, some of that coming off of the German data, but then, of course, really accelerated by the French story. On the back of that, you have seen the pound strengthen and really benefit from those fund flows. And it really just shows just how quickly that currency pair has weakened. That being said, Ben, this week, we've got the BOE coming out with their rate decision on Thursday, perhaps giving us a little bit more insight on their strategy as well. What happens to euro sterling on Friday morning?
I think euro sterling is going to stay on the defensive, because what is the BOE going to tell us? The BOE, of course, in June they are not going to do anything because we've got the elections in July. But beyond then, what are they going to do is the question. The markets are thinking they will get 2 rate cuts from the Bank of England. I think that's a tall order by the end of this year. Why do I say that? Because if you look at services inflation, it's hovering around 6%. Excuse me, it's hovering around 6%. If you look at the core inflation, it's at 3.9%. So, the real policy rate for the Bank of England is about 110 basis points, depending on how you pass it. So if that's not too much of a wiggle room to cut rates yet, which is why I think that sterling will continue to be bid, and the euro is going to be a lot more defensive because, as we just discussed, there's the French political risk, and that story has got further to play out. So investors are not going to be in a position to be piling back onto the euro just yet. So euro sterling is the best pair to reflect those sentiments where euro is going to be on the back foot.
Okay, more downside for euro sterling, more to be priced into the pound. What level are you looking at then, Ven? How much more upside do you see for the pound at this point?
Well, if you look at the options market, the volatility pricing is such that they are pricing in about a level of 82.80 in the next 1 to 3 months. So I think that is what the markets are bracing for. It doesn't necessarily mean that we'll get to those levels, but I do think that 83.50 or 83.20 is possible from here.
Ven, great stuff. Thanks for joining us. Really appreciate it. Ven Rom joining us from our M Live team. You can catch up with Ven. You can catch up with all the fantastic members of the Markets Live team. You can do so on your terminal. They're waiting for you. You can find them MLIV Go. That's the function. It's great stuff. Let's take a look at the single stock story we need to be watching as well this morning. Joe Easton's got the details of that. Joe.
Morning, guys. So we're starting in the banking space. We've got some pretty strong numbers coming out of ING in terms of their capital markets day. They've released a statement ahead of that investor conference and giving some guidance on their fee income, expecting €5 billion.
So at 3 Eastern Time, we do get Swiss KOF economic forecasts.
And also a 14% targeted return on equity through that period as well. Now, these numbers getting a strong reading as we're seeing some gains on the Tradegate exchange for this one already this morning. They've reaffirmed their CET1 capital ratio as well, potentially a good thing for their buyback outlook. Now, here's a stock on the year-to-date screen, done pretty well. There has been some easing concerns around the Dutch tax on buybacks, which has boosted that one for the market. And I think in terms of the analyst ratings, we've also got a good make-up there as well. 15 buys, only a couple of sells on that stock. But as I say, we are seeing some decent gains in that one this morning. Then in terms of the UK, we're looking at Hargreaves Lansdown because there's a bidding deadline coming up on Wednesday. An Abu Dhabi-led group has bid for the company, and that is the massive gain that we've seen in that stock this year. It's up around 40% year to date, but they have until 5 p.m. on Wednesday to make a firm bid. Now, one of the founders, Stephen Lansdown, was speaking to the FT at the weekend, and he was saying that they're not just concerned with the price, they want it to go to the right holder. And here's a quote from them: "Price is not the main consideration if it's not taking on the business the right way." So he says there's more to it than the price, but that will be key to see if this deal gets over the line later in the week. If we look on a 5-year view on this chart, it's down massively against where it was during the pandemic, given the boom in online investing at home. So that will potentially be taken into account when they're thinking about what price to accept. We can see a steep drop in that one, 45% over 5 years, with that bidding deadline coming up. Finally, we're mentioning Cristiano Ronaldo on stocks to watch for the first time because he is buying a stake in a small company over in Portugal called Vista Alegre, according to a statement over the weekend. There he is on the screen getting his head on a ball. But he is buying a 10% stake in this company. The company makes porcelain, ceramic, crystal glassware, some things we probably don't associate with Ronaldo normally. He is the 5-time Ballon d'Or winner and has a reported salary of around 200 million. The company's market cap is only around 150 million euros, so I think he can afford a 10% stake in that one. There's a stock over the 1 year, up 32%. You have to think that might be a positive if Ronaldo is getting involved. Keep an eye on that one on the small cap exchange over in Portugal today.
Joe, did you say crystalware?
I think so,
yeah. I could see that on a Guy Johnson shelf in the Manor.
to be fair, Ronaldo's got a lot of trophies, crystalware. I imagine that is
You think it makes sense. Joe, what do you make of the result? England?
We played well for half an hour, and then we sort of did the usual thing with where we crumbled away and almost gave away the lead. But yeah, we started with a win. We'll see where we go.
All right, Joe Easton, thank you very much indeed. Checking on the stocks to watch, but also with that football commentary as well, of course, with the Euros in focus for us. Joe, thank you very much indeed. Coming up, it is, of course, the market open. We're looking actually at a relatively constructive session, obviously, with the context of the sell-off that we saw in Europe last week. Currently, futures pointing higher, guys, by 0.7%.
Yeah, it was a tough week last week, though, wasn't it?
Yeah.
Just maybe a little sort of stability coming back in. Be interesting to see how sustainable ultimately that is as we work our way towards the first French vote. Politics, we started the show talking about it. That's the bit that the market, we don't know enough about what the French various parties are doing or proposing yet to make an accurate kind of assessment of what the risk really is.
But I think for the equity market, it's starting to become a function of what you're seeing in the bond and the FX market. So if you start to see real euro weakness, does that incentivize fund flows into buying kind of cheaper European equities? That's at least one take that may show up. Already you're seeing widening in the spread.
Isn't that already, though, a reflection, if you get a weakening euro, of money leaving Europe?
Yes, but it could also incentivize it, right? It's both. It's both. And I think if you're an international investor that's seeing, say, the FTSE 100 recently hitting a record high, for example, in the last, I want to say, 2 months or so, and you're looking for an option to buy, this might be it.
And there's a sweet spot, possibly then, on euro that some are looking at, and they think that's the sweet spot.
But does money come out of continental Europe and go into the UK market? I wonder whether that, if you want to keep money in Europe, maybe that's the switch that you make as well.
Yeah, especially when you're looking at maybe some of the stocks that are trying to benefit from, say, even the consumer resilience story. Isn't that been the theme that we're seeing overall? Even to access that, you need a weaker euro to incentivize that and even offset some of these stocks that are at really higher valuations. I'm thinking about your sensational six. You should be smiling right now.
Well, yeah, but they're ones, I appreciate you, but they are, a lot of those are dollar earners.
True. So you still buy them in euros.
You can, but then you've got to...
So 5 minutes time now, before we get to Swiss KOF economic forecasts.
Anyway, the market open is coming up. We'll talk about all of that next. Single stock stories to the macro. This is Bloomberg.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Monday the 17th of June, 2 minutes ago until the start of equity trading here in Europe. Doesn't look like we're going to see any real single stock action today. I'm just looking through the list of names out there. There's no kind of obvious, clear narratives that we want to talk about when it comes to single stocks. This is a market that continues to be dominated by the macro picture. What is coming out of France is having not only European effects, but global effects as well, and is likely to continue to do so throughout the rest of this week. This morning, maybe some stabilization, but it's going to be a long week. I think people kind of joke about a week being a long time in politics. This week could be a very long week.
At what point, after a 2% sell-off across European stocks last week, a 6% sell-off on the CAC 40, and a double-digit sell-off for French banks, do you decide that the value is now there to dip back in, that you start to assume that whoever comes in as Prime Minister is going to reshape around a Maloney character, and that you can afford to dip back in to French equities?
When I think you understand the risk. At the moment, you are understanding, you've got uncertainty, you don't have risk. Markets struggle to price uncertainty. Once they understand what the kind of various options are, then you can start kind of figuring that out. But we're not there yet.
So let's parse this through. On the one hand, so you have this macro risk. Does that create an incentive to dive into the heavyweights, the Novo Nordisks, the ASMLs, et cetera, the equivalents of your Apples and Microsofts in the States? Or does this create a kind of more of a play around the companies that have government stakes in them, for example, or government contracts associated? How do we think about this?
Don't know. That's not my job. Portfolio managers have got to figure that one out.
Give me something, guy.
But to your point about the euro, look at what is happening. Look at what that is telling you is that money is leaving Europe.
Or it's just FX people. Okay, this is a longer conversation around the.
But money is leaving Europe. People have made. It's not a kind of where in Europe. It's
The government sees 2025 CPI at plus 1.1%. The previous forecast was the same.
Are now open. We are expecting things to be fairly flat this morning. I think that's probably going to.
They see Switzerland's economic growth in 2024 to come in well below average.
We are barely budging. We're up by 0.1%. We'll see where.
Seeing 2024 GDP growth at 1.2%, previous forecast 1.1%.
Rotation within Europe, where are you rotating to?
Seeing 2025 GDP growth at 1.7%, previous forecast was plus 1.7%.
State-owned risk. Vinci is a name that instantly springs to mind out of France in terms of what happens with the high
And
rates.
seeing 2024 CPI at plus 1.4%. Previous forecast was plus 1.5%.
Europe effect, not only a French effect. Therefore, we are. To be to Manthey's point at Citi, we downgrade Europe in its entirety.
Well, this morning you are seeing some green on the screen as well. Your heavyweights is leading the charge. Your ASML, of course, is moving higher. It looks like I want to before I say this, I want to double check. ING, for example, also higher by about 2.3%. This is one of the companies that Joe was talking about as well. To your point about the downside, you're seeing a lot of commodity names on the downside. Tinto, for example, Glencore, Anglo American as well. The one that's catching my eye though is Total, and the reason I bring this up in the context of France.
Seeing Britain's FTSE 100 up 0.4%. Germany's DAX up 0.4%. Europe's Stoxx 600 up 0.3%.
That dynamic when it comes to that listing story?
I don't know how any of these parties would react to that. It'd be interesting to see how the left would react to that.
They probably want to just buy the whole thing, wouldn't they?
Well, I don't know is the answer. And I think that's the problem. But to Chris' point about what's happening on the commodity side, that's got to be China being priced in this morning, Tom.
Yeah, so the data, we talked about the fact it's mixed data. For me, it's really just a reminder, it's the property data. So yes, retail sales came in stronger, so it's just maybe the consumer is starting to feel a little bit more confident. It's very marginal, and the consumer's really not going to get on the front foot until the property crisis is resolved. And we got reminded that we're a long way from that, with new home prices falling the most since October, the end of 2014. They just have so much more work to do, and the constraint, it takes us to the Fed as well, because the constraint in terms of what the PBOC can do to lower rates, to some extent they are hemmed in by the higher rate policy of the Federal Reserve. But yes, for me, it was the property crisis. So that's what's dragging on things like iron ore, taking a hit. So we'll look at the miners on the back of that. So iron ore under pressure, and to some extent, you can expect that the oil price story as well is somewhat linked to that
Rio's
data.
down, Anglo's down, Glencore's down. So all of those stocks certainly seeing losses this morning, to Cree's point.
But they've also been the leaders in the past, I want to go a couple of weeks as well. You've seen this major bid into the commodity sector off of the macro that you saw as one. Total, by the way, I was talking about it, raised to an outperform at Grupo Santander this morning to an outperform from neutral, a price target about 72 euros, so 17% increase from the last close. So we're going to keep an eye on that. In the meantime, we are talking about this larger geopolitical story. How do you actually play it? Beata Manthe over at Citigroup, as we've said, downgrading Europe this morning. Here's what she had to say on Friday about navigating the risk.
Elections in France tend to be more volatile for equity markets than other developed markets. So that's number one takeaway, that perhaps this volatility could continue for a bit longer around French stocks, right? It doesn't change the underlying story of recovering EPS and recovering GDP in Europe.
Beata Manthe there of Citigroup talking about some of the sectors that she sees weakness in. Let's get a little bit more on this. We're joined now this morning by Bloomberg's deputy team leader for European equity markets, EMEA equity markets, I should say. Michael Masika joins us on set. Now, before I let Guy dig into you, what gets
I'll be okay,
investors,
don't worry.
What gets investors excited about Europe again, given that right now the narrative is all about the sell-off?
First of all, it's a small sell-off. There was no panic last week. That's the first thing I want to say. You had some exposure trimming, definitely, especially on French equities, on stocks.
That wasn't panic, what we saw in France?
No, that wasn't panic. I'm going to tell you what is panic.
Yeah, what does panic look like?
Panic is 1981, when Mitterrand became president of France and the CAC lost 30% in the first week, the equivalent of the CAC.
Oh, come on. That was like 40 years ago.
Yeah, the guy was in his 30s at that point.
But that's panic. And I was born.
Let's not rub salt in the wound. But still, a 5% drop in a week. I mean, come on, that's almost a technical correction, a mini one at least.
That's a mini correction. Yeah, that's a mini correction. I mean, as you can, the index got straight away became oversold in a week. There's a bit of rebound today, so people are kind of okay, I don't know what I'm going to do. What you do in market usually is you sell first, you ask question later. That's what people started to do. You have uncertainty, you don't know what's going on. Say, okay, you know what? I'm highly exposed. That's the thing. We came into that week, we came into June with a very high exposure to European equities.
Looking at the currency strength chart here, strongest is the Japanese yen, whilst the weakest is the New Zealand dollar.
Banks. And so when you have something like that, you trim your exposure, especially since you've been making tons of money on that bet. So you have to put that into perspective. So it's not panic selling. It's definitely trimming, reducing exposure, and wait and see.
Do I get to go now?
Go for it.
Okay, let's go back to Mitterrand and the 80s. The 80s were fantastic.
Told you.
Were they? Were you there?
Yes. If the left wins, say the left comes through strongly, how far through this process of understanding what is going on are we? At the moment, as you say, it's uncertainty, it's not risk. We can't quantify it. We don't know what the left's going to do. We still don't fully understand what the right would do ultimately. Maybe some more clarity there. If the left start to poll more strongly and if the left comes through this with the ability to form a government, was last week the warm-up act? What would that look like if you start to get some certainty around the left?
So the first thing is those legislative elections are highly unpredictable because it's a two-round election.
Yep.
It's very, very hard to assess what's going to happen between the two rounds. Coalitions, etc. I mean, what comes out at the moment is that regardless, we're going to have uncertainty because it's very unlikely there'll be any majority coming out of those elections. It's going to be a relative majority. So it's going to be hard to govern. And that's what people don't like at the minute. And that's what the market doesn't like. And that's what the market won't like after this election as well. So we need to have more certainty about the policy. Now, regardless if it's far left, far right, or if the center wins again and manage to get a government, if you get a Macron 2.0 or whatever, we'll have a place where the country is highly divided. And it's going to be hard to pass reform.
Right.
In any case. So now people are waiting to see if we're going to see, whichever party coming in and how the policy is going to evolve, because the policy will evolve. I mean, you've seen it in England. Liz Truss didn't hold her post very long because, the policy just didn't do it for the markets, and the market won in the end. Just because you have those constraints. I mean, France has a huge fiscal constraints as well. They've been downgraded by S&P. It's a tricky situation. So the margin that the stuff that they can do is limited. So, and I think the market will come to that at some point. I mean, in history, those sell-offs before elections are usually some of the best buying opportunities. So you will have some of that as well.
With the spread at about 80 basis points, and Ven Ramp from our Markets Live team suggesting it could go to 100 basis points, how should we be thinking about the ECB and how they're interpreting this? Does it change our estimates for the ECB, if we have any?
Well, first of all, the spread, the French, the OAT Bund spread, the widening is mostly due to the German yield coming down rather than the French one going up. So if you look at it like from this perspective, it's like the risk that is priced into France, okay, is higher than it used to be before that snap election call, but it's not crazy. It just went up gently. It's the German Bund that went down, just because the risk is shifting. So you go for something that's less risky, and that's what's going on here. So unless we see like a huge spike in the French yield, which would be like a clear pricing of like major risk, I say that there shouldn't be any impact on that.
In terms of the rest of Europe, what is the contagion? How do we think about France in Europe? How do we think about the perception of US investors of Europe when they think about what is happening here? Is France limited to France? What is the spillover effect? And if you're sitting on Wall Street, do you just go, to your point about kind of running home to the Bund, do you just, do I stay in the why would I park money in Europe given the uncertainty?
So first of all, in terms of contagion, there's one thing. The French equities are 40% of the Euro Stoxx 50.
Yep.
So that's like, mathematically speaking, the contagion is there. If you sell French equities, you're selling European equities, because the Euro Stoxx 50 is the most traded index. It's the one that you trade when you trade options. It's the future you trade. It's like everywhere in the world, this is the benchmark. So there is contagion here. It can't be denied. Now, for the perspective of foreign investors, I mean, Beata was saying it, Beata Menti from Citi was saying it, and that's the reason why they downgraded Europe today. It's general uncertainty. They don't like it. Foreign investors don't like it, so they'd rather go for something safer.
Do you just buy European vol then? That's picked up. So what are the hedges around this?
Yeah, so definitely European vol is one of those things. I mean, it's something we've been saying in the Taking Stock column pretty much for the past couple of weeks about, like, volatility is so low, this is the time to hedge, basically. And so the people who did that, they were prepared, and the one who didn't, now they want to hedge, but it's much more expensive. The cost of a put in Europe has shot up like massively. So yeah, you
buy protection when it's cheap.
Exactly.
When the sun is shining, not when the rain has started.
Exactly. I mean, even if it costs you a bit of money to carry, now it's more expensive. But it's still, it's still quite low. Relative to
history, yeah, definitely. Michael, always good to see you. Perfect person to talk to on a day like today, a week like this. Maybe we'll get him back a few times. Michael Masika, thank you very much indeed. Okay, let's figure out what's happening with the Core 6. This is what the big stocks look like across Europe. As Michael's been pointing out, a lot of these stocks obviously do have a French influence. Look at LVMH, look at Schneider. Both stocks are higher this morning. It's going to be interesting to see where investors ultimately hide out. Let's talk about some of the other single stock stories that we're watching this morning. Joe Easton, over to you.
So we have actually got a bit of exciting deal news. This time we're over in the insurance space. Not too much going on in deals, but today we are seeing Sampo over in Finland announcing it's going to buy the rest of the shares of a company called Top Denmark, which is listed in Copenhagen, and that is sending that stock up 21% this morning on the Copenhagen Exchange. It's the best performer we've got on the Stock 600 today. Top Denmark does casualty insurance, car insurance, that kind of thing, a bit of a broader operator. So it is a bit of deal news there. Sampo coming down around 3%, potentially a bit of a premium paid out for that one. Hargreaves Lansdown, we're watching that ahead of the deadline for the Abu Dhabi-led group to make a bid. That's on Wednesday. And then Vista Alegre, only up 1.9%, maybe expected more from that Ronaldo investment. Portugal play tomorrow, but that one is gaining around 2% at the moment. Cristiano Ronaldo taking a 10% stake in the glassware maker. In terms of ING, that is a decent move, up 2.3%. They've got their capital markets day today, and they are giving some really bullish numbers on their capital outlook that we discussed earlier in the show, targeting at a 14% capital ratio. Potentially that will benefit their buybacks going forward, and that stock gaining today. Then miners, you already touched on those, seeing iron ore once again down sharply, and the copper price as well, heading towards a couple of months low, and we are seeing some of the mining stocks in London in particular, where most of them are traded, coming down today. Rio down 1.4%, Anglo weaker, a little bit of movement in Glencore and Anto as well, so all pretty much red. Then staying in the UK, just a quick look at home builders, because we did get the latest Rightmove house price index over the weekend, and house prices in the UK are actually at another record according to that data. They did tick up in the latest year-on-year period, but interestingly there was a small decline in London house prices, which isn't something you see too much of. But there's Taylor Wimpey, Berkeley, Persimmon and Barrett all gaining at the moment. Only small gains in those stocks, but a decent number of green shares on the screen. In terms of a couple of ratings changes, SSP, this one absolutely slammed at the open of trading as Goldman cuts it to sell. It was down 5% at the open. This is the airport catering company. We know from their upper cross business in the train stations as well, but Goldman recommends you should sell that. Maybe a bit of weakness in the long-haul travel, something that we've seen recently. One more to bring you, Evertech. This is over in Germany. It's a biotech company, and Intron is predicting that they will issue a profit warning in the next few months because they think that there's competition coming from generics, and that's the second weakest one behind SSP on the Stock 600, down almost 4% for Evertech in Germany today.
Okay, Joe Easton from our equities team, thank you very much indeed. Plenty more coming up, including Guy's interview with the leader of the Liberal Democrat Party, a party that could end up playing an outsized role post-July the 4th. Stay with us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
We're the only party talking positively about engaging with our European friends and neighbours. We're talking about rebuilding that trust and relationships that have been so poisoned by the Conservatives. You know, when I talk to businesses, they say we're not investing in the UK because there's no long-term strategy, there's no real link up with Europe, and people are taking their money elsewhere. And I think that's really sad. And under the Liberal Democrats, you'd get a long-term, stable policy, and we're so committed to that stability, so we could tackle these issues about the problems with regulators, get better trade deals. That's the sort of climate that would attract investment. You know, when we were, for example, in government and running the energy sector, we saw tens of billions of pounds invested in the UK because of Liberal Democrat policies. We introduced contracts for difference, which were transformative in improving our electricity system and making it go low carbon. And that system of financial instrument was copied the world over. So I'm really proud of our record, I'm proud of our policies, and I'm particularly excited because in places like this, maybe a bit windy and a bit blowy, a bit rainy today, but the sun is shining on the Liberal Democrats.
I'm just waiting for the thunder to start, just to add to that chorus that you're speaking about. So basically, I can say with a degree of certainty after having heard what you just said that a vote for the Liberal Democrats is a vote to rejoin the single market. Is that pushing it too far, or is that fair to say?
Well, what we are saying is we're realistic about the time scale for that. It can't be done overnight.
Yep.
We've got to rebuild that relationship with our European colleagues. When I've spoken to European politicians like Christian Lindner, the finance minister of Germany, he says, look, there is a trade on the table. It falls a bit short of the single market initially because I'm afraid European friends don't quite trust the UK any longer. And who can blame them, given the way the Conservatives have broken the rule of law and treated our European neighbours? So we've got to build that friendship back. You can do that with a good trade deal to start with, and gradually over time we have a 4-phase process that could get us back into the single market, but it may take a while.
The thunder came shortly after this interview. That was Davey, the leader of the Liberal Democrats, speaking to me on Saturday in Esher in the heavy rain, talking, though, about a theme that does seem to be beginning to emerge within UK politics, and that is the relationship with Europe. At the beginning of the campaign, it feels like it's been largely relegated, left on the sidelines. But it's interesting, this morning, the FT website's Rachel Reeves to seek a, quote, improved UK-EU trade terms if Labour to win the election. Is that a conversation really about rejoining the customs union? To many people, that is something that could potentially be on the table were Labour to win. The Liberal Democrats obviously maybe taking one more step than that, and maybe talking about the single market. It's an interesting conversation. It's one that's beginning to emerge. I've been surprised at the beginning of this campaign that we haven't seen more of a conversation about the relationship with Europe, given how important Brexit has been in the economic data that we've been seeing.
Well, it was like Voldemort. It's like the topic that shall not be named up until now, as you say. So it's interesting it's come to the fore. Look, if you want that growth, 4% hit to GDP on an annual basis, £32 billion per year in the long term is the estimate from the OBR, the Office of Budget Responsibility. If there is one point of vulnerability for Labour and its plans that really stands out, it's how you price and how you answer the question about how you continue to fund the public sector. And they say growth. Well, if you really want growth, you rejoin the EU and you get that additional 4%, would be the argument from some.
Well, speaking of that growth, there's a chart I want to bring to everyone's attention because this is one that hit in the Brussels edition coming out of Bloomberg this morning, talking about what that business investment actually looks like in the UK on a quarterly basis. Now, stick with me here. You can basically see that on the right side of your chart, you haven't made that much progress since the Brexit referendum. That's that purple line or purple dot right there about in 2016. But compare that to the kind of carnage you've seen since the pandemic, since the great financial crisis, and of course, since those new UK-EU trade rules in yellow as well. laterally, net, it hasn't been that much growth post-Brexit. I thought this chart was really interesting because I've never really visualized just how little progress has been made.
Yep, it's been sideways. It's been stagnation. It's been better than anticipated in some ways, but it has been stagnation. And to Tom's point, the Labour Party's trying to figure out a way of not raising taxes, not increasing the burden, but increasing the perimeter, increasing the growth story in order maybe to drive some of the spending. Let's carry on the conversation. Moena Cunningham joins us now from our Markets Today blog, focusing on the UK. The EU conversation's beginning to make an impact. Ed Davey's been talking about it. The Labour Party's now beginning to address that. Why is it suddenly, do you think, starting to come to the fore? And how significant do you think this is? Is this actually a step change, or is this something that will happen over time, will happen gradually, is an aspiration rather than an objective?
Well, I think that's an interesting question because, looking at the polls, looking at what the parties have come out with in their manifestos over the last week, it's not the main talking point. They're much more focused on domestic policy, so things like housing. Ed Davey is mainly talking about the NHS a lot of the time, but today we have seen saying, that the UK does need closer ties with the EU. Businesses do need that. And we've had Labour Shadow Chancellor Rachel Reeves saying, that they want to have this sort of open window to Britain being open to business. And there is a big push to try and get, I think, the business community and the international business community back on board with perhaps some of the more anti-EU rhetoric we saw before, and particularly when you're seeing, I think, a swing to the right from the Conservatives in response to reform, that perhaps comes into play even more for the other parties.
In the same vein, we also got, as of Friday's close, I believe, that the UK stock market is now bigger than the French one as well. At the same time, they're losing a lot of momentum in terms of things like listings, et cetera. How long does that crown really stay on the UK financial market's head?
Well, that's a very good point, because of course, it's less than 2 years since it gave that title to France in the first place, and it's not necessarily a UK positive story. It's obviously France has got their own political turmoil, and that's really what's driven a rout in French equities, which has allowed the UK to sort of reclaim the title. But there is a positive news story there. You did mention companies are leaving, but at the same time we have had one IPO from Raspberry Pi, and there is actually some inflows into UK stocks, particularly with global growth. So a lot of those export-dependent companies have been doing very well. And there's also been quite a bit of M&A activity. So there is some momentum, which is a UK story, as well as it being the negative story somewhere else, so to speak.
Where is the focus for you when it comes to the Bank of England decision? Guy started the show by saying it's probably less consequential than the politics of particularly of France. What are you and the team looking at when it comes to that decision? What we're going to hear from the BOE?
Well, we will be looking obviously at inflation, particularly,
which drops on Wednesday, doesn't it?
Exactly. That has always been the key driving force for the Bank of England. I think it was not expected that there will be any change, this week, but we would next week. We would expect there to be some forward-looking commentary, and as we've seen, the Fed slightly changing course, and we've seen the EU pulling back potentially on its own bank rate decisions. I think it will be really interesting to see what level of divergence we should expect from the central banks.
OK, Moena, thank you very much indeed. Moena Cunningham from our Markets Today blog. You can get more analysis, of course, from Moena, the rest of the team, by going to T-Live Go. There's a redhead crossing the terminal just in the last few minutes. China launching anti-dumping probe into EU pork imports. You would assume that this may be part of the retaliation from China to those tariffs that the EU has put in place on, of course, Chinese EVs. Consequential, of course, certainly for markets like Denmark, I would have thought, a big producer of pork, of course. So China launching that probe into anti-dumping probe into EU pork imports, and of course tariffs could follow as a result of that. Plenty more coming up. Stay with us. This is Bloomberg.
News and Tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
All the time. What is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Monday the 17th, welcome back. 30 minutes into the equity market session here in Europe. Equities generally well bid in Europe. We're up by 6/7 of 1% across most of the main markets. Keep an eye on what's happening with the bond markets, though. You are seeing the OAT Bund spread widen out. We've hit 80 basis points this morning. That is a factor that we are going to keep a firm eye on as this week progresses. French politics absolutely dominant. But let's throw an extra element into the uncertainty story that we are covering this morning. We're now starting to get maybe a little bit of colour on how the Chinese are going to be reacting to those EU tariffs on the car sector that we saw last week. Pork sector looks like it could be in focus. It could be a focus on the Spanish pork sector. I'm assuming this means Iberico. It's the upper end of the kind of the pork industry. Yeah. I guess you could argue. Once again, the Chinese are going to look to European luxury as an area of focus to respond.
Yeah, look, they've said they would retaliate to these tariffs that the EU put on EVs. As you say, this seems to be the opening salvo in that. This gives them the optionality, of course, to put tariffs on these pork products. And as you say, Spain, the biggest exporter of pork to the Chinese market, they have launched this anti-dumping probe into EU pork imports. So we'll see how this evolves. The challenge for China is that they are also trying to chart this and create this narrative that China is indeed investable. They're trying to drive that foreign direct investment back into the Chinese market. So it's a difficult line for China to play at this point.
Well, I'm curious why they chose Spain in particular, given that, and I think we talked about this in the break, that Germany's pork industry is already under a ban from 2020. In your view, in your expertise, why Spain?
Well, I'm not sure that we necessarily draw the conclusion that it is Spain, as we say, is the biggest exporter to China. So they're going to, it seems, consequently, they would take the biggest hit. I'm not sure necessarily the thinking within the powers that be in Beijing would be let's target Spain necessarily. But as Guy says, is the higher end products, they can hit it's going to be a hit to consumers in Shanghai and Beijing and Shenzhen. Prices will go up in terms of these products if they can get hold of them at all. That's not a part of the demographic that the Chinese policy makers are overly concerned with, let's say.
I'd say our production team has done well to produce pictures of pork.
Yeah. And China has a pork surplus right now. Yeah. So if it's the if it's your commoditized parts of the pork market that we're importing from Europe into China, they can manage that without the risk of inflation.
But what I think is interesting is, once again, it'll be the high-end spirits manufacturers that you're going to watch out for. It'll be the Iberico ham. It'll be those kinds of luxury products that Europe is well known for and will have a disproportionate impact in terms of the effect that they will have. This will make headlines. This will be something that the Spanish will talk about. It will be something that resonates in Europe, and therefore you get a kind of bigger bang for your buck in terms of how you're responding.
Absolutely, and French cognac is part of the mix as well in terms of the threat potentially to French cognac as well in terms of spirits and luxury. For more on this and the context, let's bring in Oliver Kroku now. I know it's been charting all of this for us as well and keeping a close eye on it. Ollie joining us out of Berlin. Ollie, what is your assessment of what we've been hearing from China? Not a big surprise that they come through with some form of retaliation, but it's the type of retaliation that they've reached for.
Yeah, Tom, there were some early whispers about this, kind of some rumored reporting within Chinese media. The moment the EV tariffs dropped, we started to get sort of certain rumblings on potentially the pork market would be something that they would look at. And it appears that sort of in retaliation, this is sort of the lever that they are looking to pull. As you can see, I mean, I'm more sort of comfortable on this sort of terrain of EV markets, but I've just been reliably informed that apparently they import 1.55 million tons of pork last year, about half of which came from the EU, with Spain as the sort of largest supplier there. So, again, these are all just sort of incremental little bits and pieces, and we'll go to the market action. I've been pulled up Lean Hogs, which I discover only opens at 9:30 New York time, so I'm sure you'll be looking at the futures for that when it opens up. But really, it's sort of, what is the takeaway here? The takeaway here is that you have this opening salvo by the EU on the EVs. Now we're looking at retaliation, and really the question is this just the beginning? Are we in the foothills of what is effectively going to become slowly a trade war? And this is the big question for a lot of people. And as sort of each of the different blocks erect trade barriers to try to prevent some of these sort of cheaper items from coming in, what I think the EU needs to worry the most about is how much faster the United States can move on those, how much slower the EU is, and as a consequence, how much slower and how much more of a target the EU market is for a lot of these Chinese exports.
Well, Ollie, when we tend to see this kind of retaliation, if you will, in terms of EVs and now pork, what's the next step? Is there another sector we should be watching on either side?
Well, listen, I think as you guys have been mentioning, again, when we look at sort of the sectors that are vulnerable to the Europeans, a lot of it comes down to this sort of luxury trade. I mean, even within EVs, right, a lot of the European companies have joint ventures within China that are sort of within the trade wall of China. What is not within the wall of Chinese trade are the really, really most expensive cars. Like, for example, Mercedes-Benz, they make their Maybachs in Stuttgart, right? And these are the ones that they ship from Europe into China. When the trade barriers comes up, it starts to hit that. So I think for the sort of auto sector, I know this because I was speaking to sort of senior members of these companies last week when all of this came out. What they're really looking at right now is their global manufacturing footprint. And I think that for the EV sector, as you take a step back, if they need to start producing more and more cars locally, that is also going to pull out a lot of different models from the market. So this will have sort of huge repercussions, certainly for the auto industry. But if you start to see this trickling into other industries, you're going to see that dynamic play out across a lot of different products.
Are these the same sectors, do we think, Ollie, that Europe is worried about when it comes to potential Trump tariffs as well? Say the Republicans were to win in November, similar sort of areas in the past were hit by Trump, and I'm wondering whether or not we could have the potential sort of double effect of China hitting them and also the United States hitting them. This, as we think about kind of what has supported European stock markets over the last few years. Yes, it's been Novo Nordisk. Yes, it's been the healthcare sector, but luxury has been the area you could argue that has really outperformed. Seems like an obvious target.
Yeah, and completely, Guy. And this is sort of goes at the heart of a much bigger and more existential question for Europe, right? So there is the question of the stuff that they export and that they send out to the rest of the world. Obviously, Trump coming in is a bit of a wild card. He's talked about just throwing up tariffs kind of willy-nilly. And this would obviously have an impact here on Europe. But I think what it brings into the fore, Guy, which is not just about the exports, but it's about European competitiveness. And you guys have been talking about it earlier in the show. This is what Mario Draghi has been squarely focused on. And within these sort of discussions, even at the sort of highest level of the sort of EU kind of technocrats like Mario Draghi, basically openly advocating for subsidies and tariffs, not sort of excessive, but to basically level a playing field where you're seeing basically these three major blocks of the world, China, United States, and Europe, fragmenting and just sort of going for their own sort of personal competition. Now, if you throw in sort of more tension between Europe and the United States, that makes the conversation about European competitiveness all the more urgent, one that is frankly such a slow burn that policymakers in Europe, I think, really challenge to make the very difficult decisions that are required to keep Europe competitive.
Ollie, in Berlin, thank you very much indeed. Oliver Crook in Berlin, thank you very much indeed. That's the story, the bigger picture story surrounding Europe, what is happening when it comes to its place in the world. Within Europe, though, French politics absolutely front and centre right now. Far-right leader Marine Le Pen says she won't try and push out President Emmanuel Macron if she were to win the country's snap parliamentary election. That would be an interesting dynamic, though. And then we think about what is happening with what is going on with the left. So officially campaigning starts today. Are we going to start to gain more clarity in this hastily called election when it comes to some of these big blocks? Let's get the latest now from France. Let's go to Paris. Caroline Conan standing by. Caroline, we had a busy weekend in France. Campaigning now officially begins. Talk to us about what we saw over the weekend and what it tells us about how this election could unfold.
It's very interesting, Guy, because what you saw over the weekend were 640,000 people protesting against the far right in the streets. That's according to the CGT union. The number was smaller. If you look at the police, they were saying it's 250,000 people only protesting across the country. And really, if you put this into context, remember 2002, Jean-Marie Le Pen versus Jacques Chirac in the second round of the presidential elections in France. You had 1.3 million French people protesting against Jean-Marie Le Pen in the streets, according to the police. That's 5 times more than the numbers you've seen in the streets over the weekend. So that clearly tells you that a lot has changed in France over the past 20 years. Clearly, Le Pen's ideas, with Marine Le Pen trying to detoxify the National Rally, the far-right ideas have slowly spread across the French population, and now she is not seen as such a threat as her father used to be 20 years ago. In this Figaro interview over the weekend, she tried to play nice, saying there's not going to be any institutional chaos, that she's going to work alongside with Emmanuel Macron. Clearly an appeal for the moderate right-wing electorate who is still hesitating 2 weeks before the first round of these legislative elections.
So that's the right-wing part of the story. What about the left wing and the flank and the challenge for Macron? What are the polls telling us, Caroline, about how his party is now positioned given the challenge from the left and the right?
The polls are saying at the moment between 33 and 35% for the National Rally in the first round, and the Union of the Left would become the second bloc, getting about 25-26% of the votes in the first round on June 30, and then Macron's party would become the third force between 18 and 20% of the votes. So that would translate into at least 200 National Rally MPs in the National Assembly, but short of a majority, meaning that Emmanuel Macron, if he doesn't want to end up with Jordan Bardella as Prime Minister, will have to extend a hand to the moderate part of the Union of the Left. Now, clearly at the moment, that's not the case, because the far left is part of this union, and that's going to be a turnoff for a big part of the moderate left wing. We'll see if this union actually holds together. There were already a few cracks over the weekend on some constituencies. We'll see if this actually holds together until the first round and after July 7.
Caroline, walk us through some of the policy implications, though, here. Walk us through the main measures we need to keep an eye on.
We spoke a lot about what the National Rally means in terms of fiscal uncertainty, in terms of impact on the markets. In fact, the National Rally hasn't detailed yet their economic program. And Marine Le Pen said also over the weekend that, in fact, electors are going to find out that it's more reasonable than we think. But one of the main measures they want to put in place at the beginning is to lower VAT on energy. That alone would cost at least 20 billion euros, according to the French Finance Ministry. Now, if you look, of course, at the Union of the Left program, they also have very costly measures. They also want to abandon Macron's pension reform, also the unemployment benefits reform that's just going through Parliament as we speak. They want to lower the retirement age to as low as 60 years old. and to block the prices of some essential products. So, of course, a very costly program. Emmanuel Macron over the weekend said that both programs would actually make the French poorer.
Caroline, thank you very much indeed. Caroline, going on what is happening with the French election. Campaigning officially starts today. We are going to keep a very close eye on how that story progresses to the first round. Coming up, traders are eyeing decisions from the Bank of England, the SNB and the Deutsche Bank this week. We're going to break down what you need to know ahead of Thursday's trio of meetings. That is all coming next. This is Bloomberg.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger. But obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market, before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
It's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until...
Bank of Japan's Ueda saying service prices continue to rise moderately, reflecting wage rises.
And that's enough, right, to then say, okay, it's time to start the process.
That way we'll scrutinize Forex moves and the impact on import prices.
We're going to get to 2%, I'm telling you. That is what we're going to do. And we if you look at the last month, we did it. But that's what we got to do, and we are going to do it.
Okay, lots there from Fed speakers, of course. US Fed speakers from the regional Fed presidents, including Kashkari, Mester
and Goolsby at the end there. Let's bring in Bloomberg M Live strategist Noor Al-Ali for the latest take in terms of how the markets are interpreting what seems to be a bit of a divergence between Fed speak and the data that we've been getting, Noor.
Yeah, absolutely. And, I think it's up to the part of how markets are looking at, the latest updates from the Fed's dot plot. I know overwhelmingly we had one cut priced in by the Fed, but I'm looking at swaps tied to meeting dates for the ECB and the Fed as well. And I'm looking at about 46 basis points priced in for December. That's almost two 25 basis points for fully priced in for the Fed. The markets aren't buying that narrative just quite yet, and I think that's very interesting as the Fed continues to push back. Obviously, you've had some speakers as well and FOMC members that say, well, look, I think we'll potentially get 2 cuts this year, so that's not completely out of the picture yet. I suppose now we're just waiting to see at which juncture will the Fed look to say, well, you know what, we're ready now for that second cut to come in, and the markets will potentially rally even more on that, right? You've seen that stock market rally. It's been incredible, Kriti.
Yeah, Noor, the connective tissue, I think, is so interesting between both sides of the Atlantic. When we're talking about this bond sell-off in Europe, or arguably what Michael Masika was saying is a bid even into bunds, but creating that widening, what's the connective tissue into treasuries? Why? Does it feel like to you that the Fed and therefore the U.S. bond market is kind of insulated, whereas, say, a year, 2 years ago, maybe it wouldn't have been?
Yeah, look, I mean, the risk of contagion and that fear of where is that going to trickle to next is on everyone's mind this morning. We saw Friday really that French bonds really sell off, bunds rally in relative, as in a haven demand, even the dollar, and I would say, and you can look at FX as well, the Swiss franc also rising against the euro now at levels that make it a little bit uncomfortable for the S&B as they meet later this week as well. So there's a lot that's tied in there, and I think when you look at treasuries right now, really the dominant story there is that economic resilience out of the U.S. economy, how the jobs market is still quite tight. You still have inflation. It did ease again, so we did see that, that pairing of price pressures. So I am expecting now to get a bit of a dynamic here where yields continue to trek higher because we're still at a dynamic that's showing that resilience in the U.S. economy that's pushing the Fed into a corner that says, well, look, we don't really need to cut yet. The economy hasn't given us incentive. And now I'm a little bit
At
more
4 Eastern Time, we get Italian HICP final. Year-on-year forecast 0.8% on the price, 0.8%. Month-on-month on the price, 0.2%. Italian CPI final. Year-on-year on the price, 0.8%. And month-on-month price, 0.2%.
Economy's starting to crack, and that's going to start showing up in balance sheets for companies. We're not there yet.
I was about to say, we are not there yet.
Yes.
And the problems are over here. So the US remains an area of safety versus Europe versus other parts of the world. Does that mean that the bar
We do
is
also
even
expect to hear from
higher
ECB's Lane at 4 Eastern Time.
For risk to emerge? The risk needs to be even greater out of the United States for you to take your money out of it. It needs to be far greater in the United States to take money and put it into Europe. The bar seems to be getting higher and higher to take money out of that economy and put it to work in the rest of the world.
I absolutely agree with that, Guy. And if you look at the U.S. Stock market at the moment, I know we've talked about concentration risks in the past, but right now you have, the Magnificent Seven, as we call them, really, really leading that rally. And not all of them, mind you, as well. NVIDIA really taking that, the gains of the wider stock market on his shoulders and really carrying through. So I'm going to ask you a question now. We're all very happy. Momentum is going there. But what happens when NVIDIA starts to disappoint? Is it just an NVIDIA problem?
I think I saw a note from Torsten Slot, which I'm sure I can dig out, and it'd be great if Torsten's watching. He could re-ping it to me right now because that would be helpful. It's something like 30% of the gains, the market cap gains in the S&P this year have been on NVIDIA, so the arithmetic's fairly straightforward. If NVIDIA rolls over, the S&P's got a problem.
I don't think it's rolling over just yet.
No, I'm not. I'm not. But you raised the question about what would happen if that were to materialize. There's a lot of weight being carried on NVIDIA's shoulders right now. There hasn't been the breadth that has emerged that there was the anticipation that would emerge. That hasn't come yet. Look at what is happening with small caps.
Exactly.
That's the message.
Yeah.
The message out of what is happening with small caps is pretty clear right now, and it's not telling you good things about what's happening with the underlying economy.
Yeah, absolutely. I mean, if you take out those gains from the Max 7 or NVIDIA, you'll see that actually the small caps index hasn't been doing very well. It's not been rising. So what does that give you about market breadth? I think, but we go through these cycles, right? Right after the earnings cycle, we tend to go through these lows, and it's really cyclical, right? So we're very optimistic into earnings season. Earnings come and we think, oh my God, look at these companies. They're doing so great. They're doing very well. We're going to carry those gains. NVIDIA comes really propelling those gains higher. And then that kind of fades and you get the Fed speak saying, well, we've got to keep rates high for longer. The dollar is quite high. Yields are surging. So then companies that are small caps that aren't as appealing to investors will start, lagging in a sense, because investors start thinking, well, maybe I am too overweight on stocks. Maybe I need to find a way to do risk. Yep. And so I think it's a really balanced sheet, but you can't go away from the momentum into the summer. I think it's a summer of gains for stocks and potentially even yields higher. So quite interesting, actually.
All right, Bloomberg MLive editor Noor Al-Ali joining us this morning. We thank you so much. Of course, she was talking about some of the central bank speak that we were watching. There's plenty ahead going on this week. We've got Fed speak and ECB speak. Harker and Lane both hitting the wire. We've got plenty of data as well. Retail sales, Euro area CPI. But it's really about that central banking story. All eyes on the BOE. We've got the RBA on Tuesday. And, of course, the Norges and S&B rate decisions as well. Let's bring in someone who's going to be watching this very, very closely. Jamie Rush, Chief Bloomberg European economist from our Bloomberg Economics team, joins us. Jamie, a pleasure to have you on the program. We've got the BOE, we've got the S&B, Norges Bank, RBA. A lot of focus, of course, on what the BOE is going to be doing. But what's the game changer? What's the surprise factor that we may be waking up on Friday being kind of blown away by?
Well, I mean, clearly the most finely balanced decision is in Switzerland, where I think economists have pretty much broadly split on the likelihood of a rate cut. So if you're looking for a surprise, I suppose it's there. I mean, our own view on the SNB is that, rates are 1.5%? There's clearly not that far to cut for the central bank. So there will be plenty of time and space, really, for them to hold if they want to, and that's what we think they will do. The risk, though, is that these developments in France that have seen the euro tank against the Swiss franc are creating disinflationary pressure in the Swiss economy, and that they may try and get ahead of the curve there and cut rates against expectations. But I think more broadly, we're looking at a picture of stasis across the other economies, right? So Bank of England, election coming, now is not really the right time to make a major change of tack on policy. CPI's come in too strong for them, especially the services data, which is looking really hot. And unlike the ECB, they haven't boxed themselves in. They haven't said that they're going to cut, so they don't have to cut, so they won't. So I think we're reasonably confident very confident of a hold there. And Norges Bank, similar sort of picture. The economy's too hot, inflation's running too high. If anything, they're going to be looking very late in the year for the first cut there.
Jamie, I want to tie the politics together with what is happening with the central banks. We're starting to hear greater and greater commentary around tariffs. Tariffs, I would have thought, would be inflationary. How is the ECB, how are all these central banks thinking about the story around tariffs and how it's going to complicate their mandates for them?
Yeah, it's one of the big questions, right? We have this divide globally between countries that are relying on tariffs and countries that are relying on subsidies to kind of participate in trade wars. US, of course, doing both. Eurozone about to embark on tariffs on China with its EV actions to tackle EV subsidies in China. These things are going to have material but not huge impacts, direct impacts on inflation. I think, where the impacts really lie when you're thinking longer term. We're going to be imagining a world now where there's going to be a split, and we're going to see supply chains have to reorientate. We're going to see long-term but low-grade, persistently higher inflation, and that means basically that the natural rate of interest can be a little bit higher. That's the main channel.
Okay, Jamie Rush from our Bloomberg Economics team on the path for interest rates. On another big week, of course, of the central banks, European stocks have pared some of their earlier gains, now just up 0.2%. That is it for markets today. The Pulse is up next. This is Bloomberg.
Japan's PM Kishida saying the government and the Bank of Japan share the view that consumption lacks strength as wage growth fails to catch up to the pace of inflation. Saying, I have repeatedly said that the government will work closely with the Bank of Japan.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases.
1 minute now. I will be leading with
English
Italian HICP final year on year.
Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news,
10
insight,
seconds.
and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine.
So we are still waiting on the Italian data.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Investors assess political volatility in France and elsewhere, while traders await decisions from major central banks this week. Now, the French far-right leader Marine Le Pen moves to calm markets, saying she will not try to push out President Emmanuel Macron if she wins France's snap parliamentary election. Plus, China launches an
0.8% is 0.8% as expected. Month on month is 0.2% is 0.2%. CPI month on month final 0.2% is 0.2%. Year on year final 0.8% is 0.8%.
Given especially all of that volatility because of the French elections. Now, European stocks are edging higher. If you look at U.S. futures, a little changed. Again, investors are really trying to assess this political volatility in France and elsewhere. For the moment, you can see the CAC 40 and other indices here in Europe actually holding on. Now, escalating concern about political volatility in France has really also spurred a flight to haven assets at the end of last week, with a gauge of global stocks also falling the most in 2 weeks on Friday. The spread between French and German bonds widening sharply. Now let's look at cross-asset. The other things we're looking at, of course, is the French 10-year yield 3.188 is what we're seeing. S&P futures practically unchanged, and then the U.S. 10-year at 4.2363. We're also getting a little bit of breaking news on a corporate, and this is Deutsche Bank. This is just crossing the Bloomberg terminal. Nord LB is withdrawing from the aviation financing business and will sell this 1.6 billion euro aviation loan portfolio to Deutsche Bank. So this is according to an email statement that just crossed the Bloomberg terminal. We understand that both parties have decided not to disclose the transaction price, but we know that the transaction is expected to be concluded in the second half of the year. So we'll keep, of course, a very close eye on this. New business activities in the aviation financing segment will be discontinued. And again, Nordel be withdrawing from
Hans Kishida saying the government has no plan to instruct and request GPIF to buy the Bank of Japan's ETF holdings.
Billion euros. Now, China's central bank has left a key interest rate steady for a 10th straight month. Now, this comes as mixed data out today showed house prices falling and industrial production slowing in May, but retail spending beat forecasts. Now, let's get straight to Bloomberg's Rebecca Chun-Wilkins. Rebecca, good morning. So what's the key takeaway from first
And
of
that
all,
the Bank of Japan holds ETF holdings as a part of monetary policy goal of achieving the price target, and it's up to the Bank of Japan to decide what to do with the holdings.
Figures really suggesting that the crisis is dragging on, and that's particularly prominent here in part because there was hope that after China launched this $350 billion scheme to help with unaffordable housing, help mop up some of those unsold properties that we see across cities in China, that we would start to see some of an improvement in that specific area. Now, there was a little bit of a bright spot, as you mentioned. Retail sales, they accelerated for the first time since November, but overall, more broadly, we are still seeing from the May data this uneven model of growth with exports and clean tech industries driving GDP, with those retail sales and consumer demand still quite a ways below the levels that we saw pre-COVID.
So meanwhile, Rebecca, China's launched an anti-dumping probe on EU pork imports. So is this a direct response to the latest EU tariffs?
It's certainly going to be viewed in that way, and in some ways it's no surprise, partly because in the lead up to that decision and the announcement of those EU tariffs, we did see Chinese state media, for example, and prominent experts sort of trailing the possibility of a response from China, including specifically a potential probe into pork. Now, there are other ways that that China can actually respond to the European Union's actions. They can, for example, also look to limit its own domestic access to its own domestic markets. For example, Germany still very much relies on access into China's domestic markets, even though overall we have seen foreign car makers reduce their position in China. But the anti-probe, the probe into anti-dumping for pork in particular, does suggest it's relatively muted in China so far. It only affects a relatively small portion of the trade between the EU bloc and China. So, we might see a more moderate response, although there is a sort of broader array of tools that Beijing can rely on here.
Rebecca, thank you so much. Bloomberg's Rebecca Chun-Wilkins there on the very latest with China, and we have had quite a lot of news out of China today. Now let's talk to Thushka Maharaj, Asset Solutions Strategist at JP Morgan Asset Management. Thushka, as always, thank you so much for joining us. I have a million questions on the U.S., on the Fed, but actually we probably have to start in a pretty volatile Europe. What will support a lot of equities in Europe going forward?
Hi, Francine. Thanks for having me on. I think the main underpinning for risk markets would be a stable economic backdrop in the euro area. We need that consumption or consumer confidence to return and consumption, domestic consumption to support better growth prospects, but as well as nominal earnings. But as you highlighted, having stability on the political front would be I would call it a necessary requirement.
Thushka, how much volatility are you expecting because of politics? And does that change fundamentally your appetite for European equities?
Yeah, we are expecting volatility between now and the first round, and I think it will continue post that as well. We were actually turning more positive on European equity markets ahead of that snap election announcement, partially based on this view of a global goods cycle recovery, and I think that's still the case. We're still expecting an expansion in manufacturing activity in places like Germany, but I would say that the political uncertainty makes that harder to sort of position for time immediately. And then in terms of what we're expecting post the going into the election, I think as everyone else is, we are watching those polls. We saw some data out today, but I think it's just too uncertain to have a strong view without knowing what the underlying policies are, where the coalitions are likely to form. So there are more questions at this point.
Thuska, I mean, away from politics, the European economy seems to be expanding once again. What does that mean for ECB policy and for growth in general for maybe some of the corporates?
Yeah, so we expect the ECB to be engaging in quarterly rounds of rate cuts. They've started that process. And it all depends now on the inflation outlook in the euro area. We'll get some inflation data this week. There's this tension between resilient and strong consumer service-driven inflation in the euro area. But I guess the question we're asking ourselves now is, what's the interaction of the political uncertainty and the ECB's reaction function? For now, our view is that the political volatility is focused in France, and it's unlikely to affect the ECB's policy in the very near term.
Thuska, any appetite for UK assets? Again, we're in an election year, but actually the polls are so wide apart. There's certainly not the volatility that we're seeing in France.
You asking about the UK asset market? Yeah, I mean, I do think there are opportunities in. Yeah, I do think there are opportunities in the UK market. I mean, it's hard to map the equity market directly to the underlying economy, but as you say, in comparative terms to the euro area, we have quite a strong pro-growth impulse expected for the UK post those elections, and so. Ironically, the idea of more political stability
ECB's Lane saying the goal is to hit 2% in the medium term.
Will be viewed notably in comparison to what we're seeing in Europe at the moment, in the euro area at the moment. And so, yes, we are more positive on UK risk markets, but I do think that there's more uncertainty on the Bank of England. So if I compare the BOE to what we're hearing from the ECB, I think it would be unlikely to see them cutting rates preemptively in the UK at this point.
And Thuska, I know we'll spend a lot of time talking about the U.S. next, but overall, is it a given, or do you think it's a given that we see a soft landing, or could we see a surprise in the U.S.?
I mean, I'd say that the data is tracking quite closely to this idea of rebalancing in the labor market and the idea that growth remains resilient. So I would say it would be surprising to see the sharp turn lower in the U.S. economy at this stage.
Thuska, thank you so much. Thuska Maharaj, Asset Solutions Strategist at JP Morgan Asset Management, stays with us. Now, coming up, the French far-right leader, Marine Le Pen, says she will not push out President Emmanuel Macron as she leads polls ahead of the country's snap parliamentary election. More on how that's impacting markets next. And this is Bloomberg.
ECB's Lane saying we are seeing significant wage increases in some countries. Also adding that we have a lot of confidence on the fiscal effect on CPI.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere.
I think that 2025 pay deals are much closer to the steady state.
Changes everything.
Fixed income fix. Watch Bloomberg Real
And that cost pressures are to be muted next year.
Context changes everything.
And the economy is starting to recover from stagnation.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Noting that we should not be too sensitive to monthly inflation data, and we need to differentiate between noise and signal.
French far-right leader Marine Le Pen says that she will not try to push out President Emmanuel Macron if she wins the country's snap parliamentary election. Let's get more from Bloomberg's Stephen Carroll. So, Stephen, good morning. This feels significant, but how significant are they, given we're also seeing a resurgence of the left?
Look, you have to look at the signals coming from this interview as well. Marine Le Pen very clearly pitching for the centre ground now. She knows that she's on the front foot in these elections as well. And the comments that she was asked in this interview with Le Figaro, whether she would call for Emmanuel Macron to resign if her party came first. And in response, she said that she has respect for institutions. She will not call for institutional chaos, and there will be simple cohabitation, that word that we use in French politics to describe when we have a president from one party and a prime minister from another, essentially saying that there won't be any chaos if her party does win the election. So that's sort of a signal that she's willing to work with Emmanuel Macron and perhaps try to allay some of the worst fears that voters or investors might have about what happens if they come first, as they're represented in the polls. Interestingly, we are also waiting for details of the economic programme from the National Front. We know some measures of it, which include things like cutting the VAT rates on energy and on certain food goods, which would worry in a public finances point of view. But she says the financial markets don't understand their projects.
Retirement at 60 years old.
Yes, to bring back the retirement age, reverse the reforms there as well, and reverse some of the other reforms that Emmanuel Macron has put in place as well. Her word on that.
Lane saying that we don't like inflation jumps, but bumps we can deal with.
Find it reasonable. So a signal coming there from her. The other signal that we saw from voters over the weekend were protests. Hundreds of thousands of people protesting in France against Marine Le Pen's policies. Not the numbers that we saw if you go back to 2002 in the protests against the far right, but nonetheless a part of this political conversation.
Yeah, I know a lot of insiders say the problem with this kind of cohabitation is that unless she really is to the centre, we won't have seen a president and prime minister with so different ideas of where to go next. What can you tell us about Macron's way forward? So if he's being attacked by the left and the right, is there any chance that he wins this?
Well, interesting, we've got some clues to the strategy this morning. Actually, the French Prime Minister speaking on RTL in France, talking about them not presenting candidates in around 60 constituencies where they've left candidates who they feel are constructive, in their words, to run solely against the far right or the left-wing candidates. That includes, by the way, the constituency of former Socialist President François Hollande, who re-emerged over the weekend onto the political scene, that he's going to run in his Corrèze constituency as well. So that's part of the strategy, is they're trying to be strategic, given that the polls put them in third behind the far right and that left-wing alliance, which is also an important political player to watch. It's a hastily assembled alliance. Some of the measures involved in their programme, which we do have more details of, also could be of concern to investors. Again, rolling back the retirement reforms, rolling back some of the unemployment insurance reforms, the idea of fixing prices on certain essential goods, that could be of concern to markets too. Also, it's worth noting that alliance itself isn't terribly stable at the moment, and certainly what we heard from the finance minister over the weekend from Emmanuel Macron's party, Bruno Le Maire, talking about there being a threat from the left and the right. He says both the left and the right will leave French people poorer, and he still believes that there is a way forward and a potential victory for his party.
Stephen, thank you so much. Stephen Carroll there with the very latest, of course, on French politics. Let's talk more about market implications with Tushka Maharaj, asset solutions strategist at JP Morgan Asset Management. Tushka, we were just talking a little bit about it on Bloomberg's Michael Msika. Michael, when you look at some of the concerns, again, the markets really were taken by surprise. Two, I don't know whether they're just looking at worst case scenario and whether at some point they temper, or are you expecting a lot more volatility?
Well, Francine, it's the first thing that I would say, and I said this earlier, I did not feel any sense of panic. Last week, what we've seen was like a trimming exposure, reducing exposure from investors that were highly exposed to European equities and to France, to banks in particular. And so, I mean, you have an uncertainty like that. You have like a very big surprise like that because no one was expecting Macron to call for snap elections. You reduce your exposure. That's how you do it. So more volatility, possibly, until we have the votes, and then we'll see what happens.
I know you also wrote up something by Liberum saying, look, markets don't have much to fear from France's elections, but then if you speak to people,
ECB's Lane saying we need to see domestic services inflation momentum come down.
Events, like our memory is cast back to Liz Truss' quasi-Quartang budget. Is there a danger that the Marine Le Pen party does something like that without the proper backing finances?
So, I mean, it will depend. Everything she's been doing recently was to try to ease the worries of the market. I think at the end of the day, every single party in France knows that the country has fiscal constraints. They can't do anything they want. The UK has learned that the hard way, and they will learn the hard way as well. Now, the difference between the UK and Europe is there are safeguards in Europe more than in the UK. The ECB is here. There's a lot of safeguards in place. They can buy a lot of bonds if needed. I do understand what the Liberum strategists were saying in the sense that you might have volatility, you might have some spikes, some investors trying to play that, but at the end of the day, there are things in place to prevent any credit events.
And Srečka, we talked a little bit about the French elections. We talked a little bit about this volatility. Where are we in the U.S. cycle? Because, of course, everything's linked. So we also have a big election in the U.S. Depending on where we are in the cycle, I guess markets could look through any volatility in Europe.
Yeah, Francine, I'd say the volatility we've had in Europe is basically reinforcing the idea of U.S. exceptionalism, in our view, in many respects. One, economically. Secondly, in terms of the U.S. dollar. So volatility in Europe does get expressed through the euro, especially political volatility. And I'd say this reinforces the view that the dollar remains strong. We remain positive on risk assets in general, but most especially in the U.S. large cap market because of secular forces, but also that underlying underpinning from earnings momentum.
ECB's Lane saying tourism is strong, but not as strong as last year.
U.S. assets, Srečka, I know high yield is something that's been quite talked about. Where do you see it? Are you constructive?
Yes, actually, our highest conviction view is in carry, in the quality components of high yield. I know when you optically look at the level of spreads, they look tight, and that's mostly because of higher core government bond yields. We're not expecting spreads to tighten significantly below 300 basis points in high yield terms, but we are expecting to earn the all-in yield, which is still very attractive to us in the US. I would say that theme also applies to the euro area, this idea of carry, but as your speaker already noted, what the market's doing is reducing leverage in carry positions, and so we still expect that volatility in European fixed income and especially European credit to continue. Again, it just makes the US look more attractive.
Srečka, thank you so much. Srečka Maharaj, their asset solution strategist at JP Morgan Asset Management, and Bloomberg's Michael Mzika joining us on Europe as well. Now, coming up, Fed policymakers say they want more evidence that proves stubborn inflation is well on its way to 2% before cutting rates. More on that next, and this is Bloomberg.
Seeing according to Israeli officials, Israeli PM Netanyahu has disbanded his inner war cabinet.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade.
invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
It's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down.
Well, that was U.S. Regional Fed President Loretta Mester speaking to Bloomberg about the central bank's looming interest rates decision. Now, UBS says it will give investors in Credit Suisse funds linked to the collapse of Greensill Capital a significant proportion of their money back. That's as the Swiss bank looks to clear through the legacy issues of its former rival. Now, the collapse of a $10 billion group of supply chain funds linked to Greensill in 2021 contributed to the demise of Credit Suisse. Now, Bill Gates says he's prepared to plunge billions of dollars into a next-generation nuclear power plant project to meet growing U.S. electricity needs. Gates' startup, TerraPower, broke ground for construction of its first commercial reaction last week in Wyoming. Now, TerraPower's plant, backed by the U.S. Department of Energy, was initially slated for operation in 2028, but would have required reliance on fuel from Russia. Well, Gates told CNN that was unacceptable now. And Hong Kong and Singapore have been named the world's most expensive cities for expats. Now, the rival cities top Swiss destinations Zurich, Geneva, Basel, and Bern. That's according to Mercer's 2024 cost of living report. Now, the report says rising housing costs and the cost of living challenges have had a significant impact on expat workers' compensation packages. Coming up, trade tensions between Beijing and Brussels ratchet higher as China launches an anti-dumping probe on pork imports from the EU. We'll have a full story next, and this is Bloomberg.
ECB's saying if later this year or next year there was a surge in energy prices, it would not make sense for us to squeeze the economy. Also saying we want to be at target, then maintain it. Lane saying we will have a lot of survey data at the next ECB meeting in July.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, This is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Lane adding that it's important that Eurozone firms now think that wage growth will be lower than a year ago.
Terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Saying we won't know a lot more about momentum of services inflation by July, but every meeting live. I'm just noting that China boosts basic pension by 3% from 2024.
Investors assess political volatility in France and elsewhere, while traders await decisions from major central banks this week. French far-right leader Marine Le Pen moves to calm markets, saying she won't try to push out President Emmanuel Macron if she wins France's snap parliamentary election. Plus, China launches an anti-dumping probe on pork imports from the EU as trade tensions between Beijing and Brussels ratchet higher. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, China has launched an anti-dumping probe on pork imports from the European Union. This as trade tensions rise between Beijing and Brussels. Well, Bloomberg's Oliver Crook joins us from Berlin. Ollie, thank you so much for joining us. If you look at the pork investigation, how much does Europe sell to China?
I'm just saying that the meeting-by-meeting approach is a very good idea.
Yeah, this is basically fully retaliation for the EV tariffs. There were sort of rumblings within Chinese media within basically 24 hours of the EV sort of tariffs being announced that maybe pork would be the sort of way in which China would retaliate. And it seems from the Ministry of Commerce we've learned today is exactly how they would retaliate. So when we look at sort of the Chinese imports of pork, it's about 1.55 million tons every year. About half of that comes from the EU, mostly from Spain, some from Netherlands, Denmark. These are all the sort of sensitive sort of pork markets where that's involved. But really in terms of trade, it's only worth about 1.8 billion versus, almost $250 billion of trade. So this is still a fairly measured take so far because, of course, for China, they also produced about 60 million tons of pork last year domestically, so less than 1 million coming from Europe. I mean, this is also kind of taking into account that obviously whenever you throw up trade barriers for a lot of these things, you could also potentially stoke inflation. So for the moment, it's quite surgical and precise. What we look forward to, though, Francine, is this just kind of the beginning of what we could be, walking in towards a trade war? We're still waiting for the Chinese. Are they going to retaliate on, say, auto sector for Europe? Because remember, the most expensive cars that the Europeans sell, like the Mercedes Maybach and all these sorts of stuff, that's built in Europe and then shipped over to China. So we're still waiting to see what form the retaliation takes.
So EU leaders are also meeting in Brussels to discuss distributing the top jobs. What do we know?
Yeah, that's right. So this is going to be their first formal meeting since
Lane saying some questions we have about inflation momentum will not resolve immediately. We need more than a month.
With this trade dynamic with China as the background for this, the EU really needs to reform its sort of entire government. And there were some real questions about Ursula von der Leyen and whether she could kind of claim the top job going into this election. After the outcome, it looks basically assured that Ursula von der Leyen will remain as the sort of Commission president. We're also looking at sort of Antonio Costa to take up the European Council from Charles Michel. But then most interestingly, perhaps, is the Estonian Prime Minister, Kaja Kallas, who's been
we need a month, more than a month of data on its services inflation.
Role as the top diplomat within the EU, so that should be very interesting, particularly around all the conversations around defense, and potentially could you, Francine, in the next few months, see a European sort of defense commissioner? This is a conversation in Brussels that does not exist currently.
So when you look at Ukraine, there was, of course, this meeting over the weekend that was extremely important. The President Vladimir Zelensky's bid for support from the global south against Russia hit a bit of a snag. What happened?
Yeah, exactly, Francine. I mean, off the heels of the G7 meeting, we should just say that for Ukraine, really the prize was getting that $50 billion from, the sort of frozen Russian assets from the G7. That went through. That was the most important thing. That happened. On the diplomacy side, things got a little bit more complicated because remember, before the Swiss summit, we also got sort of Putin's lists of demand for what would be
And
required for
Lane
Russia's,
won't comment on
side
French
on
bonds.
peace. Basically, it involved forfeiting the entire east of the country and a commitment from Ukraine to not join NATO ever, right? These are total non-starters for Ukraine. And so in the context of sort of the diplomatic side, you basically have the demands of Ukraine and Russia, a sort of Venn diagram with zero overlap. And the difficulty that Ukraine is having, despite having gotten those funds in, is sort of not winning more countries from the global south and those that are a bit more ambivalent, not really signing on to a communique over the weekend from the Swiss summit, basically just trying to bring people together to begin to talk about sort of language around which a peace negotiation could move forward. And really that hit a complete standstill from those who were not really committed to Ukraine from the beginning anyway.
Ollie, thanks so much. Oliver Crook there in Berlin. Now, less than 3 weeks before the UK's general election, Labour has extended its lead over Rishi Sunak's Conservatives in 2 recent opinion polls. Now, the opposition appears on course for a large majority after the vote on July the 4th. Speaking to Bloomberg, the leader of the Liberal Democrats has set out a path for the UK to rejoin the European Union single market, saying businesses need closer ties.
So ECB's Lane, when asked on France, says that all governments need to show how they will implement new fiscal frameworks.
Party talking positively about engaging with our European friends and neighbours. We're talking about rebuilding that trust and relationships that have been so poisoned by the Conservatives. You know, when I talk to businesses, they say we're not investing in the UK because there's no long-term strategy, there's no real link up with Europe, and people are taking their money elsewhere. And I think that's really sad. And under the Liberal Democrats, you'd get a long-term, stable policy, and we're so committed to that stability, so we could tackle these issues about the problems with regulators, get better trade deals. That's the sort of climate that would attract investment. You know, when we were, for example, in government and running the energy sector, we saw tens of billions of pounds invested in the UK because of Liberal Democrat policies. We introduced contracts for difference, which were transformative in improving our electricity system and making it go low carbon. And that system of financial instrument was copied the world over. So I'm really proud of our record.
And saying Commission has an important role in assessing fiscal plans.
Like this, maybe a bit windy and a bit blowy, a bit rainy today, but the sun is shining on the Liberal Democrats.
I'm just waiting for the thunder to start, just to add to that chorus that you're speaking about. So basically, I can say with a degree of certainty after having heard what you just said that a vote for the Liberal Democrats is a vote to rejoin the single market. Is that pushing it too far? Or is that fair
And
to
that
say?
it is very important to have TPI.
Be realistic about the time scale for that. It can't be done overnight.
Yep.
We've got to rebuild that relationship with our European colleagues. When I've spoken to European politicians like Christian Lindner, the finance minister of Germany, he says, look, there is a trade on the table. It falls a bit short.
TPI is super important for monetary union.
Because I'm afraid European friends don't quite trust the UK any longer, and who can blame them, given the way the Conservatives have broken the rule of law and treated our European neighbours. So we've got to build that friendship back. You can do that with a good trade deal to start with, and gradually over time, you have a
Lane saying it's very important the ECB makes clear we will not tolerate unwarranted or disorderly market dynamics.
Well, that was the UK Liberal Democrat Party leader Ed Davey speaking with our very own Guy Johnson. Now, coming up, the climate crisis, Gen Z, and the green jobs for the future. We discuss all of that with LinkedIn's head of global public policy. That's coming up next, and this is Bloomberg.
Saying we can't let market panic disrupt monetary policy. We cannot have a situation where disorderly market dynamics impacts our monetary policy. We need to distinguish between markets repricing fundamentals and disorderly dynamics.
From the world of politics to the world of business.
But the current situation is not disorderly.
Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
We're seeing market repricing, but not disorderly dynamics.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, Britain's Met Office says the UK has seen its sixth wettest spring since records began in 1836. Now, the climate crisis is, of course, one of the biggest global challenges, and it's a growing source of anxiety for younger people looking to enter the workforce. Now, 73% of Gen Z say that they are more worried about climate change than 1 year ago, but they're struggling to get jobs in the sector and don't have enough green skills. Now, that's the finding of a new report from LinkedIn. So let's discuss all of this with the company's vice president and head of global public policy, Sue Duke. Sue, as always, thank you so much for joining us. So this is a very important and interesting report. Basically says, you know, young people are worried about it, but they don't really know how to get into these jobs.
That's right. Young people are telling us they really
And saying rates went up very fast compared to that will be slow. If the economy is growing, no acute urgency to cut rates to avoid the recession.
Awareness problem. 4 out of 5 of these young people are telling us they just don't know how to break into these roles. And we have a skills gap. Only 1 in 20 Gen Z workers today have green skills. And that means despite that appetite, they are really struggling to break into these roles. And we need to ensure that we're putting in place the skills programs that will allow them to not only power their careers, but power this transition to net zero as well.
Yeah, so it's really, you know, interesting what you say. It's basically a lack of job availables, it's a lack of experience and a lack of green skills. And yet a lot of Gen Z are ready to learn these new skills. I think your report says 8 in 10 say they could pick up some of these skills if they were offered training. Are we seeing training?
We're not seeing enough training. You're absolutely right. 8 in 10 of them are telling us, if I get the green skills training, I'm confident I can get one of these jobs. But 4 in 5 of them are telling us, I don't know where to get this training. And the issue that we have is that when they look to go to get these skills, they're not available through the companies they're working for, and they're not being put in place by governments. So what we need is both governments and the private sector really investing in upskilling.
And saying the initial phase of rate cuts will remain, sea level remain restrictive.
These skills, because as these young people tell us, that is going to be really good for their careers, and it's going to be really good for the planet as well.
So, Sue, again, at the current rate of progress, how many Gen Zs will have green skills in 15, 20 years when I guess some of these skills are needed most?
2030, a key staging post for us on the way to net zero by 2050. By that stage, 1 in every 3 workers will be Gen Z, but only 1 in every 10 of those workers
Saying if we get to welcome
skills.
surprises
That's
on
at
inflation
the
or economy
current
weakens more than we
rate
expect,
of
we can
green
cut more
skills.
quickly.
And that tells us that it's now we need to act. We need to ensure that we tap into that passion, that potential, that eagerness to work in this space that young workers clearly have, and put in place these programs at a scaled, fast rate so that we can tap into that potential and drive forward this transition.
Sue, I think when you look at the workforce, I mean, Gen Z kind of make up, what, 24% of the workforce right now?
Right.
Are they finding the right jobs?
They are really struggling to break into these green roles. So when we ask them, what are the barriers facing you? 4 in 10 of these young workers tell us, I'd love to get into this space, but I'm not able to get the access to the training right now. So ensuring that we are helping them get this training, get those skills that they need. Again, often we're talking about 2, 3 green skills.
Lane saying that speculating on the likelihood of cuts is not good use of my time.
To get that foot on the ladder. That's what we need to do to ensure that we're allowing them power those careers forward and be in a spot by 2030 where we're getting to grips with this skills mismatch.
But what are the skills needed? Is it digital? Is it STEM? Is it common sense? So, are green jobs that different to any other job?
There's 2 key categories of green skills that are right now high in demand. The first is around the rollout of that energy infrastructure. So wind panel installers, solar panel installers, energy engineers. We need a ton of workers moving into that space. And the second key area that's coming through consistently strongly is around the oversight and regulation of emissions, carbon credits, energy audits. They're key skills, key roles where we see high demand and where we need to be encouraging young people to get those skills, get into those roles, start rolling out this infrastructure and doing the work that needs to be done.
So we've also heard about the phenomenon of Gen Z quiet quitting, right? Doing the minimal work possible. Do you see it across LinkedIn? Is it something that's sizable that you can measure?
Not in this space. Our research today tells us that young people are saying, I am willing to work hard to get into this space. 2/3 of them are telling us, if you give me the training, I will get one of these roles. I am confident that I can do well in these roles, and I see myself working in these roles in the next 5 years. So the passion is there, the energy is there, the work ethic is there. Again, we have to tap into that to make sure that we're leveraging all of that passion, all of that awareness, and all of that eagerness to work in this space and make a genuine contribution to the transition to net zero.
So what about AI? So can it help drive up worker productivity in the UK, or does it actually take away some of the jobs that graduates in the past had done?
We're already seeing AI have a positive impact. 2 key areas where we see that playing out across the economy. First is in AI technical talent. So the workers who are building AI, there we are seeing
Lane saying I don't think policy divergence with the Fed is any more of an issue than it was before.
And secondly, a broader transformation across workers who are leveraging AI. There we are hearing from workers, fully 3 in 4 of desk workers are already using AI, Copilot, ChatGPT in the workplace to get those productivity gains, to do those routine tasks, and to free them up to do that more valuable human work across all sectors of the economy.
So can AI also help bring more UK workers, I guess, back after COVID and long COVID?
We see that workers are really embracing this technology, again, not just in the tech sector, but across all sectors, retail, real estate, construction. What we see is that workers are embracing this technology because they see that it can take some of the routine tasks, some of the monotony that we all have to do day in, day out in our jobs. And that means that these workers can go back to work and really do the valuable stuff that they enjoy, the strategic work, communication, leadership.
New dot plot doesn't change thinking on Fed divergence.
Potential for this technology to be embraced by workers and have them enjoy their roles and add more value to their roles across the board.
And so we were talking about the fact that, really young workers are entering the workforce at a difficult time. And there's also a mismatch between starting salaries and, I guess, the cost of living crisis. So what kind of advice would you give today to a young worker wanting to enter the workforce?
And adding that a really big euro-dollar move would matter for CPI forecast.
skills is an area that can only be good for your career and can only be good for the planet. One of the main drivers that workers are telling us is pushing them into this space is, yes, I want to protect the planet. Yes, I want to advance in my career, but I also see a prospect for a higher salary in this space. So starting
If we saw a really big move in euro exchange rates, it would be relevant for policy, and these are not big movements.
Out what are the skills, the specific skills that you need to break into that role. And thirdly, think about your network. There is a huge, vibrant community out there on LinkedIn that can give you advice, help you figure out what skills you need, and get you started on your career in the right way.
Thank you so much for everything, Sue Duke, there, Vice President and Head of Global Public Policy at LinkedIn. And now coming up, traders are eyeing decisions from the Bank of England, S&B and Norges Bank this week. We'll break down what you need to know ahead of Thursday's trio of meetings. That's next, and this is Bloomberg.
I don't think it's fair to watch US CPI dynamics for lessons for Europe.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three as the economic picture covering the intersection.
Then saying we don't think the peak effect of rates on inflation had happened yet.
People ask me all the time, what is the key to being a really good investor? And I tell them,
At 5 Eastern Time, we expect to hear from ECB's Lagarde as she visits the company Pascal in Massy in France.
I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade.
Watching the Europe Stock 600 erases opening games. Last down 0.05%.
Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
This is Bloomberg.
Rihanna making Shandong crepes.
So at 5 Eastern Time, we also get Eurozone labour costs year on year, prior 3.4%.
And an AI-powered avatar of JD.com founder, billionaire Richard Liu. All in hopes of standing out and getting consumers to spend. Similar to the Double 11 shopping holiday invented by Alibaba, 618 is JD.com's version of a month-long discount spree ending on June 18th. This battle for the consumer dollar has taken a hit in recent years as a slowing economy has turned Chinese consumers into more selective shoppers, making the price point for products even more of a focus.
Consumers are still buying. They're buying cheaper things. The average ticket size is coming down.
They are still going with some of the low price strategy out there.
Smaller companies are now competing in the same space thanks to China's anti-monopoly investigation into Alibaba in 2020. Douyin, Kuaishou, and Little Red Book have joined in the e-commerce game, Douyin leading the charge with 70% growth in GMV year-on-year. Alibaba and JD.com trailing behind in single-digit growth. The smaller upstarts have forced Alibaba to rethink strategy. Founder Jack Ma calling on employees to think outside the box. The result, a partnership with ByteDance's own Douyin, allowing merchants to advertise on the video platform and make transactions on Taobao. But even with the intense competition, consumer spending still cooled in recent months, and the platforms are hoping to reverse that during these key shopping holidays. Min Min Lo, Bloomberg News.
Well, that was Bloomberg's Min Min Law on the battle for shoppers during China's 618 e-commerce festival. Now, a run of key central bank decisions this week should, of course, shed light on who's joining the global interest rate cutting cycle. With a looming UK general election, the Bank of England looks likely to hold rates steady at 16-year high when it meets on Thursday. Well, let's bring in Bloomberg's MLife strategist Ven Ram in Dubai. Ven, thank you so much for joining us. Look, data forecast to show CPI falling from 2.3% in April. The BOE, I guess, expected to maintain its benchmark rate because we're in an election cycle.
Absolutely. Morning, Francine. I mean, it's a gripping week for central banks and for the markets. For the markets because of the French political risk that you mentioned, and for central banks because we've got a slew of central banks meeting this week, not least the Bank of England, then we've got Norway, we've got the Australian Central Bank, as also Switzerland. I think that the Bank of England is unlikely to do anything particularly because we've got the elections coming up. But the question for BOE is really what lies in store beyond this month. As you mentioned, inflation is likely to soften this month, but the Bank of England already was expecting that. So the question is, what happens to inflation numbers in the UK beyond the spring? The BOE expects them to accelerate afterward. So it is more than it is going to take more than just one softer print for the BOE to be convinced that it can go ahead and cut rates.
So, I mean, this is one thing, of course, that we need to keep an eye on. And, whether a lot of investors miss the fact that the BOE speeches are not there is one also of the big question. Does it make it easier just to look at the data without the speeches?
Absolutely. Investors are left to pause their own reaction function, and if you look at gilt yields at the moment, they're kind of in undecided territory because there was this momentum towards lower yields that has waned.
So 5 minutes now until we get to Eurozone labour costs year on year. Prior 3.4%, and expecting to hear from ECB's Lagarde as she visits the company Pascal in Massy, France.
For the markets, traders are thinking that we'll probably get 2 rate cuts from the Bank of England. I would err on the side of caution and think more that one is likely.
Very quickly, Ven, what's your take on French assets?
Well, I think that French assets. I think that the yields will kind of climb slightly more from here because I think that we haven't priced in the full scale of risk, and of course part of the problem is we don't know the scale of risk. Who's going to come to power, and what is their fiscal policy going to be? The S&P already expects French deficit to widen in the coming years. So if it emerges that it's going to widen even more, then there's some more risk to be priced.
Ven, thank you so much. As always, Bloomberg MLife strategist Ven Ram. The brief, it's up ahead, and this is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investment.
Lane saying shifts in real exchange rates in Eurozone are helping resolve existing imbalances.
Including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more.
1 minute now.
Voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Ten seconds.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief.
5.1%, 5.1%.
Charging ahead, Evercore, Citi, and Goldman all boost their bullish calls for U.S. stocks. Disruption paused. French yields steady after political uncertainties drive 10-year spreads to their worst week since the 1990s. And the housing slump in China deepens, triggering new calls for Beijing to pump in more cash. A very good morning. We kick off the week with this trifecta of bullish calls from Evercore, from Citi, and from Goldman Sachs. Late on Friday, Evercore goes for 6,000. Again, the AI revolution is the propulsion. We give back to flat at the moment. You did put on 1.6% on the S&P 500 last week. And tech, it was a furious rally in tech, over 6.4%. And that momentum, Ed Yordeni asks whether we're in a momentum melt-up or a blow-off top. I'll leave it for you to consider. Citi say go overweight the US relative to Europe. Goldman's boost their target to 5,600, and Evercore lash it out at 6,000. The CAC, however, had a torrid week last week. The tail that wagged the global risk dog and really cemented US hegemony is what the market is saying. Is that tail risk in France of Le Pen exceeding to fiscal control?
China banks bought 1.25 trillion yuan of total FX in May.
Billion euros. So the French political risk, along with a disinflation narrative, added to a drop.
ECB's Lane says central banks have to be willing to surprise markets if required.
20-year paper later in the week, and Kashkari intimates that the Fed will be one and done. The China data is pretty torturous this morning in terms of housing. We'll break that down for you in a moment. I thought we'd reflect that with copper. The depth of the housing crisis is still there. You're at an 8-week low on London copper, down for 4 weeks in a row. So that's just a manifestation of that particular commodity. So we talked about Europe and the risk. Let's get that in first of all, because we have turmoil in France looming over the EU summit in Brussels. The French president, Emmanuel Macron, calls that snap election, fueling concerns further advances for the far right. For more, let's bring in Caroline Conan. She's standing by. Caroline, the imagery from the weekend was pretty potent. This was France demonstrating against Le Pen, but Le Pen, of course, reinforces one soothing line to the markets in terms of what cohabitation could look like. Describe the weekend for our viewers.
Manus, what's very interesting is the number of people in the streets over the weekend protesting against Marine Le Pen and against the far right. There were 250,000 across the country, according to the French police. Now, let me throw back to 2002. That was when Jean-Marie Le Pen was facing Jacques Chirac in the second round of the presidential elections. At the time, you had 1.3 million French people in the streets protesting against Jean-Marie Le Pen. So that's 5 times more people than what we saw in France over the weekend. That shows you.
We've also posted out the ECB economic bulletin on the financial news feed.
Marine Le Pen has done a very good job at trying to detoxify her party, at trying to make it look more normal, more reasonable. In an interview with Le Figaro over the weekend, she actually said that she was ready to work with President Macron, that even if they do get a majority in the National Assembly on July 7, that doesn't mean any institutional chaos. Clearly, she is trying to appeal to the more moderate right-wing part of the electorate.
Yeah, and it's interesting where she comes out and she says, I'm respectful of institutions and I'm not calling for institutional chaos. And the markets really don't understand our fiscal policy, of course, intimating that it's Macron who has invoked the chaos by pulling the ripcord on the election. So let's talk about those polls. How do they translate? Because there could be a coalition on the left with an accession of the right, leaving an eviscerated power in the middle for Macron.
There is actually a coalition on the left already, and the problem with that coalition on the left is that it includes the far left. So, of course, the far left has this very charismatic leader of Jean-Luc Mélenchon, but it's also a turnoff for a big part of the more moderate left-wing electorate. So the polls, what are they saying at the moment? They're saying the national rally of Le Pen would get between 33 and 35% in the first round. Macron's party would get between 18 and 20%. And in between, you have this coalition of the left that would get between 25 and 26% in the first round on June 30. Now, of course, this is a two-round system, so depending on who gets first in the first round, we'll have to face whoever is left in the second round. That means a lot of Macron's candidates may actually be even excluded from a second round in those elections. In any case, that would mean that the coalition of the left would be the only alternative forces currently, if we're looking at the polls, for Emmanuel Macron to work with, to choose a prime minister who doesn't belong to the far right.
Okay, well, let's see how this plays out, Caroline. A long way to run and many more polls to come. Caroline Conan with the very latest on the French political situation. To China, I mentioned the price of copper this morning dropping. We've got this property slowdown showing no signs of letting up. The latest data disappointing, to say the least, leading to calls to pump more cash into the economy. This comes as the PBOC kept rates unchanged for its 10th straight month. Rebecca Chung-Wilkins is with me with the key takeaways from the May economic data. Rebecca, good to see you. I mean, anywhere you look at this housing data, it's pretty brutal, but maybe we were just too optimistic that the surpluses in the housing market would clear quickly. Contextualize the disappointing data.
Yes, absolutely. And the property market, as you say, very much in focus in the May data. Now, we saw prices, home prices falling at a faster pace in May, new home prices coming down 0.71% and existing home prices coming down 1%. It's that existing home prices that is really sort of hurting. But the broader context, as you say, is that because we saw this really forceful push from Beijing to try and salvage the property market, try and put a bottom under the property market with this 350 $150 billion plan to mop up some of the unsold housing. This part of this affordable housing scheme where local SOEs and local governments would start buying some of these properties. There was hope that we would see some kind of improvement translate into the data for May. Now that hasn't happened clearly, and there was some expectation around this. I mean, analysts have warned, for example, that the trials that we've seen so far have been too small in scale, that it takes a really long time for this type of policy to transmit into the rest of the market, but certainly disappointing. And just into broader context, again, we see this sort of reiteration, this underscoring of the uneven growth model here, with exports, clean tech industries sort of supporting GDP. There was this bright spot with retail numbers. They came in a little bit better than expected, but overall the levels are still quite a ways below pre-COVID.
And then, of course, we have the PBOC leaving rates unchanged. And then you look at the credit impulse. I know the credit impulse actually got a little bit of a boost in terms of some of the bond issuance. But again, the PBOC holding firm. And this is more about perhaps a position, a reflection on their currency perspective rather than macroeconomics.
Yes, I think that's absolutely right. It's just to put it simply, they just don't have much room to lower it because they do not want to start pressuring the currency. They don't want to pressure the UN. Partly, of course, they have one eye, of course, on the Federal Reserve. That promise to keep things sort of safer for longer. That's another concern for them too. So there isn't an enormous amount of room. The thing to really start watching for, I think, is probably the mid-year Politburo. We might see a bit more news emerging from that meeting around just where we go now with policy rates and also fiscal policy. And then, of course, the big meeting is going to be the third plenum. We don't have dates for that, but that is coming up in July. And it's the sort of one key meeting where I expect to see perhaps some hints that she might be taking much more forceful steps to try and support the economy.
Okay, Rebecca, thank you so much for being with us. Rebecca Chung-Wilkins. And this morning, as of course, China starts an anti-dumping probe into EU pork imports. So anybody thinks that the tariff landscape between the US and China is the only point of disruption, very much mistaken, as again, another anti-dumping probe into pork imports from the EU. So we have maximum uncertainty gripping markets, certainly in Europe over the past 6 trading days. Stephanie Roth is the chief economist at Wolf Research. She joins me now. Stephanie, good to see you. Who would have thought that, you know, the tail risk of the world would be the French government elections? But it does show you this potential risk of a whole new complexion of politics in France has made us waken up, I think, really to the political risk that could manifest later here, much more prevalently later in the year here in the United States or more America. What did you make of the disruption, so to say?
Yeah, I mean, I think it's just a reminder that now we're starting to hit the election season, and now we have to start thinking about tariffs in the U.S. and what Trump might mean for the U.S. economy from a tariff perspective, because that's starting to come into focus. People weren't really talking about that earlier this year, and now all of a sudden it's like, well, actually, this may actually be a reality, and we're talking about potential 60% tariffs on China and a 10% across-the-board tariff, which could hurt U.S. GDP by well over a percentage point. So I think this is just starting to become a reminder that we're shifting into this political landscape territory, and elections in France are just sort of a catalyst into this, and this is summertime is really when this is going to start to become in focus.
Do you think that possibly the spook that we had last week was even more adjusted, let's say, more aggressive because of perhaps a lack of liquidity and maybe the beginning of that summer season?
I think that's fair. I mean, every summer, especially in August, you
I think everybody's gone already.
Exactly. Every summer you often see something blow up in markets, and it's partially because of liquidity.
Okay, stay with me. We've got a little bit more to do. We're going to talk about what the Fed's perspective is. Is it one and done, according to Kashkari? I'm going to get you up to speed with your other stories on the Bloomberg terminal this Monday morning. What have we got for you? Buying TSMC shares in Taiwan while shorting its US listing has been long a popular trade. It started to backfire, however, as the enthusiasm over AI in the US pushes the Western listing to its most expensive versus the stock in Taipei. Regional finance hubs, Hong Kong and Singapore, have topped a new global list of the world's most expensive cities for expatriates, keeping Swiss destinations from the top spots for the second year in a row. Bill Gates says he is now prepared to deploy billions of dollars into the next generation nuclear power plant project in Wyoming to meet the growing U.S. electricity needs. Coming up in the show, Wall Street's boosting their calls for US stocks. More on that with the Truist Chief Market Strategist, Keith Lerner, a little bit later this hour. Stay with us. Good morning from New York. This is Bloomberg.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
From 6 all the way down to 1 in the span of 4 months. The expectations for the Fed's rate path has seen some changes this year. Stephanie Roth is with Wolf Research and remains on the desk with me this morning. So here we go. I mean, essentially what Kashkari is saying, we're one and done if you're lucky. And that is not what the markets, I mean, the markets are really front running the presumption this disinflation narrative will accelerate, isn't it?
I think that's fair. I mean, Q1 inflation, if you look at the average inflation in Q1, it was 4.2%.
Right.
In Q4, it was 1.5%. Was inflation either of those things? No. Inflation's probably running closer to 2.5%, which is okay for the Fed to be cutting.
Do you think they're overly cautious then? I mean, one after another ask for patience, they ask for prudence, they ask for time, they're data dependent. Are they being overly cautious?
You know, perhaps. I think Powell appeared for a period of time to be one of the most dovish members of the Fed. For a period of time a couple months ago, he was one of the ones saying, yeah, we're sticking with this inflation seasonality thing when the rest of the FOMC members seem to be throwing in the towel on that. But what we've learned over the past week or so is perhaps that's really true. And we're going to see core PCE print something like 0.17 for the next couple months, and then the Fed can cut in September.
Where does that disinflation come from? Where does that momentum, the continued momentum in disinflation, as you say, 0.15, it's tracking the core PCE is tracking 0.15% down for May. If we continue to get readings like this through the summer, they will cut. So where's the most disinflation going to come from?
Two things. One is going to be rent inflation. We've been talking about this for the longest time, and everybody's sick and tired of it.
I hope you can see it before I see it. Go on.
So there's seasonality problems in the rent inflation data, right? So in June, it completely goes the other way, in which case you actually could see that step down in OER everybody's been looking for many, many months now. But it's the next print that actually might be the place. And we were saying this in a couple months ago too. It's not as if we're just looking for the next print over and over again, but it actually is the June print where this goes the other way.
There is the growing argument that you're going to see the rise of the dual mandate. In other words, you're going to need to see a significant rise in unemployment, somewhere to the 4.3, the 4.4%, before they're going to take the action. Where do you stand on that?
You know, first of all, employment rate did rise to 4%. Granted, now they're talking about perhaps distrusting that data a little bit because it's been so distant from where the actual payrolls growth has been. So if you look
say
at
it's temporary. You say the recent softness in growth in this cycle is temporary, and we're going back above trend GDP. Atlanta GDP is tracking 3.5% at the moment. So it's going to be. I can't see how we get to 4.5% unemployment.
And maybe we don't need it because we have so much labor supply right now. Immigration trends have been really strong, which is the reason why the labor market has been able to rebalance in this environment. So I'm not sure they're looking for 4.5% anymore. I mean, the dots told you that. They're looking for a number a little bit above 4%, and they can still cut this year. So they're not necessarily relying on that, but I do think we probably need to see a softening. 250 on average in payrolls is probably a little bit strong for them to be able to actually be cutting. So if you see something like 200,000 or below, then that's a better environment. They want to get a couple cuts under their belt.
They want to get a couple of cuts under their belt, I think, but it's going to be potentially a fundamentally different scale of cutting cycle than we've seen historically. That's what the consensus seems to be. It could be one and done, according to Kashkari, and that's going to be at the latter part of the year. Or at the most, it's going to be 2. You're talking about potentially 50 basis points. You're not talking about anything shocking or radical that's going to change the mortgage market.
No, that's fair. We're talking about 2 cuts this year. Next year, we should probably get another couple of cuts. The thing that complicates things is if we end up with this big tariff situation, but we don't think that will actually go into effect until 2026, in which case they could probably get another couple of cuts done next year, too.
The speed of the bond market repricing last week was interesting, wasn't it? After the CPI and then the Fed reducing their dots, but still the bond market rallied, down 21 basis points. I've got in my inbox this morning furious bullish equity market notes and actually quite bullish bond notes, sub 4%. And I think these disruptive moments like French politics add to that momentum in the bond market, don't they?
Yeah, I think that's totally fair. And it was driven by the data and not the Fed last week, right? I mean, the Fed surprised us, if anything, slightly hawkishly, but it was the data that came out the morning of the FOMC that really moved markets, and for good reason.
Okay, let's leave it there. We'll see where we go to. The question is, let me just ask you this. On consumer confidence at a 7-month low. I mean, in the background of all of the hard data, there is another soft indicator that sort of suggests there's a little bit of a fissure in the system as well, doesn't there?
Maybe, but if you look at consumer confidence...
You're skeptical on that?
A little bit. If you look at the past 18 months, consumer confidence will tell you we are in a recession, and that hasn't been the case at all. So it hasn't been a great...
Do you think it's a bifurcated consumer? In other words, the consumer sentiment may well be lower at the lower end of the market, and it's resilient at the upper end of the market?
I think it's a little bit of both. I think it's a combination of the lower-end consumers is actually getting squeezed, and also people aren't happy that prices are high, but they can afford to pay it. So they're not thrilled about it. They're not thrilled about the political situation, but they're actually able to afford to spend, and they have been.
Okay, well, let's see what those retail sales give us this week, and we've got another little taster of an auction to come. Stephanie, thank you so much for being our guest this morning. That is Stephanie Roth of Wolf Research. Coming up in the show, a look at some of the other headlines making news this Monday morning. Context Matters on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg, context changes everything.
It's Bloomberg Brief this Monday morning. I'm Manus Cranny in New York. Time for a quick look at the front pages and what's making the headlines around the world. First up, we go to the Washington Post. President Biden, former President Barack Obama, along with a host of A-list celebrities, warning of the dangers of a second Trump term. This was at a fundraiser over the weekend. The Biden campaign called it the largest ever Democratic fundraiser. It's said to raise more than $25 million, and they're getting ready for a big TV spend going into this debate. Next up, on Bloomberg, Northeast will be experiencing its first heat wave of the season. Manhattan is set to reach 91 degrees Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees. Wow, get your aircon on. It's set to raise electricity demand, slow the transportation networks, and it is threatening a number of health risks. And on the Journal, Pixar's Inside Out 2 generated an estimated $155 million in the U.S. sales in the opening weekend. Now, the strongest debut for a film this year, and a jolt for the summer box office. Its domestic gross far exceeded that of the $90 million the box office trackers had expected. Now, we've been talking about the protests in France against Marine Le Pen over the weekend. Manifestation of perhaps just a taming of risk. You saw the CAC last week lose over 210 billion euros worth in value. So you've seen a small setting in the French assets this morning. Let's have a look at that for you. These are the US cross assets for you. Let's have a quick look at the European assets in the first instance. There you go. You got the CAC adding an 1%, as I say. You've had 4 weeks of outflows from Europe, and the far-right leader Marine Le Pen saying, look, she's respectful of institutions, again, trying to soothe some of the frayed nerves in the bond market. Yields trade at 3.19. Bear in mind, by the way, France is rated AA, Italy's at BBB and 3.90. It's been a long time since we talked about French government bonds, but we are far from a debt crisis. Of course, the concerns are around the fiscal policy of the national rally, and the euro-dollar steadies. Let's see what happens this week, as Kashkari says. We will probably be one and done before the end of the year on rates. This is Bloomberg.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. Charging ahead, Evercore, Citi and Goldman all boost their bullish calls on U.S. stocks. Disruption paused, French yields steady after political uncertainties drive the 10-year spread to Germany to the worst week since the 1990s. And a housing slump in China deepens, triggering new calls for Beijing to pump cash and credit into this system. A very good morning to you. This is at the state of affairs. We've got a trifecta of calls hitting the tape this morning. Equities are a little bit flat this morning. The S&P 500 rallied by 1.6% last week. Tech was pretty virulent, up over 6%. Again, a real reaffirmation as political chassis in France delivered American asset hegemony. The question Ed Yardeni asks is whether we're in a momentum melt-up, a blow-off top. To the bond market, you're looking at 423. We dropped by 21 basis points last week, the biggest weekly drop since the middle of December. The disinflation narrative grows. Neil Kashkari over the weekend talks about the Fed potentially being one and done by the end of the year. Certainly the market is just got cloth ears to the guidance, the verbal guidance from the Fed, and much more focused on the disinflation narrative. Copper, there is the dollar for you. It's flat at the moment. 12.6770 is where we are on the dollar. Again, the bullish sentiment around the dollar remains. So let's talk about those Wall Street bulls. They are getting more bullish. Evercore, Citi are just the latest teams to boost their calls on U.S. stocks. Julian Emmanuel sees the macro and the monetary conditions supporting Goldilocks with a year-end S&P 500 target of 6,000. Morgan Stanley's Mike Wilson strikes a more cautious tone, writing this. With economic surprise indices and bond yields falling, many stocks are now becoming more sensitive to softer growth conditions. This is the classic late cycle phenomena. Keith Lerner is the co-CIO, chief market strategist at Truist. You've seen a cycle or two. I mean, there's a frenetic frenzy to these new targets. 6,000 from Julian Emmanuel, evangelizing the AI situation. Goldman's upping their call by 3%. Do you think we're in a frenzy or just a pragmatic reassessment of the halcyon USA days? Good morning.
Hey, very good morning to you, Manus. Listen, I think what's happening is this market, especially at the top end, is moving quicker than strategists can adjust. So that's what you're seeing. We actually upgraded equities on April 23rd, and we moved up about 8%. So as we're moving higher, we're still constructive over the immediate term, but we're not becoming even more bullish as prices move up. I think this market, as you look at the last month, the S&P technology sector is outperforming the S&P by double digits. It's the most in 20 years. So, listen, it's hard to say when that momentum ends. We still like tech longer term, but I think we're more likely to be in somewhat of a more choppy fashion as opposed to the start of something new. I mean, again, earning trends are positive. The economy's in a good shape. We will be on an easing cycle globally. But again, we're not getting more bullish as prices go up as some of our peers are.
I mean, the whole belief that we're going to enter some magnificent easing cycle is getting more challenged by the day, Keith.
Yeah, but I think the most important thing is the direction. It's not so many other, we're going to have 3 or 4. Is the next move more likely a global easing cycle? I think that's correct. I think as long as even with the Fed, I mean, I know there's a big debate now. Is it 1? Is it 2? Is it none? We think it's likely 1 or 2. And as long as the signal is that the Fed is still going to cut rates, I think that is a positive as long as the economy stays resilient, which is our base call. What you don't want to see is an easing cycle that happens more aggressively because the economic growth is cooling much quicker than our expectations today.
I feel that we're living in a touch of Groundhog Day, but every day we talk about will the Fed cut and how much concentration do you want to technology. So let's take the Julian Emmanuel thesis this morning. He's calling 6,000. He is talking about an AI moment, and that is going to accelerate further. So let's just contextualize what he's saying. SPOOs were up 1.6% last week. Tech component was up 6.4%. But here's what he reflects back on technology. The forward earnings are 30.4. Now, if you reflect back to the year 2000, the forward earnings were at 55.5. So on a comparative basis, there's still a long way to go. I would put it to you, it's a different basket of tech, but when you look at it from the purest earnings point of view, that does not say that we are at stretch levels. How do you respond to that?
Yeah, well, we're overweight tech. We've been overweight tech all year long. And the main thing with tech is tech tends to outperform when the earnings momentum for the sector is stronger than the overall market. That's still the case. And some of the big moves that we saw last week, we had 4 big cap stocks all move double digits. That tells you that not all the good news is priced in. So I think that's fair. My only caveat is I don't know that one of the biggest bubbles of history is the best comparison to say how much longer we have to go, because then you're betting on a bubble. But there are some things I'll just point out. If you look back in 2000, into that peak, the 3 years into that peak, the market or the S&P technology sector was up well over 300%. We're up about 70% today. So it's not the same. But again, the only caveat is you want to use that as the main comparison when that was a bubble. So that's what you'd be betting on. I think tech, overall AI, is somewhat, as far as the productivity gains, is somewhat, somewhat early stage. I think what you're going to start to see is after these hyperscalers, you'll start to see on the software side, basically starting to accrue there, but it's going to be more marginal, meaning they're going to be able to raise their prices and add that as an add-on to some of their products for 3 or 4% gains per year. So it's going to be a big gain overall, but it's going to be marginal as far as, it's going to take time, and it's going to be kind of a step up each year is the way we look at it outside of the hyperscalers.
So beyond the hyperscalers then, many people come on the show and they say they want picks and shovels, they want exposure to that. Is it a purely American picks and shovels conversation, or should we now be talking about a more global lean rather than all in on the hegemony of the US tech supremacy?
Yeah, it's a good question. I mean, we've been Team USA for several years, and we are still Team USA. We think most of the best innovation is still in the USA. So if you're playing the AI thing, we still think it's the best place within the US. And you also think about it when you think about more index levels. The U.S. has a lot more tech than, say, developed international markets, which typically outperform when the banks, some of the more cyclical areas are outperforming. And there's a lot of questions around Chinese tech and are their motivation around profit, probably less so than U.S. So I would say we would still stick. If you're looking for AI, I think that the U.S. is the best place to be.
How did you and the team talk about the French shakedown last week? I mean, it really was the tail that wagged the global risk dog, didn't it? Bond yields lower, equities had a drive-by in France. There was a real moment of existential angst, and I was in Brazil, so I mean, I was tracking it from there, and it was really quite a gripping part of the conversation. How did you and the team talk about it?
Well, coming into this year, one of the things we talked a lot about is that we have more than 40 elections around the globe. So a lot of the focus, especially in the U.S., is around the U.S. elections and that uncertainty. But this is kind of reflects that there's global uncertainty. I still think on a relative basis, the U.S. is somewhat more stable. What's notable, going back to the equity markets, the MSCI EAFE index, right, the proxy for international developed markets, just made an all-time relative price low to the U.S. So in our perspective, that's still a negative. We've been, again, as I mentioned, Team USA. We have a big overweight to the U.S. We're still there. Maybe things are getting a bit extended on a short-term basis, but on a relative basis, for all the chaos we have in the U.S., I think we have actually somewhat more stability because of the institutions beyond just the presidency.
Look, there's no doubt about it. When you look at the funds flow, what is it, $30 billion of money flew into equity markets. 94% of that, according to Berenberg, was into the USA. So you don't see any sign of exhaustion. What about the rally in the bond yields? Was that driven predominantly, when Alaska said, look, that is all about the data. That is all about the disinflation narrative. Or do you think a little bit of toxic politics from Europe pushed those yields lower as well?
Yeah, well, I think the move down from 470 to the current levels, I think a lot of that was a combination of cooler inflation numbers, right? We had like the CPI number, the PPI number that was somewhat cooler. But I think the last move down was more of what's happening geopolitically. And we also had those initial jobs claims, which we have to watch closely, bumped up to above 240,000. So I think it's a mix overall. I think this level around 420 is an important one to watch. We're seeing a little bit of a bounce this morning. But in our strategies, when we were closer to 460, we went a little bit longer duration. I still think there's a decent hedge to have because of all this kind of geopolitical uncertainty and some of the cross currents. As we move past Memorial Day, we're seeing that the geopolitical risk, which were kind of quiet in the first half of this year, now come into focus.
Well, it certainly wasn't expected to come from the French Quarter. Sure it wasn't. Keith, thank you so much. There you go. Lessons of the European debt crisis. Dust off your books and have a look at your Franco-German spread. There you go. We'll be battered and bruised, Keith, before it's all said and done. That's Keith Lerner of Truist on the markets this morning. Coming up, those protests in France, as I said, erupt over the weekend as President Macron calls the election. More from Europe in just a moment. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Turmoil in France over the weekend following the calling of an election. For more, let's bring in Oliver Crook. Oliver, we had the theatre of the G7. We had protests against Marine Le Pen on the streets of France. Nowhere near what we saw in terms of protesting against her father decades ago. How palpable is political instability in Europe? Good morning.
I think it's extremely palpable, and it's mostly demonstrated, Manus, as you say, by the protests that are going on in France. Of course, Macron was at the G7, where I was also attending, and I went to some of the scrums, that had little journalist gatherings after sort of main events. And all the journalists that were around Macron, they didn't ask really very much at all about his view on global politics, on the G7, on Ukraine, all that. The focus was squarely at home and in France, where he has basically now thrown the complete spanner into the work. You have to understand the sort of degree to which this sort of upheaval in sort of the traditional political orthodoxies in France, where he came in, was not affiliated with any of the main parties. There were these columns of the center right and the center left. Macron blew that all up when he got elected, and now when he is intensely unpopular, he has left a huge political void in the background, one that has been filled by the National Rally, by Le Pen's party, a party that, Manus, as you say, has spent literally decades trying to get to this point where it's seen as a sort of potentially legitimate and viable option in France, and now looking like it will sweep maybe a third of the vote in the legislative elections. This is really, truly unprecedented in France, and all these little sort of coalitions of the Republicans on the right, sort of, a little bit of chaos there, and these sort of wide coalitions on the left, they're pretty flimsy, Manus. So for the market, this is an intensely difficult thing to price.
It's interesting. Le Pen herself comes out and says, I'm respectful of institutions. I'm not calling for institutional chaos. Financial markets don't really understand the National Rally's project. And therein lies the point as to why French bond yields spiked. The spread to Germany, which is the benchmark, also exploded. And if you look at what S&P are assuming, they're looking at a deficit ratio of 112%. By the way, there is a roadmap for what's happening in France. It was Northern Ireland, of course, the re-edification of Sinn Féin and the accession to power there. Let's talk about the relationships. You say nobody really was asking Macron about global questions, but there are global issues. This morning, breaking news that China are certainly assessing the situation on pork imports. Again, another layer of complexity post Xi Jinping sitting down with the leadership of Europe just a number of weeks ago.
Completely, Manus, and this is all the backdrop, whether it's the trade war, this instability in France, as today all of the European leaders are meeting to try to set out what the government looks like for the EU for the next 5 years, right? That is happening this evening in Brussels, where they're going to try to appoint all the commissioners and say who's going to be ahead of the commission for the next 5 years. And this is sort of the background. These are the global issues that they're dealing with. I mean, the pork one just alone, again, it hits a certain fragment of trade. It affects certain different countries within Europe differently, but it's not really about the pork, is it, Manus? It's about the tenor of what we're going in. Are we walking towards a sort of trade war? This is the big question for European leaders. And let's not forget, Manus, it's all very inflationary.
It is all very inflationary. Oliver, well done. Thank you very much. Setting the tone from Europe. Oliver Crook in Berlin. In corporate news, we've got UBS planning to give investors in Credit Suisse funds linked to the collapse of Greensill Capital. Remember that? In 2021, a significant proportion of their money back. Jeff Black is with me. I read the proportion that investors are going to get back, and I'm thinking, oh, this is interesting. I'm going to get a whacking chunk back in a disastrous investment. What's the number and why?
It's 90%. And for anybody that invested in these funds, which, as you will remember, of course, collapsed when Lex Greensill's business, lending to companies that maybe didn't have the revenue to cover the loans, went bust in 2021. if that's going to take an awfully long time, possibly another 3-4 years to resolve those claims. So UBS is trying to cut a clean line underneath the affair and give investors a reasonably good deal. And that's what they're doing, and they're managing a big reputational risk for them in the process.
Look, this is very reflective of the style of Armati, which is take the issue, deal with it, draw a line under it, either pay up and look large when it comes to regulation, pay up on the penalty. We saw it in a number of cases over his tenure when he was there before. They have taken a provision for this, so this is very much trying to close down issues and move along, isn't it?
Yes, although he can't completely close it down. The first issue is, of course, that provision, which is going to make a 900 million dent in second quarter profits. So that's one thing. The workout of the rest of the several billion worth of in those funds will take years. There's lots of legal claims against it. It will still continue to bump along in the background. It might not be such a financial risk for investors anymore, but it's still a risk for UBS. But yes, it's definitely Armati's style to try to make things go away in a sort of as decisive a manner as possible.
Okay, Jeff, thank you so much. That is Jeff Black, UBS trading, as you can see, over the past year, up 47%. It is all about the dividend, the buyback, and the narrative there, of course, the battle royal on capital requirements is perhaps the issue hanging over the background for management. Let's pivot to China. We've got the property slowdown there. No signs of it letting up. The latest data, to say the least, is disappointing, leading to calls to pump more cash into the economy. This comes as the PBOC kept rates unchanged for the 10th straight month. Rebecca Jung-Wilkins has the key takeaways. Rebecca, we caught up a little bit earlier. I mean, as you reflect on this, would cutting rates really be the solution to a huge overhang and surplus, which has taken, you know, quite a significant period of time to build up?
Yes, I mean, I think the short answer is probably not, although there has been this debate that, of course, you know, PBOC, Chinese government should step in and do more, but the real sort of problem is trying to revive demand in the property sector itself, to try and put a floor under those prices so they stop falling. We did see in May those prices getting worse again. The absolute numbers look relatively small, but when you understand them in the scale of history, so existing home prices fell by 1%, the most since they started collecting that data in this current form since 2011. And so the worry is that we are still not seeing a turnaround in the property sector, despite this 350 billion yuan plan to try and mop up some of that unsold housing, with governments, local SOEs stepping in to buy more properties. But it's really that plan that will be centrally in focus here, whether or not this affordable housing plan will be enough, whether it can be transmitted fast enough through the system to start turning around things.
Well, of course, that's going to take confidence, isn't it? You know, a great swathe of the Chinese middle classes had vested their future, their retirement, their wealth management in building property, in buying into the property narrative. I started by asking, was the PBOC cutting rates going to be a solution or a cure-all for the property sector? As you said, no. But then, is that much more about holding the line on the currency front for the PBOC rather than the domestic housing situation?
Yeah, absolutely. And I think for the PBOC, there is this sort of dual concern here. They're also looking at the Federal Reserve sending that message higher for longer, which is going to likely pressure the yuan. And so, you know, the PBOC is concerned about trying to resist anything that will add further pressure to the yuan, whilst also likely not really substantively changing things for the property sector. So quite a careful balance, but yeah, of course, fundamentally sort of quite a moderate response.
Okay. Rebecca, thank you so much. Rebecca Chung-Wilkins there with the very latest from China on the data. Quick snapshot of what's going on across your assets this Monday morning. There just seems to be a sort of a steadying in these equity markets. Flat on the S&P 500, 500. You've got some massive call-outs from Julian Emmanuel at Evercore calling for 6,000 on the AI revolution is in the early innings, so that's 500 points higher than here. Citigroup upgrades the US to overweight, substantially higher growth tilt relative to Europe. The dollar is flat at the moment and 10-year yields trade at 4.23. Again, both our guests this morning talk about the disinflation narrative. Neil Kashkari talks about being one and done from the Fed. So 4.23 is where we are. You've got a 20-year auction coming down the pike a little bit later this week. So that will test the longer end. $13 billion of 20-year paper. Coming up, a big week for central bank decisions. I'll run you through the slate in just a moment from a beautiful, hot New York. Good morning.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Your Monday Bloomberg Brief. I'm Manus Cranny in New York. Here's how your week looks. More Fed speak coming this afternoon. Williams, Harker, and Cook all hit the tape. U.S. markets will close then on Wednesday for Juneteenth holiday, and a marathon of central bank decisions coming from the UK, Switzerland, Norway, Indonesia, and China. 1 or 2 micro movers for you. Keep an eye on Broadcom again, building on its strength from last week, up over 3%. They're planning a 10-for-1 stock split. AI added $3 billion in sales, the CEO tells us last week. And then, of course, you've got the Julian Emmanuel, the evangelization of AI, targeting 6,000 on the S&P 500 and the AI revolution by the end of the year. NVIDIA up 0.6%. No day is ever set without a price check on NVIDIA. Good morning. Bloomberg brief closes, surveillance raises from New York. This is Bloomberg.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
We've got a broad story where the economic fundamentals look good, right? The growth story is pretty good. Inflation is coming down.
As far as what the Fed signaled, I think it was a very balanced sort of a message.
We're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently.
I don't think there's a lot of concerns necessarily about the U.S. economy going into recession.
The Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Upgrading U.S. stock forecasts into thinning air. Good morning. This is Bloomberg Surveillance. Anne-Marie is back from eating gelati and antipasta in southern Italy. John is doing his tour of duty somewhere beautiful and warm. He is off for the week. We are the lucky ones, however, because Danny Berger has agreed to join us throughout the week. Thank you so much for being with us. It is a week of so much Fed speak. It was the quiet period. Now it's the Fed's loud, very, very, very loud period. We have some key data. We also have this really big tension that's been culminating this week and over the weekend with a series of S&P forecasts to the outlook for year end. Danny, at a time when it's really being driven by a fewer group of stocks.
Yes. It was a record divergence last week between the market cap weighted and the equal cap weighted. And you look at Julie Emanuel, who basically says this upgrade is because of AI, is the early innings. Lisa, I think it's interesting to turn it on its head, not to say, should we be really worried this is a bubble, but to say, should we be worried that the rest of this market isn't playing ball?
And this is something that Lori Calvasina picked up on from RBC Capital, saying that it's making her really uneasy. She can understand the logic underpinning why NVIDIA and Microsoft can keep leading things going along, but this is a record divergence with the small cap stocks, and you have to wonder at what point people don't participate. It just raises the question of the vulnerabilities, and that's sort of the angst that you feel, Danny, underpinning some of this.
Yes, it is, because the margin of error is really narrow if it's only a few stocks leading it. But what is going on with the rest of this market? I mean, the economy is fine, it's growing, earnings are okay. The Fed maybe is going to cut this year. Is this a David Einhorn moment of the market is broken and there are too many price-insensitive buyers?
Well, it just raises the question of what could potentially go wrong. Anne-Marie, there is this issue of, not you, but when it comes to the political risk at a time where so many people say it's impossible to be able to really price that out. And yet last week, it really was in cold relief with what happened in France. How much was that really hanging over the G7 in a way that a lot of people didn't expect?
Domestic politics was almost the theme of this G7. They were able to get some deliverables over the finish line, but all of this, their issues at home, that is what was striking for so many of these leaders, because they stood around the table, and I think it was Politico that had the headline, "It's Meloni and 6 lame ducks." And that is exactly what it felt like, because what is going on in France? And Peter Cheer over the weekend had this note saying that Europe is making markets interesting again. And he didn't have a European debt crisis on his bingo card. He says, okay, that's long down the road. But he's saying the fact of the matter is you can have the far left and the far right potentially win big. And then what does that mean for the center when it comes to France?
And you can see the spread widening out between French and German bonds to the wides that we haven't seen since 2011 of the debt crisis. But I'm just wondering, when you forward it into the U.S., which is the stalwart market that everyone seems to be coalescing around, Anne-Marie, what are some of the vulnerabilities over the next 2 weeks? Forget heading into November, as we head toward this key election, as we talk about fundraising and a whole host of domestic issues that are coming to the fore.
It's full on campaign mode, whether or not you're on which side of the Atlantic. And Biden went immediately from an international gathering to this campaign event, star-studded event. He raised some $30 million according to the campaign, but the issue of his age, that was on display at the G7 as well. When you look at some of our reporting, what some officials and other delegates were saying and concerned potentially about his age, and that was on display as well in Los Angeles. And this is going to be something he needs to overcome at that debate in the next 2 weeks.
Yeah, unclear exactly how he's going to do that. We'll be talking about that and so much more. Let's just get a sense of the state of play, as we did have the 29th record high last week on the S&P 500. We're starting on a softer note, albeit this is not a softer note. This is basically flat. You've got S&P futures just a touch away from 5,500. You have, of course, Evercore ISA talking about 6,000 by year end, which is about 10% upside from where we are. The euro gaining just a touch versus the dollar after a really punishing session last week. 107.13. 10-year yields just marginally upward, but still so much lower than where they began last week, before we got a slew of data that spoke a lot louder than the Federal Reserve. And crude just basically hovering around that $78.38 mark. I want to take a look at the week ahead, which really comes down to 3 big data points. You've got retail sales on Tuesday, jobless claims on Wednesday, and the S&P, the jobless claims on Thursday, and the S&P Global PMIs on Friday, to give a sense of just how much we could get some sort of upset there. It is not the quiet week. It is such a loud week when it comes to Fed speak. Who is not speaking? It's Williams, it's Kashkari, it's Harker, it's Barkin, it's Daly, it's every single one of them who are going to be coming out and giving their sense of just how bifurcated this FOMC really is. At this point, we're looking at basically herding cats on the FOMC, which is what you could feel under Fed Chair Jay Powell's words. Coming up, Andrew Sheets of Morgan Stanley, with 2 stocks coming off 2 weeks of gains. Terry Haynes of Pangea Policy, as Biden and Trump ramp up their campaigns. And Neela Richardson of ADP, looking ahead to a slew of Fed speak this week. We begin with our top story, stocks coming off 2 weeks of gains as investors eye a slew of Fed speak on deck. Andrew Sheets of Morgan Stanley writing this: a clear path of disinflation, growth, and policy over the next few months sets up a constructive outlook across markets, but Beyond year-end, many uncertainties drive a wider than normal bull versus bear skew, reflecting a greater range of potential outcomes over the next 12 months. Andrew joining us now. And Andrew, we've been talking about how looking beyond the end of this year, frankly, looking beyond the next 2 weeks is a bit like staring into the sun or beating your head with something over and over again. Andrew, what do you make of the moment we're in where you have record highs, but with a smaller and smaller cohort of companies that are really keeping it all going?
Yeah, thanks. It's good morning. It's great to be here with you. Look, this is, I think you framed it perfectly. This is a pretty unusual, setup. And I think it's interesting to kind of claim that this is a very macro-driven market. There are obviously a lot of really important macro stories. But I think the phenomenon you just described is incredibly micro. I mean, it's really about a couple of stocks or a small number of stocks that are having an outside effect on the markets. And we see that within credit markets as well, where you see very low levels of correlation between individual credits, similar to how you see low levels of correlation within the equity market. And so I think it speaks to, first, a very idiosyncratic market. I think second, I think it's important for investors to appreciate that this is really important for how vol is so low in this environment, why the VIX is so low. If you think about a lot of different kind of stocks running in different directions, they can individually be very volatile, but if they're moving in opposite directions, they help to stabilize the overall index. So I think overall, for the moment, that lack of correlation is a helpful factor in kind of helping to keep overall markets stable. But I think it does suggest an environment of major winners and losers. And if something were to cause those correlations to rise, then you could very quickly have a lot more vol in the market.
I guess when you talk about low volatility, it depends where you look. If you take a look at the VIX, sure. If you take a look at even the mega caps that are driving this rally, they're swinging around, albeit only in one direction, up by some 10% on a regular basis. This isn't exactly a stagnant market or some sort of steady climb upward. What concerns you? What are the risks? Is it just basically the risks to the outlook of NVIDIA and Microsoft? And it doesn't really matter what the macro backdrop is. It doesn't really matter about the other 493 stocks.
Well, so I think there are kind of a couple of things to focus on. First, that's exactly the right way to think about it. The average volatility of a stock, say within the S&P 500, is not particularly low at the moment. It is higher, but because these stocks are kind of moving in opposite directions or moving independently, they help dampen each other out. If you think about people on the deck of a boat, if everybody's running to one side or the other at the same time, with high correlation, the boat rocks a lot. If everybody's running in opposite directions, the boat's more stable. So certainly I think that means that the earnings outlooks for these very large companies has broader implications across multiple asset classes, credit, equities, et cetera. I think the other concerning factor, the other important factor is just this kind of very odd dynamic we had last week with inflation in the Fed, right? You had a very good inflation number, kind of 0.0 month over month on the headline inflation. And then the Fed comes out later that day and raises its estimates for core inflation in the summary of economic projections. And I think that confused the market, quite frankly. And the Fed was clear in the press conference that those summary of economic projection numbers didn't fully reflect the good CPI data that they just had. But I think that's left the market more concerned that maybe the Fed is more backward looking and not interpreting, not fully appreciating some of the recent slowing of some of the data. And so I think that means certainly for, say, credit markets, good is good. I think the market this week wants better data. It wants to be assured that the economy really is strong. And I think weak data will drive more fears that the Fed is kind of looking in the rearview mirror and too backward looking based on kind of the summary of economic projections last week.
Well, Andrew, the first bit of Fed speak we got post-meeting wasn't exactly encouraging in that they would have changed their dots today. We heard from Kashkari, which maybe this won't come as a surprise, saying that he thinks one cut is reasonable at the end of the year. Mester spoke to Bloomberg, saying that the dots are close to my prediction. That doesn't exactly argue that they would have put 2 cuts in had they had the data in hand. So what do you need to hear from Fed speakers this week to calm you, to make things less confusing?
So I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data. I think, we have retail sales, we have industrial production, both on Tuesday. Morgan Stanley is expecting those numbers to improve, to bounce back. I think if the market sees healthy data, then it will become a little bit more relaxed. It will say, okay, that's fine. The economy is still humming along. Inflation's coming down. We care a little bit less, exactly when the Fed makes its first cut or exactly the pace. But I do think kind of the way that the last week played out, I just think it makes the market more sensitive to weaker data prints in a way that's a little bit different, right? We've had some times this year where, good data or weak data has been interpreted positively. I think there's a risk that that's no longer the case, that the market really is rooting for better data, and weaker data will be more challenging.
Andrew, what's changed? Because that is a big change, right? That the bad news is good news, bad news now being bad news. Why is that the case this time?
Well, I do think, some of the setup from the Fed could have changed that some. I think the fact that you've seen, some of the economic data has been a little bit softer. The economic surprise
Europe Stoxx 600 hits fresh 6-week low, last down 0.3%.
You start to see kind of the unemployment rate tick up a little bit. Now, we think immigration is a big reason for that, and so the unemployment rate is ticking
Europe
up
Stoxx
for
600 hits fresh 6-week low, last down 0.3%.
I think it's kind of a combination of those factors. And again, I think in kind of small doses, that correlation could be more uncertain. But I think what the market is probably most worried about, just because this over multiple cycles has been the major issue, is a scenario where the data weakens, the Fed is slow to react. That's happened over multiple economic cycles, and that is often the worst outcome for markets. So again, we at Morgan Stanley are expecting the data this week to be mostly better. So we think that could help, but I think it's important to watch, and investors should also be watching that correlation closely because, for any potential shifts.
Andrew Sheets of Morgan Stanley, thank you so much. And Danny, I'm glad that you mentioned the Fed speak that we heard last week, because frankly, it was all over the place. It wasn't exactly one commentary that came through. It was basically some people saying, I want to be hawkish. Other people saying, I would have cut rates, like Goolsbee, for example.
Right. I mean, but they do continue to have this refrain, we can be patient, we need to wait for 2%, that sort of thing. But, didn't we make this mistake before, to Andrew Sheets' point of we can just pay attention to the data and not pay attention to the Fed speak? Isn't that the mistake we made at the start of this year when we said, they're going to cut some 6 times, and then, oh my gosh, no, they're not. We have to pay attention to that. Are we doing it again, but albeit to a lesser degree this time?
Kashkari over the weekend was asked specifically about that Bank of America report that basically says the Fed will cut rates once this year. I think that's a reasonable prediction, and it looks like it's going to be in December.
And that's what a lot of people are coalescing around. We'll be following that throughout the morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. Oil edging higher after mixed economic data out of China. This coming as the Biden administration is reportedly ready to reopen the U.S. stockpile if prices jump in the summer months ahead. Amos Hochstein, President Biden's closest advisor on energy, told the Financial Times the administration will do everything they can to make sure the market is supplied well enough to ensure as low prices as possible for American consumers, which includes releasing more oil from the Strategic Petroleum Reserves. The U.S. has mopped up almost 1/3 of all the global investment flows since COVID. Analysis by the International Monetary Fund showing that the U.S.'s share of financial flows has climbed, with higher interest rates a major draw for overseas investors. The U.S. has also pulled in a fresh wave of foreign direct investment. But there may be challenges ahead from Fed rate policy and the presidential election, which could affect the fiscal deficit. And Pixar's Inside Out 2 is Hollywood's best debut since Barbie. The movie grossed $155 million at the box office in the U.S. and Canada, besting Dune Part 2 as the movie with the biggest opening weekend of the year. The film also notching a record. Inside Out 2's nearly $300 million haul globally is the biggest opening weekend in history for an animated film. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. It's nostalgia, it seems like. That's what sells, right? It's like the Dune 2, Inside Out 2. You want to see it. You haven't been to a theater before
I have
COVID.
not been to a theater.
All right, we'll have to change that. Up next, campaign season at Kicking Into Gear.
The Supreme Court has never been as out of kilter as it is today.
4 years ago, our border was secure. Inflation was nowhere to be seen. We didn't have inflation. The world was at peace and America was stronger and more respected than ever before.
That's coming up next. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
We're still debating Inside Out 2, and we are going to take Anne-Marie straight from southern Italy into a movie theater in New York City for her day off. This is Bloomberg Surveillance on a day where we're not seeing much market action after a week where really we saw 4 straight record highs, 29th of this year on the S&P. Today we're down about 0.1%. Not a lot of drama as we take a look at the concentration here. Yields just up a touch, a basis point. This again, not a lot of drama. Euro gaining just a touch, but really flat, 107.05. Wow, I'm really selling it. Let's get straight to it. Under surveillance this morning, campaign season kicking into gear.
The next president is likely to have 2 new Supreme Court nominees. 2 more. He's already appointed 2 that have been very negative in terms of the rights of individuals. The Supreme Court has never been as out of kilter as it is today.
4 years ago, our border was secure. Inflation was nowhere to be seen. We didn't have inflation. The world was at peace and America was stronger and more respected than ever before.
Here's the latest. Donald Trump and President Biden ramping up their campaign efforts over the weekend ahead of next week's first presidential debate. That coming as a Pew Research poll shows that 1 in 4 voters don't like either candidate, so-called double haters. That's twice as high as it was in 2020. Joining us now is Terry Haynes of Pangea Policy, who's on top of everything from Inside Out to what we should be watching ahead of that key debate. Terry, where is your center of focus on a week where we have a lot of rhetoric and, frankly, a lot of concerns about voter enthusiasm given those double haters?
Other than Inside Out 2, I think I think what'll happen is you'll get a ramp up to the June 27th debate over the next couple of weeks because there won't be much going on in politics, and everybody will wrap themselves into a tizzy about this stuff. But it actually is consequential in a lot of ways because, as you were pointing out before, and it's one of my analysis points as well, Biden's got to show pretty much every day between now and November that he's up to the job and that he's kind of the saner, calmer alternative to Trump. That's the frame of the election to me, because then more people are likely to pull the lever for Biden, go the next yard if they get there. If they can't get there, then this election gets upended.
How difficult is that when people's frame of reference is already that they're concerned about his age? Our reporting from the G7 over the weekend was how other delegations were keeping a careful eye on Biden. They say he was very cogent when he jumped in on conversation about Ukraine. This is one source, but then looked a little bit to be zoning out when the conversation moved on. If that is already the base case, how much work does this administration really need to do?
Well, they need to do a lot of work to show to continue to show and have him show that he's up to the job. They can't do it for him. But a lot of these clips over the past week or so, as you were talking about earlier, are concerning. They're going to need to dissipate that, and Biden's going to have to be on his toes, not just because he's talking to an audience that's a huge audience in the United States and around the world, but also he's on stage with his major competitor, who's going to do everything possible to try to discombobulate him. It is. I think he's up to the challenge, but there's a bar there that's not insubstantial.
You still think Biden is going to win this election? You do, right, when you talk about trying to define this election. Trump has his own issues as well. What is going to be his biggest test at this debate?
Well, I think that his biggest test is going to be, frankly, not going off the rails and coming in too hot. The joke around Washington last week while you were eating gelato was that, Trump comes to Washington and all of a sudden he's sounding reasonable in meetings with business leaders and with House Republicans. And, where did they put the other Trump guy? Trump's major problems are twofold. The Republican Party is split, as you can see from the Haley votes in the primaries, and Trump courting Haley, which legitimizes my point, and that he's not doing that great against or with independents. He needs to do both: consolidate the Republican Party, appeal to more independents in order to have a good chance to win. So he's going to have to calibrate himself in that way and not worry too much about making Biden jumpy or feel worse.
Punchbowl has a great headline this morning, Terry. If it's Sunday, it's Trump VP Day, and you saw a lot of potential picks hit the airwaves yesterday. Where do you see the short list right now for the Trump camp?
I think, honestly, where it should be. I mean, I have no personal idea of what Trump's thinking. What it should be is Haley. Because Haley's the only one that unites the party and begins to make that independent appeal. I know there's some dissent about that even in polls, but point of fact is within the party and moving towards likely independent voters, Haley's the pick. And I think there's precedent for that, frankly, with Trump's pick of Pence in 2020. Not the same person, but in 2020, what Trump understood he needed to do was appeal to traditional conservatives who were somewhat put off by his, kind of all over the map performance. And Pence succeeded in that, both in the campaign and in the general election. So, anybody else other than Haley, I think is second best or third best. And, no offense to Senator Cotton, for example, or Senator Scott, but they're going to be on the campaign trail doing what they do anyway, being attack dogs anyway. So you don't really get that much out of having Cotton or Scott, let's say, be the vice presidential pick.
Well, Terry, you say it should be Haley, but what's the actual realistic probability of that happening? Because you had her very much so distancing herself from Trump. Even her so-called endorsement of him was basically just like, yeah, I guess I'd vote for him because he's the Republican candidate. They don't seem like two people who particularly like each other and would be willing to split the ticket.
But politics is full of people who don't really like each other yet making accommodations together. Haley's playing an interesting kind of rope-a-dope game, and Trump has been courting her over the past several weeks. There is a small window, I think, between the time in which Trump is sentenced in New York and the Republican convention starts that Haley gets to make a decision, and I think she's very much in the driver's seat on this. But the decision essentially is whether her political future is better off not only in the tent, but in the tent as the vice presidential nominee, or whether her preference is to stay out of it and stay aloof from the general election and try to pick up the pieces after she would think Trump loses. So it's going to be a very interesting next few weeks.
Terry Haynes of Pangea Policy, thank you. you so much. And next couple of weeks ahead of that June 27th debate on CNN, what are you looking for most of all, Anne-Marie?
I'm with Terry. I just want to see how they act. Does Biden look like he's up for the job and energetic? We've seen a lot of reporting. This is one of the concerns. And to his point on Trump, how does he try to look like potentially he is not coming in super hot and he looks presidential? Can they both do that?
Is it actually going to happen? You really think so?
Yes.
Okay.
It's happening.
I don't know. There was a real question about that for a while. Coming up, not that. A slew of Fed speak on deck this week. ADP's Neela Richardson joining us next. Right now, you're watching Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
A new week after a week of record highs, albeit with less and less leadership. It was really remarkable last week. Good morning. We took a look at the NASDAQ that was up more than 3% versus the S&P's almost 1.5% gain. 4 record highs. Today we're pulling back just a touch. S&P futures lower by just 0.1%. NASDAQ, though, still up. and really being punished. And Danny, this is what we've been focusing on quite consistently. The Russell 2000, it's damned if you do and damned if you don't if you're the small cap.
It's true. I mean, we heard it from Andrew Sheets of Morgan Stanley that finally bad news is bad news again. You would not know that from looking at the index because it is the mega caps, as you allude to, Lisa, that are papering over. Finally, us being concerned about some level of slowdown in this economy.
Which raises this question of whether the bond market is really driving this, whether the two can diverge, and how much macro data is really going to undermine or has the potential to undermine what we've been seeing in the equity strength driven by those names. In the bond space, we saw a massive rally last week, a huge set of flows into, in particular, U.S. duration. We're taking a little bit of it back. The emphasis on a little bit, 423.44 on the 10-year. 2-year yields just hovering around that 470 mark, the 30-year 4.37%, but really just what a rip-roaring rally. And then you have to wonder, what takes precedence? The sort of hawkish message from the Federal Reserve and the slew of Fed speakers this week, or frankly, what we've seen in the data, which is true softening, true disinflation, and frankly, a growing concern that this is tipping over into something a little more protracted.
The bond market has taken its own narrative. It's not listening to the Fed speakers. It's not listening to Kashkari, who says, yeah, okay, maybe it's one cut in December and that's it. But again, I go back to this idea. We fought the Fed before, and it didn't play out well. We fought them. We decided this was the year of the bond market, but because they weren't ready to cut, that play was wrong. So are we wrong again this time? Should we be paying more attention to the so many Fed speakers we're getting this week?
Yeah, or do you just basically, how do you fight the Fed or not when the Fed is not exactly a monolithic group with a particular group? If you translate this through the FX channel, what you can see has been pretty consistent and dramatic euro weakening. And what we see today is a continuation of that around 107, a pretty significant pullback after what we saw with the French turmoil. And let's get to that. Under surveillance this morning, far-right French leader Marine Le Pen saying she won't try to oust President Emmanuel Macron if she wins the national election at the end of the month. Speaking to French newspaper Le Figaro, Le Pen saying she's not calling for, quote, institutional chaos, and that there would simply be cohabitation. So, Anne-Marie, cohabitation, what does that look like?
She says that she is going to be respectful of institutions, and I think you actually see that in the markets. It's starting to quell some of that concern. She has been vying for influence for decades, and she is on the cusp of getting it. So I think that's why she's coming out and saying, everyone calm down. She's trying to, I think, lean towards what Giorgia Meloni has been able to do in Italy, have far-right rhetoric, but at the same time be able to govern and be an actual partner when it comes to the EU. What this actually looks like is going to be, obviously, a disjointed government. And can a lot actually get done in that place?
Maybe that's a good news. Maybe that's good news for this market because you can't actually get anything done. So maybe the things she wants to push through, maybe it kind of looks like America. That really the worst that it can be for the deficit isn't that much because of inaction, because of cohabitation. It's so French, cohabitation.
ECB President Lagarde says the ECB is attentive to proper functioning of markets. So currently speaking in Marseille, outside Paris.
Disappointing data out of China, the country's housing slump deepening in May, while industrial production rose, but at a slower rate than forecast. Retail sales offering some encouragement, picking up a bit more than expected, but still a real question, Danny, on whether you get the PBOC adding stimulus, what more they can do, and frankly, what's going to revive the slump that we've seen in the world's second biggest economy.
I mean, they've already unlaid a $350 billion plan to revive housing. Clearly, it didn't do that, but the PBOC didn't trim its rate this morning. Bloomberg Economics expected that they would, saying that they have an opening. They had an opening from the ECB cutting, from the Bank of Canada cutting. Therefore, they wouldn't have to worry about their currency weakening as much. But they didn't, Lisa. And maybe this is just a PBOC that is waiting for the Fed. Maybe they won't move until they do.
Also, other news out of China that I'm looking at, because we've been waiting for this retaliation. They said they're going to start, and this comes from pork imports. It's very tiny, but this could be the start of a more heated trade war with the European Union.
In terms of overproduction or something similar, overcapacity types of arguments akin to what Europe has been making toward China. So it's sort of, two can tango. We can cohabitate with an aggressive tilt together. A slew of Fed speak on tap this week. We'll hear from Williams, Harker, and Cook today. There are 6 more speakers tomorrow, plus retail sales data. On Thursday, more Fed speak, plus housing starts and jobless claims. Neil Richardson of ADP writing this: jobs aren't everything. Labor market data has been decent news, but as the Federal Reserve takes a wait-and-see approach on interest rates, we see big changes afoot on pay. Neela joining us now. And Neela, what I love is you can dig beneath the data at a time when it has been so confusing. Can you give us a sense of just sort of the sea changes under the hood that might be warping some of the overall index levels that we're tracking?
Sure. Well, good morning. It's great to be with you all today. I think what's interesting about this moment is that this is the most poked and prodded economy that I've ever seen. Every data point seems live and important, but it's not, it's sometimes a cacophony. And what we're looking at ADP, we're going through to what we think is most important in this economy, which is how companies hire and what they pay. And that has changed significantly over the last 4 years. We've seen shifts in geographic distribution, so people are commuting long distances. That has an effect on pay. In fact, we find in our latest report, it's out today, that people who actually go the distance for employment make 16% more than people on their own teams. So that's a huge change, and it's under-examined in this market. We're seeing pay distribution change, the gaps between the wealthiest workers and the lowest paid workers has grown by our estimate 5 percentage points over the last 4 years. We're seeing occupational changes where software developers, which should be an in-demand job with all of this talk about AI, there are fewer software developers now than in 2018. And then, of course, for all of us who have teenagers, summer hiring is in focus. The summer looks strong in terms of jobs, but not so strong in terms of pay for these young people. So all of these shifts feed into the narrative and the distribution of the worker, not something we talk about a lot.
And I guess that's part of the reason why the data has been confusing, because there are these structural shifts that doesn't necessarily show itself on a headline level. So what do we do with the data then? Should we just ignore it? Should we discount it because things are different and what it's telling us isn't really what's happening under the surface?
We can't discount it because we know that a certain really important institution is pegging a certain really important decision on the cacophony of data points. But that one move won't shape the economy. Whether you lower interest rates by one dip this year, 25 basis points or 2 or 3, really won't change the distribution of the U.S. workforce, which has shifted. And I think that's what we're seeing in the data. That pay change, this low level of wage growth that was really keeping the economy on track during the 10 years of expansion is not here now. That pay is changing, it's evolving, and that evolvement in pay means that inflation may go up, may be higher for longer, and the Fed always has to be watchful on this data point and on pay in particular.
Consumer sentiment did not look good on Friday, and the director of the survey had this to say: the views of middle-income consumers resemble those of their lower-income counterparts, a departure from historical patterns in which their mentions are squarely in between those of higher and lower-income consumers. So what are you saying is that the wage gains are not on par with the inflation that middle and lower income individuals are feeling?
You know, what they're seeing is price levels, and they're looking at, yes, their paychecks, but they're looking at what's in their basket at the grocery store. And as long as there's a disconnect between how much their take-home pay has grown and how much their basket has shrunk, they're always going to be a little moody. Now, we've seen that a moody, bad vibes on the consumer side does not necessarily translate to lower retail spending. That's going to be something to watch this week. Last April, retail spending was flat. Those vibes have crept in. How long, how permanent they are, whether they affect spending is going to be really important. We've seen some resilience in the consumer, I would argue, from the high-end consumer. They have been carrying this economy. So it's a really interesting situation that we're seeing in the pay when you take the pay and the retail side together. What you're seeing is that firms are raising prices because they have to increase pay for all those double-digit pay gains they've seen from low-paid workers. But the people who've actually benefited the most are high earners from asset prices, from higher wage gains. And so you have this combination, this cohabitation. I was trying to work it in. I was really trying to work it in. Between high-spending, high earners and low-income workers who are seeing high pay growth but not able to spend at the same rates because of higher price levels.
I'm glad that you brought that up, Anne-Marie, that survey that came out and the commentary from what we got from the University of Michigan survey. It kind of raised alarm bells for me because it's atypical. Usually what you see is that middle-income workers kind of are in the middle when it comes to how they feel relative to the high end and the low end. They're not this time. They're shifting to the low end, and it raises this question. It's been the big question for a lot of people. Are we seeing the beginning of a shift downward that's going to be a more protracted weakening in the labor market? Are you seeing that? Is this a problem for you that whatever it is, you can't reject people's feelings en masse, and so there's something going on that's going to potentially have a significant impact on the economy?
Feelings do translate into behavior. That's why we measure them. That's why they're important. And if you're seeing a diffusion of bad vibes, I'll label it that way, bad vibes through the income distribution, it doesn't spell good news for the economy. What I hear from Main Street is I'm delaying. I'm being like the Fed. I'm going to watch. I'm going to watch before I take on that new lease in my new car. I'm going to watch before I buy that investment property, that rental property. So that waiting and watching has an effect on the economy. So even if you can afford to spend, you may not do it this quarter because you're waiting.
So this is sort of the divergence between the bulls and the bears. Some people, I'm thinking of Andrew Hollenhorst out there, is thinking this is the beginning of a real weakening that we're going to see in the labor market. Last week's climb and initial jobless claims was a harbinger of a greater degree of weakening under the hood. Do you see that?
No. I think, again, that goes back to my comments about this economy being
ECB's President Lagarde says we are attentive to the good functioning of financial markets.
Every quarter. You're going to have some weakness here and there. There's going to be weakness in pockets, but that doesn't mean that it's a persistent diffusion. What we're trying to figure out, and it's a hair-trigger decision, is when the Fed can feel comfortable cutting rates. That doesn't mean the economy is bad because they start cutting it. Doesn't mean it's necessarily good because they start cutting it. I think what it means is that the Fed as a whole, collectively, feels that they're a little more restrictive than they want to be in this particular normalizing economy.
So feeling better about the vibe session, maybe. But, okay, one of this idea, again, not to harp on this, but this idea of all of a sudden everybody's feeling a lot worse and the middle income consumer too. Jim Bianco, in looking at that UMich data, basically looked at it and said, there's been something strange happening with it. It's actually democratic opinion that has really turned. I wonder if you look at it and say the same thing, maybe what's actually happening is that political bias, but it's this huge cohort saying maybe Trump is going to be elected. So it's still that political influence, but on the other side too.
It's hard to tell at this stage. We know that Mich survey has had a methodological change too. It's gone online. We don't know if that changes the sample. We've seen, though, for the past 2 months, pretty downbeat sentiment. I'd be hesitant, though, given the changes that we've seen on the methodological end, to put too much on the political differences right now. But we know that politics does affect opinion, does affect vibes on the economy, and we'll see and should track how that plays out over the course of the next 6 months for sure.
Mila Richardson of ADP and a Bloomberg Television contributor, thank you so much for being with us, as always. Looking forward to next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with our own Yahaira Hackes. Yahaira.
Hi, Lisa. The Israeli military is beginning daily combat pauses along a key route in Gaza to increase the delivery of aid. The pauses run from 8 a.m. to 7 p.m. along the route and will be in effect until further notice. The army saying the moves are being coordinated with the UN and other agencies as humanitarian aid has faced major delays since the invasion of Rafah began in May. Deliveries have failed to reach their destination as they are sometimes intercepted by desperate crowds or seized by Hamas fighters. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming to meet growing U.S. electricity needs. The billionaire telling CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also making it safer and could make nuclear energy a source of low-cost electricity. Gates says TerraPower's plant is on track to start producing power by 2030. And the season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Here in Manhattan, we're set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service, which also said some areas could experience the longest heat wave they've seen in decades. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, is this a Liz Truss moment?
Drawing comparisons between what could happen in France versus the mini budget crisis in the UK in 2022. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
So basically someone in the control room is trolling me. But that's coming up next. You're watching Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice, saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Into a new week, really kind of more abound when it comes to where markets are. It's been anything but, though, last week, really climbing to record high after record high, but on a fewer and fewer cohort of names, all tied to the AI trend. What we're seeing right now, pulling back just a touch from the 5,500 mark on the S&P at the same time that you have the likes of Evercore ISI looking for 6,000 at year end. Euro gaining just a touch, basically wavering here around 107. 10-year yields up just marginally about a basis point to 423, and the crude levels you can see just lower by a touch. I want to watch this though, Anne-Marie, given the fact that we're seeing that increased demand due to the heat wave.
Yes, and also Amos Hochstein overnight talking to the FT, talking about the fact that they will step in if they see gasoline prices go higher, including alluding to the fact that they could tap the SPR again. Election Strategic Petroleum Reserve, as Jonathan would say.
All right, well, we can talk about that extensively. Right now, under surveillance this morning, the moment we've all been waiting for. Is this a Liz Truss moment?
It doesn't really matter in terms of if it's a left coalition or right coalition. The fiscal policies are worrying. Drawing comparisons between what could happen in France versus the mini budget crisis in the UK in 2022. I've heard a lot of questions from clients about that as well. Those are the scenarios that people are talking about. So beyond the headlines, let's have a look at the policies. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
Here's the latest. The euro coming off 6-week lows ahead of snap elections in France. France later this month. Far-right leader Marine Le Pen making an appeal to moderates and investors, saying she won't try to push out President Emmanuel Macron. Instead, it'll be cohabitation. Polls showing her party holding a lead with 35% of the vote, with Macron's party polling third at 19%. Joining us now is Elsa Linos of RBC. Elsa, do you think that the risks are sufficiently priced in of potentially Euro anxiety, the idea that there could be some sort of shift away from the collective region by a major economy, namely France?
It depends which market you look at, to be perfectly honest, because the spot market has barely budged. Yes, euro is a little bit lower, as you mentioned, but that's really euro dollar. If you look at euro yen, still very much near the highs. Euro Swiss has had a decent move, but only really back to levels where we were in February. The vol market's been pretty different. You know, I think tail end of last week, you saw a lot of interest from investors to buy some euro vol, to put on some downside structures. But even that, you know, Monday, given the news over the weekend and Marine Le Pen saying she'd work with Macron, not looking to push him out, investors are already fading those moves. So to answer your initial question, is it priced in? No, clearly the worst case scenarios are not priced in at the moment.
Potentially, though, we could see a hung parliament. In that case, Elsa, do we just go sideways in terms of euro trading?
It's very possible, and I think, frankly, that's why people are struggling to pile into short euro dollar positions at the moment. The fact is that we have seen cohabitation before in France. You know, we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out, and I think that makes people nervous about putting on positions, having seen it not work so many times before.
Well, Elsa, if that's the case, and it's unlikely to be anything disastrous when it comes to a deficit, let me put this idea to you, that what we're seeing from the market is they are simply trying to test the ECB. They want to see if the ECB comes in and cap spreads like they did when Meloni was elected. Is that what it is? Bond vigilantes pressing Christine Lagarde and co.?
Yes, it's definitely true that you've seen more of a reaction in the fixed income market than you have in the FX market. And part of that is, to your point, you know, markets pushing the ECB to see where's their limit. I mean, the fact is we heard from ECB officials over the weekend, you know, this is a repricing. And to some extent, they're quite comfortable with investors repricing a higher risk premium for France because that is part of the market mechanism. Now, if it looks like it's getting out of control and, you know, it feels like the market is getting dysfunctional, then you may expect the ECB to step in. But otherwise, I think the ECB are going to be quite reluctant to rush to the rescue.
But what if it starts to seep into Italy, to Spain, to other countries where we start to worry about fragmentation, where we worry about their deficit levels? Could the ECB then act?
Absolutely, but that's not really what we're seeing at the moment. I mean, in fact, you know, a lot of the observations people were making on Friday was precisely around the fact that France was trading through certain other countries. You know, when France is trading through Spain or Italy or so on, you know, that in itself tells you something. You know, it tells you that people have reassessed how they're perceiving the risk of French fiscal side. And it's not so much about France exiting the EU. I don't think anybody, you know, that's obviously a terrorist that people have in the back of their minds. But this is far more about the fiscal agenda and what's going to be the policy in terms of fiscal outlook.
Elsa, what I find fascinating about your recent research is you kind of get the sense from you that maybe you think the dollar should be stronger than where it is. That all things being equal, given the uncertainty in Europe and given what we're seeing, which is a pretty resilient economy in the U.S., the AI tailwind, the idea that people are taking weight loss drugs and getting new clothes and spurring a new boom there, whatever case, you should see kind of dollar preeminence. Why do you think we're not seeing an even stronger dollar? What do you think that suggests about where people's minds are at?
I mean, to some extent, you know, you can see that bias in our forecast. But frankly, I've had 106 as a kind of low for this year. I haven't changed it. I still feel quite comfortable with that number, which is not a long way from where we are today. And 108 on the other side, you know, it's really very much a range trade. Part of the reason I think people are reluctant to pile into long dollar positions is because there are some questions out there around the strength of the US economy. It's not our view, but there are some people out there who are saying, you know, we're seeing some cracks begin to emerge. And if the US were to hit recession, I do think euro-dollar would be quite a lot higher. And it's that uncertainty on both sides, political risk on the one side, uncertainty around the strength of the economic data on the other, and the fact that we've already priced in a very good US economic outlook. And so, the risks on the economic side, at least, are to the downside for the US.
When it comes to the dollar, investors are still split on what a Trump presidency would mean to the dollar. Why?
It's a great question. I think in part because Trump himself is so ambiguous on what his policies would be if he were elected. You can expect that he would make a lot of noise around the Fed, push the Fed to be a lot more dovish, but I personally question to what extent he could really force the hand of the Fed. He can't nominate a president or a chair, for a couple of years. And on the flip side, there's a lot of talk around America First, around tariffs, around how much more aggressive tariffs could be in a second Trump presidency. And that leads people to think the dollar would strengthen, other currencies would weaken. So you can see how on both sides there is, a push and a pull. Where I do think markets are perhaps overly worried and maybe need to tone it back a bit is the long-term deficit outlook. Yes, it's something we need to watch, but from the dollar perspective, as long as the US private sector is running a surplus, that's much less of a currency story than some people make it out to be.
Elsa Linios of RBC Capital, thank you. So it sounds like, Danny, she's not completely on the Liz Truss moment side if it doesn't seem like she's, climbing into the deficit camp.
True. I still really like this argument. I'm going to be honest, Robin Brooks put it forward that what we are seeing is not a market that thinks it's going to be a Liz Truss moment, but wants to test the ECB. That the ECB let the cat out of the bag in 2022 when they stepped in for Italy's election and helped to cap yields. But then you get to this uncomfortable space where if they do that, then are they interfering in politics? Are they making a Le Pen government more palatable?
So a Christine Lagarde moment. We can get there. Coming up, Citigroup's Stuart Kaiser, Bloomberg's Wendy Benjaminson, and Enda Curran, as well as Kelsey Barrow of JP Morgan, on a day that we are leading into a week of Fed Speak. It is full-on Fed Speak week. This is Bloomberg.
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
You have to distill down what is the purpose of what you do, what is the purpose of your company, and make that very clear, and repeat it and repeat it and repeat it. And it's very clear what our purpose is to make money for the Norwegian population.
So why did you accept the job? You had a great life. I mean, you had a hedge fund that was doing very well. You were earning lots of money.
Well, I had a great life. I had a great life, but I still have a great life, and a really good life. No, I was very keen on that job because one, I think it's one of the most important positions in asset management, right? I love asset management. In terms of the opportunity to develop that organization further, there were great opportunities, and I love organizational development. And then to do something nice for the country. I mean, these three things came together in the same job.
Why do you love asset management? Because you can influence and change the future, or is it being cleverer than anyone else?
Asset management is the most interesting job in the world, perhaps after being a journalist. Why is that? Well, everything you eat, drink, drive, all these kind of things is made by a company. You need to understand psychology in terms of the companies. You need to understand the corporate culture of companies. And then these things change all the time, right? You have the macroeconomy is changing, interest rates are changing, currencies are changing. And the data points are just changing all the time. You just couldn't invent a more fascinating game even if you tried.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
DOJ or other authorities
could face big
bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
People are chasing, right? They're chasing those winners and continuing to feed into it.
I think the haven trades are places where earnings are happening. Tech companies.
You have to be there. This is a story, and while these stocks have been great, they're still not ridiculously priced.
Equities are closer near term to being fully valued.
It does seem like there's a little bit of caution around just how much markets could be priced to perfection.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Caution, but still upgrading forecasts for year end. Good morning. This is Bloomberg Surveillance. Anne-Marie is back in the hot seat.
According to TASS citing the Kremlin, Putin is to visit North Korea June 18th to the 19th.
Throughout this week, right now we are coming into a week after 4 straight record highs on the S&P, on the NASDAQ, led by a small cohort of stocks. And this morning, Danny, coming in to a number of upgrades from a lot of shops that say, hey, listen, just because it's narrow leadership doesn't mean it's going to end.
Exactly. From Goldman Sachs, from Citi, from Evercore. Evercore's, I think, is interesting because Julian Emanuel is essentially arguing this is just the first inning of an AI boom. But that basically argues that you're going to have to see more cooperation from different non-traditionally tech companies. Is that really the case? Is the AI boom going to spread more widely to different industries?
Which raises this question, what could potentially shatter the confidence that people have that NVIDIA can keep cashing in with the leather jacket and the godfather of AI, as we hear from Dan Ives? Or is this really going to be something that's fragile, especially in light of some of the risks coming down the pike? How vulnerable do people feel, Anne-Marie, when you were over in the southern Italy eating great food and soaking up the sun?
Vulnerable about politics, not so much vulnerable about southern Italy and all the hospitality it has to offer.
All right, okay.
But when
I heard
you
this all
look
last
at
week.
actually people raising their S&P 500 targets, where else are they left to go? Remember that whole idea of, well, we're going to look at Europe? Europe's kind of a mess right now. The European parliamentary election showed that. The UK is on set for an election, and Macron is set for an absolute bruising upcoming. Sure, maybe Marine Le Pen talking about cohabitation is starting to quell some of the French markets, but there is serious concern in what Europe is going to look like.
Okay, you just wanted to get cohabitation.
I did.
Because basically we've been talking about it throughout the morning.
I want it to be the lead of your note, so I'm trying to
try to just keep going, cohabitation, because that is what Emmanuel Macron and Marine Le Pen is. It is evidently a formal term in France about the party of the president and the ruling underbelly not being of the same party. It does not reference anything else. Danny, this does go, though, to this question of American exceptionalism and how much is it just simply that there is no other better place?
This is what I'm trying to make work. It's not American exceptionalism. It's Europe exasperationalism. I don't think it's a word, but I'm going to attempt to make it work. But yeah, there's nowhere else. You look at the China data. That's not great either this morning. You have to reside within the U.S. But at what point are we not saying anymore, Lisa, it's residing within the U.S.? It's just AI. That's the exceptional trade.
And is that enough? And that's what we've kind of heard from a bunch of places. This morning, it's not quite enough, although if you look under the hood, guess what's still up? Although very small, you do see the NASDAQ with a little bit of a lift, even though the S&P is lower. When I say little bit, I mean little bit. Basically, the S&P hovering just a notch away from 5,500. You could see euro gaining just a touch versus the dollar after a real bruising week last week, 107.12. Remember, we were well through 108, and we have come down dramatically in the face of some of the uncertainty in France. The 10-year yields just taking back some of the gains that they saw last week. We saw a huge rally. Now we're seeing 424 if you round it up 1% on the 10-year, and crude just lower by a blip, but basically flat, $78.44. This is what we have on deck ahead of a slew of Fed speak as well as a 20-year Treasury auction later this week. Coming up, Citigroup's Stuart Kaiser and whether the U.S. equity winning streak continues equities. Bloomberg's Enda Curran as China's housing slump deepens, and J.P. Morgan's Kelsey Barrow as Minneapolis Fed President Neil Kashkari urges patience on rate cuts. We begin with our top story. Futures on pause as traders kick off a holiday-shortened week. The team over at Citi raising U.S. equities to overweight from neutral. Stuart Kaiser of Citi keeping a cautious approach, writing this: at this point, a broadening trade seems limited to a soft landing scenario. What has worked better are larger cap and safe stocks that have equity beta but less exposure to recession and refinancing risks. Stuart joins us now. Stuart, great to see you.
Morning.
Happy Monday. How vulnerable is this market given how narrow this leadership has gotten?
It's funny because a couple weeks ago it felt really, really vulnerable, right? You know, pre-payrolls, I think people were talking about recession risks and how this could kind of derail the rally, and then a strong payrolls report, a friendly CPI, and everything is sort of hunky-dory again. So, the narrow leadership is an issue, especially because I think the market's tried to broaden out the AI theme a couple times this year, and each time it's sort of failed to some degree because there are just so few companies that can actually demonstrate revenue related to AI. So I think there is an underlying risk just that folks have gotten so bullish about the AI theme. They've tried to apply it to other areas of the market, and I think that's the bigger risk. Obviously, with NVIDIA, just this series of huge beats to consensus, eventually that has to kind of run its course as well. But I think the bigger risk here is people trying to apply AI more broadly and then sort of getting tapped back to the middle by that.
And that's actually what I saw in a lot of notes. Lori Calvasina coming out and saying this record divergence between large caps, particularly the AI drivers, and small caps, but still stay underweight some of those small caps because there is this vulnerability. You talk about three scenarios: hard landing, higher for longer, and soft landing. How do you weigh the probabilities? What do you have to see before you start believing in a broadening once again?
Look, I think the probability is exactly right. We get a lot of questions. Is this the time to own small cap? Is underperformed by so much, by historical standards? And our point in the note was you have to assign a reasonably high probability to this soft landing outcome to really have the confidence, I think, to buy that smaller cap stock. And if it's 10 or 20%, that's probably too low a chance. And the more you talk to clients, I think that outcome has been narrowing as the year has gone on, right? Because we just saw a slew of data, whether it was downward revisions to 1Q GDP, Chicago PMI, ISM. There's been a lot of sort of shots across the bow on weakening growth, and I think that's just made people even more and more reluctant to kind of take the step into that smaller cap.
And that's what Mike Wilson, Morgan Stanley, talks about, that weak growth that is starting to seep into the market. It's this irony that both he and Julian Emanuel can be correct, that you can have a market that reacts to weak data and AI supporting us. But to your point of the AI trade widening out, J.P. Morgan's Eduardo Lucabari basically says that for equities to avoid a 20% correction, you have to believe that tech will become a much more meaningful driver of growth for the broad economy in short order. Would you go that far as to say that?
No, I don't think that's the only thing that's preventing us from a 20% drawdown. But clearly the AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create higher productivity in workers, and you're going to get a GDP growth that is this higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category. So yeah, I mean, there are some big assumptions being made about not only how profitable an NVIDIA or a Microsoft or pick your AI software stock could be, but also what does this do to kind of longer-term trend economic growth, and what does that do to your kind of long-term view?
Do you buy that it will lead to that?
We're going to have to see. I think the challenge for me on AI, one is there's only a small number of companies that are demonstrating they're able to generate revenue. So is the flip side of your argument that we're just going to see large cost reductions and that allows kind of a longer runway for growth related to AI? I think that remains to be seen. AI as well, companies have been using forms of AI for a while already, right? That annoying chatbot you deal with is what people are now calling AI, right? So, we're not going from zero here. And I think to some extent that does mean we're going to have to wait a little bit to see either A, the revenue demonstration, or B, confirmation of the cost reduction.
For a while, people were talking about potentially starting to broaden out, look at Europe. Now you're writing that you see a lot of risk premium being built into what's going on politically. Mm-hmm. What are you seeing in terms of European equities?
Yeah, I mean, the vol in Europe just spiked massively last week. You're back to levels we haven't really seen since the European debt crisis in 2015. The U.S.-Europe trade is tricky from a lot of different directions. I mean, the U.S. is large cap tech and growth. Europe tends to be a little bit smaller cap, more value, more cyclicals. So you have a lot of factor risk that people are dealing with. It's funny that people in Europe are looking to the U.S. and say, hey, we wish we had that political scenario, right? I mean, that's if you're living here, that's sort of a surprising conclusion to draw. So, I do think, particularly in European banks, people tried to engage on the long side in European banks. That position has come out pretty quick, with what's going on in France as well. So look, I think for Europe to work, I think the U.S. does have to broaden out, if that makes sense. Like, you need people willing to take more risk in the U.S., buy that smaller cap value cyclical. And once you're doing that, then you start to make this relative valuation debate between the U.S. and Europe does look cheap, right? So that can kind of lead you down that path. But I think it's a gradual path, and I think people are going to be pretty cautious about following those breadcrumbs.
So do you think this is overdone?
The pullback in Europe? Hard for me to say, because I think it really depends on what happens, in France. And I think there's reasonable concerns about the fiscal outlook in France. Obviously, we have reasonable concerns about the fiscal outlook here. So if you're getting really concerned, you're seeing some German swap spreads and some of these other liquidity metrics kind of dislocate. You have this sort of latent fiscal risk under the surface that, if it gets triggered, becomes a major issue again. So I don't know the European market well enough to be brave enough to step in. So for now, it's we're gonna step back and look. It doesn't feel like 2015. So in that sense, it does feel like tactically we've probably priced a little too much risk. But those are famous last words. So I'm just gonna stay with large cap growth in the U.S.
On the margins, though, does this basically send more dollars back to the U.S. and basically leave you in the same place where we saw Julian Emmanuel, which is 6,000 by year end?
Well, I'm not going to make the 6,000 call, but to me, 6,000 call is you need a soft landing outcome to get there. But yeah, look, it just reinforces the idea that the U.S. is sort of the cleanest, kind of safest place to invest. And, we have really deep equity markets. So if you want a risk that looks like Europe, you can find that with U.S. stocks. If you want a risk that looks like EM, we've got some nice small cap for you. So I think a lot of people are just saying, I'm going to express those risks in the U.S. a little more directly. Yeah, I think it does help the exceptionalism narrative a bit.
What do you make of this Peter Shearer argument that Lisa was talking about this earlier? The big swings that we've seen in stocks, specifically mega caps, is a sign that liquidity is really bad in the American equity market.
It doesn't feel that way. I agree we've seen some big moves. But if you look at, in the last 10 days, we went from trading recession to higher for longer to soft landing in like a 4-day period. So, is it a lack of liquidity, or is it the fact that the narrative is changing a lot and the data is unstable and people are being kind of very reactive about that uncertainty? Certainly, I think the U.S. equity markets are still pretty healthy. I haven't looked at the data he's looked at, obviously, but no, I think look, it's summer, things have quieted down a bit, but also I just think the incoming data has been unstable enough that has kind of reflected itself in the instability of the markets themselves.
Before I let you go, let's talk about weight loss considerably. That you said GLP-1, and I thought there was a fascinating story over the weekend. The Wall Street Journal talking about how a lot of retailers are seeing a real increase in shopping from people who are using some of these weight loss drugs, in particular for tight-fitting clothes, and they've changed some of their looks. How much could that be a broadening out kind of trend? We've been talking about this, and that this is sort of the new AI. At what point do you see that?
It's a great question. I mean, the bigger discussion we've had about GLP-1 is sort of labor force participation and things of that nature. So it's possible. You get a job, you have to buy more clothes. I thought those drugs made you really depressed too, though. So I'm not exactly sure what people are shopping for.
Stuart Kaiser on GLP-1s, Citigroup. Thank you so much for being with us. Looking forward to the next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. European markets continuing their volatile streak amid uncertainty in France. This coming as Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France, as you were discussing, in the upcoming parliamentary elections. But French far-right leader Marine Le Pen did soothe markets earlier, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections. The number of voters here in the U.S. who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016 when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney has announced that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw no release to months-long delayed releases as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. So it's something the Biden administration absolutely wants to address.
That's coming up next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Coming into a week without an incredible amount of price action. Last week, though, was anything but, with a massive rally in the bond market. And what you saw was 4 record highs on the S&P 500, just kissing that 5,500 mark on the S&P, down less than a percentage point, with less than 5 basis points. What you can see is the euro just a touch stronger after a real bruising week last week, 107.11, and 10-year yields up just marginally, but really not that significantly considering the huge rally that we saw last week. Under surveillance this morning, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. It's now rising at a very slow, close to normal rate. But yes, Americans see that. And mainly it comes on top of concern about costs that were making life very difficult. So it's something the Biden administration absolutely wants to address.
Here's the latest. The Biden administration ready to respond by tapping the Strategic Petroleum Reserve. In an interview with the Financial Times, Biden's top energy advisor, Amos Hochstein, saying the administration will do everything it can to bring down gas prices this summer as the election grows closer. Anne-Marie was talking about this earlier. Joining us now to discuss is Bloomberg's Wendy Benjaminson. Wendy, what is the threshold? Do we have any sense for the administration to take action and tap the SPR?
Good morning, Lisa. I don't know if there's actually a dollar amount threshold, but there will be the point where you'll start hearing voter complaints, or Donald Trump will start capitalizing on it, or people will get reports of people canceling summer road trips or things like that. And that's when the Biden administration might respond by releasing more from the Strategic Petroleum Reserve. But of course, that also engenders a lot of Republican pushback, which will show up in ads, that he is tapping a reserve that is supposed to be there for emergencies that are not just political.
We do see, Wendy, and I know you leave our polling coverage, we do see continuously in the polls that the economy and inflation weigh on the American electorate. What does Biden need to say at this debate to try to ease some of these concerns? We heard from Janet Yellen over the weekend. I'm not sure that's doing the job.
Right. I don't think it is, Anne-Marie, although I do think there's been a slight, very subtle shift in their messaging where they are at least beginning to acknowledge out loud that prices are still too high for consumers. Because, we see on the terminal and people who follow financial news and economic news very closely will see that the rate of inflation is coming down. The Fed might lower interest rates at some point this year. But most voters only know inflation from the gas pump and the grocery store. And those prices are not as high, or much higher, than they were when Donald Trump was president. And a lot of people just see that as an equivalent and need Biden to show that he's doing something more about it. But at least their messaging has shifted. You heard Janet Yellen say,
just in about 10 minutes' time, we're expecting comments from ECB segundos.
Biden's statement celebrating the CPI last week also was, the first sentence was, prices are still too high. So I think they're beginning to shift their messaging, at least, to try to get past this.
We also saw some strong fundraising numbers from the president over the weekend. $30 million the campaign said he brought in from the star-studded event in Los Angeles. But Wendy, he's bringing in the likes of George Clooney, some of the older stars. He's struggling when it comes to the
So with text, the text is expected to be published later on the ECB's website. So not expecting text on the dot.
That is really dragging down Biden's popularity with young voters. They are still very upset that the U.S. still supports Israel so fully in the execution of its campaign against Hamas and Gaza. I think there's also, although he can show that he is cogent and on top of things, he comes off as really old. He tells dad jokes. And I think that the younger voters just don't feel like he's on top of what they see as the problems in the world.
I, for one, love a dad joke, Wendy, but that's not for me to decide. It's not just the younger voters that have drifted away over Israel-Hamas. It's also the billionaire class, Wendy. You look at Steve Schwartzman, some of that ilk who have now publicly started to back Trump and fundraise for him, where they've stayed out of it before. How big of a blow is that to Biden and his campaign?
It could end up being a blow in a close race because if Donald Trump, who is having trouble raising money without people like that, because, his base are not the richest people in the country, and there is a limit to how much they can contribute. If the billionaires can now contribute to his super PACs, either paying for legal fees or campaign funding, then, that could give him a real boost while Biden can still get the establishment Hollywood money. Also the almost quid pro quo that Donald Trump is offering them is he is being very, very straightforward about it. If you fund me, if you get your friends to vote for me, I will work to lower taxes for corporations and the wealthiest Americans. And that is the 180 degrees the opposite of Biden's message. So, when they're looking at the bottom line, Trump may look like a better bet for them.
He also says, though, that he's going to fund it through tariffs. And there's some question as to whether that actually is feasible. Janet Yellen, we've been talking about her interview, basically saying that tariffs would have to be 100% to really make up the difference. Does the business community not care, Wendy, or are they hesitant on that sort of idea of how this actually gets done?
Honestly, I think people, the billionaire class actually feels they may be able to get to him and reason with him a little bit on some of it. He has talked about 60%, he's talked about 40%, he's talked about 100%. He's sort of all over the map on it now. And of course, this would have to pass Congress. So there's a lot of work to be done to still get to those tariffs. But the effect of those tariffs will be higher prices for American consumers, hitting hard the most Trump's electoral base.
Wendy Benjaminson, thank you so much for being with us of Bloomberg News. I have to say, this has been one of the most interesting aspects of this whole recovery, which is we don't really understand the full effects of all of the fiscal spending. This from Torsten Slok of Apollo over the weekend, saying the positive effects of fiscal policy dominate the negative effects of Federal Reserve rate hikes. And we saw that in terms of the economic data and just this, incredible line going straight up, asymptotic line when it comes to economic growth, despite the rate hikes that we saw. And Ray, do you have a sense of whether there is any restraint being proposed on this fiscal spending? How much still has to be unleashed in the economy?
Well, it's an election year, so no. And whether or not it's Republican or Democrats, you're going to see spending. It's just going to be different. I was struck this morning from the Committee for Responsible Federal Budget, putting out some numbers. Trump last week was proposing potentially exempt tips from taxation. They say that would add between $150 billion to $250 billion to the federal budget deficit over 10 years. On top of that fact that potentially people are also talking about tariffs being inflationary and adding to the federal budget deficit. And what does that mean for the Fed? It is why it's so hard for the Fed to predict 2025. They don't have all the information ahead of them on what actually the fiscal policy is going to look like, because it's very different, even though there's going to be more spending, but it's very different whether or not it's Republican or Democrat.
Well, part of the issue, though, is it's the trajectory we're talking about, right? It's the trajectory that we're really worried about. At its current level, perhaps it's not concerning. So you really need this forcing event. Just saying maybe sometime in the future it's going to be a problem isn't enough to get this political action. So what do you
Taking a look at the market wrap for the European session, global stocks and bonds stayed under pressure, ceding most of the early gains sparked by French far-right leader Marine Le Pen's pledge to respect political institutions if she wins the upcoming snap parliamentary election. Contracts on the S&P 500 slipped alongside the pan-European stock 600 index, and France's CAC 40 benchmark erased all of its opening 1% advance to trade lower. Euro area bond yields rose, with France's yield premium over Germany staying near the widest in years. The euro was modestly firmer against the dollar after shedding almost 1% last week. Global markets are struggling to recover from a sell-off spark last week by France's President Macron's call for a snap election that could result in gains for far-right groups, including Le Pen's National Rally Party. European assets were lifted initially as Le Pen appeared to soothe investors with comments that she won't try to push out Macron if she wins the elections. But the gains fizzled quickly. With the first election round on June 30th, investors are likely to stay wary of Europe. City analysts warn that a potential far-right majority in France is among the risk factors for European equities and said they favor the US market. Money markets policy angst could also return this week. The Bank of England's Thursday meeting could signal a July 4th election, and lingering price pressures will force rate setters to wait until August at least before easing policy. And peers in Australia and Norway, also meeting this week, also seem to be in no hurry to cut rates.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now, context changes everything.
So shortly expected to hear from ECB's Sequindos again. Text won't be made available, but it will be later. It will be available later on the ECB's website.
Names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancing.
So with Sequindos speaking at a seminar organized by the Universidad Internacional Menéndez Pelayo and Asociación de Periodistas
even the GFC
in Spain.
vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
Coming into a new trading week after seeing a slew of record highs last week, hard to find real action this week as people look ahead.
According to a poll here, the S&B is seen to cut policy rate by 25 basis points to 1.25% June 20th, according to 22 or 33 economists. 11 said hold. And another poll sees S&B to cut policy rate to 1% in September, according to 17 or 33 economists.
About 0.2%, even as the S&P is pretty much unchanged. The Russell 2000, not surprisingly, down almost 0.2%. Danny, how much are we seeing this divergence continue, frankly, in the notes that we got over the weekend with strategist after strategist saying, frankly, this isn't going to change unless some dramatic shift in the economy happens?
Again, I get back to this irony of you can have a world where Julian Emmanuel of Evercore says we're going to 6K because of AI, and you can have a Mike Wilson saying we're more sensitive to weak economic data, and both are true because under the hood, it is a record divergence between the S&P and to equal weight. Something has changed where bad news is only bad news for the rest of the market.
And that something might have to do with the bond market. What we saw last week was a huge rally, a huge bid into the U.S. government bond market as people took a look at a softening in inflation data, softening in broader economic data. And what you saw, even with auctions, people flooded into U.S. dollar bonds. Today, you're seeing a bit of that taken back, but still lower across the board from last week, up about a basis point for the 2-year and the 10-year, up about 3 basis points for the 30-year. I just wonder why this isn't benefiting that huge rally in the bond market. Why that isn't benefiting some of the smaller companies that sensibly were more levered to the potential of higher rates, and we're supposed to benefit from them coming down.
Well, one argument I've heard is that the small cap companies have a lot of floating rate debt, so you need something really big to come down, and so you need to see, look, the rate cuts. You need to see the whites of their eyes before you can actually trade the small caps, just because we are concerned about refinancing, and maybe if it's Neil Kashkari world and it's just one cut in December, that isn't enough to remove the maturity wall concerns.
Meanwhile, you're seeing a fluctuation in the currency space when you look at the euro versus the dollar as people reassess after the big sell-off from last week. Turn to green, a little bit stronger of a euro versus the dollar, a little bit being the operative word, 107.15. Under surveillance this morning, Minneapolis Fed President Neil Kashkari saying the central bank is in a good position to take its time before cutting rates. His comments coming ahead of a busy week of Fed speak, that is an understatement, as well as U.S. retail sales data. I just wonder how much we're seeing Fed officials really kind of speaking out of all sides of their mouths and us not seeing any kind of consensus whatsoever on the FOMC.
Maybe this is why we need to trade the data. We need to ignore the Fed because for the first time in a while, the Fed's not in cohesion. It's kind of a healthy thing, though. It's kind of nice to hear, isn't it? Some actual disagreement among FOMC members.
I was struck by also what Neil Kashkari said in that interview about primacy of the dollar. He sort of talked around this when he was asked by Margaret Brennan about the G7 coming out, tapping Russian assets, highly controversial. He said the dollar's responsibility ultimately lies with the U.S. and understanding people would view the dollar, given these types of move, that's really for them to decide. Really didn't want to weigh on the controversy and the politics surrounding what this potentially means. A lot of people say this is de-dollarization and potentially de-eurozation.
Although it speaks to a larger point that Neil Kashkari has spoken about, even on Bloomberg Surveillance, where he's talked about why he doesn't see a Liz Truss moment. At the end of the day, the dollar still is the gravitational force. And frankly, last week we saw that with a lot of questions around what would happen in France, what would happen more broadly with the swing in the elections that we saw in the Euro region. Want to shift gears a little bit. No pun intended. Shares of Tesla are rising after the EV. So good, it's bad. The EV maker was granted approval to test its advanced driver assistance system in Shanghai. This, according to a person familiar with the matter, it's the next step in rolling out the feature to Chinese drivers. This is so interesting to me, Emery, because this comes at a time where Tesla is kind of walking a tightrope, where their sales depend on China at the same time that the U.S. is blocking out EVs from China. Europe is raising tariffs on EVs from China,
including Tesla.
And it raises this question of how he plans to play this. What's this sort of giving you a sense of?
He clearly wants to get this robo-taxi to hit the ground running, no pun intended. But the problem is he has a lot of regulatory issues in the United States. Remember that trip he made? Out of the blue, it felt like that Sunday he went immediately to China, and then all of a sudden we saw potentially this regulatory approval for this. Now they're starting to actually hit the ground running, and we're starting to look like he's actually putting this robo-taxi to test, this self-driving car to test. It's going to be happening in China.
And is this almost a rhetoric campaign by China to say, look how far advanced we are on EVs. You might have new tariffs coming from Europe and coming from the US, but look at this. We're letting Elon Musk test his robo-taxis. I'm also going to do a John Farrow thing because he's out, and I did watch the European soccer over the weekend. BYD was a huge sponsor. Literally everywhere you looked, whether you're watching Germany, whether you're watching England, you see BYD plastered over something. There feels something to this. Like China is really trying to use rhetoric winning the hearts and minds rather than just retaliating with, I don't know, a pork tariff. It's not massive.
Want to tell you, doing a John Farrow would be calling it football. He would never call it soccer, but that was a good try.
A great point, Lisa. You didn't mention Italy and their beat over Albania.
Okay, I didn't pull a Farrow.
but who's counting?
Yeah.
let's talk about China. Given the fact that we got some data over the weekend, China's housing slump deepening in May. Home prices and real estate investment declines gathering pace. Industrial output also disappointing. Bloomberg's Enda Curran joins us now, and I want to just start with the data that we got overnight. There was a real feeling that maybe we would get a turn, and we did marginally when it came to retail sales. How negative was this, considering that industrial production really disappointed, and the housing market, yet again, we saw that we're not seeing a floor in home prices in China?
I think that's the key takeaway, Lisa, with the data on the housing market. Like you mentioned, new house prices falling by the most since 2014, new investment the weakest since 2020, and that's despite the measures announced last month, 42-odd billion worth of money made available to mop up unsold homes, on top of measures to bring down the cost of a mortgage and other incentives to try and get the housing market rebooted. So it looks like that's not yet gaining traction. I mean, it's only 1 month, of course, but it lends itself to the idea that economists say it's not enough, more needs to be done, and the rest of the world has been looking at China's real estate sector for when it turns a corner. That data suggests it hasn't yet turned a corner. We did, as you mentioned, have better numbers on the retail sales side of things, picking up a little bit there, but still well below the pre-pandemic trend, speaking to this idea that the almighty China consumer engine that used to power global growth in the previous decade or so isn't back to where it was. And to kind of illustrate just how complex things are for China right now, the central bank held back from cutting rates despite the growth story, and that's because they're trying to keep some support under the yuan, under the currency there, and they can't really move yet until the Fed makes a first move. So overall, I'd say a pretty downbeat picture on China's economic data. It lends itself to the idea that more support is needed if the government is going to hit that all-important 5% growth target this year.
And it used to be that China's problems were the world's problems, and that any time that China was slowing down, this meant a huge problem on growth in Europe, as well as in the U.S. Increasingly, we've seen the U.S. more immunized from Chinese economic woes, Europe less so. But how much does it really matter if their economy doesn't get off the ground and continues to really struggle?
I think, yeah, broadly speaking, the growth baton has been handed to the US, Lisa, no doubt about it. You saw the World Bank upgrading their forecast last week, mostly in the back of what's happening in the US. And the US consumer has been powering the global export recovery over the past couple of years. So China is playing a diminished role. Obviously, it's very important still sector specific. For example, the spending on infrastructure is very important for the commodities markets, commodities exporters. Look at the price of iron ore, for instance. And of course, the consumer story on the ground even though it's subdued to its potential, or it's still off the potential that it could be hitting, it's still very important for global multinational companies who are both producing and selling and shipping to China. So yes, it's diminished in the overall global growth story, but it's still very important on a sector basis, and still very important in the bigger picture, especially when it comes to trade as well.
Yeah, AKA all the luxury goods companies need the Chinese consumer to start playing ball. And we had the PBOC today. They didn't trim their rate. Why not? Why not? If we have this data that is so weak and there are concerns that we have yet to reach the bottom, why not have a PBOC that acts?
Well, I guess two things on it. The first point is, does China really need lower shorter-term interest rates? I mean, there's a view that money's already cheap enough in China and nobody wants to borrow, so you have to get the animal spirits revved up in the first place. That's a domestic China story. But Danny, to your point, it's also the external story, and a lot of that comes back to Washington, D.C. There's a lot of pressure on the yuan, and there's a view that China doesn't want to cut rates in case it weakens the yuan further and puts pressure on, those wanting to get money out of the economy. There's a view that they're waiting for the Fed to move first. And as you all know better than I, the Fed story, they're still on pause. They may or may not move over the coming months ahead. But it's an example of how the PBOC is locked into the dollar and the Fed story. They're reluctant to move now for fear of weakening the yuan further. They want to hold off and see what the Fed is doing and look for that window to bring down rates at the time when they can.
And this morning we saw China launch their anti-dumping probe about pork imports going into China. Do you think this is a fresh, new iteration of a trade war between the European Union and China?
I think, so there's the economics of it and the politics of it, Anne-Marie. The economics of it, probably less significant. I mean, yes, China is Europe's biggest export market for pork, but it's a fraction of overall trade. I think it's worth less than $2 billion overall, and that, by the way, those volumes have been in decline. And on the China side of things, it won't necessarily do much for China's pork import market either. It won't necessarily stoke inflation per se, given it's a small part of the overall bucket. So the economics less significant. But yeah, to your point, I think politically it is significant. It's an example of China saying, look, we're not going to take these measures lying down. We have some tools ourselves. We can respond as we want to. Obviously, this is in response to, or it looks as though it's in response to the EU probe into industrial subsidies and the tariffs on EVs. The trick for China, though, is they've been trying to court Europe. Remember that visit by President Xi to France only a month or so ago? They don't want to be seen as necessarily overly harsh on Europe. They want to maintain those business links. They're trying to court both Berlin and Paris. They can be seen as going harsher on the US, but they don't want to lose the allegiance that they have in building there, and especially with the business community in Europe. So I think that's the tricky part for China in all of this. They want to be seen to respond, but they don't want to be necessarily isolating themselves from Europe either, because they need Europe given the tensions that are ongoing between China and the US right now.
Our own Enda Curran, thank you so much for taking the time and giving us some insight here. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Manhattan is set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service. And as you were discussing, China has launched an anti-dumping probe on pork imports from the EU. It's the latest in escalating trade tensions between Beijing and Brussels. China is the EU's biggest overseas market for pork, although exports have fallen off in recent years due to domestic oversupply and low prices. The probe is seen as Beijing's counter to similar investigations being conducted by the EU, which is looking at Chinese subsidies across a range of industries and will impose tariffs on electric cars coming from China starting in July. And Bryson DeChambeau taking home a second U.S. Open trophy over the weekend, holding off Rory McIlroy by one stroke. In a wild final hour of golf that saw brilliance and some blunders, McIlroy bogeyed 3 of his final 4 holes, while DeChambeau sealed his win, hitting an incredible 55-yard bunker shot on the last hole and making his 4-foot par putt to take the title. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, investors bracing for loud week of Fed speak this week.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
That's coming up next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Coming into a new week without a lot of action in markets, coming off a week of record highs. Although interesting last week, the S&P was up 1.6%. The NASDAQ composite was up double that, 3.2%. And that really speaks to the divergence that we continue to see this morning in equities. Under surveillance this morning, investors bracing for a very loud week of Fed speak.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
So we're in a strong position, but if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Here's the latest. The Fed's Williams, Harker, and Cook all set to speak just today. Tomorrow we'll get retail sales. And Thursday, another round of jobless claims. In the meantime, a number of other Fed speakers will deliver some utterances. Kelsey Barrow of J.P. Morgan writing this. The belief remains that inflation and labor market data will support rate cuts later this year, enhancing fixed income flows and credit opportunities, with corporate fundamentals remaining robust and supporting tight credit spreads. Kelsey joins us now, and this, to me, has been one of the ultimate tensions. At what point do we see rate cuts with this soft landing possibility that we heard from Stuart Kaiser is getting narrower and narrower at a time where the data does seem to be weakening a bit more around the edges?
Well, I think in general, looking at this all very holistically, it's really going the way that the Fed would like it. Inflation has been improving over the last two reports, and I think that that is exactly what they wanted to see. They wanted to feel comfortable that Q1 was the aberration, not the start of a new trend. We've seen that. And then on the labor market side, this was really our debate. We had our investment quarterly last week in Columbus, and the debate was, what do we take from all these labor market signals? You have the magnificent strength of payrolls, and then, as I would call it, the sneaky weakness in the household unemployment data. I think the reality is probably somewhere in between. And it's actually exactly what the Fed wants. Again, we're circling back to this idea that inflation is cooling, the labor market's rebalancing. It's going to be enough for them to be able to reduce policy restriction a little bit. But, nothing's falling off a cliff.
And this is something that you talked about, how the biggest debate at that quarterly meeting was this issue of the labor market weakening and whether it was sort of the beginning of something more protracted. What I noticed last week is we did see this divergence between large caps and small caps. In credit markets, you saw spreads widen materially in high-yield bonds in particular, which was interesting given the rally into duration. Putting aside the increase in creditworthiness of some of these companies and some of the refinancing that we've already seen done, does it concern you that at this point maybe all the good is up when it comes to spreads, and that if you want to bet on credit, it's a duration play at this point?
So spreads are tight, and so I think there is a limit to how much tighter they can get. It's going to have to come from some of the lower quality names, which are what is keeping some of the yield in the index right now. But I would say, the thing that I found notable was that the correlation between duration and risk is turned right way, and that's because inflation has been coming down as we anticipated. So how we build portfolios right now, how is it different from 3 months ago? Well, 3 months ago, we were leaning into credit. We still really liked investment grade and high yield, thought the corporate fundamentals were strong. I think the difference now is trying to find those hedges in portfolios, because now we're 3 months closer to the election. That's a risk. We've also seen some mixed data on the labor market side. So where can you find hedges that allow you to keep invested, keep collecting that carry? Because ultimately in a negative yield curve environment, we do need to figure out how to build yield into portfolio, but also look at those hedges. I think the hedge that looks most attractive to us right now would be yield curve steepeners. So 2 areas where I think that works. One is if the labor market weakens unexpectedly and that household survey and that 0.6 increase in unemployment is the start of something more material, the curve is going to steepen because the Fed's going to be cutting more aggressively. On the other hand, I think the risk is election. That's a term premium story, and again, potentially good for steepeners.
So is this a steepener then, to your point, if it is concern about what the economy is doing? Is that a front-end story then? Where on the curve is that normalization happening?
So I think the normalization does need to come from the front end ultimately, and that's where you're going to get the disinversion. But one of my kind of long-standing beliefs has been that the yield curve will be inverted for longer than anyone expects. So it's been about 21 months, maybe 2 years now, where the yield curve has been inverted. That's the longest stretch on record without a recession. And to me, I think that yield curve inversion can probably persist until the Fed is really cutting in earnest.
As the November election comes more into view, when you say risk, what do you mean? What is the biggest risk?
Well, it's difficult to handicap right now, and I think that's why we call it a risk. I think there's the stimulus part of it, so the concern that there will be less focus on managing the deficit. But I also think that the tariff side and how we're going to approach foreign policy is also a really important risk. So I look back at when Trump was last president, and I look at what happened the last time we had this tariff war. And a lot of people talk about the inflation impact, but if you look back, it really wasn't inflation that was damaged by the tariffs. It was global manufacturing sentiment, and it was the growth impulse. So I think we need to also be aware it's not just a one-sided story. I don't think it's all about the risk of higher inflation. I think that there's also a risk on the growth side.
But when it comes to that fiscal impulse, do you see that changing? Or is there any daylight between Biden or Trump for a fiscal policy impulse?
So I think this is where it gets tricky. And when we were building out our scenarios for our quarterly last week, I mean, you can't just have a Trump and Biden. You also have to play out the House and Senate scenarios, because I think that's really, really key. Right now, you have to, within your deficit forecast, consider the tariffs. Also consider the tax cuts. Will they be sunsetted? I don't think anyone thinks that's going to happen, but will they be extended, or will they be doubled down in a sense that it will be actually stimulatory? Because the deficit is already quite big. So there's a hurdle there for an additional fiscal impulse above and beyond the deficits that we're already running.
So before we get to November, we have to get through this week. We've got retail sales tomorrow. We've got jobless claims on Thursday. And then on Friday, we get the latest manufacturing data and services from S&P Global. What's going to be most important to understand whether we're still on track for that soft landing that keeps you in a sweet spot? in credit that has seen an improvement, at least on the margins in creditworthiness.
All right, so I'm going to say something which is none of the things that you listed, which is actually claims. So I remember the last time that we were on, we were talking about the fact that the soft data has been telling us that the economy is terrible, and in reality, the hard data is what's holding up, and that's what's ultimately most important for the Fed, i.e. payrolls, i.e. CPI, PCE, and claims. So again, we saw that small tick up in claims. I don't think that 1 week really means much anymore. That's just kind of noise, but we do want to watch it every single week, and that can reflect a turning point. Maybe not this week, but that's what you want to watch.
Pause.
The hard data.
Okay, so how many weeks do you need before it's a trend? And what kind of increase would you need to see before suddenly you start to say, wait a second, this is something more concerning?
So this is getting a little bit in the weeds, but the way that I look at it is I actually look at the non-seasonally adjusted data, and then I look at the path relative to prior years, because there's a trend, and it's been very difficult to seasonally adjust the data in this post-COVID world. And so what I need to see is that the claims numbers are running off course relative to the path, the seasonal path for claims. So it would need to be, let's just say, more than 1 week, a number of weeks, where it is clear that we're running off the path of the seasonals.
And just real quick, the playbook, if you see that, go into long duration, move out of riskier credit?
So I think the Fed has been really clear here, which is that they will shift if the labor market data weakens. You know, that's a question that he's been asked at the press conferences, and he's been very clear that
just a reminder, in about 5 minutes' time, we're expected to hear from ECB Cipollone.
And then what brings forward rate cuts to be more urgent? It's downside risk to the labor market. We haven't seen that. If we see it in the hard data, not the soft data, that's what's going to get the Fed to move.
Kelsey Barrow of JP Morgan, thank you so much. Always a pleasure having you here. And it raises this interesting question, Danny, which is the Fed put. Is that essentially what people are betting on, that it will come back into play with just the whiff of weaker employment data?
Yeah, because it's the irony of asking, if that happens, if the labor market weakens, do you need to get out of risk? And maybe the correct answer is no, you don't, because to the point that we were just talking about, it means that the Fed is more likely to take action, and the Fed put comes back, and you can keep buying riskier credit, and spreads can continue to grind tighter.
And unlike inflation, where it feels like they need to see several reports, to Kelsey's point, it feels like with the jobs market, if they see one bad report, potentially we can see a big shift at the Fed.
And it just depends on what that looks like, right? Especially given the fact that we said, we were talking about how Jay Powell noted that the payrolls report overstated the labor market. Coming up, we're going to be speaking with Lindsay Rosner of Goldman Sachs, Sam Stovall of CFRA, Stephen Major of HSBC, and Lydia Boussour of EY. Right now, you're seeing markets treading water after a week of record gain after record gain. This is Bloomberg.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest
don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all of these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
We've got a broad story where the economic fundamentals look good. Right, the growth story is pretty good. Inflation is coming down.
As far as what the Fed signaled, I think it was a very balanced sort of a message.
We're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently.
I don't think there's a lot of concerns necessarily about the U.S. economy going into recession.
The Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into a key week of economic data, kicking off tomorrow with retail sales. Today, we are left trying to understand the narrowness of the rally that we saw over the past few months and how it is getting narrower and narrower. Good morning. I am here today, so pleased to say Anne-Marie back in her seat after her tour in southern Italy. She was really excited to be back. Danny Berger here. Thank you so much for being with us. John Farrow not here. He is on his tour of duty somewhere warm and beautiful with great food. Right now, we are looking at a market that is basically trying to find direction after a week. I have to say, I really can't emphasize enough how narrow the range is and how dominated this entire rally has been, Danny. Just from an incredible rip-roaring belief in AI with a couple companies and nothing else.
It's interesting how the shades of this rally have changed, because at first we said AI, but AI plus everything. AI would be in utilities, AI would be in consumer stocks, so everything can rally off the glory. It's changed. It's changed back to maybe it just is NVIDIA is the winner. Maybe Broadcom gets a little slice of the pie, but the flavor has changed and makes it all the more vulnerable.
Which raises a question, to vulnerable to what, right? Is it politics? Does it really matter what Fed policy is to NVIDIA? NVIDIA doesn't need to borrow money. If anything, they've got a cash pile that's invested in T-bills that will only do better if the Fed remains on hold. So this raises the question, what risks? Last week, let's remind everybody again, Anne-Marie, you were in southern Italy, really enjoying yourself, and I'm sure you were very happy to come back. You did break a lot of news, and it was during a really pivotal period of political developments and political risk really coming to the fore. How much do you really hear about this as something that people thought of as just the beginning of a number of political surprises?
It was a parochial G7 in the sense that domestic politics loomed large over basically everyone there but Giorgia Meloni, the host. And it really was her show. It was her G7. Obviously, the concerns about France are starting to quell in the market because Marine Le Pen is coming out and she's talking about that I'm not here to ruin institutions. We can cohabitate with Macron. But then you look at potentially if there's, once the risk is over in Europe, we get a little bit more direction where they're going to be, whether it's France, the United Kingdom, then it becomes the United States. And I'm looking back at the data we got on Friday from the consumer sentiment, and it feels like for the first time we're seeing that hollowing out of the middle class. This economic story that Biden potentially needs to come out and try to sell the data to the American people, because when it comes to consumer prices, they're not feeling it.
Well, and you pointed out to this aspect of the University of Michigan Consumer Sentiment Survey that I thought was probably the most interesting aspect, and I'm glad you brought it up, the fact that the middle-income consumers are feeling the same as the lower-income consumers, and how unusual this is, because usually the middle feels the middle, and then you've got the high end and the low end. Danny, how much does that speak to retail sales coming out tomorrow, and this question of how can they hold up in that?
Exactly. At some point, surely your feelings reflect how much you spend, but Jim Bianco says that it is back to politics, that the change we're seeing are middle-class Democrats who believe that Trump will be the next president, so their perception of the economy and how their future standings are going to shake out. That's what we're seeing in the Mitch survey. But Anne-Marie, that doesn't exactly point to great news for Biden either. Either people are unhappy or they've already just said, Trump's going to win.
If you translate this into market activity, it doesn't matter, because if you've got chips, you're happy, and that's basically what's been driving the market up. Today, we can see a similar type of trend, albeit in a muted fashion, with the S&P basically doing nothing, but just a touch lower, while you still have the NASDAQ inflected upward ahead of the open. Euro gaining just a bit versus the dollar after a very difficult week last week in the face of some of the news we were just talking about, with the shift to some far-right types of candidates, particularly in France in a snap election, 107.10 there. You could see yields up a little bit more now, up about 3 basis points. You've got 4.25% on the 10-year, and crude kind of bouncing around. It was lower, now up about 0.3%, $78.71 on the NYMEX. Watch this space, especially ahead of a very hot snap in terms of electricity usage. Coming up this hour, we've got Lindsay Rosner of Goldman Sachs on a path for a September Fed rate cut, Sam Stovall on CFRA on text dominance and equities, and Stephen Major of HSBC on the global macro outlook and why he sees a rip-roaring rally ahead for U.S. Treasuries. We begin with our top story. A busy week of Fed speak kicks off as investors look for clues beyond the Fed's dot plot. Lindsay Rosner of Goldman Sachs writing this, quote, paths to a September cut do exist, and there were some signs from Wednesday that more cuts may be possible. Powell said confidence 20 times, and confidence, after all, is just a feeling. Lindsay joins us now to talk about feelings, but I am curious about, what we learned from the Fed last week and whether it matters for a risk asset rally that seems to be completely independent from anything related to the Fed.
Yeah, well, it does matter. And we learned a lot last week. Back to the point that confidence is a feeling. We've heard for a couple months now that the Fed needs to feel confidence that inflation is moving in the right direction. Also, if they become unconfident in the labor market, i.e. see softness, they could go ahead and cut. What we learned last week is that if you tear apart the headline, which is the median dot went from 3 to 1, unpack that a bit. The mode, so where most of the people are hanging out on the Fed in terms of dots, that was 3, it moved to 2. That made the math shift down on the average to 1. Basically, there are a lot of ways that we could get to 2 cuts this year, and that would be probably September and December in our mind, because there really should be an air pocket around November election.
So you talk about all the importance of listening to the Fed speak. We got plenty of it this week. I mean, really, it's pretty much every day you get at least 1 to 3 Fed speakers. What do you want to hear? Who do you think is most important aside from just simply Fed Chair Jay Powell himself?
Powell is probably the most important, but it's not, as we know, his sole decision. It's going to be important to hear the different speakers out there, but more importantly than what they say is what continues to happen with the data. Remember, we had 3 really hot inflation prints, then we had a lukewarm, and this past one was cool. It was actually really cold in many ways, despite the summer heat wave we're about to embark upon. So we need to see the data continue to go in that direction. And the big thing that didn't move in the CPI that I think is important and people have been waiting for is OER. Very sticky, big part of CPI. But that moves with a lag. And it usually is a year or so of a lag from when rents start to move. So that could be happening any print now. We've got 3 prints before September. there is a case, in fact, that the Fed does go in September. But big picture, we're talking about maybe 25 or we're talking about 50. I think what you're highlighting on risk assets is really crucial. Risk assets have just cruised through this whole thing, and they ignore the volatility. That seems to us to be a bit strange. So when we look at where valuations are, we're finding spreads like everybody else, as the guest prior to me had said, valuations are on the really tight end of the range. Everything needs to go perfectly for that to continue to make sense. And last week we had a ton of news. We probably didn't need more. The US was enough. But sure enough, we got the snap election told to us that's happening in France, and we've seen a ton of volatility there in rates. So I think that needs to be a heads up to everybody in the US. You are buying assets right now at the tightest spreads they've been in a decade. There is likely to be volatility around our own election as well. It would be naive to think we don't see some of that here. So we're really looking for pockets of value if they emerge through the volatility. But we don't believe France, for example, is a contagion, but just the issue of that should be contagious. Think about it in the future. Unlikely we stay at the same place.
Right, remarkable to watch a VIX dip below 12 last week amid everything that's happening. But the strength in the valuations you're talking about have been, again, those big AI plays. It's been the NVIDIA. The rest of the market, the equal weight fell last week. It was a record divergence. Why would that be the case if we're going to get a cut in September? Why would that be the case if things are slowing, not slow? Shouldn't the rest of the market be playing along?
Well, the rest of the market is trying to figure out, is this robust growth that I think we keep coming up with explanations for? Well, is it, to your point, is it AI everything? Is it actually the labor market is more productive? Oh, wait, we have this immigration number that is enhanced, not in documented, but some undocumented. Constantly looking for ways to justify what's going on with stocks. The big picture is there is a look through to everything. Bad news, just put it on the side, keep buying. And we're trying to say, take a moment. This thing that's happening in France is important for remembering. Valuations are really important. Your entry point does count, and we feel like there could be some opportunity to have a better entry point in fixed income, despite the fact that yields are high. And the big also takeaway for us last week is you don't want to be underweight bonds. Look what did really well on the back of volatility last week.
When you look at France, you keep saying, take a look at that. Look at not potentially contagion, but the volatility it sparked. But do you think it's overdone? When you look at the polling, it looks like potentially we're just going to get a hung parliament.
No, I don't think it's overdone. France, in our mind, was really trading very tight if you look at it in comparison to Germany, and that we're now at a level, a spread between the two that makes a lot more sense. Very different economic outcomes or forecasts that we have there. So we've gotten to something that makes more sense.
So at 8:15 a.m. Eastern Time, we get the Canadian housing starts annualized. Forecast 245 at spot 14K, on the prior 240 spot 2K.
Across the globe. Really important to remember, something like this, a little ripple in the water can actually really start to move things, and there's an asymmetry when you're buying at the tightest levels.
Looking for a better entry point is code for we expect a sell-off, right? I mean, this is basically another way of saying we're looking for declines in valuations because this just looks a little bit too perfect for us. What in particular do you think is so vulnerable right now?
Yeah, so we've been talking a lot about the impact of higher for longer. I don't think we're alone in sharing that. When you've had this higher cost of capital, you're going to see certain capital structures that don't work. And if we begin to see volatility ripple through the market, it is those capital structures that will be in the most pain. That will probably lead to some opportunity elsewhere. So for us, it's not see something that's distressed, see the crisis, want to invest there necessarily. It's if things start to trade in sympathy, and i.e. widen, that's where we want to step in for things that we believe in from a fundamental perspective.
You also said you don't want to be underweight bonds, and this is duration, right?
Yes.
This, to me, is an interesting point. You don't see the risk, despite some of the politics of the moment, you don't see the risk in benchmark U.S. rates at a time where political risk is not just European effect.
Totally true. And we think bonds are going to do what bonds are supposed to do. And there's been a question, I think, for the past few years, what is really the role of bonds in a portfolio? Do you actually need them? Stocks just take off. Forget about it. I'd rather just be in equities, and I want to be able to talk about it at a cocktail hour because people want to talk about NVIDIA, they don't want to talk about the 2-year. But
depends what parties.
Yeah, okay, maybe ours. Maybe this cocktail party that we're having here, and it's a good one at an early morning in the hour. But you want to have bonds in your portfolio because they protect you. And I think when you look at what happened in France, look how much Germany rallied. So get a ballast in your portfolio of the safe haven quality assets. They will benefit you. And then if you see some inefficiencies begin to erupt in the spread markets, we want to step in there and add.
Lindsay Rosner of Goldman Sachs, thank you so much for being here. Great to see you. It's been too long. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. European markets are edging higher despite continuing political volatility in France. Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France in the upcoming parliamentary elections. But French far-right leader Marine Le Pen bringing calm to markets, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections, and that she is not calling for institutional chaos. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming
1 minute remaining
to meet growing U.S. electricity needs. The billionaire told CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also being safer and could make nuclear energy a source of low-cost electricity. Gates saying TerraPower's plant is on track to start producing power by 2030. And Pixar's Inside Out 2 is Hollywood's best debut since Barbie. The movie grossed $155 million at the box office in the US and Canada, besting Dune Part 2 as the movie with the biggest opening weekend of the year. The film also notching a record. Inside Out 2's nearly $300 million haul globally is
10
the
seconds.
biggest opening weekend in history for an animated film. That's your Bloomberg Brief. Lisa? Thank you so much, Yahira. We still have to get Emery to a movie theater because she has not yet been since the pandemic. Up next, the morning calls and Sam Stovall of CFRA. That is coming up. This
264 spot 5K, 264 spot 5K, higher than the forecast of 245 spot 1K. And Canadian housing starts annualized, prior revised 241 spot 1K.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
Coming into a week dominated by retail sales, jobless claims, as well as what we get from S&P Global on Friday, which is manufacturing and services activity data. Right now, not a lot going on. The S&P has crossed that 5,500 mark, basically unchanged. But you can see it on the NASDAQ. is actually, again, an outperformance, even as small caps underperform. Right now, let's take a look at morning calls. First up, Goldman Sachs upgrading Toll Brothers to neutral with a price target of $124. The analyst expecting higher revenue and outperformance in new home sales. Next up, Bank of America raising its price target for Micron to $170 from $144. The firm expecting the chipmaker to benefit from increased requirements to support artificial intelligence in personal computers and smartphones. And finally, UBS upgrading Best Buy to buy with a new price target of $106. The analysts expecting an electronics replacement cycle helped by, you got it, innovations in artificial intelligence. Sam Stovall of CFRA also looking closer at the tech trade, saying this: even though 6 sectors also advanced, the tech sector was the exclusive outperformer last week, causing one to wonder just how long this can this jumbo jet keep flying on only one engine. Sam joins us now, and Sam, I have to say, this in some ways is the quote of the morning to me, given the fact that this is the ultimate existential question. Is this U.S. stock market ultimately incredibly vulnerable because of the dominance of the big tech names, or is it incredibly resilient because of them? Is it a feature or is it a bug? What do you think?
Well, Lisa, good morning. I think that it is resilient. However, I do believe that we are headed for a second decline of 5% or more in this year. Good news is, however, that based on my historical work, every one of those top 15 first quarters ended up with a gain for the entire year, even though many of them went through 2 intra-year declines of 5% or more, and those average annual increases exceeded 20%. But when I look to the S&P 500, I see it trading at a 32% premium to its average 20-year PE. I look at tech at a 68% premium, and I look at tech at a 21% premium on a relative PE basis. I do sort of wonder if we've gone too far too fast and need to reset the dials in order to maintain this longer-term upward trajectory.
So basically, you're saying that you think that tech is going to pull back a bit as the rest of the index maybe just hovers around where it is now, and that's what's going to drive the index
At 8:30 a.m. Eastern Time, we get New York Fed manufacturing forecast minus 11 spot 3 on the prior, minus 15 spot 6.
We're probably going to experience a mild correction, so that 4,800 level on the S&P, I don't
European
think is
bonds
out of the
extend
question
losses.
at this point.
German 10-year yield
I think that
plus
if
7
we
basis
do start
points to
see people take some
2.43%.
profits in tech, it's not going to be just tech alone. Tech and consumer communication services are the only 2 sectors that are outperforming the S&P since we had about 68% of the S&P 1500 sub-industries trading above both their 50 and 200-day moving averages. Today, that number is down to 38%. So while the market has been advancing, it's really being led by tech and to a much lesser extent, communication services.
Sam, it's been a long time since we've seen a 5% more or decline in this U.S. stock market. It's been a long time since we've seen a 2% decline in this stock market. It is, as Bank of America once called it, the Pavlovian urge to continue to buy because stocks keep going up. What needs to change? Because valuations alone haven't spooked investors. So what changes that allows for that sell-off to happen?
Sure. Well, we did experience a 5.5% decline from March 28th through April 19th, and we recovered everything we lost by mid-May, which is not surprising because of the 64 declines of 5 to 10% since World War II. It took us only a month and a half to get back to break even. So that's why I typically say that you're better off not allowing your emotions to drive your portfolio decisions. But as we saw last time with the 10-year yield creeping higher, causing investors to worry about where it would end up peaking. Also, the worry about the Fed not likely to cut interest rates 3 times, as the March dot plots had indicated. Most recently, expectations were for 2, yet I found that investor ebullience was dashed by the dots this time around, with the expectation now only being at 1. So I think the question is, how long will the Fed maintain higher for longer, and does that increase the risk of recession?
You talk about in your note this frustration by the Fed, and people could have been humming the Meatloaf song, 2 out of 3 ain't bad. What are you expecting this week then from all the Fed speak? Do you expect them to be a bit more dovish, given the fact that the data potentially may mean they're going to cut before December?
Well, Neil Kashkari's comments, I think, were basically what he's been saying for a while, which is much more of a hawkish tone. Other commentary could, yes, take the other side as well, because the Fed wants to remind us that they are data dependent. At the same time, I think they want to let us know that they are independent of political pressures. Every election year since 1992, except 2012, had the Fed either raise or lower interest rates in that election year, and many times it occurred in September. So I don't think the Fed would be averse to cutting rates if they felt that the data supported it.
And you still think September remains in play. What's your biggest conviction for that?
Well, when I look to the CME forecast model, I see that we're looking at 1/3, or a 38% in a sense, indicating that we're probably going to stay at that current level. But obviously, 62% are implying that we will probably see a cut in September of either 25 or 50 basis points. That moves up to 80% for the July period, and even higher for December. So I would tend to say that the chances are increasing that we do end up seeing a cut sometime this year, with possibly two still on the table.
Sam, a lot of people would agree with you. Last week, we saw a massive rally in U.S. government debt. I'm looking at a 21 basis point decline in 10-year yields, down to 4.22% to end the week. Why is that not igniting a rally in some aspects of the risk market that have not participated? I'm thinking of small caps in particular.
Well, I think first off, one reason why the yields have been coming down is because the prices have been going up, because interest rates look more attractive here in the U.S. than in overseas. So that's attracting foreign investors. We certainly are looking at small caps now trading at a 31% discount on a relative PE basis, mid caps at 25% discount. I think it's because investors want to wait until the Fed does actually cut rates, because of the potential of a rising risk of recession, since these smaller and mid-cap firms are the ones that will take it on the chin more so than large caps, should we end up having something deeper than simply a soft landing. So I think investors are playing it close to the vest at this point and focusing almost exclusively on the larger cap growth universe.
At 8:30 a.m. Eastern Time, we get New York Fed manufacturing forecast -11 spot 3 on the prior, -15 spot 6.
People are going to keep buying NVIDIA.
And that is exactly what I do think it's such a good question, though. Okay, it is what we're seeing, but we're okay to say, all right, the animal spirits are going to be woken up so I can buy NVIDIA. Why not the rest of this market? Why can't we say there are going to be cuts and we can buy small caps? We're willing to suspend belief for the large caps. It does seem odd to me that this is the one place that we're saying we need to wait.
Especially at a time where people say, ostensibly, if you do get this adoption, it should benefit productivity across the board, to your point, but maybe not yet. Coming up next, a busy week of Fed Speak, as well as some key economic data. We're looking ahead to it all with Stephen Major of HSBC and Lydia Bassour of EY. Tomorrow, retail sales. We haven't talked enough about that. We're going to be talking about that more coming up, just in terms of understanding how much ammunition some of these consumers still have. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
One minute remaining.
From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
10 seconds.
Heading into a week of economic data led off tomorrow by retail sales. Those are the big hitters, although we are getting some coming out just momentarily. Heading into that S&P futures, just hovering
-6,
around that
-6, higher than forecast, -10.
Futures, though, with some modest gains, up about 0.1%. The Russell underperforming yet again, as has been the theme, with a record divergence, as Danny mentioned, down about 0.3%. What we're seeing right now, though, is a U.S. economy that has been generally trending lower but not weak, and we get that again with Empire Manufacturing, which we will get to in just a moment. Right now in the bond market, you can see yields just a little bit higher, grinding a bit higher as the session grows on. At session highs, 10-year yields 4.26%, 2-year yields 4.73%, and 30-year yields at 4.40. Danny, it raises a question at what point people still look at bonds as a haven trade, because what we saw last week very much, still very much the place where people go for safety. And Lindsay Rosner of Goldman Sachs saying just moments ago, that's the trade that she likes.
Yeah, maybe it takes chaos, messiness, whatever you want to label it abroad, for us finally to like U.S. bonds again. There's one argument I heard that I thought was interesting, that French banks selling off last week meant that they pulled back from the U.S. repo market. So actually what we saw last week was just a dearth of liquidity. And that's why bonds moved as much as they did, because French banks that usually play a lot in this market because of political chaos there weren't. So it's just another roundabout way to saying French politics affecting U.S. bond market.
Which is something we'll be looking at. It's certainly affecting the currency space. What we see right now is a euro trying to retrench just a little bit after last week.
We have posted the New York Fed Manufacturing Index June report on the feed for all those interested.
Firming up 107.12, but very much front and focus. Under surveillance this morning, Goldman Sachs and Evercore boosting their year-end outlooks for U.S. stocks. David Kostin and the team at Goldman Sachs looking for 5,400 from 5,200 on the S&P 500. Here's the big call. Julian Emanuel and the team at Evercore making the leap to 6,000 from 4,750. And Emery, we see this pretty much across the board with people saying just because it's a thin rally dependent on a few names doesn't mean it's going to stop.
Doesn't matter. They think it's going to continue. What I found so interesting about the Goldman Sachs call was actually they gamed out a few other scenarios. And they said if exceptionalism persists, they're going to be closer to an Evercall core of 6,300 by year end. So it just looks like they have a number of scenarios where, for Goldman Sachs, that initial call is just the base case for how much higher we could see before year end.
I'm kind of surprised we aren't hearing more of the David Einhorn kind of argument that something is broken, that something else is happening, that only these big companies keep getting bigger because there are too many price insensitive buyers, that it's all of the machines, it's all the S&P 500 retail buyers, that it's all of the hedge funds who are just buying tech and that's it. And that something is fundamentally different this time. That means the fundamentally okay companies, the value stocks, this time won't catch up because that buying base doesn't doesn't exist for them anymore.
Well, and it also doesn't have the same kind of buyer base of the actual businesses themselves in the same way that Google and Microsoft are the main buyers of NVIDIA chips. So it becomes sort of circular. The big keep getting bigger because they're helping each other on an ecosystem amid a technological shift. Talking about technological shifts, that's going to be on the docket as the campaigning season heats up. The Biden campaign raising more than $30 million after a star-studded fundraiser in Los Angeles over the weekend. President Biden also kicking off a $50 million ad campaign ahead of the debate with Donald Trump on June 27th. According to Axios, Trump is scheduled to meet with Speaker Johnson at Mar-a-Lago later today. Anne-Marie, fresh off your tour of Europe, heading into this debate, what are you watching in terms of tactics, in terms of trying to get some of the double haters back on stage?
That's true. The double haters, 1 in 4 voters say they don't like either candidate. This is a big problem for them, and they're trying to win them over. What you just said there, this $50 million ad blitz from the Biden camp. They're calling it character matters. This is what they're trying to tap into when it comes to the electorate, and what Terry Haynes, I think, put it really well earlier in the program. Trump and Biden, when they get on that debate stage, they both want to basically define the terms of this election and try to get one of those 4 to come over to their side.
Which has been the big challenge right now. And then the question is what the potential political risk is, given that we just saw it did matter over in France. I mean, how much are people actually gaming this out? A lot. How much are they actually trading on it? Danny, do you have a sense? I mean, my sense is not that much yet.
The only place I've seen it is the VIX. And I mean, this is slight. There is a slight kink around where the election is. But perhaps the only reason that's the case is because we know who the candidates are going to be, so we've priced it in a little bit earlier. Otherwise, we don't see it. And again, it's not just France. We learned this lesson with Mexico. We learned this lesson with India. And again, over the past few months, we are not prepared for elections.
We are prepared for Fed speak, and we get a lot of it. This week, comments coming from Williams, Harker, and Cook later today. There are 6 more speakers tomorrow, plus retail sales data. On Thursday, more Fed speak, plus jobless claims. Michael McKee, Bloomberg economics and policy correspondent, joining us now. It was the quiet period. Now is the very loud period for the Federal Reserve.
U.S. Treasury yields extend rise. 10-year yield last up 5.6 basis points at 4.269%.
Complete view of that because they're going to be data dependent until the next meeting, which is until July 31st. We just got Empire Manufacturing today. It's down to -6, but it was -15.6, so an improvement to still contraction. And new orders were better, so maybe things. We get this mixed message from all of these data points that we're getting, and it's hard to know what the Fed's going to do. But as you say, we have a lot of economic indicators. It's retail sales that matters this week because it'll give the Fed some idea of where consumers are and whether the economy is weakening, because certainly the Atlanta Fed GDP now doesn't show any signs of weakening. But we're going to go through this on a regular basis, for the next month and a half while we wait for the next Fed meeting.
Is there any expectations that retail sales might show some of the weakening, might show some of the survey data, so that some of that finally might filter through?
Well, that's an interesting question. Bloomberg Economics thinks so, but most other economists don't think so. We had a decline in the core retail sales last month, and now the consensus forecast is it goes up by 0.4, and the headline goes up as well. So this is even with gasoline prices going down, and because retail sales are denominated in dollars, that's a hill to climb, but the economists think they're going to do it. And we've seen reports from the various credit card banks that consumer spending has been holding up.
But when you look at retail sales, even if we do get a weak retail sales print, that's not going to be enough to move the Fed, is it?
No. The Fed is going to be looking at the inflation indicators, and they're going to be looking at the employment indicators. We've already got bond market analysts complaining about the fact they have to work on July 5th because it's going to be the jobs report. But that'll be a very important jobs report because it'll set the tone for what happens on July 31st, and then that sets us up for whether or not you get a September move.
Michael McKee, thank you so much. We really appreciate it. Stay close. I'm sure we will be speaking plenty this week amid all of that data as well as Fed speak. Right now, we want to dive into what to expect for the remainder of the year and whether the balance of risks has shifted as we do see a disinflationary tilt to more of the data, at least, in the United States. Joining us now, Stephen Major of HSBC and Lydia Bassour of EY, both with us. Lydia, I want to start with you in terms of what you make over the rally that we've seen in bonds over the last couple of weeks in particular, and what this signals about where the balance of risks is at a time when the Fed kind of had a hawkish tilt last week.
Yeah, so we've seen a softening in economic data, and I think that the narrative has been shifting towards the economy slowing more than what was, anticipated earlier this year when inflation surprised on the upside. So what we're seeing in terms of the economy is a gradual slowdown in economic activity. The Fed, last week was, somewhat, slightly more hawkish than expected. Coming out of this meeting, there is really this sense that they have lost some conviction that inflation is moving back sustainably towards the 2% target. So now when we look at, the next couple of months and the coming data that we were discussing, it's all going to be about rebuilding that confidence, seeing less that softening in sequential inflation, but also seeing some softening in the labor market for the Fed to be confident enough to start cutting interest rates.
Stephen, what did you make of last week, considering that we saw a hawkish tilt to the Fed, and you just reconfirmed in your mid-year outlook a belief in a rip-roaring rally in U.S. government bonds that could potentially take the 10-year yield to 3.5%?
Yeah, I'm quite glad we kept the bullish conviction. The news flow coming through on the back of these elections that you were talking about in the prelude to this interview, I think that really matters, and I think it kind of overwhelms the impact of the CPI and payrolls releases and the Fed speak. So I think it was yourself or Danny that spoke about chaos, and you both mentioned France and Mexico. There's a lot of commonality here. These are spread markets that have a lot of overseas or non-resident buyers behind them, and they don't respond well to volatility shocks. In this case, you've had election results that have brought the fiscal challenges back into focus, and bonds don't like that. So if you get a flight to quality, people move from French bonds to German bonds, from Mexican bonds to US bonds, and globally, it's all knocking on. And I think you've got an unwind going on of all these carry trades. So at a time of tight credit spreads and a bit of a vol shock, it's no surprise that treasuries are doing quite well.
Stephen, though, what happens when all of that meets U.S. political instability? If we do see something in November that looks like uncertainty about the results, confusion about the results, confusion about the policy, where does that money go?
Yeah, I guess at the start of the year, everyone was focused on how many elections there were going to be this year. It's taken till the halfway point, Danny, for there to be a significant shock, because the Indian result wasn't a big shock in a way, and it is a very domestic market. The reason Mexico and France matter is because they're so international. So the US election is still a long way away. And I think everyone who's watching this show knows that there's a lot of debt, and they know what the policies are of the two presumed candidates. So it's not like there's a big unknown out there. It seems to me that part of the reason the data is cooling is because the fiscal impulse is starting to fade. And I think all of us should just recognize whoever's the president in 2025 is going to have double the debt stock of 8 years ago. So whoever's there is going to be somehow restricted in what can be done in terms of future fiscal loosening. I don't think the US, by the way, is in that bad shape fiscally. I'm talking here about relative to other countries and considering the asset base. The growth of GDP has really helped. But of course, if the economy is cooling and the debt keeps going up, then you have more challenges. But I don't think the US Treasury market should be so worried about the debt.
Lydia, what about from an economist's point of view, if we do have, it doesn't matter who's in, we know what the fiscal situation is, what the debt looks like, a fiscal impulse that fades, doesn't matter. Do we need to start worrying about the deficit?
Yeah, I mean, we all can agree that, the fiscal policy is on an unsustainable trajectory. When we look at interest payments on the debt, they've risen, to 3% of GDP, which is double the pre-pandemic rate. Now, I don't think, this is threatening the outlook in the short run, but it does pose economic challenges in the long run. It pushes interest rates higher, can generate inflation, can, weigh on growth. And then more importantly, it also means that there is, more limited fiscal space in the event of a downturn.
Stephen, when you say that the U.S. doesn't look so bad, is that because relative to what is going on in the rest of the world that the U.S. doesn't look so bad? Or is it because you actually think the U.S. is okay when it comes to its fiscal trajectory?
Yeah, a combination of both. I don't know whether this is an English or American saying, but we call it the least dirty shirt. So I sort of imagine looking through my wardrobe and trying to find the cleanest, brightest white shirt to wear. It's a bit like that, in that the US debt stock as a percentage of GDP, if you look at the total debt, that's public and private sector, since the 2008 financial crisis, it's gone up, but it hasn't gone up as much as some other countries. And it's also been helped in the US by the fact that the household has delevered. So on a relative basis, it looks not so bad, and on a historical basis, it's okay. And I think that part of the factor is the strength of the GDP and the tax take. Now, looking forward, the US has incredible taxing ability, but as we know, it's all a question of willingness.
And it's also a question of policy. We have a new report out today talking about the fact that if Trump's proposal to exempt tips, for example, from taxation, it would be $150 billion to $250 billion added to the federal budget deficit. Is it very difficult to think about 2025 until we know, Stephen, the outcome of November? Or are you just expecting there's going to be a lot more debt added to the U.S.?
I think that's a big number you just put out there, but there's also going to be money coming in on the other side, because don't forget there's money from tariffs, for example. I mean, we just don't know what the outcome is going to be, and it all depends on whether we have a sweep or not, because I think the fiscal outlook will very much depend on whether either candidate wins with a sweep. So it's tricky, and I think in terms of probabilities, at the moment you wouldn't go down a baseline or base case of there being fiscal irresponsibility. I think that it is a risk, it's a scenario, but it's not the baseline. And at the moment, I look at US Treasuries and I think that they're priced appropriately given where the policy rate is. If the policy rate starts coming down, yields are going to fall, and they're going to fall quite fast. That's what really matters. Bond yields don't go up because there's a lot of supply. And it seems that some people want to inject additional term premium into Treasuries because of the supply. I think it's already there. You can already see it.
Lydia, do you agree?
Yeah, I mean, looking at, the elections and what the implications could be for the economy, there is a lot of uncertainty surrounding, the post-election landscape. When we look at the economic impact, we really focus on two key themes that will be very important. The first one is fiscal policy, but, the Tax Cut and Jobs Act in particular, and the expiration of the Tax Cut and Jobs Act, that's going to be an important issue, and can represent a mini fiscal cliff. We've estimated it could shave 1 percentage point of GDP. There is also what's happening on the trade front with the potential for escalation in tariffs. We are already in an environment where inflation is still elevated, so seeing more inflationary impulse and potentially some hit to growth would not necessarily be a desirable environment we want to be in, especially as the Fed embark on that easing cycle.
We're talking with Stephen Major of HSBC and Lydia Bassour of EY, both of you at a time when you're talking about yields going lower in the face of disinflation, as well as the U.S. just being. At what point boost the economy, boost the economic activity in the United States, and have a self-reinforcing cycle versus indicate some weakness that actually would be negative for the growth prospects?
Yeah, I mean, when we look at the economy today, we're looking at an economic slowdown underway. We've seen some rebalancing in the labor market, some softening in labor market indicators. We're looking at consumers being more cautious with their spending, investments also softening, and companies being more discerning with their spending and hiring because of this tighter credit condition environment, and because consumer demand has softened and consumers are more price sensitive. So in this economic environment with signs of softening in the labor market, we're expecting to see that recalibration in monetary policy happening, towards, September. We're expecting the first rate cut in September, and rates starting to gradually move lower and move away from that restrictive policy stance. And by seeing that those rates moving lower, we should ensure that the economy doesn't slow down materially. We're expecting to see growth falling below trend in the coming quarters, but we're not expecting to see a retrenchment in economic activity. And the fact that the Fed is going to embark on that easing cycle should allow for that cycle to continue and run through 2025.
Stephen, what's your view on this? Because some people would say that this economy has been a lot less sensitive to rate hikes. Why would they be so sensitive to rate cuts?
Yeah, that's a fair point. So you have to be careful with this one, because I think that people are expecting just very modest rate cuts. And in fact, that's all conditioned by what the Fed's just told us in their dot plot. So I find a bit of an echo chamber around the mainstream forecasts, because they're all basically one standard deviation from the Fed. It strikes me that it's probably true that the economy isn't that sensitive to the rate cuts. But when the rate cuts come, I think they're probably going to be more than the market's pricing in. And that's exactly the point, that cutting by 25 basis points here or there isn't going to do anything. So when the economy is really cooling, and if unemployment is going up at a faster rate than the Fed's forecast, I think that could be a kind of scenario to think about. Then rates will be cut quite hard and fast. Also, Lisa, it's not just about the US cyclical economic data. It's about the structural factors, the huge stock of debt. It's about what's happening in China and Europe, and ultimately, US rates just look out of line with everything else.
Stephen Major of HSBC, Lydia Bassour of EY, both of you, thank you so much on a week where we'll be talking a lot about the Fed and rates. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakkas. Yahaira.
Lisa, President Joe Biden will host NATO Secretary Jens Stoltenberg today in the Oval Office. The meeting comes after G7 leaders agreed to a plan to tap frozen Russian assets to help aid Ukraine. But over the weekend, Ukrainian President Volodymyr Zelensky failed to broaden global support at a summit in Switzerland, with BRICS countries Brazil, India, China, and South Africa all declining to sign a final document of support. The number of Americans who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as at this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016 when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney announcing that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw either no release or months-long delays as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much. Up next, settling you up for the day ahead. You're watching Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities
could face bigger challenges.
Listens next.
It was going to keep
Green World Cup. This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Taking a look at where markets are as we are about 35 minutes away from the open, and you can see not doing all that much right now, counting you down to the opening bell. Here is the trading diary for the week ahead. Today, the Fed's Patrick Harker, John Williams, and Lisa Cook speaking. Tuesday, retail sales, plus a host of Fed speak. Wednesday, UK CPI. Thursday, another round of jobless claims. And Friday, S&P global PMI data. Remember when that actually had a really significant impact on the market. So people who say it's not the ISMs, the ISMs, it doesn't matter, think again, because it has in the past. So for final thoughts, I know you were really key on cohabitation, but there are some other things that you're looking ahead to other than French politics. Anne-Marie, what are you focused on?
Well, I'm looking at politics stateside as well. I mean, obviously, you leave the G7. It was clouded by domestic politics and this concern. Biden comes back. It is full-on campaign mode. He went directly to a campaign in L.A., and everyone's going to be focused on the debate. I think Terry Haynes had a really good point. It's how they want to frame this election and who comes off better doing that. So I'm interested also to see what retail sales says tomorrow, because where is the consumer right now? Because after that report on Friday, when you see the middle class saying they're feeling more like the lower income class structure, that's a big problem for this campaign.
I agree. There's also this issue of if there is weakness, what can kind of happen in response to it in terms of the fiscal impulse, given the fact that there already is quite a bit of debt. What are you focused on, given the fact, Danny, that we've had a whole host of potential important aspects this week?
I think it's how the Fed speakers react to the data that we got, because the reaction so far we've heard, again, from Kashkari, from Mester, it hasn't been that great. They don't sound like people who would have changed their dot plot had they had the data in hand. So we're going to get the data. We're going to get, as you say, the loud period. Do they change their tone? We're just hearing from Stephen Major, who said, actually, they're going to cut a lot more than this market thinks. And Lisa, that's what makes a difference. That's what makes a difference to the maturity wall, into companies, into the poor small caps who can't rally along.
We'll keep talking about that. Coming up tomorrow, we have Laura Rame of FS Investments, Tony DeSpirito of BlackRock, Ian Shepherdson of Pantheon, and Greg Deco of EY, all talking amid that key question. If the Fed cuts, will they cut a lot? And just how flat on their back are consumers that have been feeling kind of rotten? This was Bloomberg Surveillance.
The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices. And if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult.
Effective Fed funds rate 5.33% June the 14th, unchanged from June the 13th.
From New York City for our viewers worldwide, I'm Matt Miller. Futures doing a whole lot of nothing, waiting for the data. The countdown to the open starts right now. Coming up, U.S. stock bulls get even more bullish after Evercore ISI and Goldman Sachs boost year-end targets for the S&P. Traders staying cautious, though, in Europe as they digest comments for France's far-right leader Marine Le Pen. And Fed speak picks back up again this week with 8 members set to give their comments. Is the data more important? We begin with the big issue, markets taking a pause as the Fed indicates it is in wait-and-see mode.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market, before we have to make any decisions. So we're in a strong position, but if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Joining us now is Christina Hooper, Invesco Chief Global Market Strategist. And Christina, thanks so much for coming on the program this morning. What do you think about the path and the sequence in terms of rate cuts? Is Fed guidance even as important as the data points that we're going to get?
I don't think it is at all. I mean, all we have to do is go back to December of 2021. The Fed anticipated in its dot plots that by the end of 2022, the Fed funds rate would be 90 basis points, and it was about 430 basis points. So we know the Fed can be wildly inaccurate, and so I don't pay a lot of attention to it, especially, if I think about the Fed's projection on core PCE. It has ratcheted that up from 2.4 to 2.6 to now 2.8. So that suggests to me if we get any improvement in disinflation, there should be merited more than one rate cut, because they're assuming one rate cut with
According to Korea,
no
Canadian home sales fall 0.6% in May from April.
I'm positive on the outlook, and I'm not a believer in the Fed dot plot as being the be-all and the end-all for sure.
So do you see inflation slowing down maybe more than the Fed? I mean, they have to be cautious, especially after what they've gone through, right? Do you see inflation coming back down closer to 2% in the next couple of years?
I do, absolutely. Yeah. It's going to be an imperfect path. At times it's going to be ugly, but it will come down. We're removing stimulus. We're doing everything that historically has resulted in a reduction in inflation. So I think that's going to happen this time around. But there will be certainly data points that disappoint, but when we take a step back and look at the trend, I think we'll get to a place where the Fed is able to cut probably 2 times this year, in my opinion.
By the way, does your inflation outlook change depending on who wins the election in November? Are there multiple
And Korea
scenarios?
says its Canadian home price index falls 0.2% in May from April, down 2.4% year over year.
Monetary policy is doing a lot of the work, and what we've seen in terms of very aggressive tightening, it's taking time to work its way through the system. But that's really the large driver. That and with removal of the significant fiscal stimulus we've seen is enough to get us to a point where we're moving closer and closer to the Fed's target.
All right, I want to get over right now to Michael McKee because we're getting our latest reading on the strength of the consumer with retail sales out tomorrow. The data, as Christina says, may be more important than what the Fed actually tells us. Michael is Bloomberg's chief economics and policy correspondent. So, Mike, what data are we going to be getting?
Well, retail sales is the big one. We had the week kickoff with Empire Manufacturing, better than expected, but still negative. That's not a major indicator for anyone in the markets, but it is something to trade on today. Retail sales tomorrow. The big event of the week is the consumer hanging in there. We get good news from basically the credit card reporting banks, but Bloomberg Economics thinks it's not going to be good. So you pays your money and you place your bets for tomorrow. Wednesday, get the day off. So that'll be great. Wear sunscreen. Thursday, jobless claims is going to be interesting just because we had such a rise last week that we want to see what happens. Is that a trend or is it like last year, just sort of a seasonal thing? But again, retail sales, the forecast is for things to get better. We're expecting the control group to be up 0.4 after declining last month. So this all tells you that if that comes to pass, that the Fed can stay on hold. It's not going to make a big difference. We are going to hear from the Fed, of course, as you mentioned, an awful lot of Fed speak this week as they come out of the quiet period. But does it mean a whole lot? We'll get their views on retail sales probably, but do we see any kind of change in what
in 10 minutes time now at 9:15 a.m. Eastern time. We expect comments from ECB's McCloof.
And the jobs numbers that the Fed is watching. So we'll get a lot of information, but do you act on it? Going to be up to you. I did throw on Bank of England there. They have their decision on Thursday. And after the ECB cut, and there's some thought that the Bank of England's getting closer to cutting, there'll be some debate about how that affects the U.S. economy and the Fed, but probably not much.
All right, we will talk about that for sure, how the international picture affects the U.S. economy. That's in our next block. Michael McKee, thank you very much for that. Christina Hooper, Invesco Chief Global Market Strategist, still with us. And Mike showed that there's some housing data coming out on Friday. I saw last week applications for new mortgages soared. And I'm just wondering, is this economy getting used to these interest rates? Old people like us refer to them as normal, right? But for the kids, this is not normal.
This is not normal, but life moves on. So I think for a certain cohort, they are starting to purchase. I think part of the catalyst, though, is an expectation that they'll be able to refinance in a year or two because they anticipate we're at the cusp. We're at the start of a rate cut cycle. And so that they can tolerate higher mortgage payments for a short time.
So I wonder how earnings, your view on earnings is, because we're starting to get higher and higher targets. Yesterday, Julian Emanuel put out a target of 6,000 on the S&P. Kind of blew my mind because he was at 4750, right? That's a little bit of a capitulation. His basis is that earnings are really accelerating this year and are going to continue to accelerate next year. I think 8% gains for this year and 5% gains for next year was his thesis. What do you see in terms of earnings?
So I would anticipate an improvement in earnings. What we saw recently was that one company was the driver of a significant portion of earnings growth for the S&P 500. So an expectation of a broadening does get us closer to his targets. And so I think that's a very possible scenario. Also, keep in mind that if we do see that start of rate cuts, if we start to see the 10-year yield come down, that gives the S&P 500 more room to run as well.
Right. So the broadening, I guess, is important, right? We're looking at a 24 price earnings for trailing earnings right now, which is historically pretty high. But if you look at just the Magnificent Seven, as they're called, they have a PE of 36 for trailing earnings. So the 493 aren't nearly as highly valued.
Absolutely. And so if they're able to contribute more, then that helps justify higher PEs. Now, I will say this also argues for investors looking abroad to make sure they have exposure to areas that have far more attractive valuations. And I think Europe and the UK are attractive destinations because they are not only attractively valued, but their cyclical exposure is higher. So if one assumes that we're going to see a reacceleration in global growth, we're going to see a reacceleration in European and UK growth, that's an attractive place to be.
Hey, do you still, I mean, I want to talk a little bit about this in the next block, so maybe we'll save that, but do you still see a broadening out in terms of regions? Because we're all worried about, you know, Le Pen winning in France, and you've seen yields go crazy over there, value wiped out from the French stock market.
Well, this is certainly a time of uncertainty and instability, but once we get greater signs that there could be stability, that when we get past this election, things look fairly smooth, I think that we'll look back and say this was probably an attractive buying opportunity. I think of this as a very short-term period, a blip. But if we look beyond this, there is a lot of potential. And I wouldn't want politics to get in the way of investing because the time horizons are so different.
Are we all being a little bit too Pollyanna-ish in terms of, you know, worries? I heard Larry Summers say that Donald Trump is the most inflationary presidential candidate in his memory, you know, and he's not young. Obviously, the worries about France, even though Le Pen seems to be coming back to the center and saying she's not going to spook institutions. I mean, this is really when you get great opportunities, right? When the whole world's freaking out if you don't.
Exactly, absolutely. And I think what we've seen from history is that typically when you put on political blinders as an investor, you get better performance because you're not
In 5 minutes' time now at 9:15 a.m. Eastern Time, we expect possible comments from ECB's McCloof.
Opportunities. It's hard to do. You have to have intestinal fortitude. But I do think historically it has proven to be an appropriate and prudent strategy.
What do you think about portfolio construction right now? I noticed in Julian's note yesterday, he said convexity is a must, which is kind of confusing and if you're not, you know, deep in it. But basically, he's saying like put on magnification trades, right? Really boost your bets on this AI thing, which has already run so far so fast.
Well, I think it's very important to be diversified and to look at your portfolio and ask, when have I last rebalanced? Do I have extreme overweights? And ensure adequate exposure to areas that have been overlooked for years, like small caps, where you probably are underweight just given performance in areas like technology. Now, having said all that, I do think that pursuing themes like artificial intelligence is an attractive additional component to a portfolio. And it is sensible to continue to have those exposures, but you don't want to be extremely overweight. Probably many investors' biggest overweight right now, though, is cash. Right. It's always prudent to have a reasonable allocation to cash, but many are way overboard in terms of cash exposure, and this could very well be a time to add that in.
Is it harder and harder, though, to tell your clients to be diversified? I mean, putting all your eggs in one basket has been paying off for a decade now.
It is absolutely harder and harder. But having said that, when we do go through periods where, like 2022, that is a reminder to investors that there are benefits to diversification. And of course, we are looking out on a different kind of market environment driven by changes in monetary policy, normalizing of economies and policy, and that could very well offer opportunities. We like to think of it as opportunities opportunities amidst divergence.
All right, Christina, you're going to stay with us because I want to talk more about what's going on internationally, and you have great experience there. Christina Hooper from Invesco. Joining us now, though, with a look at the stocks, individual stories moving ahead of the opening bell is Abigail Doolittle. Abby, what are you seeing?
Well, it's interesting, Matt, because we have the futures basically flat, slightly down, NASDAQ 100 up ever so slightly, but we have a lot of big names that are higher, including the shares of Autodesk. This on the news that Starboard Value has taken a roughly $500 million stake in the company. They are pushing for changes to the board, given some of the operational challenges, plus the way that they have handled the accounting probe. But that's not it. Let's take a look at some of the other big tech names in the news this morning, or on the move, I should say, starting off with the shares of Broadcom up, heading to a 7th up day in a row. Of course, they put up that quarter and that guide last week, having a lot to do with AI strength, investors liking that. Speaking of liking AI and chips, NVIDIA higher once again, vying for that spot for the world's second most valuable company. Microsoft on Friday first, Apple second, NVIDIA third, but we have Apple trading higher. And of course, Bloomberg News' John Arthur is talking about the momentum, the tremendous momentum, well, momentum carrying Apple higher today. But I'm not convinced it's going to keep going, we'll have to say.
Well, we're going to come back to you for a look at the charts on that for sure. Abigail Doolittle looking at some of the individual movers this morning. Coming up, we'll talk more about France. It's on everyone's tongue this morning. Marine Le Pen adding new supporters in that country.
We've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
More on the political upheaval in France and what it could mean for investors next. This is Bloomberg.
Shortly expecting comments from ECB's McLuth.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
We have seen cohabitation before in France. You know, we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
All right, we're going to continue talking about what's going on in Europe. Citi has downgraded the continent from overweight to neutral. The bank strategists saying they prefer growth-oriented U.S. stocks. So just when it looked like investors were going to go back to Europe, it seems there's another boogeyman pushing them back. Marine Le Pen is that boogeyman. I think it's safe to say gaining momentum ahead of the French legislative elections, snap elections that Emmanuel Macron called after the EU election drubbing he took and other centrists took. Alan Katz is Bloomberg's Paris bureau chief. He joins us now to talk about really this it seems like chaos, Alan, that Macron unleashed in the way it's been compared many times to what David Cameron did with the Brexit vote, and he lost that one. Why would Macron have done this? Isn't he worried?
Well, I certainly hope he's worried at this point if he wasn't worried in the beginning. The answer to that question about why he did that is a really tough one, and it's hard for many people to really get their heads around it. It was funny, there was an interview I was listening to on Sunday with Finance Minister Bruno Le Maire, and kept getting asked that question. He was saying, well, this was the decision of one man, the one man who has the authority to do this. That man's Emmanuel Macron. This is one man's decision. He repeated that over and over again. And so it really is the case that this was sort of Macron decided this. He didn't really ask anyone. And as you say, he sort of unleashed this really chaotic moment in France that that most people feel didn't really have to come this way. It really feels like it was sort of as you said, it's sort of a Cameron-like, self-made moment of chaos that's happened here.
Well, and now Le Maire and others are out, I guess, promoting a new project fear, a French project fear, right, to try and get voters worried about Le Pen and the national rally. How is it going? I mean, do we know now if they're gaining momentum, if they're losing momentum? Who's going to win?
So we don't know that yet. I mean, one of the things that is always true in these kinds of elections in France, that they're very complicated to tell ahead of time how things are going, because it's a two-round system. So it's very different than, say, the U.S. system, which is a one-round system. You go to the polls, the Tuesday in November, and then you elect the president and Congress. Here, you go to the polls the first time on a Sunday, and then you elect essentially people for a runoff vote that then happens a week later. So it's very hard to tell. There have been some early polls, and they've shown Marine Le Pen and the national rallies, you say, being in a very strong position. Now, do they get enough to actually take control of the National Assembly, which is the House of Parliament that actually matters, that really has the power in France? It's a big step for them. It's not clear yet if they'll do it, so it's really too early to say. But there's enough of a worry that might happen that it really has caused a lot of people to frankly to panic. You saw big sell-offs in stocks. You saw sell-offs in bonds last week. Things have calmed down today, but people really are quite worried about what might happen, who might take control, if anyone, and if so, as you pointed out in the run-up to this, sort of what their fiscal policies might be and what they might do were they actually to take control in France.
All right, Alan, thanks very much. Bloomberg Paris bureau chief Alan Katz talking to us about what's going to happen in the French elections. Christina Hooper still with us, Invesco chief global market strategist, and you truly have global perspective at Invesco, and in the past you were at Allianz and other big global investors. Does what happens in France really matter to U.S. assets? Does it matter to Americans?
Well, it is mattering just in that we are seeing some flows into the U.S. as sort of safe haven trades because of fears around what's happening in Europe. I think it's very short term, but yes, in that way it does have an impact.
In your note that I was reading this morning, you said divergence has reemerged as a theme. And you certainly saw that before this, right, with the ECB cut and the Fed's not ready yet. Does this amplify that?
Oh, absolutely. I mean, what we're seeing happening in elections is definitely amplifying it. We might see a number of different economies moving in the same direction in terms of that pull towards the right, but it's happening in different ways and at different times over the course of, I think, will continue to evolve this year. So that adds to the divergences, but this could be very short-lived in nature. We could see that the result of the French elections winds up being something similar to a Giorgia Meloni kind of event, where we have a more centrist party, and there really wasn't cause for the kind of concerns that many investors had. We'll see, but I do think that primarily for me the divergences are around the economy and the monetary policy reaction.
In terms of policy, you know, it used to be when I was a kid that the right wing, at least in this country, believed in free markets, right? Open border, trade, and now nobody buys that. It's all about protectionist tariffs and, you know, attracting businesses. The Biden administration has put out a ton of money to attract businesses to manufacture here in the U.S., so much so that Europe is very angry about it. Does that continue no matter who gets elected?
I suspect it will in the shorter term. I mean, what we saw in 2023 was pretty amazing. 70% of the industrial policies were created by developed economies. And in fact, if you look at the big economies, the majors, the US, the European Union, and China, they were responsible for 48% of industrial policies. That's unusual if we look at history, and I think speaks to this desire for some level of protectionism, the intersection of national security with economic interests. All kinds of things are happening. They're happening largely in developed economies, and so we're seeing some definite trends that I don't think die tomorrow, but might not last more than a few years.
All right, thank you for tempering my sensationalism a little bit. Christina, great having you on the program. Thanks so much for joining us. Christina Hooper there, Invesco Chief Global Market Strategist. Coming up, we're going to give you the morning calls, and then later Sarah Hunt of Alpine Saxon Woods joins us on tech's momentum and whether it still has room to run. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Futures searching for direction. We're going to get a lot of Fed speak this week, so that could move these dials. But right now, S&P futures just down a little bit, partly on concern out of France, although you would expect that concern to drive assets out of Europe and into the U.S. Rather than weighing on our markets. Let's get to the morning calls right now. I'll look at some of the analyst recommendations on Wall Street this morning. First up, UBS upgrades Best Buy to a buy from a neutral, raising the price target to $106. The analyst sees higher levels of product innovation, including AI and growing sales of new categories like e-bikes and furniture, driving more shoppers to Best Buy. Next up, Citi upgrades Capri, parent company of Versace and Jimmy Choo, to a buy from a neutral with a price target of $41, citing potential upside regardless of Tapestry's deal to buy the company.
of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. Looking for some direction today. The concern in Europe weighing on S&P futures right now. The stock 600
So we're looking now to the market on open imbalance. S&P 500 seeing a sell side of 273 million. The NASDAQ 100 a small buy side of 2 million. The Dow 30 a sell side of 119 million. Mag 7 stock seeing a 1 million buy side.
That we're following this morning. Speaking of the move in Europe, we see the euro back down below $1.08 right now at 107.18. The U.S. 10-year yield at 4.27, 4.28, and NYMEX crude right now 0.75% at $79.05. One of the stocks that we're watching closely this morning is Autodesk, the maker of engineering software, rallying after activist investor Starboard takes a $500 million stake in the company. Joining us now to talk about that is Bloomberg's Abigail Doolittle. Abby?
So shares are rallying, but I don't think that this news is a surprise to everybody, because if you take a look at the stock on the month, it is heading to its best month since July of 2022, up about 17%. Today, it's its fourth up day in a row. So again, I think that some folks had known about this, but what we're talking about is that roughly $500 million stake by Starboard Value in Autodesk, the engineering software company. They are saying that some of the company's performance metrics, not great, but they are also pushing for changes on the board. In fact, they are filing a lawsuit against the company to delay the annual shareholder meeting, saying that some accounting probe issues had been disclosed really at the last minute of when they could actually seek a change on the board. In return, we've had some comments from Autodesk recently saying Autodesk is quote unquote confident in the direction after the Starboard letter. Starboard pushing for these changes, investors liking it, thinking that things could change on the year. This is one stock that is underperforming down, but certainly today up 4%. And again, in the month of June, up about 16%.
All right. Abigail, thanks very much. Abby talking to us about Autodesk. Let's talk about Broadcom. It's the latest company to be caught up in the AI boom. It had an amazing week last week, and it's moving a lot this morning as well. Here's Bloomberg Katie Greifeld with more on Avgo.
Yeah, Broadcom building on its record run here. Broadcom, of course, it supplies chips to companies such as Apple, so it has some big clients there. It surged by 23% last week. That, of course, was a record weekly performance. That's after it reported a beat and raise quarter. So let's go through just some of the numbers there. Sales in the full fiscal year, which runs through October, expected to come in at about $51 billion. Analysts had projected about $50.6 billion, so a beat there. And And Broadcom, it finished Friday at an all-time high. It's up another 3.5% or so today right now with the AI hype cycle in full force. It's up 56% year to date through Friday's close. And as such as NVIDIA, Broadcom also planning a stock split. That 10-for-1 stock split, it becomes effective on July 15th. So it's going to be interesting to watch the action between now and then, Matt.
You know why the ticker is AVGO?
You know, I was hoping you would tell me.
Because, well, I think you were at Haverford at the time that Avago bought Broadcom.
Yeah.
They said, we're going to keep our ticker, but your name.
I was not paying attention, so I appreciate that.
Katie Greifeld, thanks very much. Finally, it's been a scary few days for Monster Energy. The stock has been sliding on concerns of slowing growth in the U.S. energy drink sales market. Here with more is Bloomberg's Isabel Lee. Isabel?
Hey, Matt, shares are now kind of flat. Stifel cut their price target for the stock to 57 from 63, but it maintained its buy rating. So the new price target implies around a 20% upside from where the stock last closed. So this follows really multiple price cuts. We've seen last week MKM Roth slashing their price target to 56 from 59. This analyst there is concerned over slowing growth in energy sales in the U.S. The analyst said that if this continues to eat up the market share, then it's going to be harder to justify the multiple expansion of the stock. We also have Jefferies also cutting its price target, but maintaining its buy rating. The company cut its target to 61 from 68. So highly caffeinated energy drinks really have seen a softening in demand in the past few months. That says consumers try to shift to more healthy options, and also as the regulators hone in on this segment. We have the UK party, for instance, last week saying that if they win the elections, they will consider banning the sale of highly caffeinated energy drinks to teenagers. So that's one thing to watch. That's in the UK, of course, but who knows if it will follow here in the US. For now, the Monster strategists are kind of bullish on the stock. We have around 17 buys, 10 holds, and just 1 sell. Monster is down now 16% year to date, though. Shares are now edging slightly higher by 0.5%, Matt.
All right, Isabel, thanks very much. Isabel Lee there talking to us about Monster and other highly caffeinated energy beverages. Joining us now is Sarah Hunt. She's a partner and chief market strategist at Alpine Saxon Woods. And Sarah, a couple of those stories were big momentum moves, not both in the tech sector, but we've seen that obviously with AI as well. So much momentum. Does that continue? Because we've had a real run-up in valuations, certainly for the Magnificent Seven, which is now looking at a PE of 36 times trailing earnings.
Well, I think what's interesting is the Broadcom news that you just mentioned, which is that you've seen a big rally in that stock. So I think that what's going to continue to happen is that people are going to latch on to different companies within the space and say, hey, wait a minute, this one hasn't moved like the rest of them. We had some Broadcom widely across the firm. So, of course, we're happy with that. But I do think that there is a risk that as these stocks get pushed higher, those earnings really have to come in to support the levels of prices.
I wonder what, last night I was reading Julian Emanuel's note, he from ISI raising his price target to 6,000 for the S&P, but really it's all about obviously AI and this space, and he says, you know, the gains from AI are going to come early in its development. Do you agree with that? I mean, it's obviously a process. We know at Apple, for example, it's going to take years for them to roll out their AI strategy, and they're just partnering up, not even using their own goods, really. But do you believe that the gains in terms of the stock market and the bond appreciation are going to come early in that development?
Well, certainly for the stocks that participate early in the development. So right now, who are you seeing rally? You're seeing the companies that have the most skin in the game in terms of sales being rocketed by the fact that people need more of these chips. They need more memory. They need certain things that go along with deploying the assets to begin with. Then you're going to have to see the development of how am I monetizing this when I'm not the company that's making the chips, or I'm not making any of the ancillary products that go into creating AI servers. And those companies now capitalize on the investments that they're making in the future. And that's why it could have a very long tail. But I also see the point of saying right now you're seeing the big gains in the companies that are in the early parts of it, because those are the companies that are getting paid right now for AI chips.
Does it matter if we get rate cuts, Sarah? I mean, in order for the bullish case to play out, do you have to have the Fed play along?
I don't think in the technology space you need to have the Fed play along, because right now there's a secular story going on in that part of technology that is encompassed in this AI situation that is different from the rest of the market. Does the rest of the market need rate cuts? I think they certainly, certain aspects and certain sectors of them do. We're going to have to see how inflation plays out. And I think the benign inflation report on Wednesday was helpful to the Fed, but it's just one after several non-benign inflation reports. So I think that for the rest of the market, yes, for Main Street, certainly a rate cut would probably be welcomed. But for the technology juggernauts right now, they're dishing off a lot of cash from all of this. I don't think that the rate story is what is important to them.
In terms of the tech sector now versus, Y2K, and people are making that comparison a lot, right? Because valuations have shot up here to 20 plus over the past only 150 days, and the same thing happened previously. Is there a difference in that these companies are actually making money, Sarah? Because, during the 1999-2000 boom, it seemed like driving revenue higher was the only important aspect, and there was no focus on profits.
I think that's a big differentiation, and I think that's one of the reasons that people are less worried about the valuations here as they were in that time frame. You also saw in that time frame a lot of large companies that were selling equipment, financing their own customers. And right now you have a very different situation, because the biggest buyers of some of these chips and servers are the largest companies that have a lot of cash. There's no need for companies to borrow to buy AI chips, for example. So I think it's a very different drop, and you have a much bigger, more concentrated tech picture and a much more concentrated customer base. And while there is some risk in that, it's certainly the best customer base to have right now, because it's a base that has an enormous amount of cash and a willingness to spend it.
Are you talking about other businesses like B2B commerce, or do you mean consumers still have enough cash and are willing to spend it?
I think for the current AI boom in the chip space and in the server space, the companies that are buying things like Google and Meta and Amazon all have enough money to have a large CapEx program to start putting some of this stuff into place. And back in the 2000s, you had a lot of companies that were financing their own customers because the customers wanted to deploy switches and they wanted to deploy dark fiber, but they didn't necessarily have the revenues that were commensurate with their needs. And I think right now you see that. And I think on the Apple side, you've seen a little bit of consumer enthusiasm for the changes that Apple is going to bring. So I think, AI has been a part of the consumer technology world for a while. It's just the large language models that have made it much more approachable and or much more able for people to understand what's going on there. So I think that there's a willingness for people to spend on technology. There's certainly a willingness for the large tech companies to deploy capital in specs to continue to add to their capabilities. So I think that that's a little bit of a difference from the last cycle.
Right. I can understand that, companies are waiting in line to get their hands on as many chips as they can. They want to have space at server farms, et cetera. But I just wonder about the strength of the consumer. UBS, I was just saying this morning, upgraded Best Buy because they expect droves of consumers to go in, or at least online, and upgrade PCs to AI capable. We've seen this, with Dell and others. But does the U.S. consumer really have enough money to participate in this upgrade cycle? We have worked our savings down to zero, and you no longer have the stimmies that you had during the COVID period. So can we still buy as much stuff as Wall Street needs us to?
Well, I think there's been a lot of discussion about the bifurcated consumer and the fact that on the low end, you're seeing a lot more pressure. You're seeing a lot more pressure for folks that have not kept up necessarily with wage growth as everybody else has. And on the high-end consumer, you're seeing a very high propensity to spend. So I think on that technology side, and certainly the way certain things like your phones are no longer subsidized by the carriers, but at the same time, they've made payment plans. So I think that people do have an urge to get the latest and greatest, and they don't want to be left out. I think there is a propensity for that consumer to continue to spend, even though the savings isn't as strong as it was. And I think to the extent that you had a huge upgrade cycle on the PCs when we had COVID, at some point, now you're 3-4 years after that, everyone buying an extra computer because they needed one. I think there probably is some room for additional expense, especially if people think that they're going to get some hot new ability to use their technology.
Sarah, what do you think about diversification now? Bloomberg had a great story by Lou Wang a couple of days ago about the fact that, you know, if you put all your eggs in one basket, just buy a stock tracking fund, you've trounced any kind of asset allocation fund. But it doesn't feel safe to do that. Do you go for the convexity trade? Do you look at amplification in AI specifically, or do you think diversity is still the right way to invest?
Well, I think that you always have to have a mix, because in the end, yes, this has been fantastic. And if you were just looking at the Qs over a period of time, you could say, well, that's trounced everything. But that doesn't always last forever. And especially when you start to see valuations get a bit stretched, at some point, there's going to be a digestive period. Even if there isn't a big drop in the market, there's certainly going to be some sort of consolidation. And that's when you also want to have some participation in other areas. And I think right now that's been the big challenge, because the economy, the data is coming in somewhat mixed. People are a little bit concerned about what's going on outside of the technology front, but the valuations in the non-technology sectors are not nearly as daunting as some of the technology valuations. So I think you absolutely have to participate in the technology, but I don't think you want it to be the only thing that you have. And certainly you've now got a fixed income component to a portfolio where for a while you didn't even have that as an option.
Sarah, great getting some time with you. Thanks so much for joining us. Sarah Hunt there, Chief Market Strategist and Partner at Alpine Saxon Woods. Coming up, Bill Gates is ready to go nuclear.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work.
Why he's ready to put billions more into a next-generation power plant next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world.
Surely expecting Bank of England gilt sale results.
My money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged,
Don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work. If we unleash the innovation power of this country, we tend to lead. And I feel great about the support we're getting from the federal government in this nuclear space.
Bill Gates betting on nuclear power, plowing billions of dollars into a plant in Wyoming. His startup, TerraPower, broke ground last week for the construction of a commercial reactor in the state. Joining us now is Bloomberg Power and Renewable Energy editor Will Wade. I'm so glad to get you on the show because I was listening to you on Bloomberg Business Week with Carol Massar and Tim Stenivek. You had gone out to see a new reactor brought online. Not one of these new kind of fancy Bill Gates reactors, but like an old school one, right?
Yeah, I was down in Georgia a couple weeks ago to see the Vogtle 4 project, which finally came online. It was 7 years late. It was way over budget. It was like more than 100% over budget. And it's huge. It's, you know, it's a giant gigawatt plus reactor. This TerraPower one that Bill Gates is building is more than 300 megawatts, so it's much smaller. And it's a much different technology that they're trying to build.
But the thing that struck me is when you went to see the Vogtle reactor open in Georgia, you were like, nobody else is opening these, right? It's obviously, it's so late, it's so expensive. Who wants to get into that? Now here comes Bill Gates, and he's like, I want to get into that, not on that gigawatt level, but at a smaller level, and he wants to do many. So is it possible that this could pick up, that it could catch on?
It's possible. I mean, the thing that you need to keep in mind is it's all about climate change because nuclear is carbon-free power that runs around the clock. Wind and solar don't run around the clock. Hydropower does, but it's hard to find new places for it. Only nuclear can do that, but it is expensive and slow to build.
So the Bank of England sells £600 million of bonds in auction after receiving £707.1 million in bids, with an APF gilt sale operation cover ratio of just 1.18.
New technology, new build, and everything that new is, slow and time consuming.
Well, and what about the waste? Is there still that problem of where to put the spent, uranium or whatever, or have they dealt with that?
Oh no, it's still there. Every nuclear power plant has old spent fuel rods sitting out back, and they're going to be there. But I think
they're going to be there for a while. Huh?
Well, I mean, they're going to be there for a while, and it's deadly for thousands of years. But I look at it this way: like everything is dangerous. If you live near a coal plant, the emissions are bad. You're likely to get asthma. Gas plant. Everything in the world is dangerous. Nuclear is also dangerous, but they take the waste issue very seriously, and there's not that much of it.
Well, okay, so if not the waste being a problem, I grew up in the wake of 3 Mile Island, as did you.
Of course.
We all saw Fukushima rock the markets, and they're still recovering from that. Can that part of it be contained?
Well,
with new technology, right? This is what I'm wondering, because Bill Gates is kind of a preacher in terms of nuclear can be safe. Nuclear is clean. So is he right?
Yeah, there's definitely ways that you can design new plants that they are safer. Nothing in the world is 100% safe, even if you stay in your bed all day. But the new plants, they are safer. They have a lot more advanced designs, like the ones that, if you lose the electricity, the gravity will sort of keep water flowing to keep the fuel cooled and safe. So they're not as risky as some of the old school reactors that we saw in the 70s.
This new one doesn't even use water, right? It uses like molten salt.
Molten sodium, yeah. Well, it's got liquid sodium as the coolant instead of water, so that lets it get hotter, and that makes it more efficient. Plus, it has this storage tank of salt, so you can get extra power from it if you need to.
It's such a cool science, and I'm so glad that we have you covering it, Will. Thanks so much for coming on the program. Bloomberg's Will Wade talking to us about Bill Gates' ambitions for clean nuclear power, hopefully safe as well. For some of the sector price action that we're watching in the market this morning, just 22 minutes into the session, let's get over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, we're looking at another small decline for the S&P 500 right now, on pace for a second down day in a row. Somewhat broad-based from a sector standpoint: real estate, communication services, utilities, healthcare, materials, tech, and discretionary all lower. Real estate down the most. Yields are popping higher today, as you know, so that of course makes those stocks look less attractive given the real estate play plus the dividends. On the upside, energy, but up just a little bit, up 0.3%, and then three other sectors a little bit higher as well. Let's take a look at one sector that is underperforming, however, and that is biotech. The biotech index down for a second day in a row, the worst 2 days going back to for about a month or so, and it doesn't seem to be anything so macro, but there's lots of news at a micro level, including Takeda's epilepsy drug. Their phase 3 trial didn't meet the primary endpoint, and that stock and some other stocks down significantly, weighing on that biotech sector, Matt.
All right, Abigail, looking at the sectors for us. Coming up, Fed officials return to the public speaking circuit. Did they ever leave? The market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Time now for the Trading Diary, what you need to be watching today and this week. We get Fed speak from Williams, Harker, and Cook later today. Tomorrow, we get U.S. retail sales, so watch EcoGo on their Bloomberg terminal. We get Eurozone and inflation data out of the Eurozone, so, pay more attention this week than you typically would, considering what we're seeing in rates and stocks over there. Wednesday is Juneteenth, so the markets will be closed, and hopefully you stay home and commemorate that in some way other than going to work. Thursday, we get the BOE rate decision. London Stock Exchange just overtook Paris as Europe's largest, so England continues to be important. This was the Countdown to the Open. I'm Matt Miller, and this is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
All right, we are 30 minutes into the U.S. trading day on this Monday, June 17th. Here are the top stories we're following. Bold up. Goldman boosts its year-end S&P 500 forecast for a third time to 5,600. Meanwhile, Evercore penciling in 6,000 for the benchmark, a real about face from the firm's previous bearish stance. Meanwhile, easing up on Europe, risks from France's political turmoil pushed Citi to downgrade European stocks to neutral from overweight. Instead, the bank upgraded U.S. stocks to overweight. And navigating the airlines with Brian Kelly, the founder of the Points Guy. We'll talk through the firm's report on the best U.S. airlines for 2024, with Delta nabbing the top spot for a sixth year in a row. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets on this Monday morning. It's quiet. Again, we get some interesting economic data later on in the week, but on this Monday, you can see that the S&P 500 down by just a hair. We're talking about 0.1% lower for a benchmark that is very close to record highs. The same thing, you take a look at the NASDAQ 100, just slightly higher, 0.1% or so when it comes to big tech. You're getting a little bit more action when it comes to some of those chip names. The Philadelphia Semiconductor currently higher by about 0.2%. But even with this muted action, you have Wall Street bulls getting even more bullish on the S&P 500. You have Evercore and Goldman, just some of the latest to boost their calls. Joining me now is Bloomberg's Abigail Doolittle. So let's start with Goldman, because a third straight forecast boost for the S&P 500.
Yeah, this is really pretty interesting. So on Friday, they boosted their S&P 500 year-end target for 2024 to 5,600. It had been at 5,200. This is the third rise in recent history from Goldman Sachs, as you said. So clearly expressing a bullish view, keeping up with the index's appreciation. 5,600 from current levels, not a huge amount of potential appreciation, but they're saying the reason for the call is saying that earnings was less bad than expected, basically a solid earnings season, and that the price to earnings, the valuation metrics supports the idea that we could see stocks go higher from here. What's interesting, though, Katie, is if you take a look at earnings on a forward basis, we're looking at 22 times for the S&P 500. That's not necessarily cheap. That's really actually above the average. So this call is assuming that everything is going to go well.
Everything is going to go well. That, of course, is what's baked into that call, as you say. Let's also talk about Evercore. I thought this one was interesting as well. We're talking about 6,000. That would certainly be big, but this is a real about face from what we were seeing previously from Evercore.
Absolutely. So Julian Emmanuel has really made a big change here, saying 6,000. To your point, roughly 10% upside potential from current levels. His previous target, I think it was 4750, sort of, so much lower. Lots of factors going into this, the economy, big tech, AI, that valuation. On the other hand, he does make the point that valuation, while he did raise his S&P 500 profit targets, he makes the point that it's below bubble territory. I don't know if that's the most reassuring. If we evaluate these two calls from a few different ways, fundamentals, clearly it's the economy. The Fed right now does seem to be steering toward a soft landing. On the other hand, if you take a look at the commodity space, there is some weakness for oil, for the grains, and some analysts in that space saying this does continue to point, it's a demand situation, continuing to point to the idea that there could be a recession coming up at some point. Again, valuation, I would argue that it's very healthy, if not rich. Technicals, Katie, on a monthly basis, if you were to look at the S&P 500, it's more than 100% above its 200-month moving average. That's a fancy way of saying that the bulls are well out over their skis. Now, if you go back to the GFC, only 67% above that. But if you go back to the tech bubble, 200% above. So we could go significantly higher, but it might be on borrowed time. The one last thing I would add, Katie, is a lot of the conversations that I'm having in another beat that I cover, real estate, folks are saying that the political uncertainty, not in Europe necessarily, but here in the U.S., that the election coming up, that there could be a lot of surprises there, and that they are seeing some activity sort of on the sidelines because of those concerns. We're not hearing about the risk. These calls really are assuming, again, everything goes just right.
All right, Abigail Doolittle, really appreciate that roundup. There's some really interesting sell-side action. Let's talk about these markets overall with Marianne Bartels. She is Sanctuary Wealth Chief Investment Strategist with me on set. Great to see you in person.
Great to see you in person as well.
Let's talk about all of this bullishness that we're seeing on the street. I look at the S&P 500 right now. We are just above 5,400. We're talking about 5,600 all the way to 6,000. What are you thinking when you think about just the broad index level for what's a reasonable level for year ends?
Well, we've been bullish. So we came into the year originally looking for 5,400 to 5,600, but I very quickly in the early part of this year raised my range for the S&P to 5,600 to 5,800 because we saw improvement in earnings and we saw the technicals improving. And I'm still very comfortable with that. If I do long-term technical projections, the market can go into a range of 6,000 to 7,000. But how I start feeling now, because I was so out of consensus, I feel now I'm in consensus land, and I don't like being part of consensus. But that doesn't mean I'm bearish on the markets. Earnings estimate revisions have been going up, and that's the most positive correlated indicator we have. Markets really truly move on earnings. But it does make me a little nervous that we're starting to get consensus. I'm also nervous because the VIX index, which measures volatility, has been around 12. That's pretty low. And we titled this year called the bucking bull. So we believe in the bull. We expected from time to time to see some bucking. So I wouldn't be surprised if you get a little bit of a buck. But a sign that you're in a strong market means when the market doesn't go down as much as you think.
So you're reluctantly in the consensus here. Let's talk about some of the risks, what that buck could actually look like, because there's been some chatter, of course, of maybe a summer pullback that's in the offing. You think about just how strong, of course, the outlook is right now. What are you thinking for the next couple of months?
So we've been in the camp that you're in the summer rally. The old adage, sell in May and go away, we kind of changed that. We said you want to buy in May, but sell before Labor Day. And I still think we have a chance of having a rally, but we do look for some bucking in the fall. is where we would see that. Where are some risks? I was actually really surprised. Moody's put on watch 6 banks, regional banks, for potential downgrades because of commercial real estate, and it got a blip on the radar screen and no one's talking about it. So if something was to emerge like that, you might be able to get a pullback in the markets, but we're not seeing anything that would take the market sustainably down.
Yeah, when you think about known unknowns, it feels like the commercial real estate market is definitely a place where there could be further shoes waiting to drop. But let's talk about technology and AI. There is so much good news and so much optimism baked into that corner of the market, of course, and that's really been propelling some of the benchmarks that we talk about all the time. Is there a potential for something to go wrong there when you think about just how strong the good news story is right now?
I don't see something wrong, and I do equate this to 1995, right? So we had the introduction of computers, we get the introduction of the internet, and when you look at the Dow, what really happened is you went vertical between 1995 and the peak in 2000. We always talk about 99 and 2000, but the rally actually began in 1995. But you had major bucking in 97 and 98 because you had a Thai baht crisis that took markets down almost 20%, but the year closed up over 20%. You had long-term capital in 1998. Markets went down internally 20%, but yet the market still closed on the plus side because the Fed eased up. So at any point in time, we can have an event that takes markets down, but if you're truly in a strong bull market, you recover very quickly. And I think we're in that. I think we're that 95, and we're going to go vertical out to 2029 and 2030. I've actually equated this to 1925 to the peak in 29 with the NASDAQ. The pattern to me looks very similar. So I'm very bullish AI. I'm very bullish technology. In fact, we titled our report this morning, June is busting out all over. That is an old song for you young people, but you got Apple finally breaking out after a consolidation for 3 years. Broadcom on its earnings, an announcement of their stock split 10-to-1. Broke out. We're getting breakouts in not just technology, but a company like Regeneron in biotech broke out. Microsoft has broken out. Oracle has broken out. Eli Lilly has broken out. So there's breakouts everywhere, and you don't get breakouts in a bear market.
Just really quickly, one area of the market that is not breaking out, just can't seem to get off the floor, is the small cap space. And it's interesting because you think about markets as a forward-looking animal. Okay, maybe we're 3 months out from the first rate cut. Why aren't the smaller sections of the market benefiting from that?
So yes, the valuation is there. There's a large component of small caps that don't have earnings, and that's a problem. But when you really look at the breakup, it has regional banks and it has energy. And I think the regional banks, because of commercial real estate, the concerns that you're going to continue to have consolidation due to regulation. And then you have energy, and energy is probably the best valued sector in the market. They have great balance sheets. Many of them give out great dividends, so it's great cash flow. But their earnings underperformed relative to the market. So they get this wind, and then the sale kind of goes down. So I don't think the makeup of small cap has leadership in it. Right. And secular bull and bear markets can last 15 to 20 years. And I think small cap remains in a secular bear and will not go into a bull market until we peak in the broader markets.
All right, Marianne, sit tight for just a couple minutes. Let's take a look at what's moving underneath these markets right now. We're going to do that with Bloomberg's Bailey Lipschultz. And Bailey, quiet overall, but there's a little bit of action under the hood.
Yeah, a little bit of action, starting with the activists, Katie. Want to start with Autodesk rallying 4 or 5%, depending on when you take a look. This coming after Starboard announced a stake of roughly $500 million, pushing for the company to delay its annual general meeting, basically saying they botched their handling of an accounting probe, which did not actually have a massive impact on the company's underlying business, but did cause a bit of concern and uncertainty from the investing community. The stock from that February 9th high in 2024 down about 15% before this letter, before this potential lawsuit from Starboard, again, urging the company to delay its annual general meeting so they can kind of, position some members to be potentially added to the board, just given, again, as they view it, the botched handling of that accounting probe.
So some boardroom drama there, definitely boosting the stock right now. And we were just talking about this next name with Marianne. Broadcom really breaking out.
Really breaking out again. You guys mentioned it ahead of that 10-for-1 stock split. Stock splits back in vogue for companies that have high sticker prices. As you can see right now, a really sharp move higher, 18.13 on that handle for AVGO. Katie, the stock has more than doubled in the last 12 months. Has really been absolutely rallying ahead of some of these excitement around the AI boom, excitement around what the potential growth can look like for the company. Really very much sitting comfortably in that group of winners alongside the likes of NVIDIA.
All right, and just quickly, GameStop, just for fun. What's going on, Bailey?
Just for fun, Katie. Hopefully there will be an annual general meeting scheduled for 12:30, but I say hopefully because it was scheduled for Thursday, and they had to postpone it because they had too much demand and issue with the site that hosted that meeting. Obviously, all eyes have been on what's going on with GameStop, their ability to raise billions of dollars on the back of the latest Roaring Kitty rally. Company has about $4 billion in change in cash. So hopefully we'll be able to hear from Ryan Cohen. It'll be interesting to see if he lays out anything in terms of a strategic update, something that we haven't gotten really in the 3 years since he took an activist hold and really kind of pushed the members of management out, became the chief executive, and is really the brainchild behind GameStop.
Yeah, it would definitely be good to get some fundamental news around that name, TBD, of course. Bloomberg's Bailey Lipschultz, thank you so much. Now coming up, protests erupt in France over the weekend to oppose Marine Le Pen's far-right party. City on the heels of that downgrades European equities over the political uncertainty. More next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
Well, French markets stabilizing a bit after being roiled last week on that surprise election call. However, risks remain, prompting Citi to downgrade European stocks. Bloomberg's Paris bureau chief Alan Katz joins us now with more. So over the weekend, we heard from Marine Le Pen saying that she'd work with Emmanuel Macron should she prevail. And it seems like markets, at least, and investors seem to be taking her at her word.
Well, they certainly do for the moment, at least. As you said, markets have calmed down a lot today compared with how they did last week. And also, I think it's because people are taking a little bit of a breath to sort of say to themselves, oh, wait a minute, who's really going to take control? France is a very complicated two-step system in its vote, and so it's still quite hard to tell who is going to end up sort of in control of the legislative body when this is all said and done.
And what's the path forward here, for example, for Emmanuel Macron? I mean, how does he forge ahead from here?
Well, it's difficult. There's no question about that. And it's why a lot of people, including other heads of state, we reported out of the G7 over the weekend, have sort of asked why on earth he dissolved Parliament. The path forward is that he has to try to forge a sort of centrist group with using the usual sort of fear of the far right that's worked in France as a bulwark against that for decades. Whether or not that sort of fear of the far right still exists in France it's very unlikely to be true, because when you look at the most recent election results, particularly the European elections that just happened, a third of French people voted for the far right. So it seems like there is no reticence or no hesitancy to do that anymore. And if you look at polls right now, another quarter of the French public is ready to vote for the far left. So that sort of centrist group that Macron is trying to rally, to bring together, to create that governing party that he's called for, it seems like it's going to be very, very hard for him to actually do that.
All right, Alan, really appreciate that reporting. I'm sure it's very busy over there. Our thanks to Bloomberg Paris Bureau Chief Alan Katz. And, of course, Marianne Bartels of Sanctuary Wealth still with us. And it's interesting. You saw Citi, of course, downgrading European stocks to neutral. You also had this advice from Mizuho saying that investors should stay out of it at the moment, even with the stabilization that you're seeing in French markets right now. How are you feeling about European markets when you think about the potential political risk spillover effect?
Well, markets never like uncertainty, which explains why the markets, particularly in France, have been correcting. But I don't think you should invest based on what you don't know yet, right? We don't know what's going to happen. And I'd rather see what happens and what are the policies before I made a decision about whether or not I would want to sell my European equities, because when you look for value around the world, Europe has had great value. They're not very expensive. That tells me you should have limited downside. But if it's going to negatively impact earnings any future,
so we're looking now to the Fear and Greed Index, 39 out of 100, which indicates fear, while the Crypto Fear and Greed Index is 71 out of 100, which indicates greed. Keeping an eye on the VIX as well, it's currently up around 3% on the session and around 13.
And we think Japan is in a new secular bull market. How we measure that is you've broken up above that 1980 high. You're in a whole new realm. And we think they're benefiting from the weaknesses in China. And we also think that they can become major manufacturers. We think the yen, though, will stay very weak. I think the risk is it continues to depreciate. So for a U.S. investor, if you were to invest in Japan, we would be hedging the currency, and there's an ETF for that.
I was going to ask, I mean, you think about the volatility that we're seeing in the yen. Does that give you any pause? It sounds like you're finding ways to work around it.
If I look at the technicals, I can get it to 250, which is like 100 points higher, which is actually depreciating. It's in reverse. You don't want to see that happen over a short period of time, but if it gradually depreciates, it's not going to have a negative impact. The one group it does hurt is anybody in the country that wants to buy foreign goods. Right. It gets much more expensive. But it becomes an attractive market to invest in if you hedge the currency, but it's also maybe a place where you want to go on vacation.
There you go. Yeah, and of course, I'm sure that currency volatility keeping those currency traders busy. But I want to talk a little bit more about elections, because it's fascinating to see what's going on in Europe, what's going on in France right now, and then to think, okay, we have our own version coming up in just a couple of months in November. Is there anything to extrapolate out of what we're seeing when it comes to political risk volatility in European markets into the U.S. markets when we count down to our own presidential election?
My answer is no. What we have is something very unique. Normally, when you have a president or a potential candidate running against the current president, you really don't know their backdrop. In this case, Trump is a very known entity.
Yes.
So we've been in this situation before. So there's some known knowns. We don't know who is going to get elected. But what we've been telling clients, the election doesn't matter for this year, meaning earnings are on track. policies that have stimulated our economy through Biden's pieces of legislation. There's over $3 trillion that's been that has the potential to come into our economy. The Fed's already started to ease. And again, no one's talking about this. You talk about it for a blip and then everybody stops. But on their balance sheet, they've slowed the amount of sales, which is actually a form of easing. And then we do have the potential, I've been saying, I think the Fed, if the data supports it, which I think it will be able to cut interest rates 25 basis points in September. All of that is very bullish for risk assets. So I think this year we're fine. The question is who gets elected and what does that mean for next year?
All right, Marianne, great to speak with you. Really went
Same here.
around the world. Great to see you again. Our thanks, of course, to Marianne Bartels of Sanctuary Wealth. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, the U.S. Surgeon General is calling for a formal warning label to be added to social media sites, similar to those placed on cigarette cartons. Now, in an editorial in the New York Times, Vivek Murphy wrote that such a warning would, quote, regularly remind parents and adolescents that social media has not been proven safe for mental health. Any such move, of course, would need congressional approval. Next up, Adidas is investing allegations of bribery at its China's business. It comes after a whistleblower complaint accusing staff of receiving kickbacks from external service providers. The complaint also mentions a senior manager receiving millions of dollars in cash from suppliers, as well as physical items such as real estate. And finally, pull out the popcorn. Disney Pixar's Inside Out 2 reels in the viewers with the biggest box office opening weekend of the year. Now, the animated feature brought in $295 million globally. That is the biggest opening weekend ever for an animated film. It's welcome news, of course, for cinema chains, including AMC, who have been waiting for the next big hit since last year's Barbenheimer success. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, take a quick look at markets at the moment, and again, it's quiet. The S&P 500, you could go ahead and call that unchanged, 0.1% lower. If you take a look at the NASDAQ 100, it's really a similar story, only about 0.1% higher. What's interesting is that volume is actually elevated relative to its 20-day average, but it hasn't exactly translated into big price moves. Now, coming up, the best airline in the U.S., according to the Points Guy. We'll speak to Brian Kelly next. This is Bloomberg.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Was going to keep winning World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, some good news for travelers at the start of summer, and that's that fares have moderated and airlines are using discounts to fill a surplus of seats. Bloomberg's Abigail Doolittle is taking a look at the travel industry.
Yeah, that certainly is good news for anybody who wants to get on a plane, and we were talking about that last week, Katie. In particular, those flights midweek, that's where that discounting is. But if we take a look at what's happening on planes, well, especially on long holiday weekends and weekends, the planes are pretty packed. We're looking at planes here in the U.S. Basically just below 3 million per day travel throughput. As for some of the stocks related to the travel industry, not surprisingly, given the discounting, given the number of people on planes, we're seeing some real strength for the passenger airline index overall, up a very healthy 9%. Royal Caribbean, people are also cruising, up 13%. Viking, this year's IPO, the Thinking Man's cruise line and river tours, up nearly 30%. And then hotels, not so shabby, up 6.2%. It's not just here in the U.S., though. If we take a look at what's happening between the U.S. to Western Europe, we are going to see that scheduled flights between these two areas at 140,000. That's the anticipated number of flights for this summer. That is it is actually a high since 2010. So people are out and about. It seems as though maybe that revenge travel, well, maybe it's picking up some steam this summer.
All right, Abigail Doolittle, thank you so much for that setup. And let's keep the conversation going with Brian Kelly. He is the founder of The Points Guy. He joins me now in studio. It's great to see you in person.
Thanks for having me, yeah.
So I want to get to your report about the best U.S. airlines, but let's actually talk about discounts. Are you seeing that among the airlines right now?
Absolutely. Last summer, if you wanted to go to Europe, you were spending $5,000 to $8,000 business class. Those frequent flyer mile tickets last summer were 400,000 or 500,000, 600,000 miles round trip. This summer, there's a phenomenon going on. I mean, Air France has 50,000-mile business class seats from a lot of the U.S. gateways all throughout the summer, even throughout the Olympics. So because of that increase in supply, we're actually seeing decent fares. I'm going to Ibiza in August, and it's $4,000 first class.
Wow.
Which is like half of what it was last summer. So I'd always tell people, just before you buy a ticket, use Google Flights. Switching by even a single day can drop the price dramatically, and always double check to make sure that there is frequent flyer mile availability.
And so let's talk about why that's happening. I mean, is that just really the airlines reaching the end of their pricing powers, consumers getting a little fed up with prices and choosing not to travel, or are they adding more capacity, or what is actually behind that?
It's interesting. I think since the pandemic, business travel hasn't quite bounced back as much as leisure travel. So leisure travelers are now actually spending. So a decade ago, Delta was giving away 80% of the first class cabin to elite status upgrades and selling 20%. That's now inverted. So throughout the pandemic, when pricing was much lower, premium consumers got used to paying little by little. It's kind of like they were slowly boiling the water, and now people are used to getting that premium experience. So there are now more leisure passengers willing to pay that $4,000 or $5,000 than when they were trying to just fleece that business traveler whose company had to pay $12,000. So the pricing models have changed, and I do think overall it is good for consumers.
Yeah, and it's interesting, of course, to hear that adaptations that have to come with the pricing strategies. Let's talk about the report that you recently put out, though, your best U.S. airlines for 2024, and Delta with another clean sweep for the sixth straight year, getting that top performing spot. But what was interesting to me is that its lowest performing area was affordability, which I would think would be a
big factor. At the Point Sky, everyone has their favorite airline, especially if you're in New York, like where you're closest to. But we wanted to look at the data sets. So we had 4 main categories, the biggest being reliability. That was 30% of the score, because at the end of the day, when you get a flight, you need to get to where you're going. And Delta is the most on-time airline in America, so it definitely helped there. Also in reliability, we looked at airlines that are now losing wheelchairs, which is a really terrible problem that keeps getting worse. So we ding those airlines that don't have great policies. And funny enough, Allegiant came in #1 in overall in reliability. Delta didn't win in any one of those 4 categories, but they were super strong across the board. But we also looked at loyalty, customer-friendly policies, like family seating, which Delta did do very well in. So we wanted to take a holistic approach, but with that Point Sky spin with the loyalty factored in.
And there you go. What's really stood out to me is that you take a look at some of the low-cost carriers, Spirit, Frontier, for example. They actually lost standing in this one.
They did, and I do think we also looked at route network, right? Because the Point Sky reader is global. They want lounges. So I do think our survey is somewhat, it's never going to have Spirit be #1, especially because loyalty is 25%. Those low-cost carriers do not have great loyalty programs. So I don't want to say they're not great airlines. They serve a population. They serve routes that are underserved. So they are good in certain ways. But when we look at the Point Sky, like, the global airlines that are serving passengers, we wanted to come up with our best recommendations. When people have an ability to choose at the same price, we kind of want to give people the data to show, well, you might want to choose a carrier that's more reliable.
We'll never say never.
You never say never, you're right.
Could happen, and Spirit could get
come
the
up
top
from behind.
spot.
I've seen crazier things.
Let's talk about some of the airlines that did make big gains, however, because it stood out to me, Alaska, for example, with the biggest gain. And of course, it feels like most of the recent coverage on Alaska has been dedicated to its January issue with that Boeing plane, but it seems like that actually hasn't dented its performance.
And these numbers were based on 2023 data, so that incident from 2024 wouldn't be reflected. But United, the biggest jump this year, or drop, was United from 2 to 3, and I do think last year they had their operational meltdown, but they also had some max groundings. And also the biggest issue, United's been hit the most on airplane deliveries. They just simply, every airline in the world now is dealing, both Boeing and Airbus are way behind on deliveries, which is impacting, route expansion and reliability.
So there you go. So airlines still coping with those Boeing
growing
issues.
Pains, yeah.
Growing pains, there you have it. Let's talk about driving versus flying, though, because, of course, we're talking about airfares. We're talking about people paying up for those more premium experiences they've gotten used to. But when it comes to people actually getting in their car, it seems like that's also very popular.
Booming, yeah. Gas prices have leveled out, so it's, much cheaper. I mean, it depends, actually. But yeah, I mean, Americans are hitting the roads en masse. They're hitting the airports. And I do just want to say, driving, the traffic is crazy these days. So even though the TSA can handle that record number, 2.9 million, the roads can't. I nearly missed a flight to JFK. So for anyone at home watching, those travel procrastinators who try to get there, 1 hour prior, always check in advance, because even if you show up late, at least if you're checked in online, they might let you slip through. But, New York, LA, traffic I just recommend this summer at least add in an extra hour to get to the airport.
An extra hour. Certainly.
Or just take the Blade helicopter, yeah.
Yeah, there you go. Yeah, there's alternative methods for getting there. And when you think about sort of the psychology of the industry right now, of course, we heard Abigail mention revenge travel, and that certainly seemed to be fueling some of the numbers we were seeing for at least the past couple years. But where are we in the narrative? Is it safe to say we're firmly out of the pandemic mindset and what came after it and in a new era, or would you still phrase what we're seeing as sort of that revenge travel?
No, I definitely think we're post-revenge. We're post-COVID. You know, the last several summers, I was on, shows like this just talking nonstop about the meltdowns, the staffing shortages, the baggage delays at Heathrow, images of 10,000 bags. The airlines have gotten their operations under order. It's somewhat smooth sailing. I do think we are, reaching a new normal where airfare, there is more capacity. The world's opening up. Asia is still not where it was. We're still, kind of growing there. Business travel's, a little bit lower, but that leisure travel is back. And I just think when you look at the demographics of all the younger generations who value experiences and travel over things, I think, the overall outlook for the travel industry is very bright.
And before I let you go, let's meditate a little bit longer when it comes to business travel. Like you said, it's not quite back. And is that just the new reality? Are we ever going to see those 2019 numbers when it comes to business travel?
Never say never. I do think, clearly Zoom and, companies are being smarter about spend, especially with the uneasy economic outlook, inflation. A lot of companies are getting hit for cost. So there still is that cost cutting that's going on at a lot of companies where they're saying, do we need to have this 400-person meeting in Vegas? Yes, it's a nice to have, but is it a really? So I do think it'll continue to grow, but TBD on if it ever kind of surpasses where it was.
All right, Brian Kelly, it's always great to see you. Really appreciate your time. Have a great week. That is Brian Kelly. He is the founder of The Points Guy. Let's get a check on these markets about an hour into the U.S. trading day. We're going to do that with Abigail Doolittle.
So we've just had the S&P 500 flip ever so slightly higher, actually onto. It was up fractionally just moments ago from a decline down slightly on Friday, and there it is going back down. But you can see a firmer decline for the Russell 2000. Small cap stocks continue to be under pressure, really underperforming over the recent time period. In terms of what's happening for the S&P 500, beneath the surface, a real battle between the big tech names. Apple up 1.7%, really trying to support last week's surprising, or at least surprising to me, breakout. We'll be taking a look at those charts later this week and probably in the weeks ahead in terms of what is actually going on there between the bulls and the bears. And then NVIDIA, a rare down day, down about 0.75%. This is the top point boost and the worst stock from a point standpoint for the S&P 500. And again, helping to explain why we're having this little tug of pull. As for the dollar, it's interesting. The dollar's been in a bit of a stealth rally, Katie. If we go into the Bloomberg terminal and take a look at the dollar here, we are going to see back in April, this was the year's high out of last year, a pretty solid rally. It's interesting because we have stocks higher with this. This is an ideal situation. It suggests a strong dollar signals a strong economy, and the stock market going along for the ride strong also. We are more used to, I would argue, a situation when the dollar is strong that can pressure risk assets. It's not happening right now, at least, but you can see the dollar going back up to the highs of this year. One question could be, if we do continue to see the dollar go higher from here, will that pressure risk assets? Stay tuned. As for what's behind the dollar strength, or it's hard to know, sort of a circular relationship here, but at least on the day, take a look at yields. The 2-year yield closer to 4.75, and right across the curve, we are seeing gains. So that, of course, supports the dollar going higher.
All right, Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, we're going to take a look at demand for AI and what that spells for data centers. Wes Cummins, he is Applied Digital Chairman and CEO. He joins us next in today's Wall Street Week. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, it's time now for our daily Wall Street Week conversation, and the rise of AI is posing challenges to data centers. Applied Digital, which designs, develops, and operates data centers, is looking at how to adapt its infrastructure. Wes Cummins, he is the company's co-founder, chairman, and CEO. He joins us now alongside Wall Street Week's David Weston. And data centers, I mean, it's one of the hottest topics out there.
It really is. Every day we're talking about data centers somehow, some way. But Wes, thanks so much for joining us, because normally when Katie and I talk with people about data centers, it tends to be the commercial real estate side of it and investing in it. But you actually develop these things and actually install and operate them. So give us a sense of what's the big deal with data centers now that didn't exist before the rush to AI? We've had them around for some time, right?
Yeah, David, I think that the key to understand, the primary thing to understand is the difference in the compute workload that's going into data centers now versus what it was in the past. So in the past, we were building data centers that were in population centers that were providing ultra low latency communications so that we could get YouTube, so that we could get Netflix, so we could get TikTok, right? So we could get all of our things that have been driven mostly by video applications. Now, as we're moving from applications that need ultra low latency communications outside the data center to applications that need massive amounts of compute. So think of it, doing large math problems, algorithms. This is what AI is doing inside the data center. Compute equals power. And then inside the data centers, you need a lot of compute close together. So you need really high power density. And so these are kind of some weird numbers, but historically data centers were, let's call it 7 kilowatts for an entire rack of computing. An NVIDIA H100 server, one by itself takes 10 kilowatts. And then you need to stack all of these together. So you have a massive amount of power consumption that needs to be close together. The latency inside the data center now versus outside needs to be ultra low. And so you have to build a completely different style of data center. You need large amounts of power in the same location. And so that's what we're doing. We find large amounts of power, typically different locations than you would do city centers. So it's no longer New York or Virginia or Dallas or Los Angeles. We're building in different locations where we use a lot of renewable energy that have these hundreds of megawatts, if not gigawatt of power, so that you can, run these workloads, because they're just very different style workloads versus what we're used to.
Right. And when it comes to that adaptation process, really sort of converting those existing data centers to be able to handle the AI workload that people are trying to do, I mean, how long of a process is that? How long is that timeline?
So I'm a big believer that you're better doing greenfield, in that you just build an entirely new style of data center versus trying to retrofit. Cooling is different. Again, the power density is significantly different. So there's a big issue. So the number one issue right now is finding power. Where's near-term power? We have a very unique way of finding power, which is we find things that are called stranded power, and we typically use a lot of renewable energy that's more in the middle of the country. So number one is power, and then number two is supply chain. So this is electrical components. This is, it's transformers, it's chillers, it's high voltage switchgear. So the supply chain, because of the demand for this, has become really stretched as well. So number one is power, and number two is supply chain.
So Wes, are you building your own power? I mean, you're building those wind farms or solar, or even nuclear for that matter, or are you tapping into some other part of the grid? And similarly on the supply chain side, how long is the lag time on all this? It sounds like it's going to take an awful lot of time to build that power and also come up with all that supply chain.
So right now we're not building the power. That's something for the future for us. So there's a unique setup in North America that we take advantage of. What I call it is stranded power. So there's power that is generated and not used. And I know a lot of people would think that if you can generate an electron anywhere in the U.S., it can be used anywhere else in the U.S. And that's just not the case. You need the transmission infrastructure to actually be able to do that. So we find places where, for Ellendale, North Dakota, for example, there's a massive amount of wind power that feeds into a substation, and oftentimes they have to curtail the wind farms because there's not enough demand, there's not enough load to use the power that's generated. So we go to that location, and we have several of these locations where we use power that's currently not being used. Now, to go to the other part of your question is for new power, so you can build power gen on renewables over, let's call it a 24, maybe 36-month time frame. The bigger issue is transmission. So transmission to transmit that power that typically is built, somewhere in the middle of the country to end users, that's more of a 10 to 13-year process. And so we're kind of shortcutting that by taking these workloads directly to the point of generation.
I want to talk about the competitive landscape here, because you think about AI, and it's just really made its way into every part of the market. It seems like every investor in every asset class is trying to figure out what's the AI narrative in their industry. When you think about your own industry and data centers right now, how fierce is the competition?
It's an interesting time for sure. So if you go back a year ago, everyone was trying to figure out on the data center side what's happening in this market, right? Why is all of this demand? Why for the high power density? Now, in this industry, we figured it out, and now it's trying to make this solution, because again, getting the amount of power that's needed and operating these style of data centers is extremely difficult. And so think of on the data center side, right, we're the picks and shovels. This is digital infrastructure. This is the digital infrastructure that was built out to run everything that everyone's used to running on their phone or on their TV at home, and now it has to be rebuilt. It's not a replacement, by the way. This is an add-on, but rebuilt for compute and AI workloads. So we're the building blocks. We're the infrastructure that runs all the AI that everyone wants to do. And we're talking about everyone knows ChatGPT, but if we're doing anything in video, in visual, anything generative AI runs on this infrastructure, and a massive amount of this infrastructure needs to be built. When Jensen at NVIDIA talks about AI factories, so what we've done, we actually designed our data center in partnership with NVIDIA. We work with their team to build the style of data center that we're doing, because this is the issue in the data center industry, is it's just a very different style from data centers that were done in the past, but we're running all AI workloads, and these are really split between training and inference, are the terms that are used in AI, but the entire industry is, I would call it, scrambling to build the amount of infrastructure that's needed to house the compute to run these applications.
Well, so it wasn't that long ago we hadn't even heard about all these data centers. What's going to prevent obsolescence?
So that's a great question. So when we build our facilities, we think about what we call future proofing, right? So we think the power density goes higher, cooling. But I think the last 20, 30 years were, again, really driven by applications that required, I call it comms, high-speed communications. And as we go for the next 20 or 30 years, applications are really going to be driven by compute. And that's what AI is. And so we're, working to future-proof that. And by the way, the older style data centers, those are not obsolete. We still need all of that capacity for the applications that we continue to use. This is absolutely a complete add-on to what's been done in the past. And so, but trying to not be obsolete is making sure that you're future-proofing your facilities as much as possible with power density, with cooling. We're trying to run it at an extremely high efficiency so that we lower our carbon footprint. We build where there are renewable, we mostly use renewable resources, but those are the things you try to do. Obviously, not being obsolete in the world is one of the keys here.
All right, future-proofing, that's a good place to leave it. Really enjoyed this conversation. Our thanks to Wes Cummins. He is Applied Digital co-founder, chairman, and CEO. And David, who else do we have coming up?
Tomorrow we're going to make a big turn. We're going to talk about carried interest with Ludovic Philippou, who is a professor at Oxford, has a new study out, and it will get your attention, Katie, how much money private equity is making out of that special tax treatment called carried interest.
Yeah, I'm sure there are some big numbers involved there. Looking forward to that conversation. Our thanks, of course, to David Weston. This is Bloomberg.
Morning from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, let's take a look at these equity markets. We are about 90 minutes into this Monday, and boy, it is boring. You take a look at the S&P 500, nothing going on, unchanged right now. Maybe we'll get some more action when we get that retail sales data. Of course, a very important insight into the consumer. A little bit more to talk about if you take a look at the NASDAQ 100. That's your leader today with just about 0.1% gain. Big tech breaking out on a relative basis, at least. And interesting, actually, the Philadelphia Semiconductor Index not doing too much, down about 0.2%. Of course, that has been the hot area in the market, but not so much today. Now, coming up, we have Bloomberg Technology with Caroline Hyde and Ed Ludlow. But that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturdays is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
So according to an IFOP poll, the Macron group has an 18% advantage, whereas Le Pen party has a 33%, according to the IFOP poll for France.
As the Magnificent Seven see a momentum rally like never before. Plus, we push ahead to GameStop's AGM as CEO Ryan Cohen gears up to deliver remarks. And we take a look at the summer box office as Inside Out 2 rakes in over $150 million over the weekend. First, let's check in on those markets, because we are seeing some pause, shall we say. We are looking at what the Federal Reserve comments are going to be this week after the policy. Yes, last week, of course, signaled maybe, are we going to get the rate cuts that the market is anticipating? More notably, is the political tension still happening over in Europe? 10-year yield just actually selling off significantly after there was this push for havens last week. That calms a little. Why does it calm? Because Marine Le Pen over in France, right-wing, of course, person that we could see become prime minister if indeed we do see this, well, this legislative vote go her direction. She's trying to calm the market, trying to calm, well, the broader French population, to say she would be still backing institutions and she'd support Macron if she did indeed become prime minister while he was president. CAC 40 sees some relief. We're up 0.9%. Move on and see what's happening on the individual movers today, because we are seeing a little bit of movement on what's happening in the chip sector. Now, the SOX was previously at a record high. We dial back from that as Nvidia indeed sinks. $130 is where we currently trade. We're getting some big calls from some big investors and analysts still saying, look, we could go as high as $160. Susquehanna pointing us in that direction, but we just perhaps take profits as we hit a new record high. Micron, though, up another 2% as we see analysts upgrade their price target on this particular stock. Broadcom also winning as we look towards that stock split. They follow hot on the heels of Nvidia. 1,798 is where we trade. But look, we have seen these particular chip names do phenomenally well over the course of this year. And many are saying, look, this is momentum strategy that's winning. Basically, what do? You buy the winners and you sell the laggards. It's always kind of a powerful force in the markets, but right now it has gone a complete tear on a scale that we've never seen before. We want to break it all down with Bloomberg's Isabel Lee, and there's a great bit of reporting coming from Bloomberg across our outlets, really talking about how much this momentum trade can stick, because it's working.
Yes, it's definitely working on a scale never seen before. The relative performance has surpassed that of the dot-com bubble, which was in 2000. So it's around 24 years. And it's really simple. You buy what's winning, you sell what's losing. But the question is, will it last? And momentum has a tendency to go on and on until something stops it. Worth noting, though, that this stretch has been going on for quite a while, longer than usual. But what's concerning is how the driving force is really mostly valuations. It's not anything about great momentum about earnings. So this is why some people are worried that it might buckle anytime now, but then just with anything, this is the winning trade. There will always be losing trade, and the losing one is value. But of course, if you're invested in momentum and if you're tracking momentum, it's a great year so far. In the strategies that Bloomberg tracks, there are 13, and top of the list, momentum, 16%.
It's interesting that you say some of the worry is about whether it's on valuation, whether it's on earnings. Now, some would say NVIDIA's earnings increases do vindicate the valuation uptick, but is it just the breadth? Is it some of the other names that are getting swept in on this that are moving more on valuation than actual earnings guidance?
So that's fair. I mean, I think NVIDIA, every time I ask about NVIDIA, I do get bulls and bears. So it's like there's even no consensus. But the thing about this AI rally is the big winners are getting bigger, and obviously everyone is left behind. I mean, you take a look at Apple. Apple last week saw one of its best week in years just because of one announcement. And the thing is, it's interesting that these announcements wouldn't even roll out in the near future. So how will we test whether they will work? But then for the longest time, Microsoft's lead against Apple seemed far. But now Apple is inching towards Microsoft just because of that one announcement of an AI chat GPT-like integration, basically to compete with Microsoft. So that's the thing. The players are so narrow, and whether the momentum trade will last remains to be seen. Is AI really going to be a transformative technology that will drive profits and productivity, or is it just going to give some companies a handful of cash for the meantime?
Well, I'm sure the companies are liking the handful of the cash for the time being, and indeed the investors that bet on the winners. Isabel Lee breaking it all down. Let's talk about what could be the catalyst that puts it to an end. Pleased to welcome Megan Horniman to the show, Verdance Capital Advisors CIO. And to that point, this has been a runaway trade, the momentum trade. What could stop it?
So, you mentioned it's a momentum trade. So to be able to figure out exactly what will stop it, it's basically impossible. But we think that there's a couple things to keep in mind. The interest rates right now, we did get that flight to quality last week, so yields went down. Markets like that. But then take a look at what's happening today. Yields are backing up. That can take some of this momentum out of this rally, because what's going to happen is people will just start looking at valuations. And with the uncertainty around where interest rates are going, we obviously know that eventually the Fed will cut rates. We just don't know when. And when you're looking at long-term yields, when you're looking at the Treasury market, the dynamics in the Treasury market are just for higher yields because we have so much issuance that's out there. And this is something we think could take some wind out of this sail here. It's just it can be a valuation correction.
Really interesting that you're looking at what's happening in terms of supply side with treasuries. Well, what about the inflation picture? What have you been taking from the PPI, the CPI, and whether or not we are cooling or whether actually we're still just too high for too long?
It is cooling. The data we got last week was good news, but let's keep in mind it was 1 month's data, and we still are a far way away from where the Fed wants to be. And when you actually dig into some of those reports, this is a goods deflation story. This isn't a service deflation story. In fact, we're still looking at service prices that are quite sticky, and housing as well is another thing that's sticky. These are things that the Fed is going to be taking into consideration. This is why we think, and we kind of lean in the camp, higher for a little bit longer. We might get something in December, but we need a lot more information before we can say that the Fed can do that.
And just add in, as you say, that flight to quality, that volatility that we see because of political risk over in France, of all places. I mean, how much, Megan, do you have to take in the global geopolitical risks right now?
I think it's something we have to consider. When you're coming into this year, we knew we had a lot of elections and political risks globally. And let's keep in mind, we still haven't gotten to November here in the U.S. So there's a lot from a political standpoint through this summer that can keep the markets on edge. And it just tends to be when there's so much risk out there, but the markets are so high, what's the upside risk from here? That's what I don't see. I see a lot more downside risks from here than I do upside catalysts.
So what to do as a chief investment officer of Verdance Capital Advisor? I mean, where do you see, is it protecting your downside, or is it hedging, or is it more sort of reallocating in some way?
So at this point, there's, hold cash. Keep a good amount of dry powder that you can take advantage of opportunities. That's what we've been doing. Cash isn't hurting you right now. You're getting 5% or more. Eventually, that won't be the case. But for now, you have the cash to be able to look for opportunities. And there will be opportunities. Right now, if you look at the market, parts of the market that are really unloved, look at small and mid-cap stocks. Now, the economy starts to roll over. They're going to struggle a bit, but that's the time to take advantage, because that's where you see the best upside as we get out of this, an economic slowdown. And they're priced so on a relative basis versus large cap, the cheapest we've ever seen.
When you're thinking of a technology show such as ours, and many want to understand the realities, you need to be diversified, but they also want to understand where the opportunities are outside of Mag 7 in technology. Like, is there a play for tech or indeed AI in small and medium-sized companies?
So, the AI is here with us. It's been here, but it's just only going to evolve going forward. The one thing when you think about AI is it's not just technology, and I know it's a technology show, so I apologize, but let's look at other areas of the market that will benefit from AI. So what are the companies and sectors that are going to benefit from implementing AI? That we can see that in their earnings. Those are some of the things that we're looking at. Industrials is an idea. Some consumer stocks, I think it's right now a little bit cautious because the economy is weakened and consumers are definitely stretched. But think of where the companies that are going to benefit from the use of AI going forward.
Oil prices extend gains. The U.S. crude futures rise by $1 to a session high of $79.49 a barrel.
And I'm wondering whether you're seeing energy and some of the infrastructure needed for this new AI paradigm shift as a place to bet.
Yeah, absolutely. That is an area. Look at what utilities have been doing as well because of the use for it. But the infrastructure side, we don't have yet to be able to support what this AI is going to look like in the next decade. So we do need, from an infrastructure standpoint, those are some areas that we'll look at as well as we see some broader weakness in this market.
It's great to get a take that encapsulates a lot of tech, but also how to diversify outside and around it. Megan Honeman, we really appreciate it. Verdant's Capital Advisors. Stay well. Meanwhile, coming up, look, there's been a meme frenzy, and GameStop's annual meeting actually kicks off today after it was postponed due to technical issues, due to that meme demand last week. For details, that's coming up ahead. Meanwhile, look, keep an eye on shares of TSMC. We look at what happens in terms of trading of ADRs, which actually there is a trade here. There is a long-favored arbitrage strategy where you buy TSMC over in Taipei and you short the US ADRs. The American Depository receipts listed here. But it's becoming painful because basically the premium of the US is pushing ever higher. Will we see it turn around? This is Bloomberg Technology.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg. Let's talk EVs. Ferrari will release its first
NATO Stoltenberg says more than 20 NATO allies will spend at least 2% of GDP on defense this year.
Now, younger buyers favour electric, but established customers, well, they're hesitant to give up the sports car's trademark roar. Ferrari aims to offer traditional, hybrid and electric options to satisfy all of its customers. And let's talk a little bit more along the electric vehicle route, because Tesla has gotten approval to test its advanced driver assistance system over on Shanghai streets. Bloomberg's Craig Trudell joins us now. And how important is this for FSD? How important is this for the Tesla business model?
It's an incremental step, and I do think that there's some potential for what Tesla markets as full self-driving to be a more meaningful contributor to their business in China, which they could really use at the moment. But what we don't know is just how long it's going to take them to be able to offer this more widely. Even this incremental step that we're reporting on today really just applies to the city of Shanghai and potentially also Hangzhou, another city. And so we're not necessarily seeing China take the same sort of hands-off approach that we've seen in the US, where they've been able to offer FSD nationwide, and it wasn't all that much trouble for them to make this available to consumers. On the other hand, in China, they're really going to have to sort of, in piecemeal fashion, hit the sort of tick the boxes that they need to with regulators in order for consumers to be able to activate this.
And it feels as though Musk has realized that he needed these green lights coming from regulators. He made whistle-stop tours to Beijing, and actually, therefore, having to play alongside all the other Chinese EV makers.
Yeah, that's right. And this has been, months in the making, even before that recent trip to Beijing that you mentioned. This is a case of Tesla having, offered the ability to buy this if you're a customer in China, but, not being able to actually activate it and be deployed the sort of ability to turn this on. And so, I think there's still a lot of questions about, just how willing Tesla is to continue to charge as much as it has for this
Fed bids
system,
for 3-month bills total $339.7 million, and Fed bids for 6-month bills also totaling $339.7 million.
The likelihood that they're going to be as permissive as the U.S. has been, where Washington has taken this view that we don't want to stand in the way. We want to offer, driver assistance systems, plenty of leash to try and, offer, the sort of safety benefits without, getting in the way. That still remains very much an open question.
Craig Trudell, we thank you so much. All things Tesla. Now, Tesla has a pretty loyal shareholder following. So too does GameStop. So loyal that they're going to have to reschedule their annual meeting. It kicks off today, 12:30 p.m. local here in New York, Eastern Time. It was delayed last time because of technical issues. We're going to break down why with Bailey Lipschultz. And it was because too many people wanted to log on all at the same time, right?
Too many people trying to get in. Computershare saying that they had to reschedule it from Thursday afternoon, again, to your point, to 12:30 today. We had to resort to Twitch streams, YouTube streams, X streams, which was interesting because there were tens of thousands of people flocking to these channels that normally get maybe a half dozen people checking in on a daily basis. So people trying to find a way to stream it, so fingers crossed it goes off without any
NATO Stoltenberg says allies need to impose a cost on China if it does not change the course on support for Russia.
When you look at last year's AGM, when Ryan Cohen, it was the first time as chairman leading this call, he spoke for about 90 seconds. The entire call.
90 seconds.
90 seconds.
Okay,
the entire call lasted about 15 from start to finish. So no one knows what's going to happen. There's so much interest in whether Roaring Kitty, Keith Gill, could appear or be mentioned in any way, shape, or form. The company did raise about $3 billion through sales of new shares over the last 2 months.
The S&P
So will they
extending
address the
gains,
cash
currently up
haul that they have now, about $4
0.22%
billion
on the session.
balance sheet? Will they address the strategy? No one really knows, and I think that's part of the reason that people have to tune in, because if Ryan Cohen appears, how long does he speak? Does someone else make a guest appearance, or is it strictly business from some of the lawyers?
Now, having tuned into Keith Gill's own YouTube channel the other week, it doesn't seem like he knows much about the strategy of GameStop either, but he does seem to be moving around his holdings. He's changing his options into actual share ownership. That seemed to be pushing up the stock recently.
Yeah, there was some excitement around that. So we saw about a week and a half ago, he posted a screenshot on Reddit, 5 million share stake, 120,000 call options. A couple days later, turned out he exited that call positions and reported north of 9 million shares. So that makes him a top 4 holder if we take it at face value, and is on paper worth, the last time he posted, about $262 million. So where did he get the cash from? How rich is he? A lot of questions and uncertainty around that he never addressed on his stream, but nonetheless, again, if you take it at face value, what he posted on Reddit, top 4 holder from a retail shareholder who back in 2020 was preaching GameStop, the Ryan Cohen vision, and short squeezes.
Let's just focus for a minute on Ryan Cohen, because if you haven't been a complete GameStop fanatic of the story or into the stock, why do we care so much about this individual?
Co-founder of Chewy, so a lot of people bet against that, said they would be Pets.com 2.0. Very successful sale to PetSmart, ultimately went public when he was no longer associated with the company, made a pretty nice fortune from that. He took an activist stake back in 2020 in GameStop, then pushed and really helped trigger alongside Keith Gill in early 2021, getting seats on the board, pushing for changes, ultimately ousting pretty much the entire management team, and now is the chairman, CEO, and president of the company. And really the whole belief in GameStop with Keith Gill's thesis is that Ryan Cohen will be able to turn the company from a brick and mortar company that has shown slowing sales, has shown a need to close some of those stores and completely revamp the business. The question is, what does that look like? How do we get there? No one really knows, but that's the whole kind of group mentality behind the GameStop bulls, the retail investors who really like the stock, is that Ryan Cohen knows. He won't tell us, but at some point this is going to end up working out, and that's really been why we've seen such a wild ride over the last 3 years. And you have to kind of, at some point, tip your hat, though, because Ryan Cohen in RC Ventures owns about 8.5% of the company, so he has put his money where his mouth is.
And he's put some money in the balance sheet of GameStop too, and that's meant Citron, for example, has just exited it short. Always great to get Bailey Lipshaw's on all of the backstory when it comes to GameStop. Tune in 12:30 local. Meanwhile, coming up, Google DeepMind. Well, it shifts from a research lab to an AI product factory. Or at least it tries to. We're going to talk about the move and if it's undermining its long-running strength in foundational research. That's next. Meanwhile, just keep an eye on some of these chip stocks, because AMD has been under pressure all day. It seems as though the rest of the benchmark is kind of playing catch up to it. No real news around other than some new AI 9300 series CPUs won't be
So
offering.
in 10 minutes time now, at the bottom of the hour, the US is due to sell $70 billion in 3 and 6 month bills. 3-month bill prior high yield was 5.25%, with a prior bid to cover of 2.75. The 6-month bills, the prior high yield was 5.165%, and the prior bid to cover was 3.09.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Google, which has long been a pioneer in new technologies like AI, but has just watched rivals like OpenAI harness its research and seem to leapfrog it in the world of generative artificial intelligence. So the company is reorganized. Originally, Google had two separate AI labs, Google Brain, where researchers kind of pursued passion projects with some loose oversight, and of course the acquired DeepMind, co-founded by AI luminary Demis Hassabis, who had this to say about the future of AI development.
I think AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies. So I think we're seeing, because of the popularity of AI now in the last couple of years, lots of people trying to get into this space who maybe haven't thought about this as long as people like us who've been in it for decades. And I think we're going to see a sort of rationalization process happening.
Indeed, that rationalization process is upon us with a combination of Google's two AI labs in 2023 into a super unit called Google DeepMind. Look, it was to commercialize products and keep pace with competitors, but several employees are saying this move has been undermining the company's edge in foundational research. It's a great story written by Mark Bergen. We want more on this because is there a tension internally after these 1 year down of an amalgamation?
Yeah, I mean, to be clear, it's Google. There's always a tension internally. It's a big, messy company. I think what our story does, I think kind of unfolds here is that part of it is geographical, right? DeepMind has historically has been London-based. Google is out of its headquarters in Mountain View. You've had these sort of competing labs that in some ways operated very differently. DeepMind has, for the past decade, basically been an incredibly well-funded research operation and doing some cutting-edge AI, probably the world's most cutting-edge AI, is not always connected to Google services, Google profits, its commercial center. Now they're attempting to, I think, swing much more in a focus on products to be, Gemini being the flagship one, competing with OpenAI's model. I think there's still a lot of bumps and warts and all in that merger, and there's always a conflict between how much is sort of doing these sort of core products versus more exploratory research.
Talking of bumps and warts and all, look, the commercialization hasn't
At
gone that
11:30
smoothly,
a.m. Eastern Time, the US sells $70 billion in 3-month bills, prior high yield 5.25%, and a prior bid cover of 2.75. And the US sells $70 billion in 6-month bills, prior high yield 5.165%, and a prior bid cover of 3.09.
And I think that's totally understandable given just how big of their services are, right? Like how many people are using Google Search on a daily basis, and how much responsibility that has, not just for their bottom line, but obviously like the regulatory scrutiny they're under. And internally, I think that those,
Brent crude futures rise by $1 to a session high of $83.67 a barrel.
When they launched, they clearly have been scrutinized and criticized for a long time, particularly internally for moving too slowly. And I think OpenAI and Microsoft has really pushed Google to move pretty fast. And you could say that some of these pretty public snafus they've had with Gemini might be a consequence of that.
Demis, of course, seeing AlphaFold and medical applications, a real business model, but we see how Gemini continues to evolve as well. It's a great story. Go read it. Mark Bergen, a deep dive on goings-on at the top when it comes to AI labs becoming one over at Google. Meanwhile, coming up, we're going to talk about goings-on in terms of M&A and rationalization elsewhere in AI. Clem DeLong's with us. He's the CEO of Hugging Face, talking about the M&A landscape in artificial intelligence as he does a deal. And he teased it a little bit ago at the Tech Summit with us. This is Bloomberg Technology.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that
Shortly
dining room
expecting
table
the
trying to pay
results
his
of the
phone
3 and
bill
6 month
is that
bill
same guy
auctions.
today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. A quick check on these markets for you. And we're currently up 0.4% on the bigger benchmark, the NASDAQ 100, managing to shake off some of the anxiety over in European trading. In fact, the CAC 40 rallies 0.9%. We see Marine Le Pen, of course, the right-wing contender, trying to take the prime ministerial role, saying, look, she will abide and respect institutions and indeed work with President Macron. So we get a little bit of a bounce back, but still the political anxiety is there. Bitcoin off by almost 2%. Look, we're only at 65,000 now, so we've seen some profit taking in crypto more broadly. Move on, have a look at what some of the individual movers and shakers are, because we are seeing some individual corporate moves, up 5% for Autodesk. Why? Activist investor Starboard Value has built up a stake in Autodesk, the software company, more than $500 million. They want to push for changes. Investors like that. Dell Technologies, well, the CEO is selling out some more than $300 million worth of the stock, but that does not matter in terms of the selling pressure. We're currently up more than 6.6%. That seems to be more on analysts saying, look, this is still a stock that you should be buying. I think it was JP Morgan that had been speaking with executives, or indeed it was Morgan Stanley reiterating their top pick after some management meetings. Meta off by some 0.7%. They, along with a number of social media companies, really being forced to think about how much they look at AI chatbots, but more broadly, how much they also look at focusing on the Surgeon General calls for some warnings of addiction. Let's move on to look at what's happening with Adobe, because we just had some breaking news. We're off by more than 3%, having been trading higher in, down earlier in hours, but still off by 3.3. The FTC is taking action against a software maker, and two of its executives, that's Maninder Sawani and David Wadhwani, apparently for deceiving consumers by hiding the early termination fees for its most popular subscription
The European cash equity close now, with the European indexes closing in the green today.
The FTC just releasing that action. We remain under pressure on Adobe after some stellar results last week that pushed the stock up more than 10%. But let's turn to another corporate story right now, because look, we've all been thinking about how AI is affecting Microsoft, that seem to be well ahead of Apple. But now, not so much the case.
3-month high yield, 5.25%, 5.25% with a bid to cover of 2.93, 2.93. The 6-month high rate, 5.15%, 5.15%, with a bid to cover of 2.82, 2.82. So for the 3 months, the US sold $70 billion, awarding 43.35% of bids at high. For the 6 months, they also sold $70 billion and awarded 43.29% of bids at high.
I've been sort of using the AI that's come with Windows for a little over a year now. Microsoft had this big lead. But then Apple launched or announced all these AI features last week, from easier ways to search for your photos, to making sort of custom emojis with AI in your social interactions, interacting with Siri, and suddenly I got that same excitement I had with Microsoft about a year ago, but which I haven't really had since then. These are all new products that are coming to the iPhone. They're going to integrate very well with my day-to-day use for the iPhone, iPad, MacBook, and so forth. And it's really interesting that, Apple was so far behind seemingly just, a week or two ago. And suddenly a lot of consumers are really excited about these products they're launching, despite their super comparative simplicity with what Microsoft is launching by comparison.
Investors are pretty excited too, Austin. We're at new record highs. We're eclipsing and back to the most valuable company on the indices. What is it more broadly that they're managing to integrate? Is it just that they're a more consumer-focused company than Microsoft is?
I think one of the upsides that they have is a lot of these devices and services are already in people's hands. So they're sort of sprinkling AI on top of iMessage in case I want to send a custom meme. We don't have to download a new AI app. You already have Siri, so it just makes it a lot smarter. By comparison, Microsoft has to do a lot of the legwork. We don't have a Windows phone. Yes, you have Windows PCs or Microsoft Word and Excel, but it doesn't dominate your day-to-day life, at least from a consumer standpoint, in the same way that Apple does. So that's really the upside that a company like Apple has. You were just talking earlier about Google. They run into a lot of these issues all the time because people expect their Gemini product to be as good as Google search, and it's just not easy. Whereas Apple is coming in and saying, we're just going to do a lot of simple things and do them very, very well and add them to the products that you're already used to. So they're not reinventing ChatGPT. They're not trying to become a ChatGPT competitor. In fact, they're integrating with ChatGPT, and anything that they can't do, they'll just boot you over to ChatGPT, an integration that I'm sure Microsoft's a little bit jealous of, considering they've invested about $13 billion into OpenAI.
True. Austin Carr, that's a great read. Thanks so much for coming on and giving us the feels around Apple. Meanwhile, let's stick with AI, because it would seem like we've entered kind of the AI startup M&A season. There's a growing number of artificial intelligence startup founders. Basically, they're looking to sell their companies. Why? Because it's so expensive with the compute power. The CEO of Hugging Face is with us, which has just acquired a small company called Argilla of $10 million, fourth acquisition to date. And he kind of told us that this might be occurring in the market. Clem DeLong joins us from more CEO of Hugging Face. And what was it? But a month or so ago, they were sat in San Francisco, and you're like, this is happening. This M&A is real, and I'm getting a lot of calls offering to sell their startup to me. But you went out and found this one yourself.
Yes, and I think it's just the beginning. I think we're going to start to see many more acquisitions in the next few months. This acquisition is a good example. Aguila is a fantastic team based out of Spain, working on a tremendously important topic, data sets and data for AI. Their name, Aguila, means clay in Spanish. That's a good image for what data sets and data are in AI. They're kind of like the foundation, the soil that allows machine learning and AI to grow. So we're super excited about this, and I feel like this is just the beginning for M&A for Hugging Face, but for the field of AI in general too.
Okay, so when you look at a $10 million deal that I think the team's going to remain intact and they're almost going to continue to operate as they have been, how else would you want M&A to happen for Hugging Face? Will you do such sort of standalone deals? Will they get bigger?
Maybe. I think it all depends on the talents, on the opportunities. As I was sharing with one of your other reporters, the volume of acquisition opportunities has really skyrocketed in the past few months. Just Hugging Face alone, I realized that we're receiving over 10 acquisition opportunities a week these days.
Wow.
So it's a company
phone calls
expressing
or
interest.
emails? How are you getting it?
Emails, mostly, or like connecting with me on social media. Definitely increased, so it's really interesting to see. I think there's this natural tendency of like concentration in AI, and some companies like Hugging Face or others becoming some sort of magnet, right? Because of the visibility that we have, the talent that we have, the compute that we have. And for all these startups that have good teams, that have maybe early traction, but might not attract the level of VC funding that is required for AI.
Yeah.
There's going to be a lot of opportunities for them to join other teams, which is an interesting trend.
Because you've raised hundreds of millions, and there's Google, Amazon, Nvidia, all the who's who of corporate VCs invested in your previous round. So you've got the cash to be able to make these acquisitions. You've got the compute power. Is there any theme of where these companies that are currently wanting to sell themselves are coming from? Is it geographical, or is it within the stack layer? Like, what are the problems they're trying to solve?
So I think a lot of it is parallel to the concentration of VC bets in a way. I think right now VCs are taking heavy bets on a couple of very hot topics, like for example, large language models, right? You've seen maybe the fundraising of Mistral out of France a couple of days ago. And so when the startups are working on topics that are a little bit less hype for VC, like for example here it's data sets. It's kind of like a different picture. It's a different life. It's like I won't quote quoting Rocky Balboa, the world ain't all like sunshine and rainbows for AI startups that are working on like less sexy AI topics.
Yeah.
And so we see a lot of opportunities in there. And it's super exciting because, for example, here for Aguila, working on data sets, on data, which in my opinion now is becoming kind of like the bottleneck or like the most important topic for AI.
Right.
Because better data allows companies to take a Llama 3 base, for example, and then fine-tune it and get better results for their use case than GPT-4. So all these other topics that are not that hype are super interesting.
I have to leave it there, Clem DeLong. Making the unsexy sexy for your business. We appreciate it, CEO of Hugging Face. Coming up, we're going to be talking about perhaps a little bit of M&A, where the value lies. VC Spotlight, FPV Ventures Managing Partner Wesley Chan joins us. Let's have a quick look at what's happening in the public markets too, though, because the FTC is taking action against Adobe and executives for hiding fees, so says the Federal Trade Commission, preventing consumers from easily cancelling software subscriptions. We're down by more than 3%. They were down prior to this announcement. This is Bloomberg Technology.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity
is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Time now for Talking Tech. First up, the US Surgeon General is calling for warning labels on social media sites, similar to those that you'll find on a cigarette carton. Top health officials are calling on sites such as TikTok, Instagram, to include a warning to parents that it could harm the mental health of children. Legislation on the labels have yet to be introduced. Plus, Indian fintech firm Paytm is in talks to sell its movie and ticketing business to Zomato as it looks to unload non-core assets. And the discussions between Paytm and online food delivery firm Zomato are in advanced stages, though other suitors have voiced interest. And the US Supreme Court has agreed to review a case over NVIDIA's crypto mining revenue. NVIDIA is seeking to stop an investor suit accusing the company of being deceptive about its crypto mining revenue before a 2018 market downturn. But the justices say they will hear NVIDIA's contentions that the complaint lacks enough specificity to go forward. Now, time for VC Spotlight. Joining us today is Wesley Chan, FPV Ventures co-founder and managing partner. And it's interesting that we talk about NVIDIA just before our segment. And you're kind of the anti-AI voice in the room at the moment. Why? What are you feeling around the hype?
I think there's too many people, right? I love contrarian investing. When I invested in Canva on the Series A, there was 111 investors that told them no, right? They said, you're too far away, you're in Australia, we don't get how this is gonna work with Adobe and Microsoft having these amazing tools in the market. People trained on them, and all of a sudden, Canva is now being used by everybody under 35 with over $2 billion in revenue. So I always look at it as, what's the contrarian bet that we can be making? And if everybody's rushing into the fire, or rushing away from the fire, what fire should we be running into? It's kind of like going to Europe in the middle of the summer when everybody's off in school. You get crowds, you overpay, every hotel room is €1,000 a night. You want to be going in the middle of winter when it's empty and you can get the entire museum to yourself. So that's what we look for. We're not so much anti-AI as we are contrarian, and we want to go bet and place the investment when the timing is right.
Okay, so where is the timing right for right now? Where is the original check into Canva laying right now?
Well, some of the interesting bets are in areas where nobody thinks AI can make a difference, right? So one area that we're spending a lot of time in is in drug development and drug discovery.
Sorry, I hear a lot of people thinking AI is going to change drug discovery.
Well, they're not making the bets yet, right? Like if you look at companies in biotech right now, it's still kind of half dead, right? Like there are investors investing in the LLMs, or investing in the data management. Some of them are investing into drug discovery, but not much, right? We just did a big investment in a company called Data. They announced a $55 million round, and they use AI to train on mass spectrometry data. It's the same AI that they're training that you're finding on ChatGPT, but they're training it on models, and they're training it on data from mass spectrometries, like the machines that you see on CSI, and they're trying to use that to discover new molecules that can cure cancer, that can cure major diseases in natural compounds, and they've already found quite a few, and hence Microsoft just made a big investment into them. Again, it was not obvious when we made the investment. It was contrarian. Everybody sat there and said, well, ChatGPT is great for all this tech stuff and for writing essays and for helping high school students sort of create and do research, and all of a sudden we have a company that's figured out how to discover new molecules using some of the same AI tools. That's non-obvious. A lot of people thought that was crazy when we made the bet.
You're making very early bets, and I'm interested as to how long you ride with the bet, how much you can pay to play throughout the series that we get, because we're getting these corporate VCs wanting to come in on later rounds, and are they wanting a cleaner capital base? Are they wanting to push people and earlier investors out?
And I'm fine with corporate VCs coming. It makes me look good if they're coming into the round after we made the investment. The important thing is we have to find the right timing and find the right moment when the founders have discovered a unique insight using the AI or using tools as that AI provides to help them figure out how to make something majorly different, right? Whether it's drug discovery or it's helping people figure out how to better balance their checkbooks or whatnot. Like that moment in time when the founder sort of says like, this will change because of AI, or this will change and I'm using AI to help make that change, that's where we get excited.
And you can continue throughout all the series.
I mean, we're a venture fund, right? One of the most amazing thing about venture funds is we have a 10-year lifetime on the fund, right? We'd like companies to exit earlier, but our LPs are all long-term investors, right? They're all endowments, they're all charitable institutions, they're university endowments, right? They know that there's a 10-year time horizon, and that's one of the greatest things that we have going for us in this business. I'm not making the bet for tomorrow so that like some big corporate VC comes in and marks up the deal. We're placing the bet for 10 years down the road. People forget that Google took almost a decade to really realize its major potential, right? It IPO'd 6 years after its founding in 2004, but it really was 10 years when YouTube and when Android and when some of the bets that they placed early on in the early days of Google became to fruition. And same with Canva, right? 10 years, it's been 10 years, and now everybody's sort of seeing how obvious it is, but back for the first 5 years, everybody sort of sat there and scratched their head and said, I didn't get it.
What about getting out? Like, what about sort of a company that does initially seem to do incredible work, Flexport, for example, and then has some tensions at the top and reorganization? Do you stick with them throughout that iteration?
Absolutely. I mean, I still hold every share of Flexport stock that I've invested in, right? I believe in Ryan and his team that much. It's the same with Google. When Google IPO'd, a lot of people sort of said, let's dump the stock. Like, I don't get it. Like, this company's hit its peak. And at $85 a share, I think it's at $16,000 or $17,000 now a share, right? That IPO investment at Google is one of the best venture investments of all time, right? Too bad we don't do public equities. But it's one of those things where I look at it and go, does this company have 10 years of inflection points, and does it have more coming? And the founders that we invest in, the mission-driven founders that truly understand how the world will change when they create what they're creating, those are the ones that we care about. And they usually, create 100-year plans. I still remember Mel's 100-year plan in Canberra, right? Like, she graphed it out on a pirate ship map.
And I'm sure you perhaps had some insight to Google's 100-year plan as well as you were over at Google Analytics and Google Voice. Obviously, it's always great to get your contrarian views.
Thank you. Thank you for having me.
Meanwhile, of course, that's SPV Ventures, Wesley Chang. Coming up, we're going to talk about the Sun box office. Actually, finally getting its biggest debut since Barbie. Pixar's Inside Out 2 draws crowds back into the theaters. Details ahead. Meanwhile, let's just check out what's happening with AMC. Now, meme stock, of course, up 1.2%, but we're seeing Inside Out 2 probably helping AMC Entertainment, but they're also perhaps talking more about the records, the theaters, US attendance.
In 10 minutes' time now, at the top of the hour, do expect comments from New York Fed President Williams. Williams due to be speaking at the Economic Club of New York.
This is Bloomberg Technology.
Now keep in mind with Williams, no text is expected at the top of the hour.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Oh, it was a big weekend at the box office. Pixar's Inside Out 2 seeing the best film debut since Barbie. It's grossed $155 million at the box office in the US and Canada. Meanwhile, social media has been abuzz with the streaming debut of season 2 of House of Dragon, which premiered last night. There's a lot in terms of content, not to mention the latest film that actually will be allowed in China from Walt Disney. Let's talk it all with Geetha Ranganathan of Bloomberg Intelligence. Focus in on Disney for a moment and the content and the fact that we've got people going back to the theaters. Do they just need the right movie at the right time with the right kind of audience?
I absolutely think so, and Disney is back in a big way, definitely. Pixar is back in a big way, Caroline, and so is the box office. I mean, the box office has been really sleepy the whole of this year, and especially this summer season. And for Disney in particular, I mean, we know they've had a whole string of misfires, especially Pixar. We know that they released 3 movies direct to streaming during the pandemic era, and then after that, you know, they had Lightyear, they had Elemental, which kind of really struggled at the box office, but it looks like Inside Out 2 is really resonating with everybody. And I think, you know, of course, it is a movie that appeals to kids, but I think also to parents like you and me, and it's just such an emotionally charged film, and box office is all about emotion, so they obviously got the formula right.
Every single parent of teen girls I'm talking to wants they be able to discuss anxiety and how we combat this, and so this is one way. I'm interested, though, about the global box office. Interestingly, we got on social media Walt Disney saying, look, we are going to bring Deadpool and Wolverine to China. That's a big deal.
It's a huge deal. I mean, what we've seen over the past few years with China is that Western movies have kind of fallen out of favor a little bit. So if you just look at kind of how the Chinese box office has performed, actually China is one of the leading markets right now. If you look at year-to-date box office receipts, they're actually ahead of the US. So China is definitely critical to the global box office equation. And if you kind of just look at how Hollywood movies have performed in China, about 10
It's been 5
years
minutes
ago,
time
they made
now
up
at the top of the hour. We expect comments from Feds Williams, who's speaking at the Economic Club of New York. No text is expected.
And this year, it's probably down to about 10%. So having a big movie like this, and especially one of the most anticipated movies of the summer, Deadpool and Wolverine, go out in China, it is big news for Disney, and hopefully it will be big for the Chinese box office too.
What's interesting, though, is you say the tension around whether any of us can be bothered to go to the theatre right now when we can consume such great content when we're sat in the comfort of our own sofa. And to a large extent, House of Dragon is exactly that. We are still wanting to see new content, but quite often from franchises we know.
Oh, absolutely. And, you know, that's exactly what some of these streaming platforms are betting on, kind of making these investments in what they know, you know, will be appointment television. And HBO and Max have obviously been the leaders, the global leaders when it comes to that. And of course, House of Dragon, the Game of Thrones, all of these are, you know, huge, huge titles for them. And they want to make that an event and an experience. But you're absolutely right. You know, this past weekend has been such a big win, not just for, you know, box office and movie going in general. And people are going and watching movies more in big screens. That is huge news. So they're making it like a whole big event. But then they're also coming back home and then, you know, kind of relaxing on their couches and watching some great streaming content as well.
Summer lined up. Geetha Ranganathan, we thank you of Bloomberg Intelligence. Some great analysis. And that does it for this edition of Bloomberg Technology. Don't forget to check out our podcast. Find it on the terminal, as well as online on Apple, Spotify, and iHeart. This is Bloomberg Technology.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Shortly expecting comments from Fed's Williams.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And once again, it's just the two of us. No Eric Balchunas this week.
He's over in Europe. I don't know what he's doing there. Maybe advising on the snap election, perhaps?
If that's the case, we might not see him for a while. So let's get to the biggest stories right now. The more than $12 trillion global ETF industry. And we start with small cap underperformance, the group trailing the S&P 500's record run. We're going to dig into why the sector is missing out on the rally.
And in just a few moments, we'll speak with Greg Tordo. He is portfolio manager at Goldman on why he is a small cap believer. Plus, the new weight loss revolution is led by drugs like Ozempic. We talked to Maurice Pott, CEO of Tima ETFs, who built a fund around this trend. But first, as we mentioned, Eric is gone this week, so Katie is looking into all the flow action in the U.S. What do you see?
I'm going to do my best here. Let's take a look at where money is going in the week that was. If you take a look at some of the funds that are seeing love this week, up at the top, you have some of your index-based names, of course, the S&P 500 and the Qs. A little weirdness is going on with those S&P 500 funds we'll get to on the outflows. But if you take a look at the inflows, IVV taking in nearly $16 billion. The Qs as well taking in about $2.6 billion. You go down the list, global equities seeing some love. IWY and EFG also taking in inflows. So that's the good news. Let's take a look at the outflows as well. And as I mentioned, some weirdness going on. You can see SPY losing a lot of money, about $13.8 billion. VU as well, seeing a chunky outflow there. Then you go down, you can see dividends actually losing some money as well. So too was value. And RSP, this is an equal weight fund. We've been talking about the divergence between big and small, and you can see equal weight losing about $900 million. But let's talk more about that divergence and compare small to big, and focusing on small. If you take a look at small cap outflows, it's been a real mixed bag. Of course, there's been a lot of people calling for a resurgence of small caps as we get closer to the start of the Fed's cutting cycle. And you've seen that back and forth going in the flows. February and March, huge for small cap funds. You can see taking in billions of dollars. Some of that came out in April, maybe as people got a little bit more comfortable with the idea that higher for longer will be here. Now you're starting to see people nibble again. May and June seeing in several billion dollars coming in. But of course, it feels like when it comes to the actual performance of small cap, Scarlett, we haven't quite seen that sector get off the ground.
We have been waiting, and perhaps we'll continue to wait. Joining our conversation now on small caps is Greg Tordo. He is portfolio manager at Goldman Sachs. Greg, it is good to see you.
Thanks for having me.
So we talk about small caps and how they've kind of been waiting for their moment, and it hasn't really happened yet. Are they really being held hostage by the Fed's timing on an eventual rate cut?
Well, I think it's been a search for rate certainty since the fourth quarter of last year, when we thought we had a little bit of that, and you got a preview of what might happen with a really strong fourth quarter in small caps. Since then, there's been some fits and starts. Some movement around the inflation data that has caused people to push out the rate cut bets till the end of the year, and I think that people want clarity about that, and I think that more so than in any other cycles that I've seen, it's, the small caps have been held hostage to that rate certainty.
And so when will small caps be a broad brushstrokes buy? Do we actually need to see the first rate cut for that to happen, for people to say, oh, look at these valuations, they're pretty depressed?
I don't think you need to actually see the first rate cut. I think if you look back to the fourth quarter, like I said, as when things start to get to the point where you'll have a little bit more of a percentage of likelihood of a cut, maybe in the end of the third quarter, the beginning of the fourth, I think you'll see that all clear being sounded. But there are a lot of positive fundamental signs for small caps, and you're asking a small cap guy if you like small caps. It's like asking a house painter if their house needs to be painted. But I can tell you that the valuation picture is probably the best in many, many, many years. I think the earnings picture is a lot better than large caps, especially in the sectors that we like. And if you look across small caps, the resiliency of the U.S. economy is really well set up there, and I think you can play that in a much better and more pure way than in the large cap space.
That fundamental story has been intact for a while, but it hasn't really materialized in terms of that outperformance. There is a debate on Reddit where some argued that the current market cap definition of a small cap with a ceiling of $2 billion should be adjusted for inflation. If you think about $2 billion in 1974 would be worth about $12 billion today, and that this outdated classification system no longer accurately represents the size and economic impact of companies today. What do you think about that?
I do think that there is a little bit of a prejudice against size in the small cap market, and I do think that part of the smallest of the small get classed as low quality, which I think people have kind of used to kind of as another excuse to avoid small caps. We tend to think of small caps in the $2 to $7 billion range, 1 to 7 if you widen up a little bit. We tend to stay away from some of the lower cap ones, not because of quality, but because of liquidity. I think that on the ETF side of things, we want to make sure that there is enough liquidity for everyone who wants to participate. And I do think that there is some desire, and but from the benchmarking folks, to make the average size of a small cap a little bit bigger, but it's one of those things that I think it's, beauty is in the eye of the beholder, and I think that everyone has their own definition of where it should be.
So let's talk about one of your ETFs. Of course, GSC is the ticker. That is the Goldman Sachs Small Cap Core Equity ETF. It's actively managed, has about $32 million when it comes to its portfolio. It's outperforming. You look just year to date, which is, I recognize, a pretty small time frame, but you're up 5%. The Russell 2000, for example, is down about 1% on a total return basis. I mean, where are you finding the opportunity when it comes to that portfolio?
Yeah, I think it's been in a couple of areas. Consumer and industrials have been the two areas that have led a lot of the gains for us. We've also done okay in tech, mainly in semiconductors. I think there's been some larger benchmark issues in the tech space. MicroStrategy, Supermicro being two of them that have been headwinds for us. But if you look in consumer, the retail and restaurant space have done quite well, and I think that's been a big tailwind for us. On the industrial side, a bunch of different things. Industrials is a catch-all category, as I'm sure you guys know, but areas in aviation, even with some of the Boeing issues, areas in the water space and in the electric utility space, the equipment for electric utilities as we harden the grid, have been really strong stocks for us as we looked over the past 6 months or so.
I'm glad you bring up Supermicro and MicroStrategy. They're small caps, but there's a lot of concentration risk there as well. They've done incredibly well, and on their own, they don't make up a huge percentage of the Russell 2000, even as they're the largest components. But I wonder, as they do well, don't they get too large to be considered small caps anymore, and so you lose out on the ones that do well?
So I've been doing this for almost 30 years, and I can tell you I've never seen small caps this big in a benchmark. And they usually don't make it that big. They don't last that long. Usually it's a company that's getting taken over, and it doesn't really make it to the rebalance. So there's been a lot of oxygen used to talk about these two companies. I can tell you that on the bottoms up side of things, we can ignore them in the construction process, and we only really have to deal with them in the index. I do think that people who run a bit more of a kind of a index plus or a more of a factor-based approach tend to have to deal with this on a greater detail than we do, just because we find enough ideas elsewhere that we don't have to worry about it as we build the portfolios.
Yeah, I want to talk about small cap indexes a little bit more because, of course, we always talk about the Russell 2000. That's the small cap index that everyone knows. Then you have things such as the CRSP small cap index, which I know VB, that's a Vanguard small cap fund, tracks. And then you take a look at what your portfolio has, just 99 holdings. When you think about the universe of small caps, that's pretty small. You compare that to the benchmark. I mean, how close do you want to be to some of the big benchmarks right now? Or is this the time to really go small in your small cap holdings?
Well, I think what we try to do is be benchmark aware, kind of understand where the sectors are and what are the reasons behind that. And I think once you kind of get that construction piece of it out of the way, then you start to look for your best ideas. And I don't think we don't think of ourselves as thematic investors, but if you look at where our big overweights are, consumer, as I mentioned, industrials, as I mentioned, parts of tech like semiconductors and semiconductor capital equipment, I think that's where you start to kind of look for conviction and the really best portions of the risk-reward curve, and that's where we start to build some of our bigger positions. As you look towards the bottom of the portfolio, you look for things that are earlier in their conviction for us. Pieces of the portfolio that might be a little bit less current in what they're looking for, companies in the biotech space, some of the healthcare names, and that's how we think about it. And I do think that allows us to be a lot more nimble when it comes to some of these benchmarks that are a bit more all over the place.
We go back to the beginning of our conversation about how they're being held hostage to rate uncertainty, and so much of the small cap story is built around a Fed rate cut. How do you do that without trying to actually time your entry? Because we know timing the market never works out.
I think that what we've seen is that if you try to time your entries in small caps, it really doesn't work for you. It works against you. Some of the best days that happen for the small cap space happen when they come out of the blue. And we've seen that, and when you've seen some of these big moves that are coming when people think you've gotten the all clear from the Fed. So we don't prescribe to the market timing in the small cap space. We do think that most people should have a small cap allocation. I think that amount has wavered over the last couple of years as small caps have underperformed. And I do think that some of that degree of rate certainty that people search for in small caps comes from the fact that some of that allocation has really gone into passive from active managers. And I think that passive piece of it has been more representative of what's being kind of happening when the small caps are being held hostage to the rate cut dynamic.
All right, Greg, really enjoyed this conversation. Have to leave it there. Appreciate your time. That is Greg Torto of Goldman Sachs. Now, coming up, traders are pouring billions of dollars into an investing style that has so far struggled to gain traction. We'll discuss why we may be in a quant factor era next. This is ETF IQ on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with ETF launches year to date. So far in 2024, we've already seen more than 250 ETFs launched. So far, that has us on track to surpass even what we saw in 2023. Of course, a record year. You had almost 500 new ETFs come to the market. And as you can see, that trend has been building for several years now. You also have closures picking up, which we don't have on the board. But of course, with this type of new momentum, this is an industry that is in growth mode. Let's also talk about XLK. This is one of the big tech sector ETFs out there. And it's had a strangely small weighting to NVIDIA, as you can see there. Just 6% of the portfolio is dedicated to NVIDIA, which has been holding down its performance relative to some of the other tech funds. But perhaps in its next quarterly rebalance, those allocations will reshuffle. Let's also talk about our final topic here, and that is quant factor ETFs. If you take a look at performance right now, they've actually been doing pretty well. You have your top 5 up there. Up in charge is Momentum with a nearly 17% year-to-date gain. Multi-factor not too far behind. And you add it all together, and actually billions of dollars have been flowing into these quant factor funds.
So let's talk about this story with Bloomberg's Isabel Lee, who's been writing about it. What is driving this rally? I see momentum and I see size, and I think big tech.
Definitely. It's really performance, and this is a stark turnaround from last year. So of the 13 long-short styles that Bloomberg tracks last year, only two were in the green. And now this year to date, only 2 are in the red. So it's really a good performance, and it's because we have market conditions that have steadied. I mean, Wall Street has largely made peace with the fact that interest rates will stay elevated for a longer period of time, and it doesn't help that the stock market just keeps on rallying and rallying. And also on the flip side of that, yes, there is big tech, but a lot of people pile into smart beta because it doesn't have big tech, so they use it to diversify and hedge their portfolios.
And so we're talking about these massive inflows that we're seeing into the space. Who's driving that? Is that the institutional type players, the professional money managers? Are we talking about mom and pop, for example?
Some retail traders are driving it, and we've seen around 4 to 8 billion pile into this equity ETFs, and it's really a stark contrast from last year, and we're on pace to beat 2023. And we have BI's Athanasios Serafagis saying that of the 900 ETFs that are tracking smart beta, 600 do not have big tech. So this is really their bit to diversify. I mean, smart beta equals quant equals factor. It's a cheap way to get into those trades. As we know, these styles are usually reserved for hedge funds and they're pricier. So this is a cheap entry, which is why we all love ETFs.
I'm so glad you mentioned earlier about the current market conditions, how things are really calm, and you just have this market that relentlessly goes higher. What is the correlation between that and demand for these smart beta or quant ETFs? Meaning, if we get volatility, how's that going to shake out?
If we get volatility, then smart beta demand will be a little bit less, but I think it's also hard to compare because last year markets were good, but then we saw demand wane a little bit. So I think it's really the confusion around it. And now it's really more that, okay, maybe interest rates will stay higher for longer. Powell didn't say anything new. Maybe we'll see a rate cut later this year. So it's really more sentiment as well, and not just really whether market goes up or whether market goes down.
Okay, so making peace with higher for longer. Isabel, thank you so much. Bloomberg's Isabel Lee covering the markets for us here at Bloomberg. Still ahead, we dive into the weight loss revolution with Moritz Pott. He is CEO of Tima ETFs next. This is ETF IQ on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
This is Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld. And Katie, you have today's drill down where we focus on one ETF. What is it?
One ETF. The ETF that we're talking about this week is HRTS. This is the TEMA Obesity and Cardiometabolic ETF. It's all about investing in those companies that have been benefiting from the hype that we've seen around weight loss drugs. You take a look at this fund in particular. It's one of the first to launch with this theme. It launched in late November last year. It's an actively managed portfolio for about 75 basis points. And with that launch, of course, in late November, it already is close to $70 million in assets. So pretty strong start here for this portfolio. Let's take a look at what it actually holds. It's all about equities, 46 holdings in total. You take a look at what's at the top here. You have Vertex, Eli Lilly, no surprise, Amgen, and then Novo Nordisk. So again, global in nature here, just 46 holdings. Let's take a look at performance so far. Again, it hasn't been around for too long, but you compare it to both the iShares Global Healthcare ETF and the Spider S&P Biotech ETF. And I think it's interesting because it falls kind of in the middle on a total return basis. This portfolio has returned 23% since its inception. That is ahead of the global ETF, which has returned about 13%, but a little bit behind just XBI, which has returned about 25%. So strong performance, again, right in the middle there, even though it has some of those global names, and already $70 million in assets, Scarlett.
All right. Here joining us now to talk more about this particular ETF is Moritz Pott. He is CEO at TEMA ETFs. And as Katie was showing us, HRTS has 46 companies, which kind of surprised me, given that when we talk about companies that benefit from the weight loss drugs, we're usually talking about Novo Nordisk and Eli Lilly. So I didn't realize that the universe could be expanded to 46 companies.
So when we think about the obesity opportunity, basically the GLP-1 weight loss space, there's obviously 2 big players already, which have approved drugs in the US. But based on our research, there's a whole tail of companies that are in early or advanced stage of getting products approved. And in reality, we're focused primarily on the GLP-1 weight loss space, but we also address second-order cardiometabolic obesity diseases. The trifecta of diabetes, obesity, and heart disease are very closely interrelated. So when we think about what the opportunity is, it's GLP-1 focus, but also capturing what are the impacts between the 3 different disease groups I just mentioned. That's why when we think about it, this is not taking a Mag 7 approach to weight loss drugs doesn't work. Rather, there's a lot of risk in biotech investing. You need to manage that risk. You need to reduce that risk. And by having a more diversified portfolio and also using expertise, biotech expertise to manage that risk is really important for us.
And so when when you take a look at the weightings right now, you have Vertex up in front, followed by Eli Lilly, then Amgen and Novo Nordisk. Is this supposed to be equally weighted and have these drifted, or how did you decide to have Vertex, for example, as the highest weighting versus maybe some of the actual drug makers themselves?
So we don't want to follow consensus. We really look for out of the consensus views. So for example, we were a very early shareholder in Viking, and actually we sold when it spiked, since dropped 50%. We think that actually Vertex has some very interesting innovation doing on the diabetes side that may translate over into obesity. When we think about a company like Amgen actually has a very interesting therapy they're developing that reduces the frequency of dosage. So when we think about the next stage of GLP-1 drug innovation, you're actually looking beyond GLP-1 drugs today. You're looking at amylin drugs. And for example, Zealand Pharmaceuticals in Scandinavia is one of the early leaders in an amylin drug, which really has lower side effects. So less nausea, less muscle loss. So for us, there's two big players in the room already, but the reality is we think that this is not going to be a two-horse race over time. And really being an early investor in some of those second, third horses is really important. And that's why we're looking at companies like Amgen, Regeneron, Vertex, Viking, to name a few.
So I want to go back to the ticker of your ETF. It's HRTS. And I know you talked about the second and third order effects of weight loss drugs and companies that may be involved. Why not play off of something that's more directly tied to weight loss? I mean, it could be like GLP-1, or what was another ETF that liquidated that's tied?
Oh, Slim.
Slim. Like Slim is available as well.
So if we were just marketing, we would call it the GLP-1 ETF. But if you look at the innovation, it's actually looking already beyond GLP-1. So while GLP-1 is obviously the core ingredient behind a lot of the drugs we see today, we're trying to build a product that is not just trying to capture the interest of
S&P 500 extending gains now, up around 0.3%.
This is ultimately a multi-decade opportunity. There's 1 billion obese people in the world. Novo Nordisk estimates that 2% of people are treated today. So when we're trying to build a product that is scientific based, is really based on expertise, and is not just trying to capture just GLP-1s. We capture GLP-1s, we capture weight loss drugs, but we also capture cardiometabolic diseases, which ultimately are at the heart of a lot of the obesity issues we see.
And I mean, going back to the way that you weight this portfolio and put it together, I hear what you're saying that you want to look beyond just the actual drug makers themselves, but that decision seems to be very, very active. That instead of just putting, the likes of Lilly and Novo Nordisk right at the top there, that you're actually looking beyond that and trying to pick out who will be the next winner instead of the currently established winner. I mean, is it harder to sell an ETF that is that active?
Yeah. So the reality is that in biotech, we believe you need active expertise. That active expertise is not to increase risk, but to manage risk. And that starts with having biotech expertise. So, the person who manages ETF, he's a veteran 25-year biotech portfolio manager. The inventor of GLP-1 joined our scientific advisory board last month. And our view is that you need to manage risk. So when we think about Eli Lilly, Novo, they're the winners of today. But in drug discovery and in life sciences historically, there's been a recurring trend of disruption with innovation. That's not to say that we're worried about what will happen with Novo and Eli, but we do think there's new approaches where Eli and Lilly may not be the first mover or the winner.
So the weight loss story is intact, and there's definitely a lot of fundamental tailwinds behind it. But there's a big issue here with supply and affordability. And we know that a lot of states and companies are limiting how much insurance companies will reimburse for those drugs. How does that factor into the portfolio manager's thinking about which companies he chooses?
So in our views, that's why you need to have a global approach. You can't have a domestic approach, which is why, for example, if you were to buy IBB or XLV, they don't own non-US companies. Some of the innovations coming in the US, some of the innovations coming outside of the US. Affordability will improve as prices come down, but for these companies, the TAM is so big that even if prices come down, we still think it's going to be a very
So gains quickly extending the S&P 500 up almost 0.5% now. And no news catalyst on this move to the upside here, keeping our eyes out nonetheless. Just note, we are seeing a slide in treasuries as well amid some high-grade sales from corporate debt before data this week.
For instant penetration, $6,000, that's $1 trillion market opportunity.
All right, sadly, we have to leave it there. Really enjoyed this conversation. Our thanks to Moritz Pot of Tema ETFs. And if you just can't get enough of ETFs, you can subscribe to my weekly ETF IQ newsletter that covers the industry. But that does it for us. I'm Katie Greifeld along with Scarlett Fu, and this is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now.
Missing a piece from CNBC is Nvidia's to get a 20% weighting in billions in investor demand, while Apple is demoted in a major tech fund. So the fund in question is the Index Technology Sector SPDR. Following a rebalance on pricing from Friday's close, they're again saying that Nvidia is going to get a 20% weighting and billions of dollars in investor demand.
The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns.
We have put that article from CNBC out on the feed for anybody interested.
We used to have a high interest rate environment.
Reading into this as well, the calculations show that Microsoft is the top stock in the index, followed by Nvidia and then Apple. So all three stocks would have been weighted above 20% in the index if there were not caps in place. The diversification rules for the index limit how big the cumulative weight of stocks can be.
Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Welcome to Bloomberg Markets. I'm Shonali Bassick. Looking at the S&P 500 hitting a session high right now, extending a record run with Wall Street calling for even more gains. Let's talk about that Evercore ISI call, of course, expecting a price target now of $6,000 and the S&P 500 starting today in the red, now back in the green by 0.5%. The NASDAQ 100 also seeing gains, everything flying just a little bit, 0.7% higher. The bond market, interesting space to look after that big bid in the bond market last week. We have the 2-year yield now up about 4 basis points, nearly 5 basis points on the day. 2-year at 4.74, the 10-year still below 4.30, very comfortably at 4.27. Also seeing roughly a 5 basis point move today. Some midday movers on the equity side we're taking a look at. Activist investors Starboard pushing for changes at Autodesk because of the performance issues and how it handled an accounting probe. Now, Starboard said it will sue to delay Autodesk's annual meeting and force a board vote. Starboard has a $600 million stake in the company. That is $500 million stake in the company. And you see, of course, the shares reacting. Looking at also the AI craze in the U.S., pushing TSMC's depository receipts to their most expensive price versus the Taiwan Stock Exchange since 2009. TSMC now flying as well, about 2.4% higher, but it's worrisome to investors who have adopted the arbitrage strategy of buying TSMC shares while shorting its U.S. listing. Shares have surged about 10% more this year in the United States than they have in Taiwan. Also looking at flows for HYG, the ETF that tracks junk junk bonds, of course. This is the iShares ETF. Fascinating play in the equity market on what is happening over in the bond market. And you look at the 1 month flows of nearly 1.3 billion worth of net flows, really just detracting from that bleed you've seen in the last couple of years, certainly over 1 year, definitely over 3 years, and even this year alone. But of course, you do now have that rally when you see those expectations for interest rate cuts just rising. And you have KKR saying credit investors are focusing too much on spreads, missing out on bargains further down the credit rating spectrum. They, of course, are looking at those CCC bonds. Joining me now from San Francisco is KKR partner and co-head of credit, Chris Sheldon, out with a note today. Of course, one of the most read on the Bloomberg terminal. And Chris, if you take a look at what investors are missing, of course, a lot of people concerned that you're just not getting value because of where spreads are right now. What do you tell them?
Look, I think a lot of people are just too focused on the spread and not looking at the absolute dollar price of the index, which is still below par, so you do have some convexity, and the absolute yield. And if you think about it, at these higher rates for longer, which is what our view is, you're going to compound that interest, and from a default standpoint, that mitigates a lot of the recoveries. So we like credit right now. We think it's a higher resting heart rate for rates. You know, it was Albert Einstein said, you know, compounding is the eighth wonder of the world, and I think you're just going to get that continued reinvestment of the income for a while now.
Now, Chris, I don't want to pretend that everything out there is rosy. I want to also pay some attention to what's starting to weaken in the credit spectrum because we are seeing defaults in part of the market.
For sure, you're seeing the economy slow. All the increased, Fed rate hikes is working. It's slowing the economy, but we are not envisioning a big spike of defaults. It's not like previous recessions where there's a big shock on the system. And if you look at across all the different sectors we've seen, you've almost been in kind of a rolling recession where some businesses have been in a rut for 3 years now and are just bottoming and coming out. And then there's some industries that are actually starting to see slowing and continuing to go in. So we do envision increased defaults, increased downgrades. However, it's not sort of Armageddon in terms of a big spike of defaults.
But even if you don't see an Armageddon coming, fair point, what do you think about investors who are piling into riskier credits right now? Do you think some of them might be avoiding some of the risks out there?
For sure, and if you look at the market and the market construct, the incentives to take risks have been stripped out of the market, particularly in the liquid markets. If you look at a big part of the loan market, it's CLOs, they really can't buy a lot of CCCs. Big part of the high yield market is insurance companies that really can't buy below double B, let alone single B type risk. So the incentives have been pulled out. There's more and more dispersion in the market. And so, as I sort of mentioned, people are focused on spreads, but there's a lot of dispersion in that. So it's a credit picking market. I'm not saying you should go buy all lower rated CCC risk, but there's a lot of interesting opportunities if you can underwrite and differentiate yourself on some of that lower rated risk.
Chris, to the extent that you see dispersion, where are the most mispriced opportunities worth picking at right now?
Well, right now, and as we mentioned in our letter, you're just seeing the CLO machines just start again, and you're seeing a ton of resets happening. And as a result, people are trying to bring their CCC baskets down. And so you're seeing a lot of motivated sellers in CCC loans right now today. And there's a lot of good companies, or there's certain industries where the ratings for those industries are naturally going to get CCC, whether it be insurance brokerage or software, where there are not a lot of hard assets, where the rating agencies often penalize the recurring cash flows of those businesses.
Motivated sellers, Chris, or forced sellers? Is there a reason some people are sitting here offloading at this point?
Yeah, it's more motivated. I do think when there is misses, there's a sell first, ask questions later when they're missing on the earnings. We're not seeing like dramatic forced selling. I would say that when things are going into a default or things are really in dire, you see some more forced selling. But right now, it's not, Armageddon forced selling right now.
I'm really curious about why people are tapping debt markets at this point. You saw just a tremendous boom at the beginning of the year of investment grade. Then you saw the junk bonds follow. Then you also saw a wave of issuance when it came to leveraged finance pertaining to private equity firms. We have a story out right now about how private equity just won't stop gorging on debt to pay their investors, looking at dividend recaps. Would you be a buyer of that kind of issuance?
It depends. Look, I mean, I think you're seeing a lot of flows, as you sort of highlighted in the high yield HYG inflows and from retail. You're seeing flows back into credit. You're at the point where I think you're more consensus around a softer landing, not a deep, dark recession. There's a little bit more certainty that inflation is under control. So capital's coming into the market. There's been a lack of M&A, which is why you're seeing an increase in sort of the dividend deals from private equity sponsors. So I'm okay lending and participating in some of these dividend transactions, particularly if they're businesses we know, if they're management teams we know, that they've hit our numbers for the last 5 years or 3 years that we've been in those loans. So I don't get too spooked by the increase of private equity transactions taking capital back. And in many cases, a lot of these private equity firms have still a ton of capital in these businesses, so you're still aligned. But I think you have to just be wary. It's about the right ones leaning in and avoiding the mistakes. I think right now it's about keeping it simple, not reaching for return or yield, understanding the businesses that you're lending to, picking the right sectors, avoiding the secular decliners. There'll be a time to go into complexity. There'll be a time to go into stress. We just don't think that's the time right now.
Real quickly here, if you had a choice between the broadly syndicated market or the private credit market at this point, seeing the deals that are coming to surface now, what do you choose?
Well, look, I mean, private credit market is a big market. That includes direct lending, that includes junior debt, that includes all asset-based finance, and it also includes some capital solutions. Right now, we're seeing a really interesting opportunity in asset-based finance. A lot of portfolios of loans coming out of the banks, a lot of collateral-backed cash flows that seem to be less correlated with what you're seeing in sort of fundamental corporate macro risk. So we're leaning towards sort of that asset-based finance right now. We're leaning towards a little bit of the capital solutions where you can be a little bespoke. You can construct your own capital structure.
KKR partner Chris Sheldon, off the heels of a fresh note out of his team. Thank you so very much for joining us. Perfect moment to bring in Churchill president and CEO Ken Kencel, whose firm oversees $50 billion as a capital affiliate of Nuveen, and of course very close to those private credit markets that we've been talking about. You know, we just had this conversation with KKR about things starting to weaken in certain parts of the economy. How do you feel about where things are headed from here, especially given that recalibration of where investors think interest rates are going?
Sure, and by the way, great to see you, Shanali, and of course always great to catch up. No, look, I think there's been a lot of questions about portfolio performance, a lot of issues around, okay, what is the impact on, higher for longer? How are these companies handling the higher rate environment? And I would say overall, the answer is quite well. I mean, if you look at our portfolio, for example, right, we have today a $22 billion portfolio of middle market private credit loans. We have an incredibly small percentage on non-accrual, less than 1% overall that are having issues. So I think for the better managers, I think you're seeing quality hold up quite well. I do think it is leading to a dispersion among managers, meaning the firms that took a lot of risk, that were playing at the margins, that were chasing higher yields, that really weren't sticking to their knitting and focusing on quality, they're starting to see issues in their portfolio. I mean, if you look at recent research that's been coming out, the widest dispersion I've seen in a long time, you have managers that have 9 or 10% of their portfolios on non-accrual, and you have high-quality managers with no percentage or very low percentage on non-accrual. So I think it's a mixed bag on portfolio performance, and I do think, in agreement with your last discussion, I do think it is a bit of a rolling dynamic as well. Certain industries are being impacted, others are doing quite well, so I think it's a mixed bag on
Where do
portfolio.
you see that stress? When you see the things that are starting to peek out of the surface, even if we get a rate cut, it's not coming right now.
Right.
So what is the stress that we see through the end of the year?
So I would say that in our portfolio, what we've seen is that it tends to be idiosyncratic issues, meaning you've got a company that for various reasons is challenged with some dynamics in a very specific subsector. What we're not seeing is kind of broad-based issues across an industry or a subsector that we're investing in. Of course, we generally don't invest in restaurants and retail and oil and gas and some of the other more cyclical areas. But overall, I would say it tends to be idiosyncratic and not really based upon any overall trends. There are some, I would say, healthcare, if anything. In certain areas of healthcare, you're seeing some challenges in terms of cost reimbursement. But overall, across the portfolio, we see things as handling the higher interest rate environment quite well.
So higher interest rate environment, of course, in the last week, we've seen a lot of changes in the expectations for where interest rates go from here, potentially 2 rate cuts. At least that's what the market wants. As an investor, how does that change your thinking about how you put money to work?
Well, we're certainly being more conservative today. I mean, if you look at leverage multiples in our world today, a company that might have been levered 5 or even 6 times cash flow 2 years ago, that same deal today is being levered 4 to 5 times. So you're seeing a full turn to a turn and a half lower leverage, focus on higher quality issuers, companies that have strong, consistent, stable cash flow. Certainly that's how we approach things. Now, I will say overall, with the opening of the broadly syndicated loan markets, the amount of liquidity that's poured into that market, you're certainly seeing opportunities for refinancing or fixes, if you will, in the liquid loan market. And that's put a fair amount of pressure, on spreads and ultimately leverage in that market. We have generally chosen not to play in that world. So we're staying focused on, our core middle market, companies that are down the fairway, and kind of staying away from some of those pressure points in the market. And I would say that the liquid market, you're certainly seeing a little bit more of that now today.
Well, it's interesting because the first part of the year brought so much exuberance in debt markets. Do you think it's brought on too much exuberance, given that you're staying away from some of it?
I would say that certainly in the large liquid markets, you've seen spreads come in 100, 150 basis points. You've seen leverage move up a half a turn, 3/4 of a turn. Refinancing is really dominating that market. New deal M&A activity remains quite low. In our case, we've generally chosen not to play in that world, so we're in kind of the core middle market. So these are larger companies, but not so large as to have graduated into that world. And what we like are add-on activities in our portfolio, so we know the company, we know the portfolio, we know the borrower. They're doing strategic, acquisitions or adding on to their assets. We like, new deals in certain industries with high-quality businesses, but we've generally stayed away from the kind of rescue, refinancings that you're seeing now go on in the large cap market.
Certainly playing it safe in a choppy environment. Ken, we thank you so much for joining us. That is Churchill President and CEO Ken Kencel. Now, coming up, we're going to talk about GameStop holding its annual shareholder meeting. More on that next. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
This This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets, and I'm Shonali Bassick. It's time now for the stock of the hour, GameStop. The annual shareholders meeting is underway amid drastic fluctuations in the shares. Of course, lower down on the day, roughly 5% lower on the day. Trading influencer Keith Gill, aka Roaring Kitty, posted images of a massive stake in the company earlier this month. Bloomberg now reporting that Gill has unwound that position of 120,000 call options and added more GameStop, upping his portfolio to about 9 million shares. And amid this frenzy, GameStop announced plans to sell more than $2 billion worth of stock. And we have, of course, now Ryan Cohen, the CEO of GameStop, speaking to investors at that meeting, saying that he's focusing on profitability and avoiding all the hype. We'll bring you more headlines as they come. But coming up, we're going to talk with Sarah Samuels, partner and head of investment manager research at the NEPC, to talk about what's the hottest story right now on Wall Street. Stick with us. That's up next. This is Bloomberg.
So in 10 minutes time now at the top of the hour, we are expecting comments from Fed's Harker, who speaks on the economic outlook at an event organized by the Philadelphia Fed. For anyone interested, the registration link to Fed's Harker's speech is available attached to his entry on the calendar, if anyone is interested. Keep in mind, registration for this event is charged, however, there is a fee.
How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Basak. It's time now for the Wall Street Beat. Joining us now is Sarah Samuels, who's head of investment manager research at the NAPC and a partner there. The firm is an investment advisory firm with $1.7 trillion in assets under management. And Sarah, you were part of our story today where we talked a lot about that crunch on the private equity industry, that pressure to get money back to investors. What does that crunch feel like under the surface to pension funds, endowments?
That's right. Well, Shonali, it's great to see you again. Thank you for having me on the show. So there are really three things that are happening today. And the first is that the big money, so endowments, pension funds, sovereign wealth funds, are not getting the capital back from the private investments that they've made, that they've expected, and that they've modeled out in their commitment pacing plans. The second is that we really need to see a valuation reset in order for more deal activity and exits to transpire. And then the third is that this can be a really great time to put capital, new capital, to work in private markets.
Well, that's fascinating because if investors are demanding their money back, a lot of people around the market say this is to recycle. This is to take that money back in the form of dividend recaps, other leverage, and put that into new private equity funds. But why would you put it into new private equity funds if you're not getting the money back in the first place?
Yes, so this is the challenge. So if we zoom out a little bit and think about how did we get here? So investors 15 years ago or so with zero interest rate environment were really ramping up exposure to private markets, which is what the Fed intended with low interest rates to incentivize risk taking. So lots of money went into private markets, and that worked, and distributions worked in that type of environment. Now with higher rates, what we're seeing is that there are not those realizations happening. And so there aren't the distributions that have been modeled out by these LPs, and at the same time, GPs are continuing to call capital, which is putting that crunch on liquidity. And we just saw an article last week about some pension funds, large ones, who are really struggling with figuring out how to source their liquidity. And when we think about why does this matter? Why do LPs need liquidity? It's really about important missions that they're serving in our communities and in the ecosystem.
What does it feel like under the surface? Is there some sort of liquidity crunch, just given how much private markets have become part of the portfolios of so many big institutions?
Yes, so many of our clients are doing okay. And the reason for that is that the public markets have really masked any potential issues. Should we see a meaningful downturn in public markets like we did, let's say, leading up to and during the GFC, liquidity will be harder to come by.
It's fascinating because when you say there needs to be a valuation reset, it's also this sense that returns might be lower, isn't it?
That's right. When you think about what the cost of debt is today, let's take a buyout strategy, for example. Historically, over the last 15 years, the cost of debt was somewhere between 4 and 5%. Today's 9%. Many of those loans are floating rates, so they've moved up, and that's going to eat into the profitability of those underlying portfolio companies and their ability to generate earnings. All their cash flow is going to interest expense. So when it comes time to sell, if those private equity sponsors want to sell, there's a valuation drop, and buyers and sellers are not yet able to meet on price. That's where that valuation reset needs to come in.
So it's interesting. If you say that people are taking those funds that are returned to them, and then recycling them into other private markets, do they recycle it into new private equity funds, or do they take it and go into other hot areas of private markets like real estate or private credit?
So that's where the CIO, the Chief Investment Officer's job, gets really interesting, is deciding where are those opportunities to put new capital to work. So at NAPC, we guide our clients not to try to skip vintage years or time vintage years, and to continue to commit to your highest quality GPs, because if you lose access and you skip a year, then you're out for good. Now, when we think about other areas where we see really great opportunities, and maybe some great CIOs do too, it's early stage venture where valuations are lower and there's lots of upside.
So in 5 minutes time now at the top of the hour, we're expecting comments from Fed's Harker, due to be speaking on the economic outlook.
Just about a minute left here, but when you see private equity firms turning to debt markets...
Keep in mind there is a text expected from Fed's Harker in just under 5 minutes time now, and there's also a Q&A at this event as well.
...as a form of payment. Do you say that's okay?
Yes, so this is very present. It's actually more hyped up in the media than it's actually happening. So we did a survey at NAPC and found that only about 10% of the proceeds that were coming from NAV loans were being used to recycle capital and distribute it back to LPs. In general, that's really not a strategy that we can get behind. It's not happening as much as you might think.
Sarah, we thank you so much for keeping an eye on these markets. Looking forward to talking to you again soon. That is NAPC partner Sarah Samuels.
Thank you.
Now, I want to check in on GameStop shares before we get going, because of course it has hit a wall over at GameStop here. Of course, a beloved stock for the meme stock traders have now seen a decline of the day from around 10%. This is all as as Ryan Cohen, the CEO, has been speaking to investors at that annual shareholder meeting. Of course, you are seeing those shares decline further since he began speaking. Now, I'm Shanali Basak. That does it for Bloomberg Markets on the day. Broadly, you have an up arrow market on the day here, and of course, an interesting bond market ahead with a ton of Fed speak this week. Stick with us through the close and through Balance of Power. A lot more Bloomberg for you ahead. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg.
1 minute remaining to expect this text release from Fed Tarka. We're also seeing reports that US and UK forces launched strikes on Yemen's Hodeidah and Cameron Islands. The Houthi-run Al-Nasara TV says.
Israel announces a daily pause in fighting to allow more aid into Gaza. Welcome to the fastest show in politics with an important development in lieu of a ceasefire between Israel and Hamas. I'm Joe Matthew.
So less than 10 seconds to this text release from Fed Tarka now.
This news arrives as Benjamin Netanyahu dissolves his war cabinet.
Yeah, which perhaps is more of a symbolic move than anything else, because you had two members leaving the war cabinet in recent weeks.
As I've seen comments come through from Fed Tarka in this text release then, says that monetary policy remains positioned in restrictive territory. It says keeping rates where they are for a little bit longer will help get inflation down and mitigate upside risks. Over the ensuing months, I will continue to closely monitor data on inflation, labor markets, and economic activity. Harker says more data is essential to come to a decision on rates, given the choppiness so far this year. 2 cuts or none, also quite possible. It depends on the data, Harker says. If my economic forecasts play out, I think 1 rate cut would be appropriate by the year's end, says Fed Tarka. Says I still forecast slowing but above trend growth, modest rise in unemployment rates, and a long glide back to 2% inflation. Says that last week's CPI data was very welcome, but overall progress on inflation in recent months has been modest. Long-term stubbornness on shelter inflation remains a concern, as does service sector inflation. The latest latest inflation data has been quite promising, but falls short of the confidence needed. Has not quite dissipated, uncertainly.
Federal Reserve speakers for clues about the interest rate outlook. And speaking of those speakers, Federal Reserve Bank of Philadelphia President Patrick Harker says he sees one rate cut as appropriate for this year based on his current forecast, enforcing the message that higher interest rates are likely to persist. Right now we got the 10-year 4.27% with a 2-year yielding 4.74%. Gold trading lower now, down 0.7%, 23.16 the ounce. And West Texas Intermediate crude up 1.7%, 79.75 for a barrel of WTI. Activist investor Starboard Value says it has built a stake in Autodesk valued at more than $500 million and plans to push for changes. Autodesk shares, they're surging now by 6.7%. Again, recapping, stocks are higher with the S&P up 29, up 0.5%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, here they are, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet up in New York, thank you so much. Kicking off the trading week for us. Meanwhile, Joe, we kick off this week in geopolitical news with a series of developments in regard to Israel. As we've mentioned, Netanyahu has dissolved his war cabinet. They also have decided to pursue some tactical pauses to allow humanitarian aid into Gaza. And interesting, after we just saw Antony Blinken, the Secretary of State, completing his 8th trip to the Middle East since October 7th, a new envoy is now in the Middle East, Amos Hochstein, who, of course, is frequently here on Bloomberg TV and radio to talk about energy policy.
Yeah, interesting that one of the president's closest energy advisors, the most recent to get the call, to basically leverage the relationships he has in the region. He may not be the Secretary of State, but he seems to be the man of the moment. CIA Director Bill Burns has fallen into that role more than once, and this really brings us more to the idea of avoiding a new front to the north in a war with Hezbollah, which is something that Amos Hochstein is there talking about. And Courtney McBride is here talking with us from Bloomberg's national security team. Courtney, of course, covers the State Department, the administration, geopolitics, and diplomacy for us. It's great to see you back at the table here. Amos Hochstein, rising to the surface here. What can he unlock for this administration?
Absolutely. Well, thank you both for having me here today. Amos Hochstein is really trying to leverage, as you said, those relationships to prevent another full front in the war from opening to the north between Israel and Lebanon. And really, he's able to speak with leaders in both places to try to cool tensions and continue the ongoing efforts by the administration to keep the war from spreading even further into a full-scale regional conflagration.
It's pretty stunning, Courtney, that obviously a lot of us have spent so much time in recent weeks trying to dissect and calculate the odds of some kind of temporary ceasefire being reached between Israel and Hamas to essentially stop the fighting in Gaza. All the while, it seems that others were focused pretty intensely on making sure that it doesn't cross other borders, like with Lebanon. Is there a feeling that it is more at risk of happening now in this moment than at any other time since this conflict began?
I don't know that I would say that necessarily, but there have been periods where the risk is assessed to be greater of an escalation. And, as you said, the ceasefire conversations are ongoing, but perhaps stalled. And in the interim, you do have this unilateral pause by Israel to allow for greater delivery of humanitarian assistance.
So talk to us about this 8 a.m. to 7 p.m., a tactical pause that comes in lieu of a ceasefire. What has brought Benjamin Netanyahu to this point, and could this tactically expand into something bigger?
There's always the possibility and the hope, certainly from the Biden administration, that we do still see a ceasefire that is a mutually agreed end to hostilities. But this is an entirely separate issue. This is not something negotiated with Hamas. In fact, Hamas leadership claimed that they were left out of the conversation. But this is something that the Israeli government has determined that it can do and needs to do to allow more aid to flow.
Are they acknowledging these reports of famine on an official level by doing this?
I don't know that they're doing that necessarily, but the IDF is assessing that there is an opportunity to pause their operations, which are perhaps winding down at that heightened level in the Rafah area as well.
So when we think about the Israeli government and the composition of it right now, how significant is it, Courtney, that the war cabinet has been dissolved? Is that more symbolic than anything else, or is that actually likely to change the trajectory of Israel's conduct in this conflict moving forward?
I don't know that we can necessarily predict how this is going to affect the conduct of the war by the Israeli government, but it certainly is a massive shift. Over the last several months, this is the organization, this is the group that has run the war effort, and it's no secret that it's been composed of individuals who are often politically at odds.
Getting back to where we started with Antony Blinken, is he planning a 9th trip? How's the administration taking this?
Well, that's not necessarily something that I'm ever told, but but
based on the way you've seen them work, though, this is something that's just going to be a rolling visit, it seems like, from him.
I mean, they tend to travel when there's an opportunity to meet with interlocutors who may be able to push things forward. Yeah. So if whether it's ceasefire negotiations, hostage releases, if there is something that can perhaps be achieved, that's usually when we're on a plane to distant places.
Yeah, fascinating.
Well, I wonder if in the month of July, the need to go to the Middle East perhaps is superseded by Netanyahu's own visit to the U.S. as he's scheduled to address a joint session of Congress. And perhaps that presents another opportunity to meet.
That's going to be an interesting moment. We've talked to a lot of lawmakers, and to be clear, Democratic lawmakers who said they're either struggling with this or they might not attend that speech to Congress. That's a big deal, though, for Benjamin Netanyahu. Can the administration use that as a point of leverage to get something else here?
They're certainly, I think, going to seize the opportunity to speak with Prime Minister Netanyahu when he is in town. But what they attempt to achieve is anyone's guess.
All right, Courtney McBride, playing the guessing game with us here on Balance of Power.
She knows the answer to all of these. It's just a question of whether she wants to tell us.
Just hedging. Courtney, we appreciate it. She reports on national security for us here at Bloomberg. We want to add a new voice to this conversation as well now and turn to Kelly Grieco. She is Stimson Center Senior Fellow with the Reimagining U.S. Grand Strategy Program. Welcome back to Balance of Power, Kelly. Always great to have you. If we could first begin with these 11-hour tactical pauses that Israel is now putting into place, trying to get that humanitarian aid in. How do you read into that tactical decision and whether it's one that could ultimately expand beyond 11-hour windows of time?
Well, first of all, thank you for having me. Yes, so I think, there are a couple things here. One is that there is a tempo to operations, and Israel has been engaged in some very intense operations, and you can't really sustain that momentum long term. And so this may be a natural time when it's regrouping, and so it allows for this kind of pause anyway. So I think that's one. But the second thing I think is I can't imagine this sort of converting itself into a long-term ceasefire because Israel wants to obtain hostages. It wants to rescue hostages in any kind of deal with Hamas. And so giving away this ceasefire for free in some sense doesn't really serve Israel's interests.
Why haven't we seen more raids then, Kelly? We talked about one involving 4 hostages who were rescued at the expense, according to Hamas, of more than 250 Palestinians during that raid. Are we going to see more activity like that, or do they simply not know where the hostages are?
Yeah, I mean, I think this has been an intense debate about this exact issue, which is, one, it is an intelligence challenge, of course, of knowing where they're located and being able to safely do this, meaning that you don't kill the hostages in the process. So that is certainly a challenge. And then the second part is there's been suggestions, it's very contentious inside Israel, of whether the government is really prioritizing the rescue of hostages, or if it's more focused on really combating Hamas itself. And that, of course, has been a real source of contention within Israeli society.
Well, and now it seems there is an open question, Kelly, about not just going to bat against Hamas, but Hezbollah as well. We were just talking about Amos Hochstein from the administration in the region now, trying to make sure that things don't escalate on the northern border with Lebanon. How concerned would you be in this moment about another front opening up?
Yes, I mean, I think this is very concerning. What we're seeing is this slow-moving escalation since October 7th. And in a way, because it's so slow-moving, you can sort of almost fool yourself into thinking it won't happen. But what we're seeing is that a series of sort of escalating attacks in scale and in terms of intensity over especially the last couple weeks. And so I don't think either side necessarily wants to get into a full-scale war, but we're in a really, I think, dangerous period where neither side
Fitch
may
Ratings
consciously
says
start a war,
world
but
growth
could
to slow in
inadvertently do so.
2025 despite
And
pivot to
certainly the
monetary
rhetoric
easing
on
this
both
year.
sides is very intense. And I think this mission by Hochstein is there in particular to try to tell the Israelis to not, consider launching some kind of limited ground invasion into Lebanon. This certainly, if that were to happen, would create a lot of problems for the United States, in particular in terms of being able to support the Israelis, even in terms of weapons and equipment.
Yeah. Well, that's my question here. To what extent would that further complicate U.S. relations with Iran? Would that put the U.S. in a more precarious position than it is with Hamas?
Yes, I think that is absolutely right. I mean, the relationship between Hamas and Iran is not as close as the relationship between Iran and Hezbollah. And so I think the possibility of Iran intervening far more directly, if there was an intervention between Israel into Lebanon, is far more likely. Iran has certainly signaled that it's far more likely to take action if there was a war between Israel and Hezbollah. And so I think, we're trying to avoid a regional conflict. And so that danger becomes far more heightened if we actually see this war be taken to Lebanon. And that's something we've been trying so actively to avoid. And the United States, really, the kinds of trade-offs would become so acute for the United States. We're trying to support a war in Ukraine. We have, significant concerns in the Indo-Pacific. And if this becomes a regional conflict, trying to do all of this is frankly not possible to support all of these allies and partners. And it would really create really acute trade-offs very quickly.
Yeah, it's an
Fitch
excellent
Ratings
point,
says
Kelly. There
global
are so
monetary
many hot
policy
conflicts that
cycle
the
is entering a
US
new
is paying
phase in
acute
which
attention
rates
to
will
right
be
now,
falling
including,
slowly,
as you
but
just
to levels
mentioned,
that will
Ukraine. And I would
still
like to
be
ask you
restricting demand.
about Vladimir Putin's trip to North Korea this week. The first time he has gone there since the year 2000. Of course, there's been a lot of reporting of suspicions that Kim Jong-un's regime has been sending missiles to Russia to allow it to continue its war in Ukraine. How do you view this visit and the relationship between these two leaders?
Yes, well, I mean, this is a marriage of convenience. Putin has turned to Kim Jong-un to be able to get, old stockpiles that the North Koreans have of lots of artillery, including, it seems, some short-range ballistic missiles. And these are systems that are compatible with old Soviet equipment. What this has allowed for the Russians is essentially to use these sort of millions of artillery rounds that have been provided to sustain them while they're building up their own industrial production. And in exchange, this has been a good deal for Kim. He's gotten lots of economic aid, it seems, some technology around space satellites, and including apparently a luxury limousine has been sent to Kim as well. And it's certainly, it's increased his image on the international stage.
Fascinating.
And Fitch says the US is slowing, but only gradually, and our 2024 growth forecast is unchanged at 2.1%.
Vladimir Putin try to get all of this initially from Beijing?
Yes, that's exactly right. And I think it's worth noting that the quality of this is in question from what we know on the battlefield, but that certainly provides some information for the North Koreans. And from what we know, the Chinese are not particularly happy about this relationship. There was some reporting suggesting that the Chinese explicitly asked Putin not to go directly from their May visit when Putin went to Beijing.
Shortly expecting the results of the Fed reverse repo operation.
Looking like the new axis of evil in the West. They would like to create some distance. And I don't think it's an accident that Putin is visiting North Korea and then he's visiting Vietnam, again, to sort of maybe create a little bit of distance so that it doesn't look as though there's some anti-Western bloc forming. Whether that will be successful is another matter. But this creates some headaches for Beijing.
Of course, Kelly, all of this is coming in the aftermath of the G7 in Italy last week, in which we saw not only the countries agreeing to use frozen Russian assets to provide a $50 billion
66
loan
counterparties
to
take
Ukraine, but the signing of this 10-year
$333.429 billion at
between
the
the
Fed
US
reverse
and Ukraine.
repo
How
operation.
significant is that really if it's not an enforceable treaty?
Yeah, you said exactly the right thing, which is it's not an enforceable treaty. So it's largely symbolic, in my opinion. It's symbolic
And
politics,
Fitch
and that's about
raised
it.
2024 world growth
If this was
forecasts
something
as
that was
domestic
to go to
demand in
Congress
emerging
and be
markets,
a treaty, that
excluding
would be a
China,
different
shows
matter.
stronger
But any
momentum.
president could come in and overturn it. So symbolic politics.
Well, we're going into an interesting time, as we've been discussing, Kelly, politically speaking here. The next month will walk us up to the Republican convention. We're going to have a number of important things that take place in the midst of it, including a presidential debate. To what extent are the stories we're talking about, Israel and Ukraine,
And Fitch says we expect growth in China to fall to 4.5% in 2025 as exports and government spending decelerate.
I always think that the economy is the most important thing first, but I do think this is actually an election year where foreign policy will matter quite a bit because it's taking up so many headlines in the news on a regular basis. And because the contrast is so stark. And Biden has used so much of his presidency to create this contrast, really emphasizing his relationships with allies and partners. And he's going to want to feature that. And I think Trump will want to feature his different approach, which is saying that he thinks, that the United States is being taken for a ride and is doing too much in the world. And that there is a real important debate that the two candidates can have on these issues.
I suspect you'll hear something about endless wars. Kelly Grieco, thank you for being with us, as always, Senior Fellow at the Reimagining U.S. Grand Strategy Program at the Stimson Center, with us on Balance of Power, the Monday edition. I'm Joe Matthew alongside Kaylee Lyons. 1 month to the Republican National Convention. It's kind of crazy to think about. We have less than 2 weeks to the debate.
Yep, next Thursday. Of course, it's this Thursday that Joe Biden's going to make his way to Camp David to start preparations.
Yep.
Unclear what kind of preparations Trump and his campaign are doing, but we're all just counting down the days until those two share a stage in the swing state of Georgia.
Said it. Absolutely. In the meantime, the Biden campaign is deploying some money. A big ad buy we'll talk about next with our panel. Rick and Jeannie are with us on the Monday edition of Balance of Power on Bloomberg TV and radio.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time. Hosts Joe Matthew and Kaylee Lyons deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything. Names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything. The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
It's 121 on Wall Street. We do check markets all day long at Bloomberg. We've got stocks pushing higher. Best level of the day right now on the S&P 500 index at 5,469, on track for a record close there. We've got the S&P up 37 right now, a gain of about 0.7%. Dow Jones Industrial Average up 117, now higher by 0.3%, while NASDAQ is up 148, up 0.8%. NASDAQ 100 index, full of those big tech names, doing a little bit better, up now by 1%. And now the Russell 2000 index of small cap shares is up by 0.4%. 10-year yield at 4.27%, with a 2-year that's yielding 4.7%.
And Fitch say we maintain our view that natural gas markets will remain fairly tight in 2024 and 2025.
Texas Intermediate crude up 1.7%, 79.76 for a barrel of WTI. Federal Reserve Bank of Philadelphia President Patrick Harker says he sees one interest rate cut as appropriate for this year based on his current forecast, underscoring the message that high rates are likely to persist. And a source tells Bloomberg Tesla has been granted approval to test its advanced driver assistance system on some Shanghai streets, the next step in rolling out the feature to Chinese drivers. Tesla up now by 5.2%. Bottom line here, stocks ripping higher on this back-to-work Monday. S&P now up 38, up 0.7%. We are on track for another record close. I'm Charlie Pellet. That's a Bloomberg Business Flash. Balance of Power continues now. And once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet up in New York, thank you so much. I'm Kaylee Lines alongside Joe Matthew here in Washington, where we are counting down the days to June 27th. The first presidential debate between Joe Biden and Donald Trump set to take place in Atlanta next Tuesday. And between now and then, voters, especially in swing states, are going to be seeing a new ad from President Biden setting the stage for the debate that specifically focuses on Donald Trump's record in court and his recent 34 convictions on felony counts of falsifying business records. This is a $50 million ad buy. And here is a little clip.
This election is between a convicted criminal who's only out for himself and a president who's fighting for your family.
The ad, Joe, is titled Character Matters.
Yeah, that's the race there, I guess, in the eyes of the Biden campaign. It's between a convicted criminal out for himself or this president who is fighting for families. $50 million is a good chunk of cash, and it's where we start our conversation with our signature panel. Jeannie Shanzano and Rick Davis are with us, Bloomberg Politics contributors. There have been a lot of questions, Jeannie, about when Joe Biden was going to put the money to work. This is the most recent example. This approach, character matters. Matters to whom?
They want it to matter to voters in these swing states. And I think the key here is the tagline that we keep hearing, only out for himself. The reality is we heard that from Jill Biden, the first lady, at the big fundraiser over the weekend. And we've heard it from the campaign managers. Donald Trump, is only out for himself. The conviction is making him, you know, even more animated and energized to get back in office so he can, you know, try to pardon himself, which he can't from a state trial. But the reality is they want to make this case on everything from the convictions to the economy, that this is all about Trump and his billionaire friends. So I think it's something we're going to hear a lot in the coming weeks.
Well, Donald Trump may be a billionaire, Rick, but we've been talking this entire cycle thus far about his cash disadvantage when it comes to the Biden campaign. He had a really big month of May, though. We still haven't gotten May figures from Biden. We know he raised $30 million in Hollywood just this weekend with George Clooney and Barack Obama beside him. But a $50 million ad buy is a pretty big chunk of the war chest. Is that a wise financial decision?
You know, I think it's questionable. Clearly, running ads in the summer is less effective than husbanding your resources and running them in the fall. It's pretty clear that voters tune in September when trees start to change and people start thinking about the election. That being said, I think the Biden campaign is rightly concerned about their standing in the polls. They're rightly concerned about the positioning that the candidate is in, which is generally been trailing Donald Trump for the last 6 months. And I think they're trying to do something about it, especially before all the attention on the debates and the conventions. And so, long story short, yeah, I think he's going to roll the dice. He's going to spend $50 million. I think they think money's not going to be the issue in closing this campaign. And, you know, they got to do what they can to try and get the candidate back in a better position, which in this case means driving negatives up on Donald Trump. This ad's not going to help Joe Biden get more popular, but it may help drive Donald Trump down to be less popular than Joe Biden.
Huh. And to that end, new numbers today from Ipsos and Politico magazine. Interesting.
Fed's Harker says it's fine to keep rates where they are now and wait for data.
Trump's conviction, but not enough to really understand a trend if there is one. In this case, 21% of independents said the conviction made them less likely to support Donald Trump. So is this campaign just about reminding them this happened?
It is partly about that. And yeah, the idea that they're finding in this poll that his conviction, despite the big amount of money they've raised off of it, could be a liability when people go to the polls is, you know, what we're beginning to see in some of this polls. I don't think this is something we can take to the bank, so to speak, at this point, because we've also seen some numbers suggesting Donald Trump is doing better after the conviction. But this is a fairly hopeful, if you will, sign for the Biden team that they should keep talking about the idea of a convicted felon serving as president being something that most voters will not, or many voters in the independent lane will not countenance. And the other interesting thing I think we should pay attention to is Donald Trump losing support amongst 65 plus. His numbers amongst seniors are down. A Republican has not lost 65 plus since before 2000. So the idea that his numbers are down there even a little bit and in swing states, that's a big problem for Donald Trump and a big win for Joe Biden. So there have been some of these positive signs, mildly positive, I would say, in the polling numbers we're seeing in the last few weeks.
Rick, what's your take on these figures? As mentioned, 21% of independents said the conviction is important to how they will vote, and it means they are less likely to support Trump. Perhaps not surprisingly, 40% of Democrats had that answer. Only 7% of Republicans, the total being 22%. But when we're talking about such a small portion of the electorate that is likely to decide the outcome, Rick, are those numbers enough?
It just depends on which state. I would say in states like the blue wall states of Michigan, Pennsylvania, and Wisconsin, where the numbers have been in a dead heat, you're looking for sort of what positives you can find. This is a positive, right? This could be 25,000, 100,000 people per state who might be less likely to vote. I think part of what this poll also told us, the Ipsos poll asks you, and is this a very important item? Because we know a lot of people would be less likely to vote if they knew the candidate you were running against was a criminal. But does that really make a big difference to them in their decision? And a substantial number, almost 20%, said yes. So that is really interesting to me that someone would actually decide the outcome of their vote on this conviction. So I think in those states, it's critically important. In states where they've migrated to a difference between each other, it's just on the margins at that stage. But right now, I don't think you can really rely on anybody's polls but the candidates. And clearly, Biden took a poll and tested this and said it's worth investing $50 million behind a message because they see it helping them.
Rick, I wonder your thoughts on the optics over the weekend. Donald Trump in Detroit asking black voters for their support. Joe Biden out west in California sharing a stage with the glitterati. He was there with Barack Obama, Jimmy Kimmel on stage. Julia Roberts was there, George Clooney. As the man behind the famous celebrity ad that John McCain ran against Barack Obama, do you see an opening here?
You know, look, I think they're just chasing the changes in the electorate. I mean, we've been talking about Joe Biden's electorate now being older, whiter, more educated, more likely to be influenced by Hollywood than Donald Trump's, who is more working class, lacks college education, and frankly more multicultural. I mean, he is picking up especially young black males into his coalition. He could wind up receiving 20% of that vote in the election, which would be a really amazing historical level for a Republican candidate. And so it has as much to do with education as it does with color. It has as much to do with location, living outside of cities versus in them. And so I think this was a perfect weekend. It shows you really how the parties have become restructured to the point where it's starting to show up in the things that they do and the contrasts they make. Hollywood versus, you know, a black church in the Midwest.
Well, and with this Hollywood event, as we mentioned, about $30 million was raised by the Biden campaign. Jeannie, the FEC deadline to put in fundraising data for the month of May is later this week. We already heard from the Trump campaign several weeks ago, $141 million raised in May, in large part off the back of his guilty verdict. Does it concern you that we haven't heard anything from the Biden campaign yet? We might not until they actually are forced to by that deadline?
Yeah, I think that we're waiting to see. I mean, it would be really tough to match what the Trump campaign was able to do. Those were big numbers. That said, the 28 million over the weekend was historic on the Democratic side. And I think also important about that event, putting the celebrities aside, was the message that Joe Biden was able to get out, which is a warning about the impact on the court if Donald Trump wins, which is likely two more appointees who are going to solidify a conservative majority, likely to take away key freedoms and rights until your grandkids and great-grandkids potentially are adults. I mean, this is a really important message that they're underscoring, and I think we're going to hear more about that. So the celebrities were fascinating, but the message is critical, and they've got to use this money they're raising to get that message out. Democrats don't traditionally vote on the court, but given we're at the 2-year anniversary of Dobbs, that's what we've seen happening in the last 24 months.
All right, Jeannie Shanzano and Rick Davis, our Bloomberg Politics contributors, kicking things off for us on this Monday. Thank you so much. Now let's get a quick check on other world and national news. Amy Morris has that for us in the 99.1 Newsroom here in Washington. Hey, Amy.
Hi, Kaylee. The declining flow of humanitarian aid in southern Gaza has left more than 1 million Palestinians languishing in tent camps, open sewage in the streets, and from the period of May 6th through June 6th, the UN received an average of 68 trucks of aid a day, and that's down from 168 a day in April. IDF spokesman Daniel Hagari says the blame lies with Hamas for the reduced flow, and he accuses them of looting.
How do we distribute the food without Hamas in the game, taking the food, looting the food, using the food for his military operatives?
IDF spokesman Daniel Hagari says you can expect their presence at that crossing. NATO says a record of more than 20 allies are expected to hit the alliance's target for defense spending this year. NATO Secretary General Jens Stoltenberg announced that figure during a talk at the Wilson Center in Washington,
Fed's
D.C.
Harker says we're not even close to material deterioration in the job market.
In the ranks of the 32 NATO member nations, meeting the alliance's defense spending guideline. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
US stocks extend gains, NASDAQ up 1%.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very
Harker says globally rates are heading down, just at a different pace.
But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line.
So Fed's powers to give the semi-annual monetary policy testimony at the Senate Banking Committee on July 9th.
You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks pushing higher, and once again, best level of the day right now on the S&P, up 45, now at 54.76. That would be a gain of 0.8%. S&P, by the way, racing toward its 30th record of 2024. The Dow up 150, now up by 0.4%. NASDAQ Composite Index up 189, a gain of 1.1%. Several big techs are climbing despite a jump in Treasury yields. We got the 10-year 4.27% and the 2-year 4.75%. Spot gold slumping 0.7%. Gold down $17 the ounce to $23.16, while West Texas Intermediate crude oil is up 1.8%, $79.86 now for a barrel of WTI, closing in on $80 a barrel. The Food and Drug Administration has delayed a breast and lung cancer trial of an experimental treatment that BioNTech licensed from Chinese biotech Metalink Therapeutics, citing safety concerns. Right now, we have got BioNTech shares trading lower. On an update for the rest of the market, BioNTech down now by 4.9%. Again, recapping, stocks higher. S&P up 45, a gain of 0.8%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet. Charlie, do you have Alexa in your house? You ask Alexa questions, or does Alexa spy on you from time to time?
I do not, but even better than that, my wife has me in the house. She asks questions, and I don't always know the
Okay.
answer, so.
Well, I bet you do more often than Alexa sometimes. I always love asking or talking about Alexa on the air because everyone lets me know when they start talking back in their house because the show is on. Hey, Alexa. Sorry, I had to. The Washington Post had questions, Kaylee Lyons, for Alexa when it came to politics. And I've never talked to Alexa about politics before. I don't know if you have, no? And couldn't figure out who won the 2020 election by asking Alexa.
Yeah, and this is not an Alexa unique problem. They also asked a number of chatbots, including chatbots built by Microsoft and Google. Google's Gemini, when asked who won the 2020 election, said, "I'm still learning how to answer this question. In the meantime, try Google search." Microsoft's Copilot's answer, "Looks like I can't respond to this topic.
Yeah.
Explore Bing's search results."
So they still kick you back to Bing? Doesn't that defeat the purpose?
Yeah, I guess go figure out for yourself who you think won.
Right.
For the record, Joe Biden did win the 2020 election.
That's right.
We are now in the 2024 election cycle, and apparently AI still is not able to answer what happened the last go-around.
Yeah, forget predicting it.
Perhaps is a little bit concerning. So we figured we should bring in an AI expert to discuss how it's factoring into this election cycle, but also our geopolitical relationships as well. Gregory Allen is joining us here in our Washington, D.C. studio from the Center for Strategic and International Studies, where he is the director of the Wadhwani Center for AI and Advanced Technologies. Greg, welcome to Bloomberg. Thank you so much for joining us here in studio. We should be concerned about this, right? We are heading into another election. And AI still can't tell you accurately who won the last one. How is anybody supposed to be relying on it for information?
Well, in this case, you might want to blame people, not AI, because what you're describing in this story reflects a very conscious choice on the part of these companies for how they want to handle this. Now, think about the difference between an AI tool and a classical search engine. A classical search engine is serving you up results and saying, here's what other people have said on this topic relevant to the keywords that you just gave me. Whereas an AI is saying, I, ChatGPT, or I, Alexa, give you this answer. So there's a lot more of the company's brand at stake in answering that question. And some companies have made a conscious choice that they just prefer to not weigh in on this 2020 election issue, and they'd rather refer you to their search engine where other people can express their opinions.
But it also, doesn't that challenge the whole idea, as I've been hearing, that these search engines, they don't even matter anymore. Nobody's going to Google. I've got ChatGPT. I've got my Copilot. That's all I need. And I guess the answer is not so much.
So there's multiple theories for what the future of search looks like and what the future of AI looks like. If you're Microsoft, you've been integrating ChatGPT results with Bing really since the first weeks of the modern AI revolution, since the launch of ChatGPT. But it turns out that large language model results, like those of ChatGPT, are actually much more expensive to serve up than search engine results. So whereas returning a result for search engines might cost a tiny fraction of a penny, returning results for a large language model might cost like 9
As
or
Harker
10
says, we need to
cents,
be
which
cautious, and I want several more months of
billions
data.
of queries, those are really actually meaningful economics that the companies have to take into account. So right now, the search engine ecosystem and the large language model AI assistant ecosystem are existing side by side, with really more of the economic value, at least at present, still being delivered by classical search engines, which I should mention, if you open them up, they have a lot of AI. It's just older approaches to AI and machine learning rather than the more modern large language model approach.
But when we think specifically about how this is playing into this election cycle, it's not just about asking questions and getting answers. This AI can also be generative. It's creating images and videos, which you aren't automatically able to verify with the naked human eye as to whether or not it's accurate. How concerned should we be about the opportunity for deepfakes or just other disinformation to be circulating AI-powered on social media platforms?
This is something that I worried about a lot during my time in the Department of Defense. I was previously the Director of Strategy and Policy at the Joint Artificial Intelligence Center. And one of the challenges that the DoD was wrestling with was foreign intelligence agencies who were trying to put out fake information, sometimes aided by, computer-generated imagery tools, stuff that we know about from Photoshop, for example. And at the same time, the Internet Research Agency of Russia hired hundreds, at one point even more than 1,000 people to just go write and post disinformation online. The problem was those were native Russian speakers who made a lot of lousy grammatical mistakes, the type that you make when your first language is Russian and your English is pretty bad. What AI can do is it can solve some of those problems that Russian intelligence services had. Rather than needing people who are really good at Photoshop, it can just actually say, AI, please generate me images of the following, or AI, please 1,000 posts about why Joe Biden is a terrible president that would be suitable for all these platforms. So what you're seeing is the cost and complexity of executing certain types of disinformation attack might be going down. And in fact, we just saw that last month with OpenAI revealing that it had identified multiple foreign intelligence services were already using its platform to generate propaganda.
Boy, so it brings us, at least here in Washington, to the conversation about regulation, or lack thereof, so far. And it's something that Kaylee and I got into in a conversation last week with Steve Ballmer, of course, the former CEO of Microsoft. He's got something new called, or not so new at this point, called USA Facts, that seeks to educate people in a world of misinformation on how the government actually works. With that in mind, though, listen to his take on the potential impact of regulation.
I don't think regulation is our savior. Probably the right thing is to make sure the legislation is in place so that people who have been violated in some way, whether it's deep fakes or, child harassed through an AI, whatever, that they are clearly prosecutable. That, I think, we need legislation.
What's your take on the approach that Steve Ballmer just suggested and what we've seen already in terms of the infant stages of a conversation with Chuck Schumer, for instance, in the Senate?
Sure. So AI regulation is a really broad topic, and it gets to deepfakes and really every segment of the economy that anybody is thinking about.
What's the first thing we need to get our arms around?
I would say deepfakes is definitely the one that has the most momentum in Congress. There are several bills that have been introduced by Senator Amy Klobuchar, really looking at tackling multiple sides of the deepfake issue, both the election interference side that we were just talking about a moment ago, as well as child or sexual exploitation that we just heard Steve Ballmer talking about. And in terms of the prosecutable part, this really gets to liability law versus criminal law. And liability law is typically a state-by-state issue. This gets to who can sue whom and under what circumstances. But then you think about what is actually illegal. You ask the question, who's really at fault here? Is it the folks who create the tools that are then misused, or is it the people who are misusing those tools? And you have to come up with standards around what might constitute negligence, what might constitute willful knowledge and intent for malicious conduct. Those are all really thorny questions, the one that Congress is wrestling with right now.
Well, really fascinating. I hope this is the start of a conversation with you. Come back and talk to us soon, because these stories are...
This is not slowing down. Congress is continuing to generate plenty of
right?
useful stories on
That's
this
why
topic.
he's director of the Wadhwani Center for AI and Advanced Technologies at the Center for Strategic and International Studies, CSIS. Gregory Allen, great conversation. Thanks for being with us today on Balance of Power. Once you start to scratch the surface, Kaylee, you realize just how deep this goes.
Yeah, and how little time we may actually have to sort this out. Just on election dis and misinformation. The election's in November. And are you going to be able to get your arms around policing that within the less than 5-month window you have? Seems like a tall order.
It's a tall order, and it might be more about lessons learned for 2028, because this stuff, to Gregory's point, is not slowing down anytime soon. You know, tomorrow's another primary day. Speaking of elections,
yes,
we're looking at Oklahoma and right across the river to your native state of Virginia.
Yep, go Virginia always, but it's going to be a really interesting race. Congressman Bob Good, the incumbent in this scenario, the chair of the House Freedom Caucus, one of the 8 who ousted former Speaker Kevin McCarthy last year, is in a primary with John McGuire, who has been endorsed by Donald Trump. And when Donald Trump was on the Hill last week in a room full of congressional Republicans, he also talked about doing telethons, I believe, for those candidates that he endorsed. Bob Good not being one. It probably got a little awkward.
I bet it
in the
did.
room at that point.
This is really interesting. Jack Fitzpatrick tends to join us to talk about Congress. He's Bloomberg Government's Congress reporter, but also is looking at the elections here to get a better sense of who he's going to be covering next, having spent a lot of time covering the Freedom Caucus and Bob Good. Jack, it's great to see you. We haven't had a chance to catch up in a bit. What has your attention here in terms of the future of the Freedom Caucus and Donald Trump drawing some interesting lines?
Yeah, the Bob Good race is very interesting. I think that's an interesting divide between the true conservatives and the Trump-aligned conservatives. A lot of the Freedom Caucus aligned itself with Trump, and at times aligned itself with Republican leadership. Good is the exception. So this is a test of, can you be the very limited government sort of rebel conservative against Trump's Republican Party and survive? I don't make predictions, but I think there's a lot to learn from this in terms of the identity of the Freedom Caucus going forward.
Well, and what's interesting, it's not just Donald Trump that has endorsed his opponent, but Main Street Republicans have done so as well. So there's a lot at play there. But as Joe mentioned, it's not just Virginia we're paying attention to tomorrow. Oklahoma has a primary as well. And the appropriations chair of the House, Tom Cole, is facing a primary. You, of course, spend a lot of your time looking at appropriations. Is the chair in danger?
It is looking competitive. He has said it looks competitive. There's been about $5 million in spending against him. I spoke to the candidate challenging him, Paul Bondar, who is putting up a lot of his own money. I think the edge goes to Tom Cole, who's very well known in that district. Bondar just moved to Oklahoma. It is definitely challenging to take on the appropriations chair. But as the spending has evened out, I have to think it is an edge for Cole, but the $5 million against him makes it very interesting.
Boy, it sure does. Kaylee, we've got these 2 states that we're looking at with some pretty familiar names, and the mainstreaming, I think, to your point, of Donald Trump, the Freedom Caucus, the Republican Main Street Partnership. We talked to Sarah Chamberlain here. All of these interests colliding in Virginia, which is fascinating. I think we still call this a purple state. Is that fair? Jack, is Virginia purple?
Virginia itself is purple. An individual race can be very difficult to keep your finger on the pulse. That has happened with some fascinating conservatives over the years. Eric Cantor was somebody who went against the grain in 2014, was a very conservative member who then faced an increasingly purple district.